Downs, and I would say, folks, more disappointments than optimism in terms of results.
I hear it's like the Delhi weather.
Muggy. More disappointments, yes.
Yeah, I mean, Axis, the complete howler. Wipro, I think, relatively okay.
Better, yeah.
Better.
Actually, IT is probably okay. I mean, LTM was stable, Wipro was okay, LTTS, which came out yesterday, was...
People didn't like TechM at all.
TechM, yes.
TechM had a tough day.
Saying, since all the bad news is out, can these now usher in some good news for a sector which is now seen getting pit out for the last few days? So
for IT maybe, but I think for private banks it's still the most, I don't know if it's the worst or the best, but the most is yet to come with big numbers over the weekend.
It bears speaking about quite a bit, because I was speaking to Harsh just before we started, and that whole concept of technical write-off, apparently analysts spent 45 minutes trying to understand it from the management.
Yeah, so a lot that we're going to break down today on the numbers, on the key factors that are going to determine the day today, and an exclusive coming up analyzing the kind of volatility we saw yesterday on expiry day in the last 40 minutes to 1 hour of trade. That was truly astonishing, and some of you would have seen on the intraday chart the way the Nifty took a dive in the last bit of trade. So now what really is behind that is something that we're breaking down for you today. Look at that on that chart. So you ended nearly 0.5% down, and there was a reason for that. Was there manipulation? We're going to be bringing you that story exclusively. But let's start with the global setup this morning. So it was a winning day on Wall Street as the S&P 500 closed at a record high. So you had a solid kind of a day, not major gains, but all in the green. So good results from PepsiCo, United Airlines, even Netflix after market hours has bolstered sentiment. The banks that reported a few days ago have also been good, whether it's JP Morgan or many others. Jobless claims have come in at 221,000, down 7,000 from the last reading. Monthly retail sales in the United States for the month of June are up 0.6%, much better than estimates of 0.2%. So you've got economic cues that are looking good. The 10-year has settled at 4.4% on the back of that economic data. Oil prices did rise a bit on inventory worries. Brent was above the $69 mark. Asia has been pretty mixed on opening, and you're seeing that play out right now as well. Nikkei in the red, but Hang Seng and Shanghai doing okay. The implied open for India continues to be just, I say, completely flat, and this is what we've seen for the last many days. But let me get across to Taimur Beg, Managing Director and Chief Economist at DBS Bank. Taimur, absolute pleasure speaking with you this morning. Good morning. Great as always to have you on. Let's start with all things trade wars. And your take on what's happening so far. The last we heard, there is still a deal in the making between India and the United States. But for many countries around the world, they're either waiting for letters or wondering what to do with the letters they've received.
I think this will be the state of affairs as long as Trump is around. I don't think there'll ever be an end game with any country on trade-related matters. Donald Trump has been very transparent in his writings over the last 40 years, even since the mid-'80s, that this is a tool that countries should use as a way to gain market access, use as leverage, because the U.S. market is so big, nobody can live without trading with the U.S., and therefore they will do whatever the U.S. wants. So this exercise of power does not end with a trade deal, a document, and a set of signatures. It continues on and on and on. We may think today we have a great deal with the U.S. 3 months from now, Trump will reserve the right to change his mind and lower or increase or anything for that matter. So trade-related uncertainty will weigh in on investment sentiment in particular. Consumption, as you have just alluded to earlier, that it can remain resilient if the overall macro environment is fine. But if I'm going to expand my production footprint in the US or somewhere else in the world with the US in mind, I would be mired in so much uncertainty that I will hesitate. And we're seeing that. I said in Singapore, I'm looking at corporates around me who are very much US focused and have US markets to worry about. They are dealing with day-to-day issues. They don't have the bandwidth to plan for the medium term. So the biggest upshot of all these chronic uncertainty is a paralysis of investment.
Paralysis of investment, yes, Taimur, but I just want to come back to the economic data that we're seeing so far, and even the first cut of corporate results in the United States, for example. And it seems like there isn't as much impact as was expected. It's quite contrarian to what you'd expect in the middle of all of this turbulence.
Yeah, wait and see. It's coming. We talked to U.S. corporates, and on the issue of hiring in particular, there is likely bad news down the road. U.S. job numbers are somewhat misleading because you need to sort of break it down into public sector hiring and private sector hiring. And although the first 6 months of this year have been characterized by a lot of noise around DOGE and the various firings that are going on at the federal level, at the state level, there's actually been an increase in hiring that is not sustainable. At the private sector level, the numbers are underwhelming. And my feeling, my call is that it will be even less underwhelming in the second half of this year. Both trade-related issues and, of course, tech-related disruption is another factor that's going to weigh in. Corporate earnings, as the tariffs become more tangible, not just the pauses, but actual tariffs that has to be paid at the customs level, it will start influencing corporate guidance in the next quarterly report or the reports to come. Corporations will guide some degree of negative impact on their bottom line from the large tariff that they have to pay.
Hi, morning, Alex here. I'm just wondering whether your life as an economist is more difficult now than it has been in past years, particularly because what you saw in the first quarter, inventories have completely changed the calculation for GDP, people pushing product into the US before tariffs come into play. And what you're saying, wait and watch, it sounds a little, or wait and see, it sounds a little ominous. I'm just wondering from the monetary policy standpoint as well, because of the pot shots that are being taken constantly and the desire seemingly from the White House to see a change at the head of the Fed. Does that occur in your opinion? Is that the key risk to monitor, because tariffs you can't predict?
I also cannot predict Donald Trump's decision making with respect to Jay Powell. Look, let's just talk about the inventory for 1 second before I come to the Fed decision. Hindsight is 2020. All economists can give you very clean and neat answers to the question, why did the U.S. do well in the first half of the year, when most of us were quite pessimistic within the quarters after reciprocal tariffs were announced that we would see worse numbers. Yeah, so now it makes sense. You know, people advanced a lot of orders, inventories have picked up, that'll be run down in the second half. That would probably lead to weakening of trade and weakening of orders. But for the year of 2025, probably we will not get a very bad number. All the discussion of recession completely out of the window. Now, with that in mind, and with the caveat that Jay Powell may or may not have his job in the coming months and weeks or going into the summer of 2026, what does the Fed do? I think room for rate cut will open up, regardless of the noise between Trump and the Fed. Regardless of who's the Fed chair, who's running the FOMC, there would be ample justification for some rate cuts in the second half of 2025. Growth is not accelerating. In fact, in certain aspects of the economy, you can see some degree of stagnation. Consumption is decent, not spectacularly strong. And on the hiring side, as I said, we will begin to see on the forward-looking indicators some degree of concern from the Fed side with respect to the labor market outlook. If inflation does not surprise substantially on the upside, and we're in the camp that it won't, between energy price and U.S. produced prices, things are actually pretty favorable, imported inflation notwithstanding. And therefore, there would be room to cut rates from where the Fed is now, which is arguably much higher than other G7 economies, and to bring down somewhat. So Fed's decision-making and reaction function, I think, can be looked at in isolation from the drama that is happening between the White House and the Fed chair.
Very interesting. So from that perspective, what we're seeing on the yields and the fact that they are relatively elevated is related to certain other uncertainties, and I'm guessing tariffs also come into play here. What do you anticipate the yields will settle at once some of this dust settles? And I can imagine, as you've pointed out, that dust is going to be swirling for some time. But then, and what happens, the follow-on to that is what happens to flows on account of those yields?
Right. And Alex, when we talk about yield curve, of course, we will discuss in the context of the US, but there are fascinating things happening with the yield curve around the world, including Japan. Now, on the US, how the yield curve is behaving at the belly versus the outer end itself is very interesting. The market seems to be comfortable buying some things in not in the 30-year duration, but somewhat earlier. And then, of course, there's question about what happens in the short end with Fed reaction function. The U.S. fiscal dynamics are onerous, no question about it. Trillions of dollars of interest payment, deficit, and all these uncertainty about how much the tax cuts that was passed through the one big beautiful bill would cost versus the offset that'll come from the tariff. All that is clouding the market's view on the Treasury market. And there are some structural issues related to the Treasury market, which the Fed has pointed out in its financial stability survey as recently as November of last year, which is that off the run bond market liquidity in the US is pretty worrisomely low. And therefore, the ability of the market to absorb a large amount of issuance on a sustainable basis is a very big question mark. Add to all of that the uncertainty about what the US Treasury and the Fed would do with an emboldened Trump firing governors here and forcing financial repression there. There is, I think, legitimate concern about the yield environment in the medium term. If these things were not there, we were just going on the merits of the macro, we probably should be seeing a shifting downward of the yield curve in anticipation of slower growth and lower inflation.
Taimur, good morning, Neeraj here. And I want to talk about India with you because I believe recently you've said that investors love India but are now getting impatient about GDP growth. But just before we get there, a word on Japan and the yields there, the possibility of higher rates. And the reason I ask this is the worry or the implication of a potential unwinding of a yen carry trade because of what happens to yields and currencies still very, very large in the second half of 2025?
So, Neeraj, as you know, that hedge fund managers, particularly American hedge fund managers, love to trade the yen futures. They love to play with the JGB because, it's a large liquid market outside the US where one can take very large positions. And that can then have outsized impact on local markets. Now, Japan in the last 6 months has seen substantial rise in yield without any disorderly market structure issues. I'm impressed with that. I thought by now we probably would see some accidents here and there, given the very large open positions financial investors have had on the JGB and the yen market. So far, so good as far as the systemic risk is concerned. But if you're looking at it from Japan's perspective, the chronically weak yen, one hand boosts the earning of Japanese exporters. On the other hand, the country is hugely reliant on imported energy and food. And that inflation rate for multiple years now is on the higher side, something that we never considered with the context of Japan for many, many years, if not decades. And that becomes a liability in the political side. So I think that managing that issue itself, somewhat higher than expected inflation, chronically weak yen, is a problem. Add to that the uncertainty around the political process, the steady weakening of LDP's hold on Japanese politics, and all the stuff associated with the trade war. So the Japanese policymakers don't have an easy ride these days. And informing all of this complexity is, of course, the ticking time bomb with respect to the massive 200% of GDP debt burden that they have. So Japan's case in some ways is a warning for other countries in the world who have seen their debt GDP ratio rise sharply in the aftermath of the global pandemic. Managing these things can be very, very problematic. Either you get a lot of deflation and zombification of the economy, or you get all these other complexities that I just alluded to.
No, but sorry, so is there a yen carry trade issue upon the world in the second half, Taimur?
Well, right now, from a cross-currency basis perspective, that attractiveness is no longer there. Okay. The way it was there in the first half of 2024 vis-a-vis the second half of 2025.
Got it. Okay. Taimur, one word on India, can't not talk about it. Now, you, for the last 6-9 months, I think you've been constructive India, and that's, because you look at equities as well, right? It's kind of paid off, if you will. India's maybe underperformed in the recovery phase, but otherwise done okay. Did you say that somewhere that global investors are getting a bit impatient with growth not coming back? And if growth does show up, GDP growth that is, you think flow of money, which is kind of been sideways, if you will, comes back into India with a bang?
Correct. So it's kind of interesting. So yes, you're right. We do look at the Indian markets on a cross-asset basis, and the equity market dynamic has been super interesting. At a time in 2023 when global investors were selling equities around the world, including India, Indian domestic investors themselves propped up the Indian market in a massive manner. And at that time, I started questioning whether the FII flows are even relevant for India, given the amount of domestic liquidity and domestic excitement we have with respect to the Indian market. On the 2024-25 dynamic, I began to see tremendous amount of dynamism on the private flows side. You talk to lawyers in Bombay and what they're seeing in terms of deal flows, M&As and FDI, just, extraordinary. But 2025 now is a bit of a sobering moment. private or public side, we don't see that much excitement, whether it's domestic sentiment or deal flows coming from the outside. So the lawyers that I talk to on the corporate side are not as busy as they used to be. So overall, I think there is a bit of a stock taking momentum, loss of momentum type dynamic in place as far as India's financial markets are concerned. I would not attribute all of that to impatience about GDP growth. I think some of the deals that I'm talking about and some of the IPOs that I've been seeing, they basically talk about India over the next 10 years. It's not about what happened in last quarter or where inflation is going or what RBI would do. It is about the medium-term potential. And that, in my view, remains very attractive for global investors, independent of the uncertainties we have with the trade war right now.
Perhaps it's a lull more than anything else.
Yes.
Thanks so much, Taimur, for joining us. Pleasure speaking with you and look forward to the next chat.
Take care.
All right, let's talk about what happened in trade yesterday. And by the way, we have to unpack this further. I'll just give you the headlines and we'll talk about why there might be some reason to look a little deeper into the move towards the second half or towards the end of the session. First, the flows data. And we were talking about, or Neeraj was pointing out, that the flows into India have been a little bit sideways. We've seen another day of selling to the extent of 3,700 crore rupees on a net basis by foreign institutions. Got about 2,820 crore rupees mopped up by domestic institutions. The Nifty 50 once again actually stayed within a pretty narrow band, 140 points through the session, but it saw choppiness and it slid towards the end of the session, and that's what we're going to speak about in more detail. The stocks that were underperforming in trade yesterday were the IT pack. You had Tech Mahindra, Infosys, HCL Tech, all that proved to be a drag. And only 19 stocks in the Nifty 50 actually gained ground. The broader markets managed to eke out gains about less than 0.1% for the mid-cap index and a little more for the small-cap index. And what were the sectors that actually did well? You had realty and the metal counters that stood out among the big gainers. And you had IT, which was one of the big losers, with the index down as much as 1.4%. I wonder, with some of the results that have come through, will that texture and tenor change in today's session? Defense stocks, by the way, continue to see profit taking, and that's understandable considering the kind of run that they have had in the recent past. That index is now down 9% from the high that it hit on the 6th of June. And by the way, the India VIX, notwithstanding that bit of choppiness that you saw in trade yesterday, remains pretty benign, pretty muted at 11.24. Neeraj?
Yeah. I mean, 15-month low for the India VIX, and that just shows, right? We were joking about it day before yesterday, that do we need to go to the wall? We don't, because the market is starting off flat every single day. 100%. And therefore the index will be range bound and stock specific action will continue. In fact, if you look at it, from September 2024 till now, the Nifty is at the same level. It's gone everywhere and come back to that level. We've still not eclipsed those highs as well. So, I mean, the index trades are virtually non-existent, if you will, except for sharp intraday swings. I wonder if Wipro, LTI, LTTS help IT recoup some of the lost ground. So that is one thing to watch out for. And well, I'm unhappy about the fact that my commentary was proven wrong, but I'm happy that the hotel companies have actually delivered not that bad a set of numbers. IT hotels in particular was okay, but Indian hotels wasn't terrible, if you will, on the top line front. So much as I thought that it will actually not look good, they've weathered the Q1 storm well, so we were wrong on that. But the one other point, guys, and I don't know if you guys noticed it or thought about it, but what's happened with Kalyan Jewellers in the last 3 or 4 days, or what's happened with the kind of upticks that people have given to cable companies like Polycab, right? Wow. Shows that the markets sometimes worry too much about the long term, but definitely reward the very short term, right? I mean, large competition, D-rate cable companies, Polycab at 4,800, KEI Industries down in the dumps or whatever you call it, to where today I saw Jeffrey's note saying Polycab target is 8,100 in a matter of less than 4 months, right? So it just shows that, oh, you attach so much of worry to what will happen in the long-term business cycle, but short term, just 1 quarter, and you suddenly swing and give a very high target price as well. So I mean, it's very, very interesting. And the same has happened with Kalyan, right?
Yeah.
So much of
But Polycab numbers were good.
Yeah. Fabulous.
There is basis for that kind of optimism.
Yeah. But the long-term worry might still stay, right? That, oh, is Adani Group coming in? And therefore, if they are coming in, does it derate the multiples? Yes. But short-term, I mean, 8,100 is the largest target price that we've seen on Polycab in a long time.
So if Taimur Beg can say wisdom of retrospect is flawless, I think we can stand and look back and say, okay, that was overdone.
Yeah.
Well, yeah, but it's very interesting what's happening there.
Yeah, no, but just on the point of rating agencies, I think that's a whole different conversation. And this is something that Samir Arora also pointed out yesterday in our chat with
Brokerages.
him, that brokerages will stick to their ratings sometimes just out of ego, because मैंने बोल दिया तो बोल दिया. So he made that point, and more, I think we need to look at those ratings with a little bit of circumspect. Look at Axis Bank, for example, today. A lot of brokerages, yes, they have mentioned their worries with the numbers, and we'll talk about that, but also maintaining either an outperform or keeping a buy on it, because that's where it lasts. So, I mean, only hindsight will tell us who is right at the end of it.
Yeah.
But I would say digest with care. Even brokerage ratings, don't take it as the gold standard for everything. We'll, of course, be reporting everything that comes to us in terms of information. So, yeah, earnings continue to be in focus. I think that's the big factor, save everything else. So, Hindustan Zinc, JSW Steel, Reliance Industries is the big one that will report after market hours. Watch out for that. India Mart, Intermesh, Indian Overseas Bank, L&T Finance, Mastech, some of those are on your screen. That will see earnings today. The Nifty 50 has faced selling pressure after a couple of positive sessions, and the Nifty really failed to sustain upward momentum, closed near the day's low. Index remained under selling pressure, indicating long unwinding. On the hourly chart, a consolidation breakout is visible, suggesting weakening bullish momentum. The sentiment appears bearish, 25,250 to 25,260. This continues to be the immediate and strong resistance level. 25,100. Nifty managed to close slightly above this, making it an immediate support. 25,000 is a crucial psychological level and a key support zone as well. For the Bank Nifty, resistance at 57,140, support at 56,770. So those are some of the factors to watch today. But let's get to the stocks. I'm going to start with Axis. It's a thumbs down. The GDR for Axis Bank, by the way, was down nearly 5% overnight. So you're seeing a bit of pain that you're going to see. So what's the pain point? Is the provisioning. It's a shocker. They have a technical write-off that they've taken out of quote-unquote prudence. And now it's taken some time for analysts to figure out what is this technical write-off and what is this new way of looking at this number. So even adjusted for technical write-offs, provisioning has elevated. There's a miss on the margin. It's expected to trend lower. Operating profit was a beat due to strong other income and lower OpEx. That's operating expenses. Here are the core numbers. Net interest income at 13,560 crores. That is up 1% year on year and down 2% quarter on quarter. Operating profit was at 11,515 crores, up 14% year on year, 7% quarter on quarter. Provisions at 3,948 crores versus 1,359, up 191% Q on Q. Now, remember this number because this is the pain point, and there's going to be a lot of time spent understanding what this was about. Provisions have been adjusted for technical write-offs, which stood at 3,127 crores. PAT was at 5,806 crores versus 6,035 crores, down 4% year on year and of course down 18% quarter on quarter. Gross slippages adjusted were at 3.13% versus 1.9%. So that's an increase of 123 basis points. So which is why that pain. Now here are what brokerage is saying. I'll go just through a couple of them very quickly. Jefferies is maintaining a buy. They have cut their target price though from 1,450 rupees to 1,370 rupees. They say asset quality disappoints. They expect the trend to stabilize. Slippages are surging due to a new classification and trends will normalize from second quarter. Growth stays moderate with margin correction. Results are weak. Valuation discount drives our buy call. So they've given their reason. Macquarie is maintain and outperform with a target price of 1,450. On Q1 results, they say PAT is a miss driven by higher credit costs. High credit costs concerning, partially affected by policy change. Growth aspirations are onerous. Downside risks persist for our ROA estimate. So it is an all-round thumbs down today. Is there an opportunity to buy? Well, that's a different question. IHCL, a thumbs up, all things withstanding. A tough quarter, but they've done okay. Revenues up 31.7% at 2,041 crores. EBITDA up 28% at 576 crores. EBITDA margins have pared down slightly at 28.2% versus 29%. Net profit up 19% to 296 crores. versus 248. Here's what Jeffrey is saying. They've maintained a buy. They've cut the target price by 20 rupees from 980 to 960. They say it's a decent performance in a turbulent quarter. Management has maintained double-digit revenue growth guidance for FY26 and healthy Q2. IHCL is adding rooms at 12% CAGR over the next 5 years, with several greenfield assets also contributing to growth. Management has also talked about the new Tata Sons platform for investment in select assets. That's something we'll hope to ask them more about when we speak to them later this morning. Suntech Realty, the last on my list, inline numbers, but we'll give it a thumbs up. Because of their pre-sales, which have grown about 31% up, 657 crores. Collections have also stood fairly strong at 351 crores. They've been selected as a preferred developer for Andheri redevelopment project. GDV potential is at 1,100 crores. In terms of core numbers, revenues are down sharply at 40.5%, but EBITDA was up 52%. Margins have jumped up from 9.9 to 25.4%, and net profit up 46.8%. The guidance given is that pre-sales are expected to grow at 30% like last year, and they expect margins to be better than FY25 this year. So taking all of that into consideration is a reason for that thumbs up.
I've got an IT company right up front, and we were speaking about this at the start. LTI Mindtree, a decent set of numbers. In fact, some might say the best out of the lot so far. Let's talk about what stood out and the key takeaways. First, margins were in line with estimates at 14.3%. New orders stood at $1.63 billion, and that compares with $1.6 billion in the previous quarter. You have analysts that anticipated deal wins between 1.5 and 2.2, so it's closer to the lower half or the lower end of that band, but still it's positive. Management is saying that margin expansion is expected to continue in the second quarter, and also that the large deal traction remains strong and is expected to sustain. The consumer business, which was interesting, was a standout, contributing as much as 15% and saw a sequential growth of 6.2%. Very quickly, the numbers, I already told you about the revenue. The EBIT rather, has come in 5% higher at 1,406 crore rupees. The margin was 14.3%. The estimate stood at 14%. The PAT number as a result was up as much as 11% at 1,254. The attrition stood at 14.4%. I haven't picked up a lot of brokerages. The one that I did see was Macquarie on LTI Mindtree. They say they've maintained and outperformed with a target price of 6,200, and they say that the best growth among peers so far is what they saw with LTI Mindtree. Let's move on to the next stock, and that's CEAT. And CEAT has posted its Q1 results as well. The takeaway is, first, the company has managed a double-digit top-line growth. That's 10.5% or thereabouts. Material cost as a percentage of sales remains stable at 63%, and this is important considering the kind of raw material costs that they've had to weather in the past. Marginal, or rather, you have a margin dip, and it's a very small, well, relatively speaking, 11% versus 12%, and this is likely on the back of marketing activity based on the commentary by the company. The net profit has fallen 27% to 112 crore rupees, but the EBITDA is up as much as 1.3%. So some of those line items below have caused that drop. The capex of 450 crore rupees has been announced for its Chennai plant expansion. So that's another update for you in CEAT. And finally, Afcon's Infra, it's a thumbs up because they've gotten a couple of pretty chunky orders. They've emerged as lowest bidder. I shouldn't say they've gotten the orders. They've emerged as lowest bidder in 2 road construction projects worth a total of 4,535 crore rupees. The contracts are for highway construction in Croatia, and they're expected to be completed in 42 months. Bear in mind that they had an order book of close to 36,000 crore at the end of FY25. So yes, this is a sizable order, but in the context of their order book, well, not massive.
Yeah, but should be a thumbs up for sure. Okay, Wipro, all-round beat on estimates, and I know the ADRs are a giveaway, right? Axis ADR down, Wipro ADR up, so you kind of know what the stocks will likely do. But all-round beat on estimates. Record deal wins, close to $5 billion. Margins beat versus the consensus estimates, so which is a positive. They have suggested that the growth in H2 will be better than H1, aided by the ramp-up of several large deals. You haven't heard this commentary, literally, and that is actually a shot in the arm for Wipro. The total TCE was strong at 4.9 billion, like I said, 26% growth quarter on quarter, 51.4% growth YOY. What a number for Wipro. And the Macquarie is maintained an outperform rating, a target price of 290. Most people would be constructive on this one, won't be surprised if there is a sharp leg up, and maybe it stays up through the day. So keep that in mind. Sterling Wilson is the second one on my list. So there's the good and bad here, viewers, keep in mind. So the numbers look rock solid. Revenues up 92%, margins at 4.9 versus 2.7%, PAT at 31.97 crores versus 4.19 crores. So that's the positive. But the order inflow for Sterling Wilson Solar, quarter 1 FY25 was 2170 crores, quarter 4 was 1372 crores. The last quarter, the current quarter that is, the order flow has come in at 813 crores. That's it. So the numbers are not looking that great when it comes to Sterling Wilson Solar. So that is the problem. And then you will have the casualties of the day, or the accidents of the day, as we sometimes like to call them, are the solar companies. Vari, 2V coming, Vikram Solar, Premier Energies, etc. Because a new anti-dumping countervailing duty investigation has been launched on solar panels from India, Indonesia and Laos, as from the US. And why is this important? Because, for example, Vari in the quarter 4 earnings call had mentioned that anywhere between 17 to 20% is US bound for them directionally. And substantial 80% of the revenue coming from the India market, yes. But US is important. And therefore, one, that there is a issue there. Two, if indeed the US exports go down for Avari and some of the others, it makes the pricing out here look a bit interesting as well on the downside. So keep an eye out for these stocks. They will likely correct. Just another piece that Varsha pointed out is that the US Interior Secretary will now approve all solar and wind projects on government land, and that adds more steps in political review, making approvals slower and harder for renewable projects. So very likely that Vari, which has got a US presence as well, will actually see an impact. So there's a two-pronged impact on Vari today, but even the others will likely get impacted. Sentiment gets negatively impacted. So everybody in this ecosystem will likely see a reaction today.
Okay. So, yeah, it's been tough for these solar companies, and the US story continues to be difficult, no doubt about it. So does calling the index, frankly, this morning. So, Kush, unenviable job on this Friday. So, you seem to be in the Zen Friday mood, but nevertheless, what is the kind of outlook you have for the morning?
I was in that Zen state until I got that call saying ki we're going to talk about derivatives, and all bags packed, and I had to do some more research. So no, but just a quick word on the index. I think we're still consolidating, right, in that range, 25,000 on the downside, about 25,250, 300 on the upside. This consolidation could well continue. Also, the combination of low PCR, low wicks, and markets consolidating with a negative bias, that funny combination still continues. What I would like to draw attention to very specifically now is the dollar index. Now, the reason I bring that up is because of multiple factors. One, the dollar index has moved above the 20-day moving average. Now, it's not been above the 20-day moving average for this calendar year for more than 4 to 5 sessions. Even now, it's been about 3, but it's gone above that 20-day moving average, and it's also gone above the falling trendline resistance. So if the dollar index moves higher, there is definitely a near-term negative impact on the market that could come about. It's just perhaps coincidence that 30th June is where the market made the intermediate high, and 1st July is when the dollar index made the intermediate low. So maybe that could partly explain why the markets are consolidating. So as long as dollar index remains in a range, the results that we're expecting, the Monday morning could be big, by the way. Reliance, HDFC, ICICI, all of them posting big numbers. So as long as 24,900, 25,000 is maintained, I think we're still in that uptrend, consolidating with a mild negative bias. 25,300 remains the key level of resistance at the first glance, and then you're staring at 25,500.
What is the Nifty strategy though? Is it a buy on the Nifty today?
It's a buy. I am still going with a buy on Nifty as long as 24,900, 25,000 is intact.
Okay. We'll come back to more on the Nifty and what happened yesterday in the closing session. But let me go across on the story on Wipro, because that's the big one. The IT bellwether has reported its first quarter numbers. Profit dropped by 7% but met estimates. Let me go across to Puneet on the review of the numbers.
Wipro is in focus after the company reported their quarterly earnings. While the revenue was down roughly about 1.6%, we have seen the EBIT margin as well as net profit also fall by 6 to 9%. Now, in this particular quarter, it was expected to be weak, and the constant currency revenue growth has come in the middle of the management guidance of 3.5 to 1.5% fall in revenues. Going forward, they are expecting some kind of positive momentum, and hence the Q2 guidance of -1 to +1% in terms of revenue is something that they've given. In terms of deal wins, it was a decent quarter in terms of deal wins, over $2.5 billion to $2.7 billion in terms of large deal wins. Now, and they've had 16 large deal wins in this particular quarter. But the concern largely remains on how the conversion happens from deal wins into the financial numbers, and that'll be one of the key ones to watch out for in the quarters to come by. But post this results and the guidance that the management has given in Q2, it affirms that the second half of the financial year will be crucial for Wipro to show any growth for FY26, and that'll be something to watch out for. One of the key aspects of the results and something that I came across was vendor consolidation that all of you spoke about, in the press conference as well yesterday. In this aspect, what has been one of the key aspects to have several large deals as well as look at vendor consolidation as a theme, and what do you think, according to you, has been Wipro's strength in this aspect when the macro environment is so uncertain to actually be a biggest beneficiary of vendor consolidation? Because traditionally there has been some kind of weakness in that for Wipro, but with you coming in over the last year, what has changed which has benefited you specifically in vendor consolidation to start with?
So, Puneet, if you look at it, we called out consulting-led AI-powered Wipro. I think that's a strategy that we have adopted last year. Having said that, if you look at the mega deal wins that we won, 2 of them were in the banking financial services and 1 of them was in the technology and communication. So what mattered to us and what mattered to the client is our understanding of their landscape, our understanding of their business, our understanding of where they want to go with the technology trends that's happening, especially with AI. So we brought in the consulting aspect of it, we brought the domain aspect of it, and more importantly, the solution is based on how the client was looking at and how they wanted to implement going forward. So all these factors really helped. Of course, our long-term partnership with them and the way we have delivered as well.
Well, the other one was deal wins, because we've seen that as one of the strengths in this quarter as well. Last quarter you had the Phoenix deal win, a large one. This one again, 16 large deal wins in this particular quarter. But in the last year also you had $5 billion of deal wins, but that kind of translation into the financials, if it has not happened, or maybe it's going to happen and we're going to see that in the next couple of quarters. What factors do either of you see as that of those deals which you won last year? Because these ones are going to, of course, take some time, 4 to 6 quarters to come into numbers. Of the last 2 years, your deal wins actually has been very strong. But so what could be one of the key reasons where you're seeing those deals also take some time to ramp up to reflect in these near-term numbers that we've seen?
I think your question has some of the answers that I was looking for, Puneet. So number one is you talked about the Phoenix deal, right? While we announced it in Q4, we'll start executing that in Q3 because there's a lot of planning phase that happens. Also, some of the deals that we won now, it may take a quarter for us to ramp up and get to execution mode. Having said that, there are certain changes that happened, which I talked about in the last quarter results, wherein some of the large transformation programs the client actually put on hold because of the situations that they went through tariffs, and that was specifically in certain industry segment, which was around consumer and energy and EMR sectors. I think once those come back, once a situation certainty comes back, hopefully those transformation programs will kick in. But having said that, most important for us now are the deals that we have won. How do we execute on day one, and how do we deliver the value for the clients that we are committed to them?
So you had some deal wins in this particular quarter, also in the weaker segments, for us to say the retail, the consumer. Has that largely been shifted to cost takeouts or some new features that the client wants specifically? Has that change now happened?
Yeah. So if you look at our deal wins, there are a combination of both cost optimization, vendor consolidation. There are also some of the new programs that they want to start. For example, Aparna talked about the B2C opportunity, right? They want to see change the customer experience, especially the digital customer experience. So that's a new project or a program that particular retailer is starting to take off. Second, there are certain areas of the back office that they want to actually bring in agentic AI and transform their business process so that they get in the velocity and productivity and experience for their end customers as well. So it's a combination of both, Puneet.
And the one aspect also was the capex of IT companies. You've had a new dividend policy earlier this year, 70% distribution over the next 3 years of profit. So how does that align with your capex which you have to do on new technology? Essentially, the incremental capital which you say, and in finance we love to throw the term of sales to assets. Essentially, how will that? I'm sure that won't take a backseat, but how will that transform over the next, few years, maybe 3 years since you have the dividend policy for that aspect, in terms of going into new areas, and what is the strategy for that?
Maybe Aparna, if you could.
Yeah, so we do have, even as we started the fiscal year, we're about $6.2 billion of gross cash. That has only improved in the first 3 months already. We had been generating consistently about 120% and upwards north of that in terms of net income. So cash flow generation has been robust, and we expect it to be robust even going forward. And we starting off on a very, very solid base of cash on the balance sheet, and that gave us the confidence to increase our capital allocation. And even while we've increased it, we made sure we have enough of a war chest to pursue both organic and inorganic investments. We feel very, very confident that we will be able to support this increased capital allocation and meet the strategic.
Okay, yeah, we'll play out the entirety of that interview later in the day, but key portions there of responses from the Wipro management. Sushovan Nayak is joining in. He's research analyst at Anand Rathi Institutional Equities and tracks this space and the company. Sushovan, very good morning and thank you for speaking with us. Your take on Wipro being seen as relatively better?
Yeah, I guess there are two parts to it. If I look at Wipro, one is the deal wins. It's been phenomenal this quarter. The large deals, in fact, as a percentage of those deal wins, is also something that is quite interesting. And if we look at all these large deals which Wipro has been able to win, what it ensures is that over a longer period of time, it is able to ensure that the revenue stream is protected. That's one. The other bit, as we were also flashing prior to this discussion, was the capital allocation policy. It is generating a significant amount of cash. So 70% of the net profits, if they are distributed to the shareholders, it will also ensure shareholder returns. So one is the deal wins, the other being the capital allocation policy. I guess these are the two interesting aspects as far as the Wipro results are concerned. The numbers, the revenues were basically on expected lines as per the management guidance. In fact, it was exactly the midpoint of the management guidance. And the other bit is the second half of the year being better than the first half is also a positive, because most of the deals that they have signed, they will basically ramp up. And the interesting takeaway again is if you look at the BFSI segment as well as the telecom segment, that telecom and the high-tech segment is where they have won most of the large deals, which is again a good sign for these sectors, which also has been echoed by most of the other large cap IT players.
All points well taken, Sushovan. Morning. So therefore, based on what you saw, would you say that your estimation on your expectation for Wipro for the full year remains intact? And what is your call on Wipro?
So Wipro, for us, it has been a hold and it will continue to remain a hold, because I think the execution also becomes extremely important. We just want to see that execution translate into the numbers. Obviously, these deals have been won. Now the deal conversion into revenues is something that we would want to understand. But as of now, it continues to remain a hold for us. I think we have almost a 15% upside as far as Wipro is concerned. That's basically because of the cash generation and the capital allocation policy. Right.
While we're speaking with you, I just wanted a quick view, Sushovan, if you also track LTI Mindtree and saw the numbers. Yeah. I saw a couple of comments saying that it's the best of the lot. Do you agree? And what's your call on LTI Mindtree?
Yeah, so LTI Mindtree has been a buy for us for almost the last 6 months now. This is the only large cap IT which has shown a constant currency sequential positive growth amongst the large caps. All the others have shown negative growth. So that is one thing. And during the last quarter, this was the only company which basically stuck its neck out and said that retail and manufacturing, that is the place where they will continue to get the deals, and they have actually delivered on that promise. So in this sort of an environment where cost takeout deals are being dominated, I guess LTI Mindtree is the player which has actually delivered on those expectations. The other bit is from an AI perspective also, it had launched its Blueverse agentic AI platform. That is something that is a positive as far as LTI Mindtree is concerned, because it's one platform that it can leverage on to create a network effect for multiple customers, right? The other bit is we also get the fact that the execution is validated. If you look at the large deal win that they had won this quarter, I think it was a $450 million deal which they had won. So that also justifies the execution of the company. So we have a buy rating on the stock as such.
Got it. So Showman, thanks so much. You were saying, sorry?
No, I was just saying the target price was around 20% upside. That is basically the way we are looking at it.
Understood. Yeah. Thanks so much for joining us this morning. Pleasure speaking with you as always. Look forward to the next one.
Thank you so much. Thanks a lot for your time.
All right. It's 8:45 and you know what that means. It is time for Heard on the Street and the Taza Khabar of the morning. Be quiet. Samit Sarkar joining in studio to tell you what is what. Samit, morning.
Well, yes, firstly, the stock that remains in focus is Paytm. Now, yesterday also we did see the bounce back in the share prices, but and dealers are indicating that there are buy flows at lower level, and the street is quite bullish when it comes to Paytm. They're expecting EBITDA profit to come in the first quarter of FY26, and if at all, if the company reports an EBITDA profit, then there could be multiple target price revisions and upgrades that could come in for Paytm. Second stock on the list is Cipla. Dealers are indicating that there are sell flows on institutional desks. Both domestic and foreign institutions have been selling this counter at higher level, and dealers are also indicating that the first quarter numbers could be a bit weaker for Cipla to come in. For M&M, there are buy flows on large HNI desks for the last couple of trading sessions, and dealers are expecting some kind of a positive corporate action that could come in for M&M. For Patanjali, there are in fact a couple of news flows that is leading the stock higher. The first is there could be a management change in the company, and the second buzz on the street is Patanjali as a stock could actually enter MSCI, and these two buzz on the street are actually leading the stock higher. It has gained nearly 10% in the last couple of trading sessions. And when it comes to Gland Pharma, the stock has been buzzing off late. Few days back, we did indicate that large HNIs have started to accumulate this counter, and the current buzz on the street is that the existing promoter, that is Fosun, might exit the company anytime soon, and that is one of the reasons why the stock has been buzzing. And a couple of news flows that we indicated earlier, Veranda was one where it was part of our segment on July 16, where we did indicate that there could be a fundraise, and yesterday the company announced that they're looking for a fundraise via QIP, and the floor price has been set at around 237 rupees per share. And for Shoppers Stop, we did indicate that large HNIs have been accumulating on expectation of a strong Q1, and that has come, and the company has reported a very good set of numbers. The numbers are way ahead of what the street was estimating. If you look at the EBITDA number, that is around 15% higher than the consensus estimate, and 17% jump on a YY basis at close to 166 crore.
Spot on, Samit. Thanks a lot for bringing us all of those details. In fact, we highlighted Polycab as well 3 or 4 days earlier, and that too has actually become very good. Push very quickly on one or two of these stocks. Paytm in particular, but maybe even Patanjali Foods. Is it either of them topish?
So, Neeraj, Paytm, we had a call on, even I initiated a call on Paytm 3 sessions ago for a target of 1,025, second target of 1,025. 1,000 was the first target. That was hit. I am more impressed by the volume action on this one. So, continue by 985, about thereabouts. You keep your stop loss. 1,050 is the next target. What I'm more impressed with is the Mahindra & Mahindra setup. Price action positive, but a very similar to Paytm volume action. The last 4 sessions have had an extremely encouraging volume action spurting the stock higher. So, if 3,200 or those levels are taken out, I think you could see a big spurt towards 3,300, 3,400 levels. So more excited towards Mahindra & Mahindra. Patanjali, I think it's time to book profits. Very sharp up moves. I think, the near-term trade is done. Perhaps on declines you could consider.
Okay. It is time now to talk about what we had referenced at the start of today's show, and that is the activity from yesterday's session with respect to the Nifty and the slide that you saw towards the end of the session. Was this a case of continued manipulation on the expiry day as yesterday was? And Sajith is here to tell you about a step-by-step explanation that he's pulled up based on several parameters that he's looked at as well. The derivative data is on the screen. So Sajith, over to you.
That's right. Even if Jane Street is not in the market, there are other whales which are there and manipulating the options market there. So there is a market manipulation, especially on the expiry day, with respect to how premiums and calls are being written, and that's what we're going to show you through a step-by-step process here. So if you look at the day, how entire expiry day charts for call and for put, there's a call line graph there in the middle. You see what is the Nifty closing at 25,111, and then you have the call which closes on a decay value which is there. This seems a little complicated, so we'll just break it up for you into three halves. The first half being that you have a pre-expiry or expiry -1, where we have seen a lot of call writing happening going into the expiry, which is on Thursday there. The second thing which we're going to explain is between how 9:15 to 10 a.m. we have seen what kind of activity which has happened, and the third is after 2:15 what has happened there. So if you look at the first component, which is the expiry day 9:15 onwards, what we have seen is call writing has been witnessed, and 25,200, which was the at the money strike, had the highest open interest and resistance and that was a resistance for the market. Subsequently, what has happened is that you're seeing writing a call option at the open which was trading at a very high premium, and subsequent and buying of puts at open which was witnessed, which was at very low premium there. Post that, if you look at after 2:15, call options were allowed to decay to near zero because it's an expiry day, so the call premiums will move towards zero to coincide with the market price or the strike there. And we've seen a sharp writing of puts coming in, which rose after 2:15, and the premiums went up to as high as 96 rupees there. So that was one of the things which is there. Now let's break it up, what happened after 2 o'clock. You can see the Nifty, how the Nifty started falling, and that's primarily because there were shorts which were created, especially in the IT stocks it was created, and as a result of which Nifty closed at 25,111. What happened to the put is it went all the way to 96 and closed at 88.4. And what happened to the call? It decayed gradually to 5 paisa. That's something which is a natural phenomena on an expiry day for calls and put, because they converge to the strike price. But what we saw here was a put there because because of the shorts created in the market, the implied volatility went up, and as a result of it, the premium went up and closed at 88.4, thereby making a killing for the for the put writers on the expiry day.
Very important and very interesting data that you've pulled up, Sajith. I'm just wondering, Kush, what you thought of this breakdown of analysis and how different it has been to other instances in past expiries. Can you tell us if you've pulled up any data?
So, Alex, this is a little interesting, and I'll tell you why. You're questioning the very basics of how, I wouldn't call it basics, how market participants had started accepting that volatility to rahega expiry hai, correct? It's like teaching a tiger how to purr. I mean, you can't do that. It'll roar. Expiry hai, volatility to rahega. Correct? I think we can break this down further into two key components. First is the Jane Street impact. Has there been any impact post the Jane Street announcement that came out by SEBI? And the second part is volatility on expiry day. Let's start with the first one. If you see the SEBI data, for the last 4 years, the total losses that the retail traders have made in derivatives is close to 2,86,000 crores. Correct? The Jane Street profit for the last 2 years has been about 36,500 odd crores. That is just about 12% of the overall losses that the retail traders have made, which means as Sajit also mentioned at the start of his conversation, there are other players also. I mean, you could attribute some to HNIs and some to small prop desks here or there, but you can't have the 88% coming out of these small players, right? So there has to be some other participants involved very clearly. So that's the first point. Second, has there been a Jane Street impact? There most definitely has been a Jane Street impact. What Sajit mentioned was the intrinsic value change, or what we call delta, correct? You read the change in the landscape of options through walls, right? Now, for an ATM option, a weekly option which is 5 days out, the implied volatility, the walls used to typically be around 15, never below 12. Right now, it's at 9. Which means there are definitely some supply pressures, some algos being distorted. So definitely that Jane Street impact has come about in the last 2.5, 3 weeks.
But specifically on the diversion between the put and the call,
right,
and the fact that the call was allowed to decay and the put premium on the put rose very substantially, and so therefore put writers made a killing. Specifically on that, was that leaning towards the possibility of manipulation?
So again, as I said, this has perhaps been the nature of the beast. I don't blame this particularly to Jane Street. And let me give you one more instance for this. COVID, pre-COVID, that's how I think we'll see Indian market financialization going forward as well, right? Has anything changed pre and post-COVID in terms of the expiry day volatility in particular? No, it hasn't. Correct? Somebody, some broking firm would have trademarked, Hero Zero Trade. But ये तो बहुत पहले से चल रहा है. I've been professionally in the market since 2008, much longer, if you don't count the professional aspect, but I've been there since 2008. Derivatives में ये तो हो ही रहा था. It's something that traders were anyway doing, correct? In fact, they graduated to strangle trades. You know what strangle trades are, right? 100 रुपए ऊपर का call खरीद लो, नीचे का put खरीद लो, and then you might have one big move somewhere. Okay. That has not changed. That has not changed over the last 2 decades. So I don't think there is any change. Also, one last point on this is that the retail, the rise of the retail trade that we are seeing, this is in derivatives specifically, is the dark effect of the financialization of savings that we've been talking about. We've all discussed how beautiful it is for the mutual funds to have that kind of cash. But just to give you numbers, about 2018 thereabouts, the daily volume on derivatives used to be about 1 lakh crores, correct? That shot up to 400 lakh crores. And at the same time, the retail participation went from 2% to 41%. Now, you're talking Insti versus retail. It is never a fair fight. It's like fighting Tyson, in the ring with your hands tied, your ankle weights on, and eyes closed. You are never going to win that fight. You can educate it to you can educate retail to an extent.
Would you blame Tyson for it?
Absolutely not.
Correct.
Absolutely not.
That's the point at the end of the day.
Yeah, it has to be a structural change where let Instis fight it out.
I have to go into a break.
Sure.
But very good point there. And of course, we'll come back with more on this story. But we're back with the pre-open rates, top trades for the day, and much, much more. Stay tuned for all of that.
जनता के पास सवाल ही सवाल है. जवाब ढूंढने को वो देखती है न्यूज और देखती है यहां तो सवालों का मायाजाल है. ऊपर से ये अलग फाइट है, कोई पूरा लेफ्ट तो कोई पूरा राइट है. बीच में मुद्दे के साथ कौन है, जनता को जवाब चाहिए. इसीलिए सवालों की परेड नहीं, मैं लाऊंगा खबरों की कचहरी. मैं शुभांकर मिश्रा, मेरे साथ देखिए कचहरी रात 8 बजे सिर्फ एनडीटीवी इंडिया पर.
They promised guaranteed returns. They advertised illegal trading in broad daylight. But NDTV Profit picked up the trade.
2 साल हो गए मैडम. डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We called, we questioned, we exposed.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात, खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
Because your money deserves protection, not empty promises.
All right, welcome back. We're just waiting for the pre-open rates to kick in, the implied. I mean, I don't know if all of these are any indicators of what's going to happen through the day or even in the opening. Seems to be off for the last several sessions, but anyway, showing 12 points up. Axis Bank in focus after the company announced its Q1 numbers. If you want to understand very, very simply what's happened, they suddenly changed the rules of the game, said that there's some extra provisioning which has come in. People are trying to figure out what's really happened. Harsh? That's the crux of the problem, right? This technical write-off and this technical parameter which has been put into place.
Well, yes, they're calling it prudence, and 820 odd crore in terms of excess provisioning is what they've done. But that doesn't do away with the fact that in any case provisioning was elevated. So your provisioning number expected around the 2250 crore number, it came in above 3100 crore, even adjusted for the 820 crore provisioning which they've done. What they're saying is the ROA was impacted by around 15 bips thereabouts, which is roughly 600 crore post-tax, and therefore you saw that compression, very sharp compression in ROA from over 1.8% to below 1.5%, and even adjusted for that 15 bips, it's still just above 1.6%. It's a miss, and this is despite the fact that other income was much better than anticipated, 7% sequential growth on other income, and you had much better operating leverage at play. So your operating expenses actually shrank both YOY and QOQ, and therefore ideally operating profit was well above estimates and therefore should have spilt over to profitability, but that's clearly not happened because of the factors I've put out. Growth though slightly, marginally better, margins in fact marginally lower than estimates. So those two got completely ignored in the middle of all of the provisioning that was done.
Your retail book is not at all at this point in time showing any material growth. It's 6%. 27% of your retail book is just home loans, which has not grown at all in quarters, multiple quarters. And if you were to look at the next largest piece of your book, which is rural loans, there as well, you've seen a quarter-on-quarter decline. I'm just trying to understand the reason behind this confidence that you will beat industry growth. Just these two questions. Thank you.
Well, we are normally, I think you will notice that as Axis Bank, we are quite careful about what we say. I think sometimes we are blamed for not saying enough or not projecting things in the future too much. The fact that some of the retail asset book has not grown should actually give you confidence that we can grow, because there is that much more opportunity for it to grow. Some of the asset classes not grown because you have seen a spate of regulation changes, which has meant that the way loans are done or the way loans are given out, their process has changed, or the way they have to be booked, that process has changed. So in some of the areas where the growth is not there, it's not because if you go and look at the numbers, the disbursement growth is quite solid, but the overall AUM has not grown because in many cases we have seen loans getting repaid or renewal not getting done, etc., etc. So the second part of the confidence comes from there, that we know that the disbursement growth is going quite well in number of asset classes in the retail area, but the AUM is not reflecting that as yet, and it will reflect over a period of time. Wholesale is the area also which did not grow for a long period of time, or did not grow fast enough. In this quarter, we have shown that the wholesale side has started growing.
Okay, so unfortunately, when it comes to numbers like this one, the focus is on that one aspect, which is the technical write-off, 4,000 crore rupees. Parag Thakkar joining in to tell you about what he thinks about that. Parag, a very good morning to you. And what do you make of that? 4,000 crore rupees of slippages, gross level, and technical write-off is what they're calling it, and they're not anticipating that the asset quality issue is going to go away anytime soon.
Yes. So this technical write-off is a new word coined by Axis Bank. So I would like to say that even if you suppose believe them and say that, okay, this is a technical write-off, 80% of that is secured, so it will come back at some point of time. First of all, retail slippages cannot come back so fast. That is my view. And the second is in retail to have such a high magnitude of technical write-off is also difficult to digest. Even if you knock off that, the credit cost is 1%, above 1%. Now, see, banking is a leverage business where you make 1.52% ROA. And if you have a bank like Axis, which is saying your credit cost adjusted for technical write-off is above 1%, I think here the only saving grace is valuations and so much of liquidity in the market. Fortunately, I don't hold the stock, but I will buy, as you very rightly pointed out, I will buy only and only once management clearly says that this is the quarter from which our asset quality will improve.
Okay. By the way, you were talking about Wipro just yesterday, and the question that we asked you was, would you be willing to stick your neck out? And you did. Yes. Are you happy that you did?
Yes, extremely happy. Large deal wins were $2.7 billion. Margins, they were able to protect at 17.3% in such an environment. Of course, LTI Mindtree also did that. Deal wins were absolutely great. I think the guidance, Wipro is a very conservative and clean company. So I would say that -1 to 1% guidance for Q2, which is okay. But I think they sounded very confident for H2. And I would say that full marks to their team. I think that new CEO, Mr. Srini, is doing a wonderful job. He's a people's man. And I'm very happy with the result. I will even thumb the table today and buy the stock. And see, trailing P is 20. 70% payout implies around 3.8 to 4% dividend yield, as I mentioned yesterday. Yesterday on the call, they were very clear that even buyback is not completely off the table. So I would say that where you are getting such margin of safety of trailing P of 20, cash flow generation, they have a net cash of about 30,000 crores. You have a dividend payout of above 70%, which implies around closer to 4% dividend yield. Where there is so much of safety and little bit of growth traction coming back now with such large deal wins.
Okay, so Parag bhai, sorry, just reconfirming, 20 seconds. You would buy Wipro even if it opens 3-4% higher?
Yeah.
Wow, okay. Okay.
And if it falls due to the concern, one concern which people might have is that EBITDA margin. They have said on the call that in order to win such large deals, of course, there was intense competition to win those deals. And so when they will ramp up these things, there will be some front-end expenditures, and which will brings margin to some degree to downward levels. But I would say that if that is the reason, and if the stock gets sold, I'll be a buyer for sure. Because in Wipro, everybody was looking for leg. See, why the stock has been a laggard? There was no growth. Now the new CEO is talking about growth. Okay, they have demonstrated by winning such large deals in a competitive and extremely volatile environment in the middle of this Trump tariff thing. So I would say that a great margin of safety. I think there are very few stocks like this in the market today.
Okay, buyer at open as well, but happy to buy even otherwise if it opens lower.
Already I have 4% weight in the portfolio.
Wow, okay, that's confidence personified. Parag bhai. Yeah, okay. Well, point well noted. The optimism shows.
My view is very long term.
Yeah. But people should use their own due diligence. Agree.
Short-term guys to buy.
Agree. Parag bhai, thank you so much for joining in today and giving us this quick view. Okay, just before we get to the brick broker, Kush, 30 seconds. I'm not giving you as much time, sorry. But Wipro, would you buy it 3% higher from a trade perspective?
Yeah, I wouldn't need as much. No, I won't. 270 has been a resistance for the last 15 days. Call congestion there. I'll take this opportunity to book profits.
If it opens, stays above 270, then would you buy? No.
I would give it a day.
You would give it a day?
Give it a day.
Okay, fine.
Supply pressure.
Thank you, Kush. Thank you for that.
Axis.
6%
down pre-open.
Yeah, that's the thing. 1160 was a very strong support zone. I was just going to say if that's broken, then 1100 could be taken out. I won't be a buyer just yet. I would wait and watch.
Not at these lows.
Not at these lows.
Okay, interesting, because Axis has corrected quite a bit. Let's see. But Kush is saying that caution is better than bravado. Time for the big brokerage call of the day. And all eyes are on Polycab after Jefferies and UBS has reiterated the buy ratings and raised the target prices. Harsh Johnson with the key reasons for this. Harsh.
Well, yes, I want to start off with the kind of numbers that they've clocked and the target prices which have been increased, because it's really a solid increase both by UBS as well as Jefferies. Difficult to pick between the two. In terms of Jefferies, they've hiked the target price from 7,150 rupees a piece to 8,180 rupees a piece, and this is even before the con call has come through. UBS as well, from 7,150 they've hiked the target price to 8,100. So very strong increases in target price. Jefferies calls the execution extremely strong. Q1 was obviously a beat, good operational performance as well. What they're saying stood out was the FMEG sales, both on the top line as well as on profitability. Both has delivered in terms of FMEG. The growth there was 18%. Cables and wires, which is a larger part of the business, the growth was extremely solid at 31%. Both of those a strong beat. They estimate a 25% PAT CAGR for this one. From FY25 to FY28, they've hiked the multiple from 33 times to 35 times, therefore adjusting the target price. Even for UBS, very similar. FMEG growth faster than expected, margin improvement better than expected. They're saying demand coming from power T&D, data centers, real estate, market share gains in cables and wires is a positive. They're raising earnings multiples by 6% FY26, 5% FY27, 4% FY28. They've hiked the target multiple from 35 times to 36 times, and therefore that target price.
Got it. All right. Thanks so much, Harsh, for that. In fact, Dharmesh Kant of Chola Securities joining us this morning. Dharmesh, very good morning to you. What do you think about Polycab? I'm sure you saw the numbers. Commentary seems to be very rah-rah, if I can call it that, at this point in the morning. It's up about 1.5%. Do you agree? And do you have a buy on it?
Yeah, good morning, Alex. No, we don't have a buy on this. And the reasons being, I do expect that 15-17% kind of a growth for next 2 years will be given for all these companies who are into cable wire manufacturing. But the point is, the way copper prices have gone up this year, the margins are definitely going to be under pressure from Q2 onwards. So Q1, till Q1, they have an advantage of inventories at their place. But you will see the margins getting hurt from Q2 onwards, and valuation-wise, it's just very expensive. I mean, I agree with this foreign brokerages that 20% kind of a CAGR should be there, but at 20% kind of a CAGR, you are giving a valuation multiple of say 35 or 40, I mean 1 or 2 year forward, which translates to around 50 on a TTM basis. And then you have a competition setting up in next 2 years. So it's a trading play. I mean, liquidity flows and positive sentiments and reports can have it up 4-5% up from here, but it's not a structural wealth creation play from here, to my mind, at these kind of valuation multiples.
So Polycab doing well in the pre-open session, but just look at some of the other buzzers and movers in either direction. Axis Bank paying 0.6% down, Clean Science on the basis of numbers, Tatacom, Sterling and Wilson. All of this is impact of numbers that you're seeing today, and some of them truly weak. Wipro, on the other hand, seems to be something that the street is celebrating. Afcons in focus, so over a 4,500 crore order coming in for Afcons Infra, and will be doing well. Along with Polycab, RR Kabel, Motherson Wiring, all of those moving up. So maybe some of those concerns actually receding. RBL Bank ahead of its numbers. Numbers will be out on the weekend, doing fine. There's a block in Adani Wilmar that is buzzing as well. I want to ask you about some of these wire plays, Dharmesh. And Polycab you spoke about, but what about some of the others in the space? And RR Kabel, Motherson, all of those companies, would you be looking at them right now?
Not exactly, Tamala. This is just a rub-off play which we are seeing this morning, and it can continue. As I said, trading play of 5-7% upside can still be there, but structurally, Q2 and Q3 would be difficult for them, seeing how the commodity prices, especially the copper prices, are faring up in the international market. And that is where the hurt will come. The margins will definitely be under pressure. Business-wise, 12-15% kind of a growth will be there, but again, valuation of any of these companies, if you look at, nothing is at a comforting level. One may argue that historically this is the valuation multiple they enjoy, but the things are changing going forward in the future. So that is the only concern. I mean, at best, it's a trading play. One can continue with more 5-7% kind of an upside, but we will be booking profit there.
Dharmesh Singh, he'll book profit on the wire companies. Kush, very quickly on Afcons Infra.
Good move. It's now broken above the falling trend line resistance, also starting above the 20 and the 50-day moving average. I would actually continue to hold this one. Buy or not remains to be seen whether it holds this opening gains for the initial 30 minutes or not. But on the whole, the setup looks positive now. On the upside, you're looking at 445 and 460 as well as the next targets. So yes, a hold right now, but during the day how it progresses, it might just turn into a buy as well. On the downside, 425 is a stop loss.
Kush, 20 seconds, top call for the day.
LT Foods, very good accumulation, very good moves on this one today. Also, it's opening with gains. 525, 540 are your targets. 495 is where you place that stop loss.
Okay, so effectively Kush saying viewers that buy at 510 or 511 as well. With 525 and higher are your targets and 495 is your stop loss. I think the target is higher than that, but we'll revisit this with Kush, of course, in the next 15 minutes. But here come the first trades and they'll be flat. I'll be surprised if it's anything otherwise. No, it isn't. But the bank nifty is down courtesy Axis, I'm sure. Bring up IT and see if IT is up. Yes, 0.37% higher, so good going there. Mid cap and small cap indices on your screen. Very, very flat for the nifty mid cap and the small cap space. So it's a flat start, but for individual movers on banking and IT side. And let's get those up on the screen. Axis, well, the accident on the index. Wipro, the big positive for the Nifty. Geofin too didn't have as bad, and plus there's approvals for that those plans, the 3 or 4 funds, passive funds that they want to launch, which came in day before. All of that adding to the Zing, maybe 1.3% higher. There's strength in metal names. Tata Steel and JSW are doing okay, and courtesy Wipro, I think Infi too has done okay. Now what is Axis's loss? Is it HDFC Bank's gain? Maybe, because that is looking okay. But suffice to say, more green than red, despite the fact that it's a very, very flat market. And flat because some of the banking names like Axis and Kotak are dragging it lower. Wipro on the upside. Axis now nearly 5% in trade. So this is really facing the selling pressure this morning.
Axis with that those bloopers of provisions, not feeling any kind of reprieve from the street. Geo financial numbers were also good. JSW Steel also ahead of numbers, not looking bad at all. Let's look at the broader markets just for a second this Friday morning and what's happening there. Even as the India VIX is spiking very, very marginally. Flat to negative on the small cap 250. The mid cap also completely flat. The action is going to be in specific stocks, and that to basis results this morning. Maybe some brokerage notes will move companies. Let's look at the sectoral heat map just for a second and look at what's moving there. Wipro, I think all by itself is moving the Nifty. IT, maybe some help from an Infosys there. Metals are doing okay. And US economy doing fine, good for global economy. Metals are having an okay day today. So IT, metals, realty, all fine. Private banks taking a knock. Thanks to Axis Bank, Bank Nifty, Finance, that whole space looking in a bit of pain. And this you can expect to continue till you have clarity on what's happening with the big 2 private banks, HDFC and ICICI, which will become clear over the weekend. RBL, Yes Bank, all of them are expected to report. Let's get to specific stocks because that's where all the action is. And we'll just review all the result impacts, starting with an Axis, a Tatacom, Indian Hotels, all of these have reported results, a whole lot of them, and we'll go through them quickly. Tatacom results are actually a bit disappointing, but the street's doing okay with it. Indian Hotels as well, slight dip in margin, but in a turbulent sector has done fine. Axis Bank, of course, deepened to over a 5% cut. Suntech, Realty, CEAT, Wipro is the other list that we're looking at. CEAT, negative set of numbers. Suntech, Realty was okay, fine. We gave it a thumbs up. Wipro also, we also gave that a thumbs up. Let's look at Nuvoco, Vistas and Shoppers Stop as well. Again, have reported results. Shoppers Stop not looking good at all. Nuvoco Vista has been received very well by the street. Clean Science, again, not that good at all. 361 WAM. If I want to look at result impacts, I want to just look at a 361 WAM. The numbers actually look pretty good for the street with its question marks there. Inox Wind is raising funds. There's a bit of pressure that you can see there. Afcon's Infra was the top gainer in the pre-open session. Is that holding up? Well, 4% up, not half bad at all, on a fairly large order win. Capri Global in focus because Nuvama has initiated coverage with a buy call, but the stock dwindling right now. Wari is the other one to look at after a move on possible duties on companies from 3 nations, including India, that make solar panels. But not too much of a hit on Wari right now. So an interesting mix this morning, I would say, dominated by result impact.
You said it, and by the way, Clean Science was on Tamanna's list. I just want to pull that up. Also news that the family that owns Clean Science is going to sell a considerable amount of stake. 24%, I believe, is the number for the Boob family that is going to be selling stake, bring it down to 51% for the promoter group. And so that might be one of the reasons why the stock is under a tad bit of pressure. Axis down 5%, Newgen Software down about 3.4%, Dabur as well seeing a little bit of selling pressure, down about 1.4%. A few of the stocks that are up and about and that are moving, Motherson Wiring, by the way, doing reasonably well, up about 3.3% or thereabouts. RR Kabil, I'm just wondering if it's a rub-off effect, up about 3% or thereabouts. And you have something like a NetWeb Technologies, it's up about 2.5%. But really, the few that we've mentioned so far for you, Afcons, Wipro from the IT pack, and Axis Bank are the real big movers. Dharmesh, I want your opinion on Axis Bank because perhaps we need to speak about this in some more detail. In a sense, some might argue that this is shooting yourself in the foot because yes, these are delinquencies, but technical write-offs, the way that it is described is that you were only required to take a portion of this and provision for a portion of this, but you've decided to take the 100% amount. And you've said that that's going to likely remain the case going forward as well. Is this harakiri or is this normal and prudent?
It's a play of words or terms they want to do, but the fact remains there's a problem. And prudently, to my mind, if it's a one-off kind of a thing, then they have done away with all the problem areas. Since the acquisition of, say, Citibank consumer business, Axis Bank has run into trouble. There has been a higher slippages and asset quality concern. And at the same time, they were, also plagued down by the MFI issue. So two verticals were clearly, posing trouble for them. So retail was not, they have done nothing. They stopped the advances growth totally on the retail side, home loan, retail or car loans, everything, credit card growth. Everywhere there was a very, measured slowdown. At the same time, this time they are saying about agri. So agri is a new slippage which has come into the play of Axis Bank, which was not there earlier. So I think since they were providing for, microfinance and the retail side of the business, they were going slow on agri part, and now this has also come out. So only, benefit of doubt which one can give to Axis Bank is they have done away with all the problem areas, and going forward from Q2 onwards in a low interest rate regime, they are going to gain business back in traction. So a lot of structural changes are happening inside Axis Bank, be it, the software issues and things like that, and the compliance part. So to my mind, I will still, given the size of Axis Bank and given the management competence they have, I would be a buyer at current levels in the Axis Bank and being prepared for 3-4 percentage point kind of a slippage going forward. And Q2 is the earnings update which I would be looking very closely into as far as asset quality is concerned. So if there you get a first indication that silver lining is around the anvil and things are improving from here, then it will become a big outperformer going forward in this year. But it's a clear cut as of now, a benefit of doubt kind of a play on Axis Bank, rather than getting a clear sense that worst is over for Axis Bank.
That's an important clarification to make, by the way. It's not a clear buy based on what Dharmesh is saying. Kush, you want to review what you had said at the start? You wouldn't be a buyer, you said at a certain point. Has that level still not been hit?
No, not at all. In fact, very interesting that the downfall on Axis started somewhere, 26th, 27th June with 3 sessions of big dips, about 1%, 2%, on few days, and then it's been steadily consolidating negatively. Now, this break, what it's done is that, it's almost filling that gap that it had somewhere close to, mid-April, and now trying to hit or achieve or stay afloat that 200-day moving average, also 1100, psychologically important mark, put option congestion will be there. So I think you could expect some consolidation going forward around this level. Will it see a V-shape kind of a recovery? I doubt in any way. If you see the last, few weeks, months of discussions that we've had in the private banking space, the 2 stocks that stand out are the biggest 2, right? The HDFC and the ICICI of the world, and Kotak is inching up, making its presence felt, but Axis didn't really, hit the radar. So that view continues. I wouldn't really buy Axis right now, especially when I have ICICI and HDFC, consolidating and could see a bump up.
You had said LT Foods, but did you take a look at Sapphire Food by any chance? It's up about 6% at this point, and I wonder if there's a trade here.
There could be a momentum play. If I have to play this, I'll play with very small volumes, but given the kind of setup that I'm seeing in some other stocks, I would avoid this. This is more of a hold. The reason is that it's a follow through. It's had 3 good sessions of an uptick, and now it's approaching overheated territory, so you don't want to be stuck at the higher end. So perhaps that declines close to the 350 mark, as in when you see some profit booking, Sapphire Foods entry or a re-entry will make sense. At the moment, well, you could continue to hold, keep a stop loss around the 355 zone and continue to hold, not a fresh buy.
Okay, guys, stay on. Let's talk about the renewable sector for a bit. And Dharmesh, I would want your view on this. I'd urge you to stay on because there is 2 major updates that impact the sector. One regarding the anti-dumping duty and CVD investigations on countries like India. Indonesia and Laos are the other ones. And the other one is a regulatory hurdle in the United States. Varsha, quick details on both of these.
With the first one, wherein Indonesia now targets of new anti-dumping investigations, where they claim, US is claiming that solar products from India in Indonesia are being dumped. Now, what is the next step for this? Now, US Commerce Department will check for these unfair pricing, and the US Traditional Court will decide if manufacturers are being harmed or not. The second news, which is going to impact renewable companies, is wherein US Interior Secretary will now personally approve all solar and wind projects on government land, and this will add more steps and political review, making approval slower and harder, because government wants to stop giving preferential treatment to wind and solar, and they are favoring coal, natural gas and nuclear power instead. Now on the companies to be impacted, Waaree Energies is one such company, because 57% of the order book comes from the US. That is 20%, if you say in a value terms, is the revenue contribution from US. And also Premier Energies, though the US contribution is little like 1%, but there was a JV planned for 1 gigawatt solar cell factory in US. However, this has been put on hold by the company because of the given policy uncertainty. So these are the two news which can impact renewable companies as a whole.
Got it. Thanks a lot for that, Varsha. Now, Mr. Kheruka, Pradeep Kumar Kheruka, Chairman of Borosil Renewables Johnson. Mr. Kheruka, the news flow is out there. Not seen too much of a reaction on the stocks per se, and at least some of them. But the optimist believes that, or the optimist says that there is a lot of conversation that happens in things like these. The eventual impact doesn't quite turn out that way, and therefore, maybe not enough cause for worry. How do you see this?
Well, I think Waaree is perhaps the largest exporter of solar modules from India to the US. And from what I know about their activities, I've not heard any alarm from them so far. The question is that an anti-dumping duty is essentially meant to counter government subsidization, directly or indirectly, of the exported product. As we all know, that there is no government subsidy of any sort in India on the manufacture of solar panels. And therefore, I do not know what the Americans might find in their investigation. That is one. Secondly, Waaree have a decent-sized solar module manufacturing operation in the US. So one way or the other, I think that company will not stand to lose. Regarding the second question about the tightening of permissions for solar energy deployment in the US on government land. This is something, of course, which is well within their rights, and it is in line with their stated goal of pushing fossil fuels. And they speak about nuclear energy, but it takes a very long time for nuclear energy to be commissioned. So in the short term, of course, it means that they'll be using more fossil fuels in the US, apparently.
Okay. All right. Mr. Kheruka, thanks so much for joining us this morning and for giving us that clarity.
Yeah, important to get that, right? From somebody who looks at this very, very closely. And by the way, as he said, I mean, just look at the kind of reaction. There's hardly any reaction on some of these names. In fact, Waaree Energies is up about a couple of percentage points. So that's very, very interesting. But there is lots more happening beyond these things, right? And there are a lot of individual movers and shakers out there in the market which are looking or which are thinking very interesting. Now, Dharmesh, I don't know if you've looked at the small NBFCs of late, but Indostar Capital, something that came out very late last night, they have sold off a part of their business to EQT, gotten 1,700 crores. That stock is up about 3%. So my question is whether you track Indostar individually or you track some of the smaller NBFCs. Do you like anything in that bucket?
No, Neeraj, I mean, the smaller NBFCs we have purposely, kept on hold because of the credit problem which was happening with most of them last year. So we would like to see how Q2 pans out before taking a call on them, because you are having a better place on the NBFC space, on the larger cap space, which are bigger ones, and they have been doing fairly well. There was definitely, collection efficiency ratio kind of a problem with most of them, which has dipped to around 83-84% kind of a level. Usually it should be 93-94. So we'll see if what they update comes in Q1 and Q2, if it is inching again upwards to 97-98 in the light of lower interest rate regime, then one can have a look. But you're good plays in medium and large size kind of a company, so they can offer you a better returns. We are avoiding smaller plays totally as of now.
Okay. Thank you so much, Dharmesh, and thank you so much, Kush, for joining us this morning on India Market Open. And it continues to be an exciting morning because we're talking to Dixon. Dixon Tech is the stock in focus. The EMS player has been in the news for a lot of recent corporate updates. They're completely leveling up on various aspects of their broader plan to be an end-to-end player. Now, let me get in Varsha on the key updates that have come in the last 24 hours.
Yeah, thank you so much for that. So as you rightly said, companies in focus on the back of lot more of updates. Let me start with the first one, wherein they've entered into binding term sheet with Chongqing Yuan, which is a Precision Manufacturing Limited. Now this JV is to manufacture and supply precision components for laptop, mobile phones, IoT, and any other products. Also, the second update, if you see, they've entered into binding term sheet with Q-Tech India. Now the proposed acquisition is of 51% shareholding in Q-Tech India, and the purpose for this collaboration is to manufacture, sell and distribute camera and fingerprint modules. Now why this is important? Because this will due to this, Dixon will foray into development and production of camera modules and fingerprint recognition modules. On to the last update, wherein the company has executed SPA with DTSPL and a JV to subscribe 2.5 crore equity shares of JV. Now they've entered this binding term with Signify Innovations India Limited, which involves transfer of the lighting business to the company, and the entire stake in Dixon. This will be a transfer of lighting business to the company, which is an entire stake in Dixon Tech, and this transfer by if you see this signifies of its business undertaking, which comprises LED lighting, manufacturing operation, assets factory in Vadodara.
Okay, thank you so much for that, Varsha, and putting it all together, because that sets us up perfectly for this conversation with Saurabh Gupta, the CFO of Dixon. Saurabh, great to speak with you as always. Now, a couple of things you guys are doing. One is the Q-Tech deal, which puts you in good space for the camera and fingerprint module segment. Then lighting OEM is the other one that you're looking at. Let's start with what the larger plan is with these three specific announcements that have come in.
Yeah, so basically, as we have been always guiding to our investors and also to on your channel, that our focus now, we already have a very large play in mobiles, and going forward, we will have a large play in the IT hardware segment. So the idea was to deepen the level of manufacturing, get into the backward integration. So one, we had signed with HKC on the displays. Displays were mostly for mobiles, IT hardware, TVs, as well as automotive. Now this partnership with QTech, which is a Indian subsidiary of a Chinese company, we will take a majority stake in this company. They are into manufacturing and supply of camera modules and fingerprint modules. And clearly, we pretty much have all the customers in the Android ecosystem. So, and they supply to all those brands. So we buy a majority stake as part of our backward integration strategy, so that we are able to offer those camera modules to our set of customers.
There is a partnership with Chongqing Yuhai. I hope I'm saying it correctly. There's QTech. Just Saurabh, any concern at all? Because these things tend to become, geopolitical concerns and flare-ups all of a sudden on the kind of stake these Chinese companies will have then in the JVs. It goes into privacy, data protection, etc. So are those guardrails in place?
Yeah, there'll be enough guardrails. This company has been already operating in India, QTech, and there is no government approval which will be required for this particular transaction, because you're buying an Indian company, in a company which is operating in India. So there's no such approvals which are required. As far as the other JV, potential JV of this Chongqing Yuhai manufacturing is concerned, machinery is concerned, which is basically for precision components for mechanicals and metal parts, again for mobiles and IT hardware largely. So there it will be a 74-26 JV, and that would of course require the approval of the government under the Press Note 3 guidelines. And we will of course apply for our approval. We feel confident that government has been very forthcoming in giving those approvals. Of course, there are certain broad conditions that the Indian company should have a kind of a majority in that particular JV. There should be some kind of a transfer of technical competence or technology which should happen. So we feel confident that, of course, it will follow its own due course, but we feel confident that we should be able to get these approvals.
What is the timeline for those approvals under Press Note 3? Because these are, the intention has been obviously conveyed by you, Mr. Gupta, but then it is dependent on the approvals from the government under Press Note 3, isn't it? What are the timelines for this that you see in place?
So QTech, as I mentioned, there's no approval required. So we should start consolidating those numbers from Q3, hopefully. The next few months, we should be closing the definitive agreements with them. As far as this other JV is concerned, I think so they should take another 6-7 months to get those approvals. And so we expect that those numbers should start reflecting in our numbers from next financial year.
Just one more question on this China JV bit of it, Saurabh, before we move on to other aspects of what Dixon's broader plans is. We've talked about guardrails from a governmental policy standpoint, but what about you as a company? And I'm just referring to what happened with Foxconn a few weeks ago, when suddenly their engineers and their technicians, for whatever reason, had to leave. When you're looking at that transfer of technology, are there enough guardrails for you internally in these JVs?
Yeah, we think we'll have enough guardrails that will be factored into the agreements. And please understand, for them also, it's a decent kind of a part. It's a good partnership because we bring in the customer access to our own customers. We give them a large order book of our customers, and clearly, of course, we get access to their technology. We get access to their talent pool. We get access to their high precision manufacturing. So I think so it's a win-win situation, and enough guardrails will build into the agreements. And I feel that the government will be forthcoming in giving those approvals. Of course, it has to follow its own kind of a due diligence at the government's level, but we feel confident about it.
Saurabh, good morning. We may not be able to talk exact numbers, but the one thing, Saurabh, that people think about, and increasingly I've seen that in notes, in conversations with fund managers, etc., is that with the base and the size that you have, plus the competitive intensity increasing, it's a given that you can't have the pace of growth that you probably had in 18, 19, 20 or FY21, if you will. But that could there be a significant slowdown in the pace of growth, even if you try to manage the return ratios, etc.? Could that happen as a natural evolution of Dixon as a company with the size that it has achieved now?
So Neeraj, one, we feel there is a large opportunity for everybody. So if you look at India share in global EMS space is just 3.5%, and a lot of analysts, a lot of reports have projected that this number can go to say almost higher single digits by 2030 and almost 19-20% by 2040. Clearly, we see a lot of tailwinds internationally, given the way it is happening globally. A lot of tailwinds for India, government policy framework for India. So one, Neeraj, should definitely make a note that one, there is an opportunity for everybody, and Dixon will not get everything which is there in the which is available. So we feel that given the kind of investments that we are making in backward integration, in systems, in people, in also building up a great infrastructure, I would say. We feel that we are better positioned as compared to some of our competitors to take advantage of this opportunity, largely in mobiles, IT hardware, and we've already got that first mover advantage by getting all the customers on board. Now we are getting the first mover advantage by getting into this backward integration play of displays, camera modules, this mechanicals, and metal parts. So we feel that, and we have a strong balance sheet, so we'll continue to invest in that business. And I feel confident that our relationships with most of our partners are very strongly are very strong. And some of the partners, some of those relationships are also happen through a JV or a acquisition or partnership kind of a mode, where I don't see them basically shifting to any other player. So we feel that lion's share of business of all those brands will be with us. Yes, some part of that business as part of the brand's de-risking strategy can potentially go to our competitors, but we feel confident that if suppose last year numbers was almost 39,000 crores, we feel confident that in next 2 years, this year as well as next financial year, we should be able to almost double our revenue numbers.
Well, Saurabh, we're looking forward to talk to you more and keep up the great work. Thanks so much for talking to us today.
Thank you, Neeraj. Thank you. Thank you.
That's Dixon. Okay, Tata Communications is the next in focus. Let's get in Somit to set up the conversation and give us an insight into the results. Somit.
Well, if you look at the first quarter numbers, they were a bit below compared to what the street was estimating. If you look at the revenue, it was down 0.5% at close to 5,960 crore. EBITDA growth was just 1.3% at close to 1,140 crore. Margins expanded by around 40 basis points on a sequential basis, with the net profit number that was down around 82%. But this was because of one-offs, not only in the first quarter of FY26, but also in the fourth quarter of FY25. In fact, in the fourth quarter, there were exceptional gains of around 890 crore rupees, while in first quarter there was exceptional losses of around 62.6 crore rupees. Hence we are seeing this 82% drop in the net profit number. But apart from that, even if you adjust for the net exceptional gains and losses, the numbers are below than what the street was estimating. Now if you look at the data margins, they continued to decline. EBITDA margin in fact was lower than estimates owing to weaker gross margin and rising contribution from lower margin portfolio products.
Well, Somit, let's put some of those things and the questions to Kabir Ahmed Shakir, CFO of the company, joining us on the show. Kabir, so good having you. Thanks much for taking the time out. Relative to what you may have either guided for or expected or led the street to have expected, this flattish kind of growth, what could have been the reasons for the same? And also, Kabir, just a word on the margin picture as you kick-started the year.
Morning, Neeraj, and always good to be back on the show. Let me unpeel this for you. I would say over the 3-4 years, the journey in Tata.com is almost like a swan on a lake, and it look calm on the outside, but we are like paddling very, very heavy. Sometimes there's a splash, and sometimes it's calm. And I think it's one of those quarters where it may look, kind of flattish on the top, but there's a lot of heavy work, that's gone in, and that's why I'm here to unpeel, those details for you. I mean, the growth at a very top level, consolidated for all of it, maybe a decline of 0.5%. I mean, that's a result of a couple of things. One, honors deal that we did for one of our subsidiaries when we exited, that deal. I mean, we had to take that reversal on the top line. All the costs were already provided for, so it didn't have a P&L impact, but optically, it did bring that down. So I'll shift the focus to data growth, despite all these macroeconomic conditions and uncertainty on tariffs and all of those things, grew at a 9.4%. And let me again, resituate, this growth, no acquisition benefits on the base. So it's a clear apples and apples comparison. So a 9.4% growth is something quite decent. I mean, yes, we would wanted it to be in double digits, but I'm quite happy with 9.4. On the margins front, Neeraj, we are making a sequential improvement. We were at 18.7 when we ended the year. We closed at 19.1. So we're making a steady increase in margins to get back up. Sumit actually did a very good analysis of our PAT. We had the land sale. I mean, I've spoken many a times on the show. We have a real estate strategy. We are going to monetize land parcels. And as we monetize land parcels, these are chunky, deals and chunky transactions, and they will come and hit in that particular, quarter or a quarter before when we recognize the deferred tax, asset coming as a result of that. So you'll see that lumpiness coming through. If we remove, all of that impact, yes, there is headwinds that we have because of mix effect. Our core connectivity business, has, declined. There are again some reasons for it. That's a high calorie business. If that declines, you obviously see that effect, come through. Our digital portfolio is picking up. It is lower margin to start with, but it's our focus. We will get to a certain scale after which we can, ramp up the profitability of the business. So I would say this is all clearly on track. Yeah, I mean, there'll be a little bit of slip here there that I'm fine with that, but it's clearly on track.
Yeah, I mean, no, small slips can be understood, Kabir, 100%. But just a question on that, therefore. If I strip off the M&A, what is the margin? And because of these, it's a challenging business per se. You still some time away from 23 to 25. Do you reckon that is multiple quarters out, that guided zone of 23 to 25%?
Neeraj, let me, first answer the M&A. There's no M&A effect anymore because the base is also now, with M&A, and now even the current quarter is with M&A. So the effect of M&A is completely worn off because Kolera happened almost, 7 quarters ago, right? So that effect is completely out. In terms of our margin, we just concluded our investor day early June. We gave a very clear picture to the, to the street. By FY27 is what we wanted to get to 23 to 25. That's out by a few quarters, 4, 5, that, is out. Are we committed to that ambition as structurally as a company? Absolutely, yes. Right. So we are tracking against that.
Okay, but there are no timelines that you are attaching to that, I reckon, for now.
We have given an ambition that we are looking at FY28 to get back into that particular range. But my only point is, in between, if there is any corporate action, that kind of happens, and lots of these things are there. I've told the market that we are continuously reviewing our non-core assets, right? And whatever action that we may actually take will have a corresponding impact, up or down. So we sold the ATM business. We diluted our stake in NetFoundry. Another 10-11% is left over. We will do at some point in time. So all of those actions, will continue to have an impact. Sometimes up, sometimes down.
So Kabir, would you say that then for the 23 to 25, FY28 should not be construed as a guidance, but more like an ambition? But there are other actions which may change the timeline.
All our numbers that we have quoted, right? Doubling our business, margin, ROCE, these are all our ambitions and our guardrails with which we take management decisions. These are not, I hate to give, I know the market loves guidance, but I hate to give guidance because we are in such a volatile business scenario, right? I mean, interest rate environment, tariffs, geopolitical crisis. It's very difficult to pinpoint one number and not have the elbow room to navigate your business.
So then that 28,000 crores as well by FY27, you would reckon now that too you are saying it's not a guidance per se. It is more a number that you want to reach, but it may happen in FY27 could get pushed as well.
Absolutely. So the moment we start aiming higher, we are of course, doing better than what we used to do, right? So we used to be 5 years ago, low to mid single digits, kind of growth in this company. We consistently delivered for a a lot of quarters double digits. So we want to stay in the double digit territory. I mean, 9.4 is almost, there close to 10. And once we, start aiming at double digit, then it's a matter of time. We will, our digital portfolio should start kicking at 25-30% kind of a, growth trajectory. Then we will get there to doubling our business.
Okay. By the way, because the stock is doing very well now, 4% higher as the conversation is going on. Kabir, just one more question, maybe two more, maybe very quickly. One, I think in Q4, as I'm told, you had mentioned that few deals which are supposed to get signed got rolled over. Now, tell us about deal signings and about the order book as well. Has it grown? What's the outlook? Are large deals still getting time to close?
Yeah. So, Neeraj, firstly, Q1 signed a very, very healthy order book. Right. So I'm quite pleased with that. It's a very healthy double-digit order book that we actually signed, in Q1. Now, the effect of it we will see in Q3 from Q4 onwards. It does, take time. The large deal time closure, well, that's the nature of the beast. Ours is, an important, activity, but never an urgent activity for an enterprise, right? So to bring that urgency is where we are to demonstrate, what the value we bring to the, to the table. But these uncertainties will always remain. I think we need to build that into our funnel. I think we need to build that into, our ways of working and maybe work ahead, and circumvent that. That's what the teams are doing. So I'm happy with the order book that we have in Q1.
Those rollover deals, you closed some of those too, you're saying,
yes,
right?
I mean, yeah, we've closed, some of them, and there's, one which needs to have happened this quarter again got rolled over. I mean, so that is going to be now almost BAU.
Got it. Kabir, one final question, and I'm not asking now you now for a guidance on core connectivity, but just the color there, right? Because that, as you also mentioned, right, was kind of, maybe you're trying to stitch it together, it's taking time, whatever, but it was weak and it's been there for a while. Now, I'm not asking for a quarter from where it will turn, but give us some color about where do you expect the recovery to be like?
Yeah. So, yes, I would say for the last 3-4 quarters, we did have cable systems down and cable cuts that happened. Never happened that 3 cable systems were down at the same point in time. So that was the reason why we saw the decline, in the last few quarters. Now that's behind us. Q1 is normally, when we do renewals, of contracts and stuff like that. So that has its own seasonality, effect coming through. We don't see this business as being, a negative growth as we see this quarter. That's not where this business belongs. If we actually look at the macro trends, DC to DC connectivity is going up. AI and use of AI is going up. And for using of AI, you do need, to pump in the data to train the models. So all of the macroeconomic factors are in favor of supporting a core connectivity growth. And therefore, we are behind it to get our customers to start, using that. So I would say I would soon start to expect this to come back to its low to mid single digits growth, if not definitely in 2 quarters.
Got it. I'm not constraining that as a guidance though, Kabir. And point well noted, more indicative numbers, not a guidance on any of those numbers. Wish you all the best for the quarters ahead. Thank you so much for taking the time out and speaking to us today.
Thank you, Neeraj.
All right, that's Kabir Shakir on Tata Communications, have 4.5% higher now for that stock. Deal signings have been particularly strong for them, as he mentioned. This time around, and some of the rollover deals from Q4 have also been signed in. Okay, on to an NDTV Profit exclusive. About 60,000 businesses and traders are learned to have received GST notices from state GST departments in Gujarat, Tamil Nadu, Andhra Pradesh and a few other states, apart from Karnataka, where traders and businesses have threatened protests and a complete shutdown over tax authorities assessing their UPI transaction data. Shimi Johnson with more on this. Shimi.
Yes, apart from Karnataka, actually couple of states, GST department, especially in Andhra Pradesh, Tamil Nadu and Gujarat, have issued similar sort of notices to trader and businesses seeking tax demand for not getting registered under GST and evading taxes for some time. And in fact, the sources tells us that the investigation revealed that the UPI transaction of these businesses and traders has actually actually revealed that the turnover, the transaction they are receiving is above the threshold limit of GST, which is 40 lakhs for goods and 20 lakhs for services. Now, these businesses are predominantly is in the business to consumer segment, like ice cream parlor, eateries, event companies, as well as automakers, dealer, etc. So now the GST department, the state department particularly, is trying to nab these businesses who are not under the GST registration despite crossing the GST limit, and try to sort of ensure that they are GST compliant. But at the same time, there are certain debates going on the UPI transaction, as investigation has tried to sort of track these UPI transaction of these businesses, and in some more state may also use these data to understand and to track the transaction and the turnover of these businesses to ensure the compliance part. So the debate is going on that whether the authorities have legal authority to access these data is one point, and in fact this has sparked a more bigger debate on the fact that whether it could demotivate the UPI transaction and push towards the cash economy. But so far the development is that more state GST department in different states have started sending notices seeking tax payment on pending dues, and in fact they have also reported that some businesses have also actually underreported the income, underreported the tax, and they are ensuring that all should come under the GST net.
All right, thanks for that, Shimi. Well, other company in focus is IOCL. With the geopolitical turmoil and trade wars escalating, crude has shared its share of volatility as well. In an exclusive conversation with NDTV Profit, we spoke to Mr. A.S. Sani, the chairman of IOCL, who tells us that the latest challenge close to reality was when the Strait of Hormuz was at stake. Listen in.
OPEC, in fact, has hinted that they will be boosting. So far, there was a trimming of production. They will be boosting supply going forward. How are you looking at that macro situation and crude impact on crude overall on the pricing as well?
Actually, it is basically not increasing, I will say. It is a partial restoration of what was cut down earlier. It was earlier cut down to a much larger extent. Now slowly every quarter or every few months they are bringing back those figures, and still they have not reached to where they were 3 years back or 4 years back. So it is basically restoration of whatever was earlier kept as capped. And that is what the hint that we got, or that is the sense that we got, that they are also trying to bring a stability to the whole oil market, which is in their favor also, because they also get a sense of what kind of revenues they are going to get in coming future or in the coming year for their budgeting. And it gives a good sense to us also, because we also understand where do we stand in terms of what amount of outgo will go in terms of billions of dollars that we will be going to spend as India or as Indian Oil in the coming year.
So what's the sense?
The sense is that today we are at, when we are talking today, we are at $68.5 to a barrel or something. The sense is that it is going to come down and it will be hovering around 65 somewhere. My sense it is more 60 to 65 range, it will be there. And this is because so much uncertainty is there in the world today, that some premium or some penalty, I'll say, is always there in the crude barrels because of this uncertainty. Because every day some new news is coming, some different news is coming, different view is coming, different set of statements are coming, and everything has to be factored it into dollars per barrel. So that's why it is at 68 or 69 today. But if everything is normal, if we go by normal supply chain, a supply demand kind of a scenario, it will certainly cool down and it will come to 65 or below 65.
So cool off, will it mean for retail consumers, will it mean a lower price in terms of retail petrol, diesel, etc.? Should that be something they should be looking out for?
I think this is a very tricky question that you are asking me, and I am not very comfortable answering it. But I always say that whatever we earn, it is going into capex. Whatever we earn today, it either goes back to the government as dividend, 50% of it, or to the other stakeholders also, and the balance of it goes into the capex. And capex is today ultimately necessary for the company, for India to develop, for India to grow, and for India to meet its energy demands going forward. We have to do capex. If I don't do capex, tomorrow we will face a very severe problem. So this whole thing, and then we'll also have to build in a scenario wherein anything can happen, and tomorrow is another war starts. Because in the last 3 years, you have seen that 3, 4, 5 big wars have happened. Ukraine has happened, India-Pakistan has happened, Iran has happened, then Israel versus Hamas has happened. So there are so many things are happening all across the world. And everything again comes down to and puts its weight on the dollar per barrel.
गोल्ड क्लास ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
They promised guaranteed returns. They advertised illegal trading in broad daylight. But NDTV Profit picked up the trail.
2 साल हो गए मैडम। डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We called, we questioned, we exposed.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
Because your money deserves protection, not empty promises. Easy money, hard lesson. Stay alert. Verify before you invest.
जनता के पास सवाल ही सवाल है। जवाब ढूंढने को वो देखती है न्यूज और देखती है यहां तो सवालों का मायाजाल है। ऊपर से ये अलग फाइट है, कोई पूरा लेफ्ट तो कोई पूरा राइट है, बीच
This week on Talking Point Unfiltered, we sat down with Ravi Dharamshi, founder and CIO of ValueQuest Investment Advisors. We explored the mega trends driving capital markets and pharma, and how can investors spot pockets of value, particularly from these couple of sectors. Here's a snippet from that really insightful conversation with the Alpha Investor. You've always spoken about these mega trends all through the times that we've spoken. Back from 2015-16 when I first started talking to you, when I think we were in the midst of the chemical mega trend, if you will, and the pharma mega trend, you kind of try to identify some of these and then maybe invest early in them and then ride the whole wave till you can. Would that be a good summary of one basic investing style?
So let me try and explain a bit with a little bit more nuance and a little bit more in detail. See, in any particular industry, there are phases, right? You have a tough phase, struggle phase, then you hit that inflection point, you have the great growth phase, and then you reach a kind of a plateau, then again you have a growth phase. Idea for us is to identify which that growth phase is. Everybody can name a lot of mega trends today, but even within a mega trend, you make money only when you are invested in that particular growth phase. And for that, you need to be very clear in your mind what stage that particular mega trend is. And there are markers that we keep track of, whether it is the technology curve, the cost curve, behavioral shifts, regulatory shifts, capital flow, talent flow. All these things tell us which way the wind is blowing, how strong that wind is. Is the mass adoption reached that kind of an inflection phase? Are we going to see a J curve kind of a growth phase? If yes, then that is the phase in which the maximum value creation tends to happen. And that is what we want to capitalize on. A mega trend can last 20 years, 30 years, 50 years, but the phase of making money might not last that long. That might be a 5, 7, 10 year phase. And that is what we want to capitalize on. I hope that's a small nuance that I had about investing in megatrends.
No, it is a good one, but just trying to probe that a bit. So this would be different for different industries, right? The growth phase, if you will, because I read a chart in your presentation that there is a start phase, a growth phase, and a scale phase, if I'm not wrong. So for every industry, its growth phase would be different.
Absolutely.
In terms of the timing.
Oh yeah, for sure. In terms of the timing, in terms of the duration, in terms of what kind of delta we can see, how much of that value can actually be captured by the participant, everything differs from one trend to another, one industry to another industry. And one trend can spawn many sectors also. It is not restricted to one sector. And for example, we have spoken a lot about energy transition, but it is actually a trend that encompasses 15-20 different sectors. It is not restricted only to solar. Solar might be the biggest, but there is power transmission, there is biofuels, there is nuclear, there is hydrogen. So many other sectors are also part of the energy transition, and not every sector hits that inflection point at the same time. Solar probably has hit that inflection point 3, 4, 5 years back. Nuclear is probably some time away in terms of hitting that inflection point. So you need to be able to identify that inflection point within a mega trend to be able to ride that extraordinary growth phase where the value creation tends to happen.
What are the markers for this growth phase? I mean, are there common markers which people can take kind of?
No, so let's go one by one. I already mentioned them, but let's say technology curve. So for example, lithium-ion battery technology has hit that inflection point 3-4 years back, and it is expanding it is getting adopted very, very quickly. However, there is a competing technology called sodium-ion technology. Now the problem with lithium is that lithium is short in supply, and we might not have it in our country. So then you might still end up being facing the same problems that you face with fossil fuels, that you're at the mercy of some other nations whether they will supply or not, like it is happening in the case of rare earth elements right now. Now, sodium ion is freely available, but that technology has not reached that inflection point because the lithium ion by nature tends to be very dense. Sodium ion is not that dense. If it is not that dense, then you need more of the material to produce the same unit of power. And for that means maybe the size of the battery expands. So if that is the case, then the applications will be different. It might not be applicable in a transportation kind of a thing, but more stationary kind of application might be there for sodium ion. So where are we on the technology curve? Then where are we on the cost curve? It is not only about technology. Nuclear might be a mature technology, or solar, for example, is a 70-year-old technology, but it hit that cost inflection point few years back when China mass adopted it. And once China mass adopted it, the prices crashed. And when prices crashed, that's when the mass adoption everywhere else in the world has begun. So along with the technology, you need to hit that point in cost also. Then regulatory tailwinds need to be in favor. Governments need to be supporting that, no, we are going to adopt this particular technology and we are going to incentivize the user industry to deploy that. Then you need to see the money flowing in, that people deploying the money need to be able to see the IRRs, and if they can see IRR, that's when the money will flow into it, and that's how everybody will plan their capex and their capacities according to the opportunity. So a confluence of a lot of things need to happen for you to say that this particular technology has reached the takeoff stage and now money can be deployed. From a primarily a listed market investor's point of view, investing in something that is 10-20 years out is not a prerogative. We don't invest in something that is loss making or not reach that kind of an inflection point. So we have a very time limited view of these trends. In next 5 years, which are the technologies which will hit that inflection point where we can make good money, and that is how we narrow down our focus.
Got it. Okay. So so okay, let me, so by the way viewers, we've done a very exhaustive conversation with Ravi and his colleagues on the energy transition piece. So I'm not going to spend so much time on this episode talking about energy transition as much as I thought we'll talk about two other themes and two other mega trends and try and take Ravi's understanding of those mega trends and want to understand whether the technology markers or other markers, if permissible in these industries, how do they suit or how do they fit in? So let's talk about financials and a particular subset of financials, Ravi. You've been selectively constructive in that bucket. 2025 has marked a new Reserve Bank of India and people are very constructive on NBFCs. But I remember a conversation with you wherein you spoke about how the non-lending financials and particularly the capital marketplace is a mega trend that people should have caught ideally early, but maybe right now, is it too late to latch onto it, or is it still in the early cycles?
So definitely we are not at the beginning of it, but at the same time I don't think we are at the end of it also. I think this particular trend has a long way to run, and we will see a lot many more players emerging out of here. And case in point, my own firm, which is an AMC, right? We might see a lot of AMCs. We are witnessing one of the first private equity, pure play private equity player filing for DRHP, and they might get listed. Tomorrow there will be other alternate asset managers that will also get listed. And I think this is still the beginning of the trend. But let me dial back. What are the drivers of this trend? Number one, India is getting formalized. India used to have a huge informal economy. With the advent of GST, with the informal sources becoming less and less because we are going towards cashless, less cash economy, let me put it that way. So the avenues for the cash deployment are going down and down, and that means you have to go through the formal channels in terms of borrowing or lending or doing any kind of business transaction. So formalization is underway. Second trend is the financialization is underway. And when I say financialization, essentially India used to be a 35% savings economy. We have dropped to being a 25% savings. 25% of the GDP is what we save, but 25% is also a huge number when you put it in context with some of the developed nations. They barely save. So of that 25% bucket, large part of it used to go towards real estate, gold, nothing against that. But as you create more and more wealth, it's only so much real estate that you can handle, and it's only so much gold that you can have. All these, the billionaires and the wealth family offices that have come up in the last 5 years, they are not incrementally going to buy more and more real estate or more and more of gold. So they naturally are gravitating more towards financial assets. Now it might be so that some people might prefer alternate assets, some people might prefer mutual funds, some people might want to invest overseas, but that's fine. Incrementally the money is going more towards the financial assets. So one is the formalization, second is the financialization. So any financial product which is fee based will see a big tailwind over the course of the next 10-20 years. In some way, this is a moment you can compare with the 1980s in US, where in their what is it called, 401k, they were allowed to invest in equities, and that trend caught up and it became bigger and bigger portion of the American public's portfolio. And I think it went from some less than 10% to more than 40-50% kind of a number in a 20-year time horizon. I think we are in year 4 or 5 of this. The way we have seen the money come into equities and particularly in SIPs and mutual fund is, I believe, a beginning of a trend. For a long period, since say 2008 till 2020, almost a 12-13 year period, we did not see that pie grow at all. Markets were more driven by foreign flows rather than by domestic flows. But because of allowing EPFO money, because of more money getting into the financial channels and into the market, now we have enough pools of capital domestically to be the main driver of this whole trend. And I think this is still the beginning. So any business that is in and around the capital markets, it could be bond markets for all you know, but in and around the capital markets should do well over a 10-20 year period. And of course, like any other industry, we will also have our cycles and there will be consolidation also at some point of time. Right now it is all very fragmented because the numbers are large. More and more people. In fact, we are going to witness one of the largest top 3 players in the AMC industry getting listed. If this is the beginning of the trend and the player is still getting listed, I mean, I'm sure the trend is not over. But of course, it doesn't mean you will make money necessarily from the next 1-2 years perspective. You have to have a slightly larger perspective over there is what I feel.
Indian hotels in focus for a pretty decent quarter at a time when it has been tough with geopolitical tensions also dominating. We're speaking with the MD and CEO Puneet Chhatwal on the results for Indian hotels. Mr. Chhatwal, thank you so much for your time with us here at NDTV Profit. So the consensus seems to be that it's been a good quarter. ARR has remained in double digits. RevPAR has been decent despite some turbulence. How has that been achieved?
You know, we have been consistently communicating the change in our business model, which gives us the resilience. We have a very strong, not like-for-like growth. And obviously, our iconic assets and the strength of our brands help us in higher penetration in the market. So the RevPAR premium that we are able to command, especially with the Taj brand, is significant. And the Taj brand just continues to grow from strength to strength, well supported by all other brands and especially the new businesses.
Of course, revenue per average room has been good. ARR has also been good, the average room rate, and some boost coming in from the New York property, the Pierre. Is that something which was slightly unexpected? Is that one segment, the global properties which are beginning to pick up?
Yes, you know, Pierre has been a drag for us for almost 2 decades now in terms of the profitability, in terms of its iconic status, in terms of its location, in terms of its addition as a marketing tool. It has been a significant contributor. So it's a double-edged thing that has happened for us. We have made certain changes there, which have worked well for us. And this quarter was the best ever quarter for Pierre. And I think the ones that will follow will be the same. What is also interesting is that San Francisco, which unexpectedly went really bad for the last 2-3 years as a city, it became very dangerous to even walk through the city center. is now coming back to a very normal situation, and obviously it'll take another 1 or 2 years to get to the level where it always used to be. So I think all in all, both the American properties have contributed positively, but going forward, I am very bullish also on London. I think London has been buzzing in the month of July, and obviously the next months that will come, it should do well, and it's a very large property for us. So international business more and more robust, not anymore a drag. What it used to be 7, 8, 10 years ago was a consistent messaging. Also, properties which we have on management agreements in Dubai are doing well. There is no big challenges in Sri Lanka or Maldives at the moment. So very positive. We'll be opening Frankfurt in the end of Jan in this financial year. And before the end of the calendar year, we will open Paro and Phobjikha in Bhutan. So all in all, also on the international front, things are looking positive.
There's also a plan for a bit of front loading of your capex, which was planned at $50 billion over the next several years, and I think about 12 billion coming in this financial year as well. Can you explain the idea behind it, the rationale behind it?
Just a correction, Tamanna, not dollars but rupees when you say.
Yes.
Yes, the rationale is when you're in a high growth phase, I think it's a good time to invest, especially when you are having good free cash flows. And as long as our free cash flow is higher than the expected capex, it is a right strategy at this point of time, and we don't have any debt. So investing in our core business, investing in our competitive advantage, investing in our assets like Bandstand. Now we are deposited the monies for the IOD, that's the intimation of disapproval, which is a significant amount. And going forward, we first had thought like few years ago, we'll take a partner to do such a big development. But now with a lot of cash reserves that we have, we can easily do this on our own through our internal accrual. So hopefully that will also kick in at the end of this year or in the Q4 of next year with MOEF and CRZ permissions also having come in. Now we just wait for the commencement certificate.
What's been another positive surprise or a positive development is the performance of TajSATS. Do you see that continuing, or was this more of an aberration?
No, TajSATS is, as a business, has done well in the last 3 years. It has become more than 1,000 crore business, expected to get to 1,500 crores soon. And, you know, we all know the news with the number of new planes coming into India. Serving meals in the skies will be a very important business going forward. And also TajSATS is diversifying into non-aviation business, using those kitchens and utilizing the capacity that we have for institutional catering contracts. So I think over time, we will see that the dependency on just airline catering will be reduced from 100 to 80%, and 20% of the contribution will come from non-aviation business for TajSATS. It is doing phenomenal margins for the business that it is in. It's at around 23%. 23% EBITDA margin in this kind of business is very healthy, and we are very optimistic about the future of TajSATS. Just think about the number of new airports coming in, the number of new aircrafts coming in. So this demand is going to keep increasing by leaps and bounds.
So what is the current revenue contribution of TajSATS, and where do you see it go to the total business?
Today, it is around 1,200 in an absolute terms. So it's around like 17-18% of the revenue. But the other businesses are not going to stagnate. So as long as TajSATS and other businesses that we have, the new businesses, if they get to 30% of the total revenue, and our revenue guidance has been that it will go to 15,000 by 2030, then we will be very pleased with the outcome.
Another aspect which is a bit different, and if you could explain this for our viewers, is the Ginger Calcutta plan, the tie-up with the Tata Sons platform. Now, what exactly is that, and where do you see that business going?
It's an interesting story. The Ginger success at the Mumbai airport, and then our tying in for the Bangalore airport, and then followed by our own investment in Goa airport, triggered this idea that we could have another platform with the help of Tata Group. We had one with GIC also. So this idea was in the making for several years, and under the guidance of the chairman of our board and the board members, we worked on it, and we could have done this also on our own, but I think it's a good asset to kickstart, especially it's an airport location, very visible, and the asset will be completed and finished and will go into operation in 12 to 14 months. But from our point of view, it gives us another source of capital where we remain the owner of the business and the capital is coming from another source. So we are not putting our capital for every project, and we still have the monies to do other projects also. So it's always good to have different sources of capital, and internal accruals is one, but getting Tata's on board or Tata Group or Tata Sons on board is just, I would just call it another blessing and another very important strategic step.
But what was the reasoning for it? I know I asked this, but if you can, because it's a fairly newish development, so people are trying to understand it. What is the reasoning for it, and is this a one-off? Will you be doing this more and more? How will it help you on the balance sheet, if at all?
We will be doing more and more of this, and this is just the start. It's a part of just another example of the trust in the brand, the trust in the management's capability to deliver. And it's not a very big investment from a Tata Sons point of view. So we can do easily several of these under this platform. And we are very excited, actually very happy to have actually done a deal on this platform. And that too, it was finished on 30th of June. So you see that movement in some of our ratios in the way that was done.
What is the advantage for Tata Sons here? For you, of course, there's another source of capital as well. But for them, what is the advantage?
That question is you have to ask Tata Sons. From our point of view, it's another source of capital. We get a revenue share model. So we have the revenue, we have the profitability. We will provide good returns like to any other owner, in this case to Tata Sons. And as I said, we are very happy to have this for our new brands as another source of capital to scale up rapidly and have significant contribution from the Ginger brand to the IHCL ecosystem at large.
Okay, let's get your view on the forward-looking aspect of it. The July quarter was a strong one. The base is strong. Do you expect the momentum to continue? The geopolitical tensions are behind us. So, what is the outlook looking like?
See, Tamanna, there is always going to be some headwinds. What we have behind us, that we know, but what is lying ahead or coming, we don't know what will come from there. The job of the management is to navigate through any of these crises. Having said that, given our strength of the brands, number one, our not like-for-like growth, number two, the demand expected to outpace supply in the next several quarters to come. Even once it will level out, it will level out. We'll see when that happens. Given these three important factors, with a very diversified brandscape, which has helped us diversify our top line, I see no reason why we are not able to protect our margins or to continuously deliver on all the promises that we have made.
Brought to you by Canara Bank. Together we can.
Gold Plus glasses that build the nation. Clear glass that shows the world. Mirrors that reflect dreams. Reflective glass that shields from the sun. And build homes that bring families together. Our country, our glass. Gold Plus glass.
और सप्लायर ने ऑर्डर शिप कर दिया?
हाँ, बस अब पेमेंट्स करने हैं।
पेमेंट्स के लिए SBI योनो बिजनेस इंस्टेंट है। फॉरेक्स ट्रांजैक्शंस, टैक्स पेमेंट्स 24/7 365 डेज फट फट फट।
सबको पता है।
SBI योनो बिजनेस फास्ट है, सबको पता है।
हम होंगे कामयाब, हम होंगे कामयाब।
हम हो गए कामयाब, हम हो गए कामयाब दिन ब दिन। ओ मन में था विश्वास, पूरा था विश्वास।
बढ़ते इंडिया की कामयाबी को ना कराएं एक दिन का भी इंतजार। सम्मान कैपिटल के साथ पाइए होम लोन्स, MSME लोन्स और लैब। जियो सम्मान से।
माय बर्थडे गिफ्ट टू पापा, ये उनके पापा की पहली गाड़ी एक गैराज में पड़ी थी दार्जिलिंग में। जब इसे फाइनली घर लाया ना, तब लगा लाइफ में ग्रो किया। बुलाओ।
SIP करो, इन्वेस्ट करो, लाइफ में ग्रो करो। प्रतिभूति बाजार में निवेश बाजार जोखिमों के अधीन है। निवेश करने से पहले सभी संबंधित दस्तावेजों को ध्यान से पढ़ें।
रास्ता है वही शहर।
तू कब आया अभी लाइफ से?
अरे वाह ताई, पहचान गई? शहर जाके आँख का ऑपरेशन करा लिया क्या?
बाहर जाए मेरी जूती। नहीं, यहीं अपने गांव में ही करवा लिया। वो जो सूरज है ना अपना, वो सब कर रहा है।
अरे राकेश, अरे वाह छोटी, ये स्कूल में सीखा?
इंटरनेट पे।
इंटरनेट?
हाँ, सूरज भैया है ना?
कौन है ये सूरज भैया?
आपको उनसे मिलना है क्या?
हाँ
चलो, वो रहे सूरज भैया।
हम सूरज से सिर्फ बिजली नहीं बनाते हैं, खुशहाली को देश के कोने कोने तक भी पहुंचाते हैं। अदानी, हम करके दिखाते हैं।
Hi, thanks so much for joining in. Happy Friday to you. My name is Alex Matthew. With me is Mahima Vachajani, and this is Ask Profit, a show that gets you answers to all of your stock-related questions. And to that end, there are several ways that you can get in touch with us. You can either send us a message on the number on the top of the screen, or you can call us on the number at the bottom of the screen. We would love to hear your voice. Remember, if you're sending a message to us for the first time, tell us where you're tuning in from, what your stock is, or maybe a stock that you want to buy. And remember to also tell us what your time frame is ideally. Is it short term or long term in nature? Let's very quickly take you through how the markets are faring this morning. And it's another day of, wow, it's actually changed over the course of the last 20 minutes. And you have the Nifty 50 that's trading with cuts of about 0.7%. I wonder if this will hold to the close of today's session, because prior to today, the last 4 trading sessions have been pretty range bound for the Nifty 50. Even yesterday, despite the fact that you saw a little bit of chop and churn and a slide towards the end of the session, it's been quite range bound. So I wonder if the Nifty 50 will hold below the 25,000 mark as it is currently doing. I wonder what the broader markets are doing. Let's pull those up. The mid-cap index currently trading also with cuts of about 0.7%. So just over the course of the last 15 to 20 minutes or so, you've seen quite a bit of selling emerge. Let's also pull up the winners and the losers, or rather the advanced decline ratio, just to give you a sense of how that is faring. And you have a few clean signs. For example, there is news that the promoters are going to be selling 24% stake. Shoppers Stop reacting to earnings, down about 4.4%. Axis Bank also reacting to earnings, and particularly the technical write-offs that the bank has announced to the extent of 4,000 crore rupees. Street not taking it too well. Sterling and Wilson Solar, a decent set of numbers, but the order book and the order wins in the quarter not very good, and so that's having a bearing on the stock as well. Tata Com also in focus on account of earnings. Nuvoco, Vistas doing quite well, up about 3%, but off the high point of the day. Let's pull up the advanced decline ratio, because I want to see if that has shifted quite materially. There you go. What a dramatic shift over the course of the last 20 minutes or so. and right now you have far more declines on the screen. So it looks like we might just be ending the week on a bit of a weak note. We've got the first questions already in, and in fact we've got Sameer Dalal of Natwar Lal & Sons Stockbrokers and Jatin Gedia of Mirai Asset Share. Khan, thank you so much to the both of you for joining in. Manav is calling us and is the first caller today. Manav, very good morning to you. You're calling us from Gurugram. Namaskar, how can we help you today?
Hello, namaskar. Good morning, everyone. Good morning to the experts also. So I'm holding 50 odd shares of DLF at the average price of 733.
Right.
I have I can hold it for like 5 years. I have initial holding. And I want to know. I'm very much interested in this counter to add more. So, what would be the appropriate price to add more?
Yeah.
At what price I can add more? And what is the street? Is there any street estimation on the upcoming results? If I can get a brief on that Q1 results also.
Yeah. Okay. Let me ask Sameer what he thinks. Sameer, a lot has been said about the valuation of DLF as things stand right now. The fact that it's once again looking to enter the Mumbai market, the fact that it has that income that it is receiving through rental income, and that is expected to go up over the coming years as well, heading to that 10,000 crore mark. What do you think about the valuations as they stand? Would you build on it right now?
The valuations are a little bit on the expensive side, but if you have a 5-year view, I think the opportunity is quite large, right? So entering the Bombay market is not like the changing point for DLF. They have huge parcels of land in Gurgaon, which they're going to be developing. Like you rightfully said, the even rental income will continually keep increasing because they're building more projects, which they keep renting out. So overall, the business fundamentals are quite strong. Valuations are punchy. But I think, what's happened is the Indian markets have started to live with high valuations across the board. It's not something I'm in favor of, but the fact remains that people seem to be very okay with these high valuations. For example, Godrej Properties continues to trade extremely expensive, similar with the Prestige Estates from Bangalore. So wherever you are, if you're buying anything in the real estate space, valuations are punching. So if you have a view of holding for 5 years, keep holding on. If you're asking me the right price to add on to the stock, which is what the question was, I think closer to 650, 700 would be great if you get, but the probability is you may not get, given the kind of money that's there in the system and given the fact that real estate is being chased as an asset class, not as class, but as a stock investment from, that segment is something that's looking very attractive. You may not get that. So hold on, look at other stocks in that sector. My suggestion, as I've been saying for some time, Keystone Realty is a Bombay-based developer under the brand Rustamji. You could probably diversify your portfolio a bit, plus have something at a little better valuation with good growth opportunities.
Okay, so that's with regards to where DLF stands, and of course the entire view on the real estate sector, and Keystone is what Sameer is liking. All right, our next question is from Siju, who's writing us all the way from Qatar, and he's asking about Protein EGOV, and it wants to know the right levels to make an entry in this counter. Jatin, hi, a very good morning to you. I'll come to you on this one. What do you think is the right time to make an entry into this counter?
See, Protein has been in a downtrend. We'll wait for the stock to close above 840, 845, where we have the resistance currently. So at this point of time, I would not suggest to jump the gun and try to catch a falling knife. So wait for the stock to close above 840, and then only we can re-enter or make a fresh entry into this stock. As of now, avoid is the suggestion.
Avoid Protein EGOV is the suggestion that Jatin has with respect to where charts are concerned, of course. Dheeraj is our next caller. He's calling us from Hyderabad. Dheeraj, hi, a very good morning to you. How can we help you today?
Good morning, ma'am. My query is regarding Garden Reach Shipbuilders.
Okay.
I purchased 46 shares of Garden Reach Shipbuilders at 2596. Sorry, 2600, ma'am.
Okay.
So, should I stay in the same counter for the short term, or should I shift to something like HCL or Persistent, which have corrected, is my query, ma'am.
Okay, Dheeraj, I got your question. I'll take this up with Jatin. Jatin, are the charts attractive enough for Garden Reach to continue to stay invested, or shift to something like a Persistent?
I think the charts are suggesting a little more downside towards 20 to 80 on the downside. So that's a decent 300 point downside even from current levels. Now, at this point of time, we believe that the places to hide would be FMCG and pharma to some extent. The defensives would be these sectors to hide out. So, at this point of time, GRSC, some correction is warranted. Look out for stocks like Marico, HUL, Godrej Consumer, where you can park some of your investments currently.
All right. Okay. So that's the view on Marico. Guna has got the next question, writing in from Hyderabad and asking about PVR Inox. He's bought at levels of 1,052. He's got 500 shares. The stock is currently trading below that, but because of the size of his purchase, he is losing about 44,000 rupees at this point. He intends to hold till at least 2029, and he's wondering whether there's a four-fold or five-fold increase that is possible over the course of this time frame. Sameer, what do you think?
So four-fold and five-fold is difficult to say. Look, the problem for PVR Inox has been twofold. One, the online, the Netflix, the Amazon Primes, and all this content that is now available at home, that is kind of eating into some amount of the spends that are happening at the movie theaters, because you can sit in the comfort of your home and watch a nice movie or show or whatever. You don't need to have that entertainment necessarily going to a theater. Now, going to a theater is an experience, and that is something that will obviously remain. So we do believe that there will be people constantly going to the theater, but where the second problem has been is the content has not been the greatest over the recent past, right? So what is very important for this space is the content comes in that is something that draws the public in. And that has been a bit of a lack, and that's why you've seen this stock not doing too well. Then you also have certain news where certain states, they want to cap pricing on tickets. I think it was Karnataka government that said they want cap pricing on tickets, so that works out as a bit of a negative. So these overhangs have led to the stock being a decline. We believe the growth for the space is still good, because yet I think the opportunity for multiplexes to expand is there. But I'm not saying you'll get a 5x, but definitely you can get a 15 to 20% CAGR return over the next maybe 5 years. So if you're willing to stay invested, if at 15%, maybe or 20%, you could be 1.5 times in 5 years' time, not 4 or 5 times.
Okay, that's a very interesting take. And the ticket pricing that he's talking about is Karnataka, which is a big market for PVR Inox and has capped tickets at 200 rupees. So that's a big overhang for sure. All right, the next question is from Hansraj Nahata, who's writing us from Delhi. He's got 1,500 odd shares of healthcare global enterprises bought at 550 a piece and wants to buy more at the current levels and wants to know if this is a good counter to continue to hold for a longer term perspective. And this question is directed to you specifically, Sameer. I'll come to you. What's the view like for healthcare global enterprises?
So it's a good counter at the end of the day. Again, punchy valuations when it comes to the entire space. Look, something like this, the healthcare space and especially in the hospital business will continue to see traction growth. We've seen the stock has had a massive run up if you look at it over the last maybe 2 years or so. So you're paying top dollar for it. So if you want to buy some more, I think wait for a while. You might get a time-based correction, maybe not price-based, and that time you might get a better opportunity to get better returns on your money. It's a good counter to hold for the next 2-3 years, but I would not be willing to add at this point of time.
All right. So Siemens is the name of the counter we're talking about next, and Vijay from Mysuru is asking a question. He's got 110 shares at a price of 3,700 rupees per share. He's got a short-term outlook of the next 3 months, and he's wondering what the potential upside is from this point, and he's losing quite a bit of ground at this stage. Jatin, on the charts, is there a possibility of him recovering his buy price, and how long would he have to hold for that to take place?
Yeah, see, currently post this correction or sideways consolidation, it has reached its 20-week average, which was around 3,040. And now from there on, we are witnessing the buying interest also kicking in. So we believe that it has reached its now crucial support zone, and we can expect a move towards 3400 to even 3500 to from a short to medium term perspective. So hold on is the suggestion with a stop loss at 3000, and he can expect, or if he can add more at current levels, then nothing like it, and we can expect 3400 to 3500 from a short term perspective.
Okay, so hold is the view on Siemens with respect to where technicals are concerned. The next question is from Satyan. He's holding Kolte Patil with around 55% of profit is what he's saying. And he's saying that is it better to switch to something like a Ahluwalia contract for the next 12 to 15 odd months? Samir, I'll quickly come to you on this one. Your take on Kolte Patil, and if you don't like the counter, should you shift to something like Ahluwalia contracts?
So I don't have coverage on Kolte Patil, so difficult for me to comment on that. Neither is the Ahluwalia under my coverage. But if you're looking for something in the construction space or the real estate space, the one we recommended for real estate is Keystone Developers. If you're looking for a counter which is doing the actual construction activity, which is what something similar to what Ahluwalia does, one of the counters that we like in the space is a company called BL Kashyap, which is kind of a turnaround over the last many years. The stock has seen a decent correction from 110 odd levels to maybe 70 odd levels. Look, they have good order backlog with the construction activity continuing to take place in Delhi and NCR region where they have a primary focus. We think they will continue to do well. Valuations seem expensive, but once the operating leverage kicks through, I think you'll see that the valuations are not so expensive. So those are the two I would recommend given that. I just want to if you give me 30 seconds, about Siemens, I don't think 3,700 is the right price. And if it is the price he's bought it at the previous question, it may be before the demerger that happened for the Siemens
Let me
Energy.
check. Yeah. It's an important point that you make.
Siemens has not gone to 3,700 post demerger.
Yeah, it's an important point that you make. I will check. I will write to him and ask that question. In the meanwhile, let me go across to this interview that we did with Polycab India. It has reported a strong set of numbers in the first quarter, and in fact, a 50% year-on-year growth in net profit. The revenue from operations also surging. In fact, Mahima spoke with him, with the management, Mr. Tongia, and here's what they had to say.
Mr. Jaisinghani, I'll start with you first. As I mentioned, it's been a great quarter, strong execution in terms of cables and wires. There's been growth momentum that has continued. FMEG profitability is improving quarter by quarter. Just want to get a sense of this quarter. What is the volume versus value growth been like? And because the kind of revenue growth that you've seen, have you seen market share gains as well?
Yeah, market demand is good, and availability we are keeping and supplying material. Demand is good and still looking better in future.
All right. Mr. Tongia, I'll come to you on this one. Have you seen volume growth this quarter? If yes, what's the gap between that volume versus value growth? And plus, market share gains is also seen this quarter?
Thank you so much. You're absolutely right. This was the best ever first quarter in the history of the company. We did close to 6,000 crore rupees of top line and bottom line of 600 crore rupees. At the company level, the growth is around 26%, and cable and wire, which contributes close to 85% to the company's top line, registered a volume growth of mid-20s. Within that, cable grew at a rate which is higher than wires growth rate. So cable was perhaps around in late 20s, whereas wires was in early 20s. And in terms of FMEG, which contributes almost 5-7% to the top line, has also registered a fair amount of growth, a leader being the solar category. And other categories have also improved performance, particularly on the premium side of it.
Okay. In terms of your EBIT margins also for the CAPEX business, Mr. Tongia, I just want to get a sense because they've been in the range of that 12 to 15% mark. Considering that competition is also heating up, do you think some impact or pressure on the margins going forward, or will they be in that same range? And if yes, will that be on the upper side of the range?
You're right. We gave our guidance for the next 5 years in Jan this year. We call it Project Spring, wherein we are trying to transform the organization. This, in a way, is an extension to our previous transformational project, Project Leap. Within the Project Spring, we aspire to grow at a rate better than the industry's growth rate in cable and wire, perhaps around 1.5x of the industry growth rate. As far as FMEG is concerned, we would like to grow at 2x of the industry growth rate. On profitability, let's split it in two parts. On cable and wire, historically, we have been guiding 11 to 13% of EBITDA margin. We believe we should be able to maintain it, and wherever possible, probably would be able to improve it. As far as FMEG is concerned, last 2 quarters, we have been able to report profitability in this segment, March as well as June this year. Between now and 2030, we would like to get to 10% of EBITDA margin in FMEG. So overall, at a company level, it's possible that we are able to improve on our profitability predominantly because of FMEG improvement.
So then, where do you expect the blended margins to be at on a consolidated level basis?
So as you know, the cable and wire, our guidance is 11 to 13%. FMEG will improve from say whatever 2-3% to 10%. That is where there should be a possibility of some improvement. On the other side, there are some expenses which we'll have to probably incur as we go along. For example, advertisement and publicity is slightly under index at this stage. So we'll do that. We are also doing a lot of capex. This year, likely number is going to be around 1,500-1,600 crore rupees. This first quarter itself is 400 crore rupees. So if we were to take a balanced view, it's quite possible a few basis points here and there. But we are aspiring to have profitable growth, sustainable growth, and industry-leading growth.
Okay, so 15% margins is doable, correct?
What I'm saying is today we are hovering between 11 to 13% on cable and wire, and FMEG we should be able to improve. And on a blended basis, we are looking for a profitable growth. And I would probably take you back to 2020 guidance, which I gave. You know, we don't give quarterly annual guidance.
Okay, Mr. Jaisinghani, just want to get a sense on the exports part of the business. You know, it is revived, saw 24% growth this quarter itself on a YOY basis. Just want to get the export scenario considering everything that's happening in the US with regards to tariffs. Of course, we are not certain yet as to how the tariffs will be imposed, how much percentage will be imposed on India. But how is it looking like? What's the scenario like?
I think so. Export will be continue because let it be whatever tariff come. But definitely our relation with US, our PM's relation with them, I think so they will support to India. And they will definitely put the tariff, but they are not going to put a huge tariff to India. So that will be, the export will be continue.
Right. But then,
demand is good there.
Correct. So then do you think that export business will see that impact? And if yes, what do you think will be the impact on financials then going forward? Mr. Togia, you can go ahead and answer that question.
So exports, as Inderbai mentioned, is an important line of business for us. Under Project Spring, our guidance is that we would like to get to 10% of exports contribution to top line. 5-7 years back, it used to be 100 crore rupees, and it is material number already contributed to almost 5.5%, 5.23% to the top line. And it's not only US-based exports; it will continue to be there across all the geographies. We already have presence in 80+ countries. So it's a broad-based growth opportunity. We are taking all the initiative to grab this opportunity, and we firmly believe that in years to come, we should be able to improve on exports contribution to company's top line.
All right, the management of Polycab and quite a few brokerages coming through very positive on the stock and the outlook going forward. They've raised their target prices as well. I think Macquarie was one of them, if I'm not mistaken.
No, they've not.
No.
I'm not sure.
Jefferies.
Yeah, I think
Jefferies dramatically increasing it. I like the interview, by the way.
Yeah.
I saw that you pushed them a little bit to try and give you a guidance for them.
Guidance for their margins for sure, but they did not budge.
Well, you got to try.
Yeah.
Having said that, let's move back to the questions that some of you have asked. And by the way, if you've got questions on Polycab, you know where to send them. Bharti Airtel is the name of the counter that we're talking about next. And Santosh is writing in from Hyderabad. He's seeking a view from you, Samir, on the fundamentals. He's bought levels of 1,960, 4,400 quantity. What is a view according to you? And we'll see Reliance Industries results. We'll see Jio results today. How do you rank? And I'm not even asking about Vodafone Idea. I know your view on that. But between the two, would you say that Bharti is going to be the right bet in the telecom space?
Bharti is the only bet in the telecom space you can actually make if you want, because Jio, you're buying Reliance Industries, which you're buying a whole bunch of other stuff as well. I mean, I'm not saying that's bad stuff, but it's not a telecom play per se. And the carrot, which they've been dangling, that's been pushed back further. So I believe now they're not even going to do the IPO in the current financial year. So Bharti is really the only play you can make an investment in the telecom space. Now, again, the problem with Bharti is valuations, right? So given it's kind of I'll not say it's a duopoly, but it's more or less a duopoly given that fact that Vodafone Idea is just limping along. Bharti will obviously be able to get share. And as the ARPUs keep moving up within India, the profitability will keep increasing for Bharti. So I think it's something that will do well over maybe a 5-year period, but you expect very, very muted returns or even over a 5-year period for the simple reason that you're paying very lofty, high valuations for Bharti right now. I'm not talking about purely the India business. Even if I look at the all the assets that he owns internationally and everything, I think you're paying very, very high valuations. So unfortunately, you bought it at a very high price. Maybe if it comes closer to 1,500, I would advise you to average on. Again, like I said, given the fact that we're living in a scenario where valuations don't seem to want to come off, you may not get that, but don't expect these high valuations to sustain forever. At some point in the near future, they will come off, and that's why I think returns will be muted. So if you can find something else to invest in for the time being, take this money off, find something else, and buy Bharti at a lower price.
Okay, so that's with regards to where the entire telecom space stands, and for Samir, that's just Bharti Airtel. All right, Samir, since we were talking about the Jio IPO, there's one more question on Reliance. Kaushik is writing us from Vadodara, Gujarat. He's bought Reliance Industries at 1352, and he's got 20 odd shares, and wants a long-term view on this. Considering that we are expecting the earnings today, what is the kind of expectation that you have from the earnings, and should he continue to hold?
Yeah, so first of all, you can continue to hold on to the stock. I think the long term for them is still very good. Look, the 1 quarter results won't change anything for me. If you ask me what I'm expecting of the results, I think the results will be fairly in line. You will see a big jump up in profitability because of maybe that sale of those Asian Paint shares. But that's a one-off. So I wouldn't, if we eliminate that part of it, I think they'll do quite well, right? They'll do a stable set of numbers. Now let's talk about the various businesses, and just quickly, we believe the telecom business, they are the second largest. They are the largest player actually when it comes to it, and most profitable player at the end of it. They will continue to do well. So whenever the listing for that happens, will lead to value unlocking. The retail business, they are again the largest when it comes to store footprint, the space that they have, the number of brands that they have under the entire basket. We believe that the consumption growth that's going to come over the next 2-3 years is going to be really good in India, and Reliance will obviously be one of the benefactors of that. And once the operating leverage for them starts playing out, I think people will start thinking that the retail venture should get a better valuation. Oil to chemicals will continue to do what they're doing. It's a cash positive business, which will continue to remain so. But what they're getting into, the renewables, setting up all of the renewable energy, getting into green hydrogen over a period of time, the new age businesses that they're going to be doing, I think that will lead to a lot of upside potential. So stay invested in Reliance. I think the long term is really good. Valuations are not mad expensive. Actually, one of the few counters where I can say the valuations are good, then you can even go out and buy today at these values. So I'd say stay invested, and if you can, whenever you get a chance, add some more.
All right, so that's view on Reliance Industries. Jatin, I understand that you have to leave us, and thank you so much for joining us today. Really appreciate the time that you spent with us, and happy Friday. We have to slip into a very quick break. We'll be back on the other side to take more of your questions, so do stay tuned.
Brought to you by Canara Bank. Together we can.
Samman Capital Limited announces a public issue of secured redeemable NCDs, offering coupon rate of 9% per annum for NCD holders in category 3 and 4 for 24 months in Series 1. Tranche 4 issue is open for subscription. To subscribe, log on to www.sammancapital.com. For issue structure, risk factors and more details, please refer to the Tranche 4 prospectus available on the websites of SEBI, stock exchanges, company and the lead managers.
जब मुंबई से वापस कोल्हापुर शिफ्ट हुआ तो सबने कहा कि ड्रीम सिटी को छोड़ रहा है। ड्रीम सिटी, मैंने कहा ड्रीम में तो यही गलियां आती। तो जब ये रियलाइज हुआ कि कुछ बड़ा करने के लिए बड़े शहर में रहने की जरूरत नहीं, तब लगा कि लाइफ में ग्रो किया।
SIP करो, इन्वेस्ट करो, लाइफ में ग्रो करो। प्रतिभूति बाजार में निवेश बाजार जोखिमों के अधीन है। निवेश करने से पहले सभी संबंधित दस्तावेजों को ध्यान से पढ़ें।
ये रोशनी का सफर दिलचस्प है, दिलचस्प है।
हम सूरज से सिर्फ बिजली नहीं बनाते हैं, खुशहाली को देश के कोने कोने तक भी पहुंचाते हैं।
ये रोशनी का सफर
अदानी, हम करके दिखाते हैं।
Hello, Moto.
Welcome back. You're watching Ask Profit, a show that gets all your stock-related queries answered. For viewers who are just tuning in, you can either call us or WhatsApp us on the numbers that are flashing on your screen. And as we speak, markets are actually trading at its day's low points. Almost 42 companies out of the Nifty 50 companies are now trading in red. Nifty down by about 0.7 odd %. The Nifty IT also under pressure by 0.4 odd %. Nifty Bank seeing a downtick of around 1 odd % in trade today. But with that, let's also welcome in Rajesh Bhosle on this side of the show, equity technical and derivative analyst at Angel One, joining us now. Very good morning to you, Rajesh. We've got our next caller who's lined up. Pradeep is calling us from Bengaluru. Pradeep, hi, a very good morning to you. How can we help you today?
Good morning, ma'am. I'm having Gland Pharma, 30 shares bought at 1365. Now, it was below my purchase price for long, but recently it has started rising. So, should I hold it for a long term, say 1 or 2 years? Or should I book profits at this stage?
Okay, Pradeep, I got your question and take this up with Samir. Samir, your view on Gland Pharma?
Sadly, Gland Pharma is one of the few companies in the pharma space that we don't cover. So no comment on that. But the entire pharma space is expected to continue to do well. It's just that you got to see what the exposure of Gland Pharma is to the US markets, and if Donald Trump does put in some sort of tariffs, and how quickly or how efficiently they'll be able to shift that. But barring which, I don't have a view on Gland Pharma.
Rajiv, your quick view on Gland Pharma with respect to where charts are concerned?
So technically, if we see recently the stock has given a saucer pattern breakout at around 1900 levels. So we see extension of up move possibly towards its previous swing high of 2200. So buyer can hold on to it. 2200 is what we are expecting. In fact, any dip towards 1900 would be a buying opportunity.
Rajesh, apologies for that slip of the tongue. Mahima will buy you a coffee later for getting your name wrong.
No coffee for Samir this time.
This happens to one of us every week. And I'm terribly sorry.
Very sorry.
It usually happens on a Friday, Rajesh. So maybe we should call you on another day of the week. All right. So let me get the next question. Mithun from Karnataka is saying that he wants to start trading. And his plan is to start with 1 lakh. And he's wondering what his strategy should be. Could you help him? It's for you, Rajesh. Yeah, it's for you.
Okay, so first of all, Alex, wonderful combination of coat and shirt you are wearing.
I think my inspiration came from you, though I don't know about it.
Okay, so I think it's from a 1 year's point of view, if I'm not wrong. So overall, what now we need to do is we need to see which sector that would perform from going ahead from here on. So the sector that we are bullish is auto and cement space. And from the auto pack, if we see, we are very strongly bullish on M&M and Hero Moto. And also, if we see cement space, we are very bullish on Ultra Cement and Ramco Cement. So sectors rotation is what we need to see, because we don't expect a broad-based buying, but sectors that will perform, and auto and cement is what we are expecting to perform in the coming year.
Got it. Hopefully that gets you started, and if you've got specific questions about any of the stocks that were mentioned or any other that you spot, then you can send your questions here. Shiva is calling us from Chennai. Shiva, very good morning to you. How can we help you today?
Hi, good morning, and thanks to Ask Profit. I very closely watch your show almost every day.
I'm glad.
My question is regarding Tata Steel. I purchased it towards end of last month with a long-term view.
Okay.
I just want to know, I purchased at the price of 160, 500 shares. Just want to know whether, it's flat after it went down a bit. What's the view of the company? Is it time to accumulate more, or what? Or will there definitely be an upside, or how is it showing?
Yeah. Am I right in assuming that this is part of your long-term portfolio though, Shiva?
Correct, yeah.
Got it. Okay, so then the question is to you, Samir. Tata Steel, there's a lot of buzz, and I think every time there is some conversation about China data coming in a little better than expected, there's a spurt in metal prices, and as a result, metal counters go up. There's so much in the way of tariff announcements that has had a bearing on these counters as well. What would you say specifically about the business and the fundamentals of Tata Steel though? Would you add more?
So, the fundamentals of Tata Steel are probably far better than what they were in the last maybe 3 to 4 years. They've managed to bring down their debt levels. They've pared off some of their loss-making units in the UK. And, the fundamentals keep getting better. But remember one thing about steel companies, especially, anything to do with commodities, they're cyclical in nature. So when you say you want to have them as your in your portfolio as a long-term investment, it's great to have it, but expect huge ups and downs over the period. If you pull up maybe a 5-year or 10-year chart on Tata Steel, you'll see massive up moves and down moves. So right now we believe we are still in the midst of a bull cycle for for the metal space, and that's why Tata Steel, being one of the counters which is doing quite well when it comes to everything, it will continue to go up, and we believe the stock would probably move towards the 200 levels. But keep a very, very close eye on commodity prices, and if at any given point of time you start seeing commodities starting to peak out, or supply increasing in a huge way from China, or certain things happening, then get out of these counters, because the fall that can happen can be very, very large. So I'm not a big bull, perpetual bull on metal counters, but Tata Steel, given where it stands and given where commodity prices are, can continue to do well over the next year and a half.
Okay, so that's with regards to where Tata Steel stands. The next question is from Mani, who's writing us and asking about Varun Beverages. He's got 606 shares of Varun Beverages at the price of 453 and wants to know if he can continue to hold from a short-term perspective. But it's an interesting question, Rajesh, because he's asking how long can it rally in the short term? What do you think? Is there further upside that you're seeing on the charts?
So this week, if we see, the stock has outperformed and is up around 8%. In fact, on the weekly chart, we are seeing that last 5 weeks weakness has been engulfed. So yes, in short term, we do expect a further bounce back. Possibly 520, 530 is what we are expecting. So can hold on to it. And on the downside, if we see somewhere around 470 is a strong base for the counter in the near term.
Okay, all right. Ashoka Buildcon is the name of the counter we're talking about next. And Kishore is saying Namaskara from Bengaluru. He's bought at levels of 180.7. And he's saying that they're showing, according to him, what he's seen, Samir, they've shown good earnings growth over the years. And considering the exceptional demand on construction, would you mind providing... Okay. So he's asking for order book guidance. I guess this is a question that we can ask to the company next time we speak to them. But how do you look at the fundamentals? Samir, would you say that this is something that you would buy? Would you say that the valuations are reasonably attractive?
The valuations for Ashoka Buildcon have been reasonable for quite some time. I mean, if you look at it, what they own in the the road construction projects where they are obviously looking to divest some amount of stake and all of those. But this company is kind of disappointed for me for a period of time. I actually was invested in it for quite some time, and then given the kind of stock performance it had over the last many years, we've actually taken a call to exit it. The fundamentals remain decent. We believe the construction space will continue to do well. They will continue to get decent orders. They will execute it. But for some reason, this stock just doesn't seem to perform. So we've taken an exit. I think there are other counters in the space which probably have done far better, where orders have been growing at a quicker clip. So from that point of view, I think rather focus on something else than an Ashoka Buildcon.
All right, Balaji is calling us from Madurai with the next question. Balaji, very good morning to you. How can we help you today?
Yeah, hi, very good morning. I would like to say that I'm a regular person who watches this show. Appreciate your efforts.
Thank you so much, sir. Really, really nice of you to say that. Please go ahead. Please go ahead, Balaji. Yeah.
I do have a query. Is it the right time to buy HDFC Bank shares? Because I am an investor who wants to invest in all the categories like large cap, mid cap and small cap stocks. So I would like to know from the experts.
Okay, that's a good question, Balaji, and let me take your question to Samir. Samir, possibility of a bonus, and I was actually looking at whether or not banks usually do a bonus issue, and it's not very common from what I saw. And there was an interesting comment that I read on social media. Somebody was just pondering, banks need capital, of course, to grow, and they have to give out dividends as well. This is something that they do. But when they give out the bonus, it doesn't really do anything for them, and it creates pressure on dividend payouts down the road. Is that something that you agree with? And also, that's an aside. Balaji's question was essentially, should you buy HDFC Bank?
So to answer Balaji's question first, I don't think there's ever a bad time to buy HDFC Bank. If you look at the history, whoever's bought it at any point has made money. Yes, the stock has run up, but if you have a 3-year view, I think you'll continue to make money. Now, coming to what you discussed on bonus, so bonus really doesn't change anything for anyone, right? It's not saying that because they've given a bonus, that now that if they've given a 10 rupee dividend last year, after they give the bonus, they'll give a 10 rupee dividend. Dividend is always as a percentage of the profit that you make. So that will change accordingly, obviously. And that doesn't change the dividend yield when it comes to, the pricing or what the stock prices so that doesn't change anything. So I don't see it. It's just that when you give a bonus like this, it allows the price to come off, and maybe some smaller investors can get into the stock rather than only, many large investors. So it allows smaller investors to invest. Beyond that, there's no really reason for giving a bonus, if you ask me.
Okay, our next question then is from Angad, who's writing us from Indore. His question is on Mahanagar Gas Limited. He's bought at the levels of 1324 and wants to hold for the next 6 months to 1 odd year. I'll come to you on this one, Rajesh. In terms of Mahanagar Gas, what are the charts indicating?
So recently we have seen a channel breakout on MGL, and after a mild correction this week, we are seeing resumption of up move. So higher bottom chart structure is forming on the MGL. So definitely a hold kind of counter. In the near term, we expect a strong support around the levels of 1465, which is a strong support of 20 EMA. So 1465 would be the stop loss, and on the high side, possibly the stock can move towards the levels of 1650 in the near term.
Okay, so that's with regards to where MGL stands. Our next caller, Shankar, is calling us from Chennai. Shankar, hi, away. Good morning to you. I believe you have a question on Piramal Pharma.
Yes, very good morning.
Good morning.
I want to know about Piramal Pharma, madam.
Yes, okay.
Is it correct time to enter it for long-term investment?
Okay, I got your question, Shankar. I'll take this up with Samir. Samir, Piramal Pharma, what's the view like?
I think one can continue to hold. Yes, valuations again a little punchy. It's trading at about 40 times historical, but they have a decent pipeline of products coming through. They obviously cater more to the Indian market as well. So we believe the growth opportunity there is also quite good. So I'd say continue to hold on. Expect slightly maybe a 12 to 15% CAGR return over the next 2 years, any correction would become a better buying opportunity. So closer to maybe 160, 170.
Okay. All right. Sushila is writing in from Bellary in Karnataka. NDPC Green is the name of the counter. 112 is a buy price. 726 shares have been bought by Sushila and wondering what to do with this. Currently trading at 111, so very close to the buy price. On the charts, Rajesh, what's the view?
So as of now, not much is happening in the charts. If we see last 1 month, it has been consolidating within the range of 120 on the upside and 103 on the lower side. So as of now, no momentum. But yes, definitely some higher bottom structure is there. So can hold on to it. 103 would be the stop loss. And on the higher side, 115 is what the immediate resistance is. That also coincides with the May swing high. Once 115 is taken, then possibly the stock can move towards the levels of 135 to 140. So as of now, hold 103 would be the stop loss.
Got it. All right. Jitendra is calling us from Hyderabad next. And Jitendra, very good morning to you. How can we help you today?
Yeah, good morning to all. Sir, I'm holding the 70 shares of Sona BLW at the rate of mentioned there. So, sir, mutual funds are aggressively buying the shares, and can you please tell me that can it be a good bet in future, like multi-bagger?
Multi-bagger. What is the time frame that you have in mind, Jitendra?
I can hold up. EV sector will boom in future. No, I can hold more than 2 years.
More than 2 years. Okay, Samir. So auto ancillary player, of course, Sona BLW. I haven't really seen the data, and I must go back and look at which mutual funds are buying. But Jitendra seems to have read something. What do you make of it? Would you add at these levels, and what are the prospects for 2 years?
Yeah, so we are quite positive on Sona BLW, and 2 years is a great period to be investing. This company's seen a huge correction recently. The prices valuations have become, I'll not say cheap, but closer to fair. Now, what we believe is the growth opportunity for this company is still very strong. Unfortunately, recently the promoter just passed away, so we need to see how the new management now who's going to steer ahead and guide the company going forward. But we believe, look, they have great prospects from the electric vehicle side. They're one of the largest providers of certain products to Tesla. In fact, yesterday there was some news that they're looking to tie up with BYD for certain products in China. If they're able to do that, BYD is the largest electric vehicle manufacturer in the world, which is going to continue to grow. So I believe long-term, Sona BLW is something that will do well. Yes, you can go out and buy at this price as well. I think in the next 2 years, probably we could see a high of close to 700, 750. So I would recommend a buy for this one.
Okay, recommend a buy on Sona BLW. All right. The next question is from Akshay, who's bought HAL at 3489 per share and has got 144 odd shares. Wants to know if he can book profits at the current moment or hold for a year or so. Rajesh, I'll again come to you on this one. What are the charts indicating for HAL?
So from a short-term point of view, we are seeing a topping out formation. The recent swing low has been broken, and earlier 50 EMA was acting as a support, and that has been reached. So in the near term, we are expecting price correction, possibly a dip towards 4,300 is what is expected. So yes, profit booking can be done at current levels.
Okay, so that's the view with regards to where HAL is concerned. Our next caller, Shankar, is calling us from Kolkata. Shankar, hi, a very good morning to you. How can we help you today?
Good morning. I'm having 150 shares of Birlasoft.
Okay.
Bought at 293 rupees.
Okay.
Now, I just wanted to know whether I should hold it for another 1 or 2 years, or should I book my profits and shift to Deepak Nitrate?
Okay, got your question, Shankar. Samir, he's sitting on profits of almost 20,000 odd rupees. Should he book profits for Birlasoft and shift to Deepak Nitrate?
So definitely, I think you can book profits in Birlasoft. I think, look, I've not been very positive per se on the entire space when it comes to the IT. So I still believe that there are better opportunities in different segments. Now, book the profit. Now, should you be invested in Deepak Nitrate only specifically? So I believe the fertilizer space will do well, the chemical space, but I think Deepak, nitrate is not the counter that I would be recommending, given the fact that valuations are high, given the fact that growth has not been there and the chemical space has not been doing relatively well in the recent past. I think there are other opportunities when it comes to auto, if it comes to banking and financial services, when it comes to consumption. I think that is where my focus would be. So I'd rather find something in those spaces. I can tell you, if you were looking at the bank, IDFC First Bank is a great investment. HDFC Bank, IndusInd Bank. If you're looking at the consumer space, anything in the QSR space would be something that will do well. Westlife Developers, Restaurant Brand Asia, Sapphire Foods, Devyani, those are good counters. If you're looking at clothing, then you can look at a Trent. Of course, Trent is valuation very expensive, but operating leverage can be great. Otherwise, a Vedant Fashion is something you can look at. So I would focus more on that side than anything. And if auto, of course, Sona BLW is there. We think Tata Motors is a great investment. Hero, Honda, Bajaj Auto, any of these are good investments to make over the next. So I'd stay away from a Deepak, but yeah, these are some of the counters I can suggest to you.
Samir, you can tell, or at least I can tell, how long somebody's been looking at the automotive space when they say Hero Honda. But point well made, and quite a few stocks that you can choose from. So not just, of course, the viewer that asked that question, but anybody who's tuning in, a whole host of fundamental buys that Samir has suggested. Apollo Hospital is the name of the counter that we're talking about next, and short-term target is being sought by Malika Mehta, who's writing in from Mumbai, and she's bought at levels of 7,750. Actually, no, can it be bought at this current level for a price of 7,750? She's talking about the next 6 to 9 months. Rajesh, on the charts, what's the view?
So if fresh entry needs to be done, then the ideal level to buy would be around 7,200. In the past, in the start of the June month, we had seen a breakout around 7,200, and recent low also coincide around that levels. As of now, the short-term momentum is on the downside. So if fresh entry wants to be made, then 7,200 would be the right levels to enter.
All right. Okay, so we just got a view on HDFC Bank on the fundamentals, and of course, Samir has said that you can buy. I just want to very quickly, Rajesh, ask you whether you would, if you bought at levels of 1993, as Mandar has done, how long would you intend to hold if you're only looking for a trading strategy, and what levels would you look at?
So from a trading point of view, if we see somewhere around 1950 is the very short-term support that can be kept as a stop loss, because in the past we have seen 50 EMA acting as a support, and with results around the corner, that support would be very crucial. If prices hold on to 1950, we can see a bounce back back towards 2040 to 2050. But if 1950 is broken, then some short-term downside can be triggered towards 1900. So from a short-term point of view, 1950 would be the stop loss.
Okay, we've gotten a lot of questions for companies that are around that 1,000 crore or less than 1,000 crore, even 50, 55, 300 crore market capitalization. Unfortunately, we're not going to be able to give you very detailed answers on any of these. We will try, of course, but we may not be able to promise that. Narayanan is calling us from Bengaluru. Very good morning, Narayanan. How can we help you today?
Yes, sir. I have bought Lakshmi Organic at the rate of 204.
Okay.
About 1,500 quantity I have bought.
Right.
So what should I do? Last year by the same time I sold it at the rate of 270. As it corrected from that level, I thought it is wise to enter the stock.
Right.
And it is always taking support at the rate of 180.
Yes.
So should I hold it for a month or 3 months, 3 to 6 months period?
Let me ask
Can I please
Rajesh.
suggest?
Yeah, let me ask Rajesh what the strategy should be. 204 is the buy price. What would you do, and where would you place the stop loss?
So not much has happened in Lakshmi Chemical from after it moved in May from the levels of 160 to 220 levels. Now it is consolidating. As of now, if we see last 1 month, the stock has seen support around 189. That also coincides with 89 EMA. So 189 would be the stop loss, and on the high side, if we see 210, 215 is the resistance. That also coincides with previous high and 200 EMA. So 215 is the resistance. Once that is crossed, then we can expect some broad-based up move. On the downside, 183 should be the stop loss.
All right, 183 is the stop loss on Lakshmi Organic. It is time now to hit the rapid fire round. Samir and Rajesh, you know what this means. We'll throw as many questions at you over the course of 2 minutes. We'll start with a question on BSE. This is a question from Krishnan, who's writing in from Hyderabad. He's asking, can it be bought at the current price? And what is the target that you would put? Rajesh?
So as of now, wait. If it dips towards 2250, then can be bought for the targets of 2800.
Okay, the next counter is EPL Limited. Rajendran from Pulend is asking this question and wants to invest from a longer term perspective. Wants to know if he can make the entry right now. EPL Limited is the counter. Rajesh, your view?
Once again, wait. Dip towards 220 can be bought, and then the target would be 251.
Garden Reach bought at levels of 3,425. Sumon from Kolkata wants to know whether to hold for a period of 1 year. Rajesh, what's the view?
So yes, can be holded somewhere around 2350. There is strong support, and once momentum is there, 3200 can be retested.
Okay, Inox Wind is the next counter. Akhil from Dubai is asking this question. He got 23,000 shares bought at 172 a piece. Wants to know if it's a good decision to hold for the next 2 odd months. Rajesh, your view again?
Exit, overall there is weakness, and stock can retest 150 levels.
Samir, Interglobe Aviation for the medium term. Jayakrishnan from Kozhikode wants to know whether to buy at this point.
Avoid at this point.
Okay, Ircon is the next counter. Chandan is asking this question if he can book profits or continue to hold. Samir, your view?
Book profits.
Okay, SIAT results out yesterday. Samir, would you buy at this point?
Yeah, I think you can add on to it. Ideally, I would like more of a correction closer to 3,200, but even 3,800 is fine from a long-term perspective. I believe auto industry and especially tires will do well.
Okay, so that's the next counter. Sankar Narayan from Bangalore, Sula, and he's holding 2 odd stocks of this counter and wants to know if he can continue to hold. Your view on Sula, Samir?
Avoid.
Okay, Moschip, would you buy at this point, Samir, for a period of 1 year, or actually hold if you bought it at levels of 210? No view?
No view, sorry.
Rajesh?
And hold on to it.
Okay, all right. We're completely out of time. Samir, Rajesh, thanks so much for joining in, for answering all the questions. 32 questions is what we took over the course of the last 1 hour. Happy Friday to you, and indeed happy Friday to everybody tuning in. We've tried to take as many questions as possible. Of course, we also had the management of Polycab, and if we don't have any interruptions on Monday, we'll try and take more than 32 questions. Thanks so much for watching. Do stay tuned. Up next is Know Your Company from Mahima and myself and the team that put this show together. Thank you so much, and stay tuned.
Brought to you by Canara Bank. Together we can.
भाई बिजनेस रजिस्टर हो गया?
यस, सिर्फ करंट अकाउंट बाकी है।
करंट अकाउंट के लिए तो SBI बेस्ट है। यूएस मशीन मिलेगा और QR कोड भी। बेस्ट कैश डिपॉजिट लिमिट, ईस्ट और वेस्ट इंडस्ट्री में बेस्ट।
सबको पता है।
SBI करंट अकाउंट बेस्ट है, सबको पता है।
Samman Capital Limited announces a public issue of secured redeemable NCDs, offering coupon rate of 9% per annum for NCD holders in category 3 and 4 for 24 months in Series 1. Tranche 4 issue is open for subscription. To subscribe, log on to www.sammancapital.com. For issue structure, risk factors and more details, please refer to the Tranche 4 prospectus available on the websites of SEBI, stock exchanges, company and the lead managers.
My birthday gift to Papa.
ये उनके पापा की पहली गाड़ी एक गैराज में पड़ी थी दार्जिलिंग में। तब इसे फाइनली घर लाया ना, तब लगा लाइफ में ग्रो किया। बुलाओ।
SIP करो, इन्वेस्ट करो, लाइफ में ग्रो करो। प्रतिभूति बाजार में निवेश बाजार जोखिमों के अधीन है। निवेश करने से पहले सभी संबंधित दस्तावेजों को ध्यान से पढ़ें।
रास्ता है वही शहर।
तू कब आया अभी लाइफ से?
अरे वाह ताई, पहचान गई? शहर जाके आँख का ऑपरेशन करा लिया क्या?
शहर जाए मेरी जूती। नहीं, यही अपने गांव में ही करवा लिया। वो जो सूरज है ना अपना, वो सब कर रहा है।
अरे
राकेश,
अरे वाह छोटी, ये स्कूल में सीखा?
इंटरनेट पे।
इंटरनेट?
हाँ, सूरज भैया है ना?
कौन है ये सूरज भैया?
आपको उनसे मिलना है क्या?
हाँ
चलो, वो रहे सूरज भैया।
हम सूरज से सिर्फ बिजली नहीं बनाते हैं, खुशहाली को देश के कोने कोने तक भी पहुंचाते हैं। अदानी, हम करके दिखाते हैं।
Hello and welcome. You're watching KYC. Today we have a unique company in the oil and gas space that we'll be covering. We're talking about Deep Industries today. Let me first start off with what I want to know with regard to where Deep Industries is concerned. They've guided for a 25% growth. They're seeing good growth tailwind, but for how long is really the question, because it's a small company, 3,000 crore in terms of market cap, and therefore the tailwind can be very, very strong. The question is, as the base starts to creep up, and it's done a decent growth clip over the last 3 years, and you'll see those numbers, as the number, absolute number in terms of top line goes up, for how long can they grow at 25%? Really, that's going to be my question. The second one is they've announced a 500 crore capex. Now, I want to know everything about this. The funding, I also want to know what this does to capacity, and maybe not capacity per se, but in terms of top line capacity, how much bandwidth in terms of top line does this capacity expansion give to Deep Industries? And the third piece is with regard to ROEs, therefore, because it's such a large capex project, what the ROEs will be at the end of it, or maybe a year or two as this fully starts to kick through. Margins at 40% plus, they've guided that this is sustainable, but of course there's a possible downside risk from maybe a raw material price or otherwise. I'd want to explore that and understand that better. Now, Dolphin Kandla, this is the big piece, because there is a huge one-time knock which the company has taken in FY25. Likely that will not trickle through, but is there absolutely any additional risk with regard to Dolphin and Kandla, or is it fully provided, is what I would want to know. And what the possible upside to it is also something I'd want to know. So both set of risks, downside as well as upside. Then I'd want to know how much will Dolphin and Kandla contribute to margins, because this is more backward integration. So how much will this contribute to the margin number of Deep Industries, and how much otherwise can the margin number go up by in any case, is what I'd want to know. They've guided for maybe a 2% inch up in margins this year. 40 to 43% is the band they've given for margins. Last off, client concentration, of course, very few players in the space, and therefore the clients are concentrated, but is there a thought process to diversify at all, and if so, how, is what I'd want to know. But let's start off with what the company is about. And we did say, and I did mention, that it's in the oil and gas exploration and drilling industry. It provides 70% of, or rather covers 70% of the value chain in oil and gas post exploration, and that value chain is largely what drives the numbers for a Deep. So let's understand the products and services better. One is
the natural gas compression. This boosts gas pipeline pressure, and it calibrates the gas pipeline pressure, and that is one of the services that it provides. Second is gas dehydration, that removes water from the natural gas, making the pipeline safer. Third one that they do is workover and drilling rigs. Now this is of course for new rigs and maintenance of old rigs as well. So both of those is what this service covers. The fourth piece is integrated project management, end-to-end project execution when it comes to oil and gas. Charter hiring gas facilities is also what they cover. Full gas processing systems end-to-end is what they take care of. Production enhancement contracts, takeover and boosting oil fields already existing is also the other piece that they take care of. And then there is offshore marine services where they provide supply vessels, tugs, and accommodation barges as well. So all of those are provided by Adeep Industries. Then there's equipment manufacturing, and this is basically compressor boosters which they provide, among other equipment that they manufacture as well and they provide as well. And then of course it's trading. Specialized equipment is what they trade via international arms that Deep Industries has. So all of this is what they do. In terms of business model, let's understand that as well. They manufacture some compressors, chemicals via subsidiaries based mainly out of Gujarat, but the core is renting services equipment to oil and gas firms, and a lot of them are Indian PSUs. So you have a decent recurring income which continues to come through as well. They also do selling, or rather they operate sites, they sell services, or rather they operate sites through in most Indian oil states. They also have forayed into global expansion, UAE, Africa, Mexico. How much of that diversification is actually playing out is what I'd also want to know. So that's going to be a key. Last one is with regard to raw materials, whether there's any risk of that. Well, in a nutshell, the risk is extremely low. Those are some key inputs for you in front of you. That's with regard to raw materials. Certain suppliers as well, let's pull those up, and those are fairly standard. And commoditization, yes, chemical spares, there is some bit of commoditization but not too much. Price fluctuations are surely a possible downside. Timely availability of specialized machinery is the other big downside. So if you don't get machinery on time, you aren't able to execute all the contracts that you have. And that's something you want to keep in mind as well. So that's broadly the understanding of Adeep Industries. Let's start off with the 8 metrics that we'll talk about today with regard to Adeep: income statement, balance sheet, cash flow, return ratios, shareholding, street cred. We'll look at guidance that the company has given and thereafter derive valuations and try and see where it is, where the 5-year average price to earnings is concerned versus what valuations currently sit at. All of that on KYC today. Let me start off with the income statement. Now, in terms of top line, it's done 21% on a 3-year CAGR basis on the top line. You see the way in which top line has moved. It's moved from around 322 crore to 576 crore in FY25. There's been a consistent growth. The guidance continues to be 25%. We'll come to that when we come to the guidance metric. EBITDA has gone up by 26%. In the same time period on a CAGR basis. From 116 crore, it's come to 231 crore now, so doubled. Margins have also inched up from 36% to 40%, and profitability has gone up from 71 crore to 134 crore, which is a 24% CAGR. But something to keep in mind is you have a one-time knock on that net profit number of 251 crore in FY25, which we have ignored for the purpose of this calculation. Why have we ignored it? Because it was due to an acquisition, or rather a couple of acquisitions that Deep Industries made of assets where the assets weren't fully, the receivables reflecting in the assets and the inventory wasn't correctly valued. So they've done an accounting adjustment, consolidated all the assets into Deep Industries itself to try and work out efficiencies, and that's why there was an exceptional loss. The point being It's a one-time exceptional loss. That's something to keep in mind. That's the trajectory in terms of margins that you are seeing. Now let's look at the balance sheet, and in the balance sheet as well, first off, this is a 3,000 crore market cap company with a near 1800 or 1900, 1850 crore book value. So that's for your reference with regard to the price to book. The borrowing number is also fairly low at just 205 crore. Very strong capex is what they've penciled in. And the cash and bank balance currently sits at around 51 crore. So fairly healthy in that sense. For a 3,000 crore market cap company, borrowing is not too high. This includes short and long-term borrowing. So 100 crore roughly each. So that's the whole picture with regard to the balance sheet. We've given this a thumbs up as well. No concerns. Let's talk about cash flow now. And when you're looking at cash flow, largely we've given this a neutral only from a perspective that cash flow, yes, very, very healthy. But the CFO to EBITDA in FY23 was slightly lower. So there's been some bit of choppiness with regard to CFO to EBITDA. That's something you want to be mindful about. But unwind has happened in FY24-25. So it doesn't look as bad at this point. Net cash flow, not exactly the metric you'd want to look at in a company which is investing quickly into capex. So that's something to look out for as well. They will continue to invest in capex, so net cash flow may not really come through, but again, not the appropriate metric. Operating cash flow is what we will look at, but we've given this a neutral out of abundant caution. Let's look at return ratios now, and you'll see the return ratios are on an upward trajectory, but they've not crossed 12%, and that's for me a bit of a concern. Can it cross 12? That's a question we'll pose to management as they continue to ramp up on capex. But 8, 10, 12, at least there is some bit of consistency to it. There isn't wild choppiness. We've given this a neutral, giving the management a little bit of benefit of doubt with regard to return on capital employed. But broadly, this is one metric which you really want to look out for, because if you're doing large capex, you want to see that the ROCE of the company is solid. So you want to keep your eye out on this one if you're looking at Adeep Industries. Let's look at shareholding now, and you'll see a decent shareholding sitting with the promoters. Very low interest from FIDIs, public hold the rest, and even in terms of number of shareholders, they've jumped substantially from FY22, where there were just 17,000 shareholders. You're currently sitting at 38,000 shareholders overall. So that's one metric you want to kind of consider if at all you are an investor. The number of shareholders has gone up, no FIDI participation, but a thumbs up nonetheless, because the promoters own a very solid 63.5% in the company. Let me now talk a little bit about street cred. And the street cred, 1 month the stock is up 9%, but you look at the 6-month trajectory, negative 21%. Year to date, negative 16%. 1 year, the stock is up 50%. And 5 years, it is up 22x. So what we've seen in a nutshell is that over the longer period of time, as the performance has really picked up with regard to this one, you've seen very strong returns. But in the near term, we've seen that there isn't as much return that investors have made. Is it time to be cautious or not? Well, we'll look at valuations, of course, and that will give us a better picture. But that's the street cred that we see at this point. Now let's look at the commentary that's come through. And this is an important one, because you want to see and you want to be sure that the commentary that's coming through is good. FY26 top line, 25 to 30% growth is what they've guided for. 40 to 43% margins is what they've guided for. They've also guided for PAT to grow faster than top line. We'll extrapolate some of these numbers when we look at valuations. Kandla and Dolphin's receivables are nearly fully provided, is what they've said, but I want to know whether there's a downside or upside risk to that. Contracts with Indian PSUs are fixed, so there's visibility with regard to where growth is concerned. And you also want to therefore understand where do return ratios stack up at the back of all of this, if at all that is the case. But we've given this a neutral out of abundant caution. That is on the guidance. Now let's look at valuations. You've got FY25 to FY26. If top line were to go up by 25%, that's the top line number you'll see, which is 720 crore. EBITDA at 40%. We've been conservative here, lower end of the band, but likely this will be slightly higher. I will give you the number if it's slightly higher as well. So EBITDA margin at 40%, you got an EBITDA of 288 crore, very close to 300 crore. And this is only in a case where you are virtually doing a 40% margin. If you're doing a 43% margin, it's a little in excess of 300 crore. So maybe 310 crore is what the top line will be. And revenue also, I'm building in lower end of the band at 25%. If it's 30%, then the revenue number will stand at 750 crore and the EBITDA number will stand at 330 crore. So that's something you want to keep your eye out on as to where it stands, and maybe we'll get some color from management. Now, profit at 30% growth versus the current year, removing the one-offs, will be around 175 crore. That places the price to earnings multiple at around 17 times. If profit were to do, say for example, 35%, then the number will be 81 crore and the price to earnings will be around 16.5 times 1 year forward. That's just 1 year forward I'm extrapolating for, or rather 9 months forward. Now let's talk a little bit about the market cap to EBITDA as well. That stands at less than 10%. The 5-year average price to earnings on a Deep Industries is around 15 or just below 15. So it's trading roughly at the right price point when you're looking at the 5-year numbers versus the 1 year forward price to earnings. That's the way one should look at it. Maybe a 10% premium on the price to earnings number, but an upside surprise to earnings could well reverse that. And mind you, we're looking at just 9 months forward. So FY27, that's what most analysts currently are looking at. Then maybe this number changes a bit. So something again to look out for. But that's valuations. We've given that a neutral. Let's stack up now all of the metrics and give it the final KYC rating. Let's look at, okay, so those are the first 4 metrics. Income, balance sheet, that's how it's stacked up, and those are the last 4. One thing that stands out here is probably no thumbs down. And if at all, and it's 5.5 on 8, but if at all one were to just try and give a possible one big monitorable here, it's the return ratios, and we'll quiz the management with regard to that. Let me bring on board Rohan Shah, Director Finance and Group CFO Deep Industries. Rohan, we've spoken earlier. Thanks so much for joining. It's a pleasure having you here. Sir, give us the color. You've won a couple of contracts as well this quarter. And I don't want to talk about Q1 FY26, understandably on silent period. But what is the top line shaping up as? You've guided for 25 to 30. My question is, can it exceed 30? Is there a positive bias to that top line guidance that you've given?
Hi, good morning, Harsh.
Good morning.
Definitely, the way we have guided in past, the growth is appearing very promising. And we are gunning towards year-on-year growth of more than 30%. So this year also we are expecting growth somewhere above 30%.
So how long can you grow at this 25 to 30% kind of band? So FY26 will be a strong growth here, 30% plus. What does that do to FY27, 28? Give us a slightly zoomed out picture, 2 to 3 years.
So based on our current order book, whatever we are just giving a guidance is based on existing order book itself. And based on this existing order book, we expect that next 2 financial years, we would definitely grow above 30%. And for FY28, if we'll have to talk, whatever new projects we would be adding in our existing order book, that would help us in growing FY28. So there is a clear visibility of next 2 years, which should be more than 30% growth.
Got it. So you should be at 1,000 crore in terms of top line by FY27, if I'm getting this math right. Let me, sir, talk to you a little bit about EBITDA. You've acquired Dolphin Kandla. What does that do to your margin number? And you started off also on a lower margin base in terms of FY25. So how much will be the organic margin pickup as a result of this and the inorganic margin pickup from the acquisition of Dolphin and Kandla?
See, organically, our EBITDA margins have been in range of 40 to 42%. And with acquisition of this companies, we are anticipating to improve it further. So organically, 40 to 42% is growth we are anticipating going further. And with these acquisitions, this EBITDA margin can go as high as 45% as well.
Got it. So okay, so upward bias to margins. How quickly can it go to 45 in the next 2 years, sir?
We are expecting in next 2 years, yes.
Got it. Understood. Okay. I'll pull out the numbers as well. So on the 500 crore capex that you're doing, what is the kind of funding that where are you going to get that funding from? You're sitting on around 50 to 60 crore rupees of cash, maybe a little bit more at the end of Q1. Where does the 500 crore come from? Are you planning a QIP? At what value will you plan a QIP?
See, the capex we have planned would be funded with mix of all different resources. One is, of course, as you rightly mentioned, the internal accruals. We will definitely take some amount of debt as well, because we are fairly, or I would say highly, very confident on taking debt, because our debt equity is very much in control. And we may think of raising equity as well. We have taken all approvals for raising equity through QIP, and we might go for QIP as well, depending on the market conditions.
Sir, give us some color. So if you were to do a QIP, you've suggested at the end of Q4 in your con call that you will do the QIP at the right price. What to you is the right market capitalization?
See, based on the growth which we are envisaging, based on our existing order book itself, year-on-year growth of more than 30% is something one should cannot ignore. And with such improved margins, the valuation which currently we are getting, we believe it is quite on lower side. And we'll definitely look for some good PE multiple and some good valuation to come in by market recognizing our growth and the margin prospects.
Okay. Okay. I won't push you on that count, but would it be something in the range of 20 to 25 times 1 year forward? Is that something that you're more comfortable with? And if you get that valuation, will you do an equity raise?
Yes, we can look.
Oh, understood. What happens if the equity raise doesn't go through? You do a debt raise, and that is a large amount of debt to take on your book. You have around 200 crore of debt already. How much will be the debt raise? Because you plan to do this entire 500 crore capex in FY26 itself.
See, as I said, we are quite comfortable on taking debt because our existing debt is very minimalistic. Probably we are the only company in this industry who is having such low leverage on their balance sheet. And so taking debt of 300-400 crores is not an issue at all. So even if in case we'll not be able to raise equity, we can definitely fund this capex through internal accruals and debt.
So, sir, what is your current cost of debt? Give us that picture.
Our current cost of debt is in range of 8.2 to 8.5% per annum.
Understood. And you'll probably add another 300 to 400 crore of debt if at all you don't get equity, or if you don't get the right valuation in equity. Is that what you're saying?
Yeah, we are pretty much comfortable in raising debt.
Understood. So another 400 crores of debt at around 8.5%. Even if I take that as 9%, that's around 40 crore of EBITDA shaved off in interest cost. That's broadly the take, right? That's how one should look at it. And therefore your profitability and so, okay, what does this 500 crore capex do to your top line? Give us that picture. For how long does this capex suffice, and what is the max top line you can do on the capex that you're undertaking?
See, in our business, the mobilization time for deploying any particular asset in a project is ranging from 4 to 8 months. And so whatever capex we do in a particular year would fairly start earning in next financial year. So the capex which we are planning in this financial year will definitely start earning probably in Q4 or in next financial year. And this capex will definitely add to a great amount contribution in our top line. and this would be additional to what we are envisaging as of now.
What would that top line be? Would it be 1,500 crore? Can you give me a number?
See, in our business, generally 500 crores of capex would give you annual revenue of to the tune of 350 to 400 crore.
Understood.
And this particular assets have a useful life of more than 20 years. So we can use these assets for 20 to 25 years.
Got it. And the 1,000 crore top line that you're guiding for in FY27, without this capex, can you do 1,000 crore, or what is the outlook with regard to that? Give us that color.
Yes, as I said before, this growth of FY26 and 27, we are envisaging on existing order book only. And for that, there is no need of any further capex. So 1,000 crore we can achieve without capex.
Understood. So if you do the capex, your top line can easily go from 1,000 to maybe 1,500, 14 to 1,500 crore, or 1,350 crore at the very least, 1,500 crore at the most. Am I right when I assume that?
Yeah, you can assume that.
Point taken. Okay. Sir, give us color on Kandla and Dolphin, the receivables as well as the inventory that you carried over there. You've provided a certain number. Any more provision which may be required, or any amount that you haven't provided for? That's my first part of my question. Second part of my question, is there any upside, which means will any of that money actually get realized or come back? Do you see that happening?
See, we have experience of acquiring now more than 3 companies from insolvency, and we have seen that we have been fairly able to recover their old receivables to the extent we can. And with regards to Kandla and Dolphin Shipping, we have already taken write-off of inventory which was not there in their books. So that has already been written off. With regards to receivables, we will give our best efforts to recover out of this old receivables of these targets. And we are quite hopeful that we can recover at least 25 to 30% of it in current financial year. Probably we'll give a try for next 2 years to recover, and then can take a decision.
Wow, that's amazing. So, sir, what was that receivables number? Give us that perspective. 250 crore is what you wrote off. But how much of that was inventory? How much was receivables?
So whatever we had written off was majority was inventory. Okay. We had written off almost 250 crore, of which 240 crores were inventory and 10 crores were receivables.
Got it. So, sir, on a 500 crore capex, if you're doing 350 crore at the very least in terms of top line at a 40% margin, right, that gives you a ROE of maybe 20%. How quickly do you get there? Because you're currently at 12.
See, in our return ratio, I would request you to evaluate in a way that there is one item of goodwill is lying in our balance sheet, which is a non-cash item of almost 400 crore. So while calculating any return ratio, one should exclude that part, because that is a non-cash goodwill, and we haven't paid anything to acquire that. And so to my mind, calculating correct return ratio, you should exclude that. So that will give you the correct picture of return ratio. And the existing return ratio, which we are at, would definitely tend to improve going forward with an increase in top line as well as margins, because going further, we are expecting to improve on margin fronts as well.
Got your point, sir. Thank you so much. This is super insightful. You've been very, very candid with me. Thank you for that that conversation and that perspective that you've given to us and our viewers. But thank you, sir. But that's all the time we have, viewers. Thanks so much for tuning in to KYC from myself and the whole team that puts the show together. Thanks so much for watching.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
They promised guaranteed returns. They advertised illegal trading in broad daylight. But NDTV Profit picked up the trail.
2 साल हो गए मैडम। डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We called, we questioned, we exposed.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
Because your money deserves protection, not empty promises. Easy money, hard lesson. Stay alert. Verify before you invest.
जनता के पास सवाल ही सवाल है। जवाब ढूंढने को वो देखती है न्यूज और देखती है यहां तो सवालों का माया जाल है। ऊपर से ये अलग फाइट, कोई पूरा लेफ्ट तो कोई पूरा राइट है। बीच में मुद्दे के साथ कौन है, जनता को जवाब चाहिए। इसीलिए सवालों की परेड नहीं, मैं लाऊंगा खबरों की कचहरी। मैं शुभांकर मिश्रा, मेरे साथ देखिए कचहरी रात 8 बजे सिर्फ एनडीटीवी इंडिया पर।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry.
Hello and welcome to NDTV Profit. You're watching Markets at 12. I'm Hiral Dadia and with me is Mahima Vachajani. Mahima, an interesting day of trade. Clearly, the markets have cracked right now midday. The reason for the crack is something which is not really known, but the obvious, if you go to see right now, is you have Nifty which has gone ahead and slipped below that 25,000 mark, and that is something which is actually indicating an absolute bearish tone right now. You're down almost 0.7% near the day's lowest levels as we speak. Overall, in terms of individual sectors as well, it's a sea of red across sectors. Everything is in the red, and if you talk about the top losing sectors, that will tell you, though the light is in terms of IT, which is trading with marginal gains of around 0.1% right now. So there is that recovery from the day's lowest levels that has come in with regards to IT, and it's mainly on the back of Wipro. Metals is also in the green and media is in the green. But apart from that, defense is seeing good amount of profit booking in terms of today's session. Private banking index, now it's Axis Bank. On the back of that slippage in provision number has been trading under pressure. And you have HDFC Bank, ICICI Bank and Yes Bank. All the three report numbers tomorrow, so that pressure ahead of numbers is building up on these names as well. Overall, if you talk about Bank Nifty, it opened gap down in today's session, and it seems it's the private banking space that will lead that kind of decline in terms of financials in today's session. From an FI perspective, if you talk about the short positions, they have been increasing the short positions in the derivative market, and which is indicating a bearish sentiment on that front. On the additional front, if you talk about the cash market, you have consistent selling that has come in from the FIs as well. In fact, they've gone ahead and sold nearly worth 12,000 odd crores in 1 week, and that's a big number. So that bearish sentiment from the FIs is something which is not really taken well. You have your trade war uncertainties, which do continue to have an impact, and your Asian market cues overall have been quite weak in today's session. So cues from there that the Indian markets have taken are also impacting. VIX, you just saw that the spike that has happened. So the percentage is not important, but still you are at that 12 mark, which is a very comfortable level to watch out for as of now. So no major concerns in terms of where the India VIX goes. Other commentary, if you talk about cement stocks, they are trading higher, but that's mainly on the back of earnings cues that they've taken from Nuvoco. UltraTech Cement will be reporting numbers on Monday. So ahead of that, you're seeing some bit of pressure in terms of UltraTech Cement as well. Insurance companies are seeing profit booking. HDFC Life, SBI Life, both these counters are trading under pressure. And what's interesting is the Newgen Software. On the back of weak numbers and a bearish brokerage view, that stock is also down at the day's lowest level, 0.6%, 6% lower in terms of trade today. But what's happening with the markets? Let's quickly get in. Feroz Aziz, joint CEO at Anand Rathi Wealth. Feroz, good afternoon and welcome to the show, and a pleasure to speak to you as always at NDTV Profit. What is spooking markets at 12 noon?
Yes, good afternoon. Like I was hearing you say, the derivative indicators from an FII standpoint, and both the cash market and the derivative market, they've expressed their bearish view. In fact, I track about 4 short-term barometers, which gives us some sense of where the market is headed in the real short term. So I personally think the short position in the index futures, which has reached almost 84% yesterday, is a very good news from a rebound probability standpoint. Why? Because every time it crosses 80 on either side, the markets have a likelihood of moving in the opposite direction because जिसने बेचना था वो बेच चुका. That's the kind of sentiment for the last 12-13 times in the last 1.5 years. It's crossed 80 on either side almost all times, not almost all times, all times this hypothesis has been proved right. So I would be watching for a short-term bounce back. If the trade deal goes through better than expected, and if you get a 250 points gap up, that's also algorithmically calculated, the short covering vicious cycle will start. If there is a good news and that happens, that's point one on the derivative indicator. The second derivative indicator is something called the synthetic futures on the weekly options basis. That's 24th, which is the next expiry. The synthetic futures caught quoting at 40 rupee premium from spot, the 24th. That implies for this expiry, the market is oversold for the subsequent 4 days. That's what synthetic futures also implies. So I'll stop here. So these two derivative indicators, I'm just telling you real time how they shape up on the terminal.
So Feroz, basically what you're trying to say over here is, in terms of the synthetic futures as well as the short positions that have been taken in the index futures, which has reached around 84% yesterday, that is giving you an indication that there is a possibility of a short-term bounce back in the markets. Correct me if I'm wrong.
Absolutely, yes. But what happens is, the one problem with the first indicator, which is the long short, is it does not reverse itself automatically. It requires some degree of cash market buying for that cycle to start. It can remain at 84 for the next 2 months. If there is any positive news which comes from cash market, which can give you that starting, let's say you start a car, right? Then it moves. So that 16% long position and 84% short position by itself can remain like that unless there is a trigger from the cash market. And that trigger could be the trade deal between India and the US. Of course, US indicated that it's going to be the Indonesia way, which is not a great way, because they've got Indonesia to agree to buy everything under the sun from them. But yeah, so that could be one of the triggers. Synthetic futures is the most short-term barometer, and that being at a 40 rupees premium for 24th April, 24th July, says that there is some degree of positive bias possible over the next 4 trading sessions. 70-80% probability. These don't go 100% right.
So Feroz, my other question that comes to you over here is, when you talk about that underlying buying that needs to happen in the cash market, if you talk from an FI perspective, they have been sellers. We've seen a sell number of nearly 12,000 odd crores in this week itself. How important will it be for the FIs to then come in to support this kind of an up move? Because DIIs have been buyers in the last couple of trading sessions anyways.
Yes, so see how we look at buying from DIIs. We like to real-time find out what was the money which came into all mutual funds yesterday. That is also algorithmically possible. Now let me tell you, on 15 July 2025, which is a couple of days back, the total inflow in small cap funds, which is a great barometer, 145 crores in active funds and 8 crores in passive funds. Now this you need to know before SEBI and AMFI also get the reporting. So how do you figure that out is a separate story. But this month, so far, small cap funds have got 2,641 crores. What does that mean? Why are we checking only small cap? Because if the money has to dry up from retailers, the first thing which stops coming in is small cap. अगर कोई डर जाता है तो पहली चीज क्या करता है, स्मॉल कैप में पैसे रोकता है. So if this month we have already finished getting 2,600 crores, which is higher than the same date of last month, I know there is enough dry powder in the domestic institutions which will bring in some buying at a point in time, if not for a triggered upwards, but at least for a resistance downwards.
Firoz, hi, Mahima also joining in. Just want to get a sense on sector-specific views, because there are private banks that are under pressure because of Axis. There's cement stocks doing well because of Nuvoco on the back of that. There's also insurance that's not doing well. Any sector-specific cues that you're taking up here?
Mahima, when I look at sectors at Anand Rathi, we generally look at sectors from a little more longer-term perspective, at least 3-4 quarters. I can tell you from that perspective, I'm very, very positive about interest rate sensitive. Why am I so positive about interest rate sensitive? Is because the fiscal deficit assumption, which is estimated to be 15.7 crores, for 15.7 lakh crores in absolute terms, which is what we track, not percentages, they are deceptive, will be lesser than 15.25 lakh crores. That's our guesstimate. If that were to happen, the yields will further soften and give you a lot of headroom for further correction in spite of a 100 basis point correction already. I personally think interest rate sensitive, auto has not run up. I think auto in the subsequent part of next financial year, this last part of this financial year, should do well.
And Firoz, the other aspect is in terms of yesterday's session itself, the way the put option and call option premium was moving towards close. I mean, it was really not, I mean, the call option premium, which actually came down to zero, your put options climbed from 40 rupees to almost around 85, and that kind of volatility which we've seen has not been receding. And you don't have a Jane Street in the picture right now because they are not trading. How would you actually describe this kind of an aspect as well from a derivative point of view?
I have to get a little technical, but I'm sure it's worth understanding because derivatives today dictate cash markets also. Ideally, derivatives are supposed to be dictated by the cash market, but derivatives are so large in volume in India, across the globe relatively. So, see, whenever an option price moves, it has a certain movement which is genuine movement. For example, like you're saying, the put options went higher because markets closed lower. That's called the delta of the option. Delta of the option is the most genuine movement of an options price. If the market goes down and if by 100 rupees, if the share or the price of the option moves up by 30 rupees because of the delta, it means that the delta is 0.3. So yesterday's expiry, which was Thursday expiry, we almost closed at the lower point of the day. That's why some options, input options, went up because of delta. But if you look at the theta of the option, which is the time value left for the next 2-3 hours, was reasonably low because the 1st July circular, this 1st July circular, I think, has not been decoded well. Maybe if you think your ears need to understand it at a point in time, we can decode it separately. It's the best circular which India has ever seen in the derivative space. And the executive director and the group of SEBI professionals have done a phenomenal job to make sure that the odds of a Jane Street again happening, or this instance happening, is lowered significantly. So coming back to your point, I think yesterday's Thursday expiry or the Sensex expiry were very calm expiries from a other Greek's perspective. Only Greek which was moving the price was delta, and delta is a genuine Greek for price movement of an option.
Right, Firoz, thank you so much for coming to us and speaking to us at such a short notice and giving us all those interesting insights. Thank you so much for taking out the time. All right, moving on to the next big story. Axis Bank is the top Nifty loser today and contributing almost 31 points loss to the Nifty. The company announced its Q1 numbers and provisions saw a significant amount of slippage, and we have Harsh joining us with more details on that. Harsh, what are you picking up?
Well, yes, a technical write-off of around 821 crore is what has led to the kind of provisions number of just shy of 4,000 crore. That was a huge number in terms of provisioning when I first saw it yesterday, And after this adjustment as well, it's still a very, very large number nonetheless, because it still stands at around 3,100 crore adjusted for this technical write-off, which is substantially higher than the 2,200 crore which most analysts on the street had penciled in. So that was the one big miss. The other miss was with regard to margins, which have fallen to 2.8%. So those two big misses, but one on the positive side as well. OPEX has come off sharply and other income has gone up sharply. Other income went up 7% QOQ, 25% plus YOY, so very strong growth on the other income count, but that was completely offset by the adjustments I just spoke to you about. Now let me talk about what brokerages are saying. One, Jefferies, they maintain their buy rating. They've cut their target price from 1450 to 1370. They say asset quality disappoints, slippages surge, growth stays moderate with margin correction, and results are weak. That's what they call it, but valuation discount drives the buy call. Macquarie is saying they maintain their outperform, target price 1450. They say that PAT miss driven by higher credit cost. Growth aspirations are onerous, they say. They say downside risks persist for our ROA estimates. Citi on Axis, they maintain their neutral, cut target price to 1285. They are saying technical slippages are drag on earnings, significantly higher technical slippages adversely impact earnings, and they await greater consistency before turning constructive on something like an Axis Bank.
Right, Harsh. Thank you so much for giving us all those details on Axis Bank. Currently, the stock trading 4% down as we speak. Now, shifting focus to the IT space, the IT bellwether Wipro reported a muted first quarter earnings. The profit dropped by 7% but met the estimates. But the company remained cautious on the revenue guidance for the second quarter in a row. My colleague Puneet Javeri flew down to Wipro's campus in Bengaluru and caught up with the company's management and spoke about what's the future looking like. Listen into that conversation.
Well, hello and welcome back to NDTV Profit. We're now in conversation with the management of Wipro post their quarter one earnings. We're now joined by Mr. Srini Palia, who's the MD and CEO of the company, Mr. Aparna Iyer, the CFO, as well as Saurabh Govil, who is the CHRO. Gentlemen and ladies, thanks so much for joining in today. Largely, one of the key aspects of the results and something that I came across was vendor consolidation that all of you spoke about, in the press conference as well yesterday. In this aspect, what has been one of the key aspects to have several large deals as well as look at vendor consolidation as a theme? And what do you think, according to you, has been Wipro's strength in this aspect when the macro environment is so uncertain to actually be a biggest beneficiary of vendor consolidation? Because traditionally, there has been some kind of weakness in that for Wipro, but with you coming in over the last year, what has changed which has benefited you specifically in vendor consolidation to start with?
So, Puneet, if you look at it, we called out consulting-led AI-powered Wipro. I think that's a strategy that we have adopted last year. Having said that, if you look at the mega deal wins that we won, 2 of them were in the banking financial services and 1 of them was in the technology and communication. So what mattered to us and what mattered to the client is our understanding of their landscape, our understanding of their business, our understanding of where they want to go with the technology trends that's happening, especially with AI. So we brought in the consulting aspect of it, we brought the domain aspect of it, and more importantly, the solution is based on how the client was looking at and how they wanted to implement going forward. So all these factors really helped. Of course, our long-term partnership with them and the way we have delivered as well.
Well, the other one was deal wins, because we've seen that as one of the strengths in this quarter as well. Last quarter, you had the Phoenix deal win, a large one. This one, again, 16 large deal wins in this particular quarter. But in the last year also, you had $5 billion of deal wins, but that kind of translation into the financials, if has not happened, or maybe it's going to happen, and we're going to see that in the next couple of quarters. What factors do either of you see as that of those deals which you won last year? Because these ones are going to, of course, take some time, 4 to 6 quarters to come into numbers. Of the last 2 years, your deal wins actually has been very strong. But so what could be one of the key reasons where you're seeing those deals also take some time to ramp up to reflect in these near-term numbers that we've seen?
I think your question has some of the answers that I was looking for, Puneet. So number one is you talked about the Phoenix deal, right? While we announced it in quarter 4, we'll start executing that in Q3 because there's a lot of planning phase that happens. Also, some of the deals that we won now, it may take a quarter for us to ramp up and get to execution mode. Having said that, there are certain changes that happened, which I talked about in the last quarter results, wherein some of the large transformation programs, the client actually put on hold because of the situations that they went through tariffs. And that was specifically in certain industry segment, which was around consumer and energy and EMR sectors. I think once those come back, once a situation certainty comes back, hopefully those transformation programs will kick in. But having said that, most important for us now are the deals that we have won. How do we execute on day one, and how do we deliver the value for the clients that we are committed to them?
So you had some deal wins in this particular quarter, also in the weaker segments, first to say the retail, the consumer. Has that largely been shifted to cost takeouts or some new features that the client wants specifically? Has that change now happened?
Yeah. So if you look at our deal wins, there are a combination of both cost optimization, vendor consolidation. There are also some of the new programs that they want to start. For example, Aparna talked about the B2C opportunity, right? They want to see how change the customer experience, especially the digital customer experience. So that's a new project or a program that particular retailer is starting to take off. Second, there are certain areas of the back office that they want to actually bring in agentic AI and transform their business process so that they get in the velocity and productivity and experience for their end customers as well. So it's a combination of both, Puneet.
And the one aspect also was the capex of IT companies. You've had a new dividend policy earlier this year, 70% distribution over the next 3 years of profit. So how does that align with your capex which you have to do on new technology, essentially, or the incremental capital which you say, and in finance we love to throw the term of sales to assets. Essentially, how will that? I'm sure that won't take a backseat, but how will that transform over the next few years, maybe 3 years, since you have the dividend policy for that aspect, in terms of going into new areas, and what is the strategy for that?
Maybe Aparna, if you could.
Yeah, so we do have, even as we started the fiscal year, we're about $6.2 billion of gross cash. That has only improved in the first 3 months already. We had been generating consistently about 120% and upwards north of that in terms of net income. So cash flow generation has been robust, and we expect it to be robust even going forward. And we starting off on a very, very solid base of cash on the balance sheet. And that gave us the confidence to increase our capital allocation. And even while we've increased it, we made sure we have enough of a war chest to pursue both organic and inorganic investments. We feel very, very confident that we will be able to support this increased capital allocation and meet the strategic needs of the business.
So how long could you, now there's a timeline, but how long do you think your new investment today, $1 invested today in new technology, how long do you think that will take into conversions of either a deal win or in your financials? Has that gotten longer? Or
I think those cycles have actually got much shorter. Especially from a technology standpoint, technology cycles are getting extremely quick. We started with generative AI, and then it became agentic AI, and now, there's going to be, I'm sure, the next big one that will come through. So I do think that these investments that we make are very here and now and pay off here and now. And that's been the nature of how IT services has worked, and we just expect it to get faster and faster.
No, just taking a long-term view, and if you all three of you can comment on this, because during Y2K we did see coding as one of the key expertise for which IT companies wanted that kind of talent, and we saw a lot of regional hubs within India created across states where coding became such an important thing, and that kind of went into the 2010s itself. Last 20 years has been that. My question largely is that with AI you might not see that case anymore of coding, or it has transformed in that role. So what do you actually see right now in an ideal employee when you're hiring? Because Gen AI and everything is changing so quickly. So you won't find that employee who will know everything about that because it might be old in 3 months. So what are you looking at in an ideal employee, and if you know what from each one of your perspectives?
Sure. Maybe I'll take the first business. Saurabh can add to that. If you look at the way the world is, the programming world is changing for the engineer, right? Earlier it was about pure play coding. Now we're talking about prompt engineering. But what is important when you get into prompt engineering is understanding the business context, right? And only then you can prompt the right one, right? So the way I see it is the new hires that we have, their understanding of the business landscape, understanding how the data works, and then how you implement the AI. I think that aspects become more important in addition to basic programming language. And please understand, when you're doing a coding, the tools can do so much in code generation, so much in testing, so much in deployment. The human involvement could be there, because when you're getting into production environment, you have to be extremely careful how that the application will happen and how do you monitor that. So there are definitely certain tasks that can be automated, but there will be very important tasks in the context of the business, prompt engineering and so on and so forth, that an individual must have.
And if I look at it, apart from the technical skills, today is anyone who wants to become part of us or anywhere, two aspects come out very clearly. One is learnability. Given the changes happening in the macro environment and in the technology landscape, how quickly people are able to learn. I think that's a very key aspect which we try to look at it. Communication. How do you? Srini spoke about understanding business. You have to work with the clients. You might be extremely good in your technical knowledge, but how are you able to communicate to the people? I think all these things come together, when you're looking at a person. And the last point I'm saying is that we are still not there. We still need people who understand basic language skills also, because there is coding happening right now. 100% is not AI driven. But we are evolving as we move forward. But these tenets would continue as we look at people.
Just final couple of questions on, the fresh hirings has been one of the key aspects you mentioned before, 10,000 new fresh hires you want to do it this year. But the net headcount addition number, when I see over the last 3 quarters and remove the quarterly aspect, it's not been that in terms of, addition. And now with Srini coming in over the last year, what is the strategy over the medium term, if not numbers? With fresh hires coming in, you will be looking at new verticals from the clients that you want to challenge, and you need that people. So what would be the net headcount addition be in the medium term?
So I think if you look at headcount, it's a function of the entire people supply chain. There is how much we hire, how many people are attriting, what is the bench. And I think if you put all these 3 things together is what we need to look at it when you look at headcount number. Today, if I look at, we have a good bench. Our utilizations, while for the quarter has gone up, for the year-on-year we are down, and we think we have had space to improve. We are looking at hiring attrition which is flattish so if you keep all we will continue to hire depending on demand, depending on requirement. We have won some large deals. We need to make sure we execute on them. We deploy people. We have in fact utilization has come down because we are keeping people ready for those big deals. So we will hire depending on the demand, both from campuses as well as experienced people. But it will keep changing as we move forward over the business scenario. That's how we look at it.
Well, one final question, in terms of margins, because we've seen some impact this quarter, but again, over the last 8 to 12 quarters, we've seen a strategic increase from 15 to 17%, and this quarter has been the first where we've seen some impact on that. Do you think that for this year, the margin, you will try to manage the margins in a difficult environment, while on the medium term, the 17% margin to 18% margin is the target for Wipro going forward?
We've, like you rightly said, over the last 8 quarters, we've shown a lot of strength in the fact that we can improve margins. Right now, we are very, very focused on converting some of the deals that we've booked. We're very excited about the bookings we've had. This will translate to a good potential in the quarters to come. And, converting those deals into revenues will need upfront investments. We've spoken about how some of these are vendor consolidation wins, which are, by nature of it is very, very strongly contested. And, clients do want a share of the savings, right? So in some sense, there are pressure on costs as well, as we start. But we go back to what we have done in the last 8 quarters. We will continue to put those levers in at play and offset some of these pressures. I'm not calling out a band at the moment. We're very, very excited about the deals that we've secured. We're focused on better growth.
Well, gentlemen, thanks so much for joining and giving us perspective on a whole host of topics apart from the recent quarter. We wish you the best and look forward to our next conversation.
Thank you, Puneet.
Thank you.
Right, that was an interesting management conversation with Wipro. But with that, we're completely out of time on this edition of Markets at 12. But do stay tuned to NDTV Profits. More news and updates on the other side.
That's huge. That is a biggie. It's out of there.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
They promised guaranteed returns. They advertised illegal trading in broad daylight. But NDTV Profit picked up the trail.
2 साल हो गए मैडम। डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We called, we questioned, we exposed.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
Because your money deserves protection, not empty promises. Easy money, hard lesson. Stay alert. Verify before you invest.
जनता के पास सवाल ही सवाल है, जवाब ढूंढने को वो देखती है न्यूज और देखती है यहां तो सवालों का माया जाल है। ऊपर से ये अलग फाइट है, कोई पूरा लेफ्ट तो कोई पूरा राइट है, बीच में मुद्दे के साथ कौन है, जनता को जवाब चाहिए। इसीलिए सवालों की परेड नहीं, मैं लाऊंगा खबरों की कचहरी। मैं शुभांकर मिश्रा, मेरे साथ देखिए कचहरी रात 8 बजे सिर्फ एनडीटीवी इंडिया पर।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary sir said is 100% true, and today private industry can really increase their involvement in R&D.
Hello and welcome to NDTV Profit. You're watching Profit Buzzers. I'm Hiral Dadia and with me is Mahima Vachrajani. Mahima, good afternoon. Again, in terms of markets, a mayhem. 550 points cuts in terms of bank Nifty is what you're seeing.
Yeah.
Let's quickly pull up that one on the screens. You have Nifty which has slipped below that crucial support of 25,000 and continues to trade at the day's lowest levels. A 170 points cut coming in there. What's interesting is the kind of recovery that IT is seeing in intraday trading session. Let's quickly pull up the intraday chart of Nifty IT. From the day's lowest levels, it started to inch higher, so there is some bit of relief that's coming in on that front. But very quickly, let's quickly address Indian Overseas Bank. That stock is seeing some smart moves today on the back of the earnings that have just come in. A spike in trade today. The asset quality has improved. 1.97 is the gross NPA number. The net NPAs have also improved marginally, 0.32 versus a 0.37 on a sequential basis. A strong jump in terms of profitability, a 75% increase is what you're seeing. So a strong profit number. Improvement in terms of where asset quality is concerned. Operating profits also seeing an uptick of around 40% this time around. NI, double-digit growth, 12% is what you're seeing in terms of the NI growth. All the parameters working in favor of an IOB, and that's the reason why you're seeing this kind of a spike that's coming in terms of the stock price as well. So that's with regards to where IOB goes. But let's quickly shift focus in terms of what the broader markets are doing. Your Nifty, your mid cap 150 and your small cap 250. Let's quickly pull up both on the screens. There is a mild recovery that's come in terms of mid cap 150 from the day's lowest levels, and the small cap 250 also mirroring the same, a 0.5% downtick though on both these aspects. If you see in terms of the advanced decline as well, absolutely in favor of the declines. 1,500 declines is what you're seeing versus a little over 700 advances in terms of today's session. Moving on now, what is important to watch out for is Heritage Foods. Let's quickly pull up that one on the screens and see what a Heritage Foods is doing in trade. The stock is near the day's highest levels with gains of over 5.5% coming in there. What has happened? Your profits have dipped around 30%. Your value-added product sales have been hit on the back of early rains. Margins have declined in the first quarter. Your milk sales has been steady amid rising procurement costs, and you have early rains which are weighing in on the value-added product revenue contribution. Yesterday, market hours when the numbers were reported. Today, you're seeing some bit of buying interest that is coming back. But let's get in. Shradeep Kesavan, CEO at Heritage Foods. Shradeep, good afternoon and welcome to the show, and always a pleasure to speak to you. My first question coming to you is, overall, in terms of the top line, it's the highest ever quarterly revenue that the company has clocked. And secondly, your value-added product sales, though, have been hit by early rains. Usually, it's the value-added products which do land up driving your top line and, your margin aspect as well. How has there been a divergent trend this time around, and what has worked?
Thank you, Hiral. Thanks. It's always a pleasure to be on your show. And good afternoon to all your viewers. Yes, this is the first time that we crossed 1,100 crores in revenue. We clocked 1,140. And if you actually see how the company has progressed in the last 4 years, 4 years back, we crossed 800 for the first time, then 900,000. Last year, same quarter, we said that we crossed 1,000 crore for the first time. And this time, we have crossed 1,100 crores for the first time. So I guess the first thing that you could note as far as the company strategies is concerned is that we've been able to grow our top line steadily. And our strategy is not just dependent on value-added products. We are focused on milk as well as consumer fats as well. This year, in the first quarter, the unprecedented unseasonal rains has actually put a stop to the kind of growth momentum we had in value-added products. If I could just call out certain numbers, in between the 2 months of April and May, out of 60 days, we saw rains of heavy rains on 20 of those days, and on a blended average basis, temperature was down about 3.6 degrees compared to previous year same period. And our value-added products, especially curd, drinkables, which is buttermilk, flavored milk, ice cream, etc., are heavily dependent on having a good weather. And it's only that aspect which hit our business in this quarter. And there has been nothing extraordinary as far as the the negative trend is concerned. In fact, within the quarter, in the month of June itself, we saw the business bounce back to normalcy.
Mr. Kesavan, hi. Mahima also joining in. Always a pleasure speaking to you. Just want to get a sense on your margin picture because they've slipped quite a bit this quarter, and this is because of certain costs going up. But there was a point in time when your margins, did go to that 11% mark as well. Just want to get a sense in terms of everything that's happening. Because of rains, value-added products were slightly impacted, plus raw material costs going up are some of the reasons as to why the margins have been impacted. But going forward, FY26, what's the kind of margin range that you're looking at? Will it come back to the normative range of 9 to 11%?
So let me talk about EBITDA. EBITDA for the company for this quarter has been only 6.5% on a sequential basis, QOQ compared to quarter 4. We have dipped by about 1.1%. And at a revenue level, if I could just talk about the kind of revenue opportunity that we missed due to the value-added products decline, also because of the mix change, is in the range of about 2%. We must have already recovered about half of that 2%, maybe around 1% in the last couple of weeks. So you should see the margins coming back to the kind of range that we had in quarter 4 of last financial year. Going forward, as we expand our value-added products portfolio and as we strengthen our brand portfolio and increase the revenue realization, we should be able to expand it even further. But in the immediate term, let's talk about the present as of now. We are looking at margins coming back to what it was in quarter 4 of last year.
Okay. All right, Mr. Kesavan, with regards to where value-added products are concerned, there was a slight dip of that, from that 37% to your total contribution to revenue to that 36%. This is because of early rains. But just also wanted to understand, with respect to value-added products, you're now at 37% of your total revenue. Where does this go from 37% to in the next, let's say, 2 years down the line? And then do you see margins improving? Because I believe margins in the value-added products are better than that of your normal products.
Yes. Thank you, Mahima, for that question, because our journey is not like, we might have hit an air pocket in this quarter, but that doesn't take anything away from the kind of growth journey that we have been on for the last 4 years. About 4 years back, the value-added product contribution was only about 26%. Now it stands at, last year, we ended with 37%. This year, actually, in quarter 1, we were expecting it to expand further by a couple of points and go to 39%. In fact, the inclement weather that we faced forced us to settle with about 36%. So for us, actually, it's the delta of where we should have been and where we are, 39% versus 36%, which is what is reflecting in the bottom line as well. But like I said, month of June itself, we saw numbers coming back to normalcy. And in this quarter, in the first couple of weeks itself, business is back to normal, which means that we should be able to push year-on-year basis, on every year, we should be able to expand our value-added product contribution by a couple of points at least. In the next 4 to 5 years, we should expand our value-added product contribution by about 10%. That's what we expect.
Okay. Mr. Kesavan, also wanted to understand, last time when we spoke, you did mention that you are, strengthening your supply chain backwards when it comes to your procurement. That's what you're trying to strengthen right now. Just want to understand as to what's the kind of outflow of money that's, happening, to strengthen that, first thing. And secondly, in terms of your overall capacity utilizations right now, where do they stand and what's the aspiration like once the supply chain gets strengthened?
Supply chain is going very strong for us. We have, in fact, actually, we have improved on every metric of supply chain, not just on the farm side, but also on the sales side. I'll just call out the numbers for the benefit of your viewers. On the supply side, which is actually on the procurement side, we have 198 chilling centers and reaching close to about 10,000 villages, collecting milk directly from over 1.8 lakh farmers every single day, out of our 3 lakh odd farmers in our network. And in terms of efficiencies, we have improved our procurement efficiencies by about 14% in terms of productivity efficiencies. In terms of capacity utilization, we are still hovering around 67 to 70% of overall capacity utilization. That said, we are pushing almost near 100% utilization of several of our value-added product portfolio, such as paneer, ice creams, etc., which is growing at great speed. Even in this quarter, when the numbers were not so great, paneer, for example, grew at 40% for us on a year-on-year basis. And you might recall in our previous conversations as well, for the last several quarters, we've been growing paneer at the rate of 40%. So some of these value-added product categories, we're seeing tremendous surge, and we are investing in capital expenses consistently to expand the capacity of these value-added products. And on the demand side as well, in the market side as well, we have had all the metrics have actually worked very well for us. We've expanded distribution by about 25,000 retail stores, now crossing 200,000 retail stores nationally. And we have added several of our, we have expanded our own sales outlets called as Heritage Happiness Points, which now stand at 420 outlets. Across these 420 outlets, we are today doing close to about 250 crores of annualized revenue. These are all big numbers for us. Even in organized trade, for us, our supply chain has strengthened. We have expanded our footprint across modern trade and e-commerce with access to 20% additional stores. Now the total store count, both in terms of modern retail as well as quick commerce dark stores, have crossed 5,000 stores for us in the Q1. So all numbers, all metrics are looking strong for us. Business is good, except a little bit of a bump on the road hit thanks to the bad weather.
Right. I think interesting points to watch out for from your own as well. Thank you so much for joining us on the show and sharing the views with regards to what can be expected going ahead. But moving on, you have India-US trade deal, and that is all about preferential access from here on. My colleague Rishabh is with us to tell us more about the same. Rishabh, over to you.
Right, Hiral, what we're picking up from government sources is the fact that this trade deal, which has been imminent for a very, very long period of time, what we're hearing on that about now is that the main theme is going to be preferential access. That is something that Donald Trump has also pointed towards in terms of his deals with Vietnam, his deals with Indonesia. But this is something that we'll also see now with India. That's what we're hearing from the official government side. The Indian negotiating team, led by Special Secretary of the Commerce Department, Rajesh Agarwal, continues to be in the US. This will now be the 5th day of negotiations for them. And there is some sort of an outcome that is expected ahead of the August 1st deadline, roughly about 12 days left for that, and that is something that we're keeping our eyes peeled on so far as well. An update on the UK FTA signing as well. Remember, this FTA was finalized about a month or two back, and now the final formal signing of this deal will take place, post which the operationalization of this deal will take about an year or so. So that's what we're hearing, is that the Prime Minister, India's Prime Minister Narendra Modi, is likely to visit the UK for this signing sometime next week, perhaps July end, is what NDTV Profit also reported. But what we know so far is that there's no finalized date, but July end, India's Prime Minister might go for a formal co-signing of the UK FTA with UK Prime Minister Keir Starmer as well.
Right, that is interesting, Rishabh. Next week likely, but the date not finalized for Prime Minister's UK visit for signing the FTA. That is the key, but we should be watching out for more. But Rishabh, that you're with us. You have India's smartphone makers who've written to the government seeking action to counter informal Chinese sanctions. What are the details that you're picking up, and what is the kind of impact that you're looking at?
Right, Hiral, this was a letter that was sent by the ICEA. This is an industry association of electronics manufacturers and smartphone makers. They sent out a letter to Ashwini Vaishnav, India's IT minister, India's IT and electronics minister, on July 1st, asking for an urgent meeting. And also they flagged off 3 very interesting specific choke points that the Chinese have been informally administrating. So these are not curbs that the Chinese government is doing on paper. These are all off paper, informal stuff that is being done by the Chinese administration to stifle India's growth in terms of electronics and smartphones. Now, the three choke points that I have here with me, we reviewed a copy of this letter that was sent. The first choke point is, of course, the restrictions on exports of high-precision tools and machinery. So that is something that the Chinese government has been doing for a very long time now, and this is across sectors. But over the last 8 months or so, these choke points, these restrictions have now been extended to electronics manufacturing. Choke point 2 is the critical mineral risks that has been the talk of the town for a while now. We've seen with rare earth magnets, but this is going to impact electronics manufacturing as well, not just EVs. And 3 is the travel restrictions and recall of Chinese technical workers. This is something that we saw happen with Foxconn very recently, and now we're seeing this on a broader basis as well across manufacturers, across smartphone manufacturers, because this leads to some sort of stalling of technology transfer, as well as the new sort of product development that Indian companies want to do. So these are the sort of Chinese informal Chinese sanctions that have been affecting this electronics industry, and this body really wants to set up an urgent meeting and also find some solutions to mitigate these issues.
Right. Thank you, Rishabh, for that. So this is interesting. Your domestic brands are actually seeking help from the government, and with regards to the informal Chinese sanctions. We will try getting more updates as things develop. But moving on, the Prime Minister's office is stepping in to address the growing concerns around the rare earth magnets crisis. A meeting with key stakeholders is scheduled for this afternoon, with Mines Secretary Kanta Rao expected to be in attendance. My colleague Aishwarya brings us more details on the same. Aishwarya, the story with regards to unavailability of rare earth minerals is just intensifying, and now the Prime Minister's office stepping in.
That's correct. As you rightly mentioned, the PMO's office is conducting a meeting along with key stakeholders, likelihood of Mine Secretary Kanta Rao also to attend this meeting and discuss further what can be done in order to evade the crisis as China restricts key minerals as well as rare earth magnets exports to other countries. Now, if you remember, on the 11th of July, in fact, the Ministry of Heavy Industries had proposed that there will be a scheme of about 1,300 crore to ramp up the domestic production. And what we're hearing from our sources and picking up is also that this could also be on the cards in the point of discussion at the PMO this afternoon. As we speak, the meeting could be underway, is what we're learning from our sources. Of course, the background, as Rishabh has rightly mentioned as well, that geopolitical tensions have led China to go ahead with these restrictions and kind of hold back on their resources as well. So we'll keep you posted on what is the outcome of the meeting that happens this afternoon. I hear that also Heavy Industries Ministries representatives will also be there at this particular meeting.
Okay, so any developments out of this meeting are absolutely going to be crucial to track. You have various companies who have got approvals with regards to exploration, but the kind of timelines that they have to work with are really long. So short term, it is going to be a painful period, though you have auto companies who have come out and said that some of them do have, some bit of inventory. Some of them are looking at alternative sources as well. So interesting moves that are happening on this front. But moving on, Reliance is turning up the heat in the consumer durable space with its latest acquisition, which is Kelvinator. The iconic refrigeration brand now joins Reliance's portfolio in a strategic move aimed at accelerating growth in the premium home appliance segment. In addition to this, let's just quickly pull up what they have said with regards to Kelvinator. What they've indicated so far is, in terms of Kelvinator, Reliance Retail already had the rights in terms of selling it. That was the latest that we did pick up. The acquisition strategically aligns with company's vision of democratizing aspirational living. They are looking to accelerate growth in the premium home appliance market, and they're strategically positioned to accelerate this category growth, deepen consumer engagement, and unlock substantial long-term opportunities. If you talk about Reliance Retail, a consolidated turnover of around 3.3 lakh crores with an EBITDA of around 25,000 odd crores is what they had reported at the end of 31st of March 2025. In terms of Kelvinator as well, what is interesting, what we need to note over here is that Electrolux Group, that brand has a long legacy in India. It entered the Indian markets in 1960, and in 1995 you had Whirlpool, which went ahead and acquired Kelvinator and entered the refrigeration market. In 2019 you had Kelvinator, which actually made a comeback in India with Reliance Retail signing an exclusive and long-term brand licensing pact with them. And the distribution deal with Electrolux. So the brand, which is Reliance Retail, is already selling refrigerators, washing machines and air conditioners via the Reliance digital store network and retailers and e-commerce platforms. So a strategic move to strengthen the Reliance Retail portfolio from here on. So that's with regards to where RIL goes. That stock is seeing marginal cuts of around 0.2% ahead of the numbers that will be reported in terms of today's session. But moving on, India's largest laptop refurbisher, G&G Electronics, opens today. In fact, we spoke to Sharat Khandelwal, MD of G&G Electronics, about the upcoming IPO. Let's quickly listen in.
Mr. Khandelwal, good morning. Can you take us through the business model of the company? What exactly the company do? Because you are coming from a sector which is a new one, and I think is one of the few to in the Indian listed space.
Good morning, Mr. Mangat. Thank you, and thank you for giving me this opportunity to speak to your viewers. We are an Indian multinational, and we are India's largest refurbisher of computers and one of the largest, if not the largest, in the world. What we do is refurbish used laptop, bring them to state of new in terms of both performance and aesthetics, backed by our 1 to 3 years of unique replacement warranty. We actually follow true sustainability. We have repair over replacement approach for our refurbishment, which is both climate friendly and cost efficient. Devices sold by us are priced at 1/3 price of a new computer, and they look like new, they work like new. And with our replacement warranty is a unique proposition for all kinds of customers. In terms of market size, 40% computers sold globally are pre-owned, and the phenomenon is common both for developed and developing countries alike. Very important point to note that we all use multiple devices for multiple tasks, phone for consumption, tablet for note taking, but computer is a primary device for productivity, creativity and education needs. And with more and more AI-related high-end application being required these days, even a brand new computer entry level cannot perform a task which a high-end refurbished laptop can. Our facilities are very, very granular. We are fully integrated across full value chain. We are present across full value chain, buying from corporates, ITADs, SMBs, mid-market, leasing companies, integrated refurbishment facilities, refurbishing in them a very cost-efficient and climate-friendly manner, and selling through our channel strength, which we have nurtured over the years in India and overseas market. So this business is very, very difficult to replicate. Our input is non-standard, non-linear, but output standard. So we try to address reliability, credibility, and affordability.
So that's with regards to where G&G Electronics go, refurbishing in terms of laptops, and that's an interesting business that you are looking out for, because they are one of the largest in terms of ICT devices globally as well. They have presence across USA, Europe, Africa and the UAE. What the objective of the issue is to repay the borrowings, which stand at around 320 odd crores. Issue price is in that range of 225 to 247. The issue actually opens on the 23rd of July, which is next week, and ends on the 25th of July. A fresh issue of around 400 crores, OFS of around 60 odd crores is what you're looking at so far. And in terms of the total size of the issue, that stands at around 460 odd crores. So that's with regards to where, GNG Electronics goes. But an interesting one is NSDL. Now, why is NSDL important right now is because in the primary market space, you have the pre-IPO shares that actually get locked in from today. The company acts as a securities depository in India. And Anushi is joining us with more details. Anushi, I think now is going to be an interesting time after the kind of surge that we've seen for NSDL shares in the unlisted space. Today, actually the shares get locked in. What are you picking up?
Absolutely, some wild moves that we've seen in terms of where the stock price performance is, and this is in the private space that we are looking at. So what has essentially happened is that all the pre-IPO equity shares which will be there will be locked in, and this will start effective today. So the number of off-market buy or sell transactions also which will be permitted will be only till the 6 months after the listing date has been crossed. So that is something that we should be watching out for. In fact, NSDL has instructed the depositories at NSDL itself and CDSL for ISI and freeze, that's the International Securities Identification Number freeze for its equity shares, and urges shareholders not to pledge any shares during this lock-in period that we are looking at. Just a bit about the company. Now, it acts as a securities depository in India, the only two players being there, NSDL and CDSL, which are there, maintains electronic records of allotment and ownership transfer of securities as well. Assumed market cap of this particular IPO that we are seeing is in the range of 20,500 crore. And this is a pure offer for sale IPO that we are looking at with an offering of 5.01 crore shares. Now, if you see in terms of how the share price movement has been, in the last 1 month or so, we have seen a downtick of 18%, and this is after a surge, significant surge that was noticed earlier. Unlisted shares currently trading in the range of 1,025 to 1,275 is what we are looking at. In terms of how the financials had shaped up for the company, total income was up over 28%, while net profit had seen about a 25% growth. Just a bit about the shareholding pattern as well. If you look at the banks, they collectively hold about 59% of stake in the company, which includes the likes of IDBI Bank, HDFC Bank, Deutsche Bank and SBI. So this is the overall picture that we are seeing for NSDL. Of course, an interesting one in terms of where the primary markets are concerned.
Thank you, Anushi, for the details. Let's just pull up a CDSL and see what a CDSL is doing in trade. Just ahead of the details that are emerging with regards to where NSDL goes, the stock continues to trade under pressure with cuts of around 0.8%. But let's quickly slip into a short break. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
गोल्ड क्लास ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
जनता के पास सवाल ही सवाल है, जवाब ढूंढने को वो देखती है न्यूज और देखती है यहां तो सवालों का माया जाल है। ऊपर से ये अलग फाइट है, कोई पूरा लेफ्ट तो कोई पूरा राइट है, बीच में मुद्दे के साथ कौन है, जनता को जवाब चाहिए। इसीलिए सवालों की परेड नहीं, मैं लाऊंगा खबरों की कचहरी। मैं शुभांकर मिश्रा, मेरे साथ देखिए कचहरी रात 8 बजे सिर्फ एनडीटीवी इंडिया पर।
They promised guaranteed returns. They advertised illegal trading in broad daylight. But NDTV Profit picked up the trail.
2 साल हो गए मैडम। डब्बा टेकिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We called, we questioned, we exposed.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
Because your money deserves protection, not empty promises. Easy money, hard lesson. Stay alert. Verify before you invest.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen.
Hello and welcome back. You're watching Profit Buzzers. Now, it's time for an interesting management conversation that we are supposed to have in the stock in focus as Worry Renewable Techs. Varsha, it's an interesting set of numbers that we are looking at. Give us a breakdown before we go to the management on the scene.
Yeah, sure, Anushi. So if you see the revenue growth you're seeing is, led by the strategic execution that the company has done. Well, material cost, if you see, was flat year on year, and the employee cost with respect to revenue was at 2% versus 3% year on year. Just to speak about the four numbers, revenue were at 603 crore versus 236 crore last year, while margins were at 19.5% versus 17.4% last year, and the net profit were at 86 crore versus 28 crore. Just talking about their major EPC accomplishments, I would say the project commission stand at around 3.03 gigawatt, while project site which is under execution is at 3,155 megawatt peak, and the rooftop projects commission were almost 59.26 megawatt. But just to get a sense of how the Q1 numbers were and what is the growth ahead, we are here joined by Mr. Manmohan Sharma, who is the CFO of Worry Renewables Technologies. Mr. Sharma, hi, this is Varsha here. Welcome to the show. Just wanted to know, my first question would be, how was the quarter Q1 FY26 for you? What were the expectations? Did you meet the expectations, or what were the misses?
Thank you, Varshaji, for giving us opportunity on your platform to meet our stakeholders. So as far as the company growth you have already displayed, so we have executed 699 megawatt worth of orders, and we have maintained our margin to 19.5% as against 17.38% in the previous quarter.
Got that, Mr. Sharma. Also, just wanted to know about the order book position as of today, and also what is the execution timeline, where you want to, by when that order book would be completed?
So we have present order book 3.15 gigawatt peak. That is to be executed over next 12 to 15 months. And more, actually, we are chasing order book pipeline. The order of 25 gigawatt worth of order pipeline is there in the system. That also we are following and trying to get maximum into our order book.
Understood. Also, Mr. Sharma, so, just having a rough back-end calculations, please correct me if I'm wrong, considering, 1.2 crore per megawatt realization that you get, and the, the existing order book which stands at around 3.1, gigawatt. Now, can we see revenue for around 3,500 crore by FY26? Just a ballpark number that I'm just, trying to calculate.
So what you did is more or less the calculation you had calculated. But to tell you that this, the entire 3.15 gigawatt order book is to be executed over next 12 to 15 months.
Understood. But we can see, because meanwhile you'll see more orders coming in, which would be completed within 12 months. So overall, a ballpark number of around 3,000 crore is what doable by at least FY26.
See, if I'll tell you, like last year, if you see our top line was 1597 crores, and prior to that 876. So if you see that on a quarter-on-quarter basis, we are 2.5 to between 2.5 to 3x in any kind of parameter. So looking at the presently what we had did in March 25, we have already done 603. So I think this pace will continue over this financial year.
Understood. Also, sir, in your last con call, that is Q4 FY25, you had given a margin guidance of around 14 to 15%. But this quarter, if you see, the margins were at 19%. Now, just wanted to have your view there. Can we see 19% of margin, for the next 3 quarters also, or you're seeing some kind of pressure in margin, and that's the reason you've given a outlook or rather guidance of 14 to 15%?
So whatever the contract which we have as of now is the fixed rate contracts, and the cost of the execution of the contracts is also almost finalized. But as far as the guidance is concerned, we are not giving any kind of guidance for the next FY26. We always state that we will be in the range of around 15%. So whatever we got this current quarter is 19.38% for this quarter.
Okay.
And with the same amount of the order book which are likely to be executed order book, this should be in the same range.
In the same range means 19% or 14 to 15%?
It will be above. It will be between above 15% or more or less in the same range.
Okay, got it. Also, sir, so to execute this, 3.15 gigawatt of order book that you have, what would be the kind of working capital requirement, and how prepared are you for this? Whether would you need to raise any capital? Just wanted to have your view on that.
See, we are the EPC company. We are the EPC player. So we are not capital intensive company. We are the asset light company. So for executing this EPC project, we don't need any kind of like term loan or anything debt in our books. We are good enough to avail the working capital limit, that to non-fund based working capital, which we are availing as of now. So there is no immediately requirement to put this raise any kind of debt for EPC executions.
Okay. Also, Mr. Sharma, when it comes to the new areas that you are venturing into, you have one BESS, that is battery energy storage system, and also you've also mentioned in your press release about the expanding into data centers. Wanted your view. Can you elaborate more on both the aspects? One is your BESS and your data centers. Have you got the orders? I mean, what is the on-ground reality there? What are the updates there?
Yeah, so apart from the EPC as a solar EPC, we also have 2 other revenue streams, that is the O&M and IPP. So gradually we are developing our IPP assets that can give the continuous revenue to this company, and whatever solar projects which we have installed, we are doing the O&M business of that. Apart from that, what you mentioned like data center and this is we have presently 40 megawatt hours of data center order in our order book that is to be executed over the next few months. And moreover, if you see, the data center is likely to increase because the data consumption is very high when you are especially using AI and these kind of tools. So the EPC work of those data centers is also in our radar to have in our revenue stream.
Okay, got that view, Mr. Sharma. My last question to you before I let you go, given the 50 gigawatt annual execution needed, just a rough calculation for India's 500 gigawatt target, what is your outlook on market demand and the industry's ability to achieve this scale, and also what kind of market share Waaree is aiming within that kind of annual capacity?
See, as of now, the total country's installed capacity is 484 gigawatt. You must have noticed that 50% of that we have already achieved. So, and for achieving the 500 gigawatt of by 2030, we have already done 220. So, keeping for the next 4-5 years, we need to execute 35 to 45 gigawatt annually. And if you see from the last quarter itself, we have done 10 gigawatts. So as a EPC player, we have lot of opportunity, lot of business to come to our as a revenue going forward.
Right. Got that view. Well, thank you, Mr. Sharma, for answering our questions. Pleasure to have you, and all the best for the business.
Thank you, ma'am. Thank you.
Well, Anushi, interesting stock. If you see, considering the order book that they have and the per megawatt realization that the company has around 1.2 crore, we can see, a rough estimate of 3,000 crores of revenue in FY26.
And this is with the margin profile of 15% or also.
Over 15%, yeah, absolutely.
Right. In fact, let's see how it is doing in trade currently. It's up over 1.7% in the trade. So this is what we are seeing. The stock was in focus in the back the previous two sessions as well. So that's in terms of Waaree Renewable that we are looking at. But the next, what is interesting is what the markets are also doing currently. Now, if you see across the indices, there is some bit of pressure building in Nifty 50. We are seeing a downtick of about 0.7%. In fact, what we are seeing, even the broader markets, they are in pain right now. The mid cap and the small cap 250, all under pressure, mirroring some of those moves that we are seeing in terms of how the benchmark indices are there. In fact, Feroz Aziz did speak about the overall interest rate sensitive sectors. In fact, what he said that, if the short positions were there, they were breaching the 84% in the index futures. And this is a good news from the rebound probability standpoint that we are looking at. And he's watching for a short-term bounce back. In fact, he's saying if the trade deal is better than expected, a vicious cycle of short covering will also start. Synthetic futures on weekly options trading at 40 or so to the premium to the spot, implying market is oversold. In fact, long short ratio also seems oversold, but needs some cash market buying to start the reversal that we are seeing. There's enough dry power with domestic institutions for buying to start at some point, and he's positive on the interest rate sensitive sectors, expects auto sector to perform well in the second half of FY26 as well. So that's the overall picture that we are seeing in terms of how they are doing. But with that, let's also welcome in our guest who was with us, Sharmila Joshi from sharmilajoshi.com. Sharmila, this was discussed at the start of the show as well, but just want to get your overall check in terms of the markets as well. Along with that, we have Aditya Arora as well, founder and multi-asset research analyst of Analytic.in that we are seeing. Aditya, I'll take this up with you. The overall sense in terms of the market commentary that we just had from Feroz Aziz as well. What are your views on the same?
Very good afternoon to you and to everyone. I think market structure has been lower high, lower low pattern since last few days, but now market is testing important demand zone of 25,000 to 25,800. A lot of times market has taken friction and support from this point. We have already broken the psychological support mark of 25,000, but I think this is just a retest of the breakout zone. The last breakout happened from this zone itself, 24,800 to 25,000. So I think this is not the time to be actually very fearful. I think we are already in the demand zone. So one should maintain buy on dip strategy, accumulation strategy right now, because the global sentiments are also pretty positive. Look at Nasdaq trading at 52-week high, S&P, Dow Jones, and all the global markets are doing pretty well. And as the short exposure in the market has increased, if any positive news comes in, I think that could result in a good short covering rally in the market. So risk reward seems pretty positive, and I maintain bullish bias over some 20 to 30 days. We believe that a short covering rally could play out and Nifty could head towards levels like 25,500 to 25,700.
Okay, so those are the levels that we should be watching out for. But Sharmila, earlier we had a conversation with Waaree Renewable Tech as well. Strong set of numbers that we've seen. Margin profile, the company expects to be in the range of 15% or upwards or so, and revenue growth also strong projection seen over here. Want to get your overall sense on this stock?
Well, it's very positive. I think, as you all were discussing, I think the kind of outlook that they have, as well as the visibility for earnings. And what I like best is that in their business model, they are asset light, and everything that they're talking of, whether it is margins, whether it is the kind of revenues that they could deliver, they are sort of cautiously optimistic, so they are not giving the highest that they could get, and they're not giving the lowest. They're sort of, positioning themselves in the mid-range, and even that mid-range is much higher than where we are today. So looks like they are on a very good, strong growth trajectory. And again, I think the kind of theme that this stock belongs to, which is renewable energy. This is precisely the kind of space that a lot of investors are liking, and not liking just domestically. I would say, if you look at a global scale, this is one of the preferred themes. People are chasing stocks in the renewable energy space, and this fits in very nicely with that the theme as well. So I think a great stock, and you really need to watch this one.
Okay, so an overall positive view is what we are seeing for Waaree Renewable Tech. So do keep that one on your radar. But another stock which is buzzing in trade today is Saregama, and Vansh joins in with more details on why is the buzz that we are looking at for this stock.
Right, so if we talk about some key developments that are taking place in this counter, the company has acquired the biggest and the most popular Haryanvi music catalog. So basically, company has entered into a deal with NAV Records Private Limited. Now, the NAV Records is the leading player in the Haryanvi music space. And if we talk about the key benefits to the company, this deal will provide access to 6,500 tracks across Haryanvi and Punjabi music to Saregama. And this acquisition also includes access to YouTube channel like NAV Haryanvi, which has a 24 million subscriber base. And along with it, the company will jointly work with NAV towards the Haryanvi and Punjabi music content creation. So these are some of the developments that are taking place in this counter right now.
Okay, thank you for that, Vansh. So that's the view that we are seeing for Saregama. Particularly interesting acquisition is what we are looking at. Sharmila, your view for this counter?
I really can't comment because I really never heard her Haryanvi music. I don't know how popular it is. But on a valuation perspective and on an earnings perspective, the stock looks all right.
Let me take this across to Aditya then. Aditya, what is your view on this counter?
I think stock has recently seen very good volumes. It's actually above 1 month moving average. So I think there's a lot of strength with which this stock is rising. The rise is accompanied by good volume. So I think that's a good sign. And second thing is that the stock has taken multiple supports, more than 4 times at 480 odd levels. So this time also the stock is respecting this important demand zone. I think this is a good time to be bullish on this counter. With stop loss of 470, and on upside we can expect levels of 560 to 630.
560 to 630 is the levels that we are looking at for Saregama. So that stock on your watch list as well. But let's talk about Nuvoco Vistas, and it has delivered a strong set of numbers in terms of where the first quarter results were concerned. Let's get across to Puneet for more details on this one.
Well, thank you for that. So it's definitely a couple of key points for Nuvoco Vistas. One is, of course, the EBITDA per ton has grown 42% on a YOY basis and 6% on a quarter-on-quarter basis, signifying the company's cost optimization deals in the cost optimization measures that they've done in this particular quarter, and that's reflected as well. The cement volume was also up 6% on a YOY basis to come in at 5.1 million tons. That's another key positive, as well as the profits growing to 133 crores from very minuscule about 2 to 3 crores in the same time last year. So we've seen a huge jump in profits, and they're led by some of these key measures that I just spoke about. Revenue as well grew at a strong click of a 9% growth. What's also important is they've mentioned that they've completed the acquisition of Vadra Cement, which will give incremental volume growth. So they're currently at 25 million ton per annum. With this acquisition as well as their own capacity expansion, they'll reach to 31 million ton per annum by Q3 of FY27. So these are just some of the key positive aspects that's working in favor of Nuvoco Vistas, and we'll see some more commentary coming in on the following quarters in terms of EBITDA per ton and how that could increase, but it's already about 1,000 rupees per ton, so that's a key positive.
Okay, thank you for that, Puneet. So, if in terms of realizations, it's a positive that we are looking at, even the acquisition, adding to that incremental growth picture that we are seeing. Sharmila, what is your view on this counter?
It's very strongly placed in terms of numbers and the future growth. But, I think in terms of valuations, a lot of positives are now in the price. So, yes, maybe an upside is likely possible. But I think if you need to buy, you really need to wait for the stock to correct a little.
Okay, so that's the view that we are seeing for Nuvoco Vistas, and that's in the cement space. But, an interesting deep dive is what we are looking at now. And this is after multi-bagger mid-cap IT stock Nugent Software had shed 6% after the company's net profit saw about a 54% of a downtick sequentially in the first quarter. Why there is a slower growth? Now, that is a question that we should be asking Varsha, who joins us with more details.
Well, thank you for that. And despite many people bullish on this company, there are a few concerns that we want to highlight. Let's start with Q1 FY26. So if you see now, Newgen Software is a product business. So gauging Q on Q performance would not help. So let's see how performance has been year on year, considering product business being a lumpy business. So in Q1 FY23 to Q1 FY24, if you see, the growth there was 58%. In Q1 FY25, the growth year on year was 60%. And in Q1 FY26, that means this quarter, if you see, the growth is only 4%. Now, we all agree that this is a seasonality business and a lumpy business, but if you see, even if we consider year on year growth, just a 4% year on year growth, and that's the concerning point. Number one. Number two, is there a problem in demand? Let's highlight what is not working in favor of the company. You have India business revenue, which has declined, or rather I would say increased marginally year on year, and the APAC revenue, if you see, has remained flat year on year, and the US business also, if you see, was flat year on year, has declined quarter on quarter. So these were the problems when it comes to Q1 FY26. But let's just go back and see, were there any problems when it comes to Q4 and Q3 also? It seems that there were problems. So if you see, there was in Q4 FY25, there was slower growth and execution challenges that the company has faced. If you see, the annuity revenue mix also declined. Now this was due to delayed inflows from large and long gestation projects. And even the new license sales growth, if you see, moderated 34% year on year in Q4 FY25 from 71% in Q3 FY25. Problem lies there. Even management in their con calls also noted that clients are becoming cautious and in wait and watch mode. So these were the problems which the company faced even in Q4 FY25. Now let's also talk about, were there any financial misses and margin pressure that the company has seen? So if you see, a Q4 FY25 did not meet analyst estimates. Even profit and revenue missed analyst estimates. The EBITDA margin contraction that the company has seen in Q4 FY25 was due to weaker revenue growth and higher non-employee costs. Even in this quarter, if you see, other income actually saved the company, and that's the reason there was a slight growth in PAT. Margins are expected to remain in 24 to 25% range for FY26 to 28, suggesting a limited upside only. Now, even this is not, even if you see, the analysts like Jefferies has highlighted this and has continued downgrade call. So let's just deep dive into this. So in Q3 FY25, Jefferies had downgraded from buy to underperform. Why? Because Q3 missed estimates due to slower growth in annuity revenues. Number one, what they said, and the longer execution will be affecting growth. That's what the word coming was from Jefferies. Even in Q1 FY26, that's the current quarter, Jefferies also said that there was a big miss when it comes to revenue, and there was a decline in licensing sales, and implementation also disappoints from the company, and they have downgraded to underperform on growth concerns. So a lot of problems if you see in Newgen Software when it comes to, in the last 3 quarters there was not a good growth, even it missed analyst estimates. And lastly, if you see the valuations, this if you see, the Newgen Software is trading at around 46 PE. If you compare it with its peers, you have Oracle Financial Services, which is trading at 32, and Birlasoft, which is trading at 24. So if you see at 46 of PE, a risk reward remains unfavorable considering the no growth that the company has seen. So overall, yes, there are issues, and we have been seeing issues in the Newgen Software in the last few quarters.
Sharmila, while this is the overall deep down that we are seeing from Varsha, thanks for that, Varsha, first of all. What is your view? These are a couple of points which were highlighted in terms of that.
So I think we are seeing it play out in the stock price, because I think for 2 reasons. One is that, as it was being discussed, the valuations are higher than the peer set. And this is not a new problem. Now, this is the second or third quarter where we are seeing these problems of annuity and license, closing large license deals affecting the company. And yes, while you may argue that it's a product company, earnings tend to be lumpy, you can't compare it sequentially, etc., etc. the fact remains that it is a problem that you are spotting over the last couple of quarters. So therefore, you must give it some time to correct and come to reasonable valuations and allow for at least a quarter where we can see some recovery path or some commentary that makes us believe that things could get better from here. So I think for me, the stock will be an avoid as of.
Okay, avoid is what we are saying on the fundamental side. Aditya, your take on this?
Actually, the stock is in a strong downtrend since last many days and many weeks. So I would say this is an avoid right now.
Avoid is what we are seeing from both the fundamental and the technical side. So thank you so much, Aditya and Sharmila, for joining the show and sharing that perspective on various of these stocks that we've discussed. But that's all the time that we had on this edition of Profit Buzzers. Stay tuned to NDTV Profit. Lots more lined up on the other side.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
They promised guaranteed returns. They advertised illegal trading in broad daylight. But NDTV Profit picked up the trail.
2 साल हो गए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We called, we questioned, we exposed.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
Because your money deserves protection, not empty promises. Easy money, hard lesson. Stay alert. Verify before you invest.
जनता के पास सवाल ही सवाल है, जवाब ढूंढने को वो देखती है न्यूज और देखती है यहां तो सवालों का मायाजाल है। ऊपर से ये अलग फाइट है, कोई पूरा लेफ्ट तो कोई पूरा राइट है, बीच में मुद्दे के साथ कौन है, जनता को जवाब चाहिए। इसीलिए सवालों की परेड नहीं, मैं लाऊंगा खबरों की कचहरी। मैं शुभांकर मिश्रा, मेरे साथ देखिए कचहरी रात 8 बजे सिर्फ एनडीटीवी इंडिया पर।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What
Hello and welcome to NDTV Profit. You're watching
Profit Top Trades. I'm Mahima Vajrajani and with me is Varsha Chandani. Well, before we move on to the interesting management conversation that are lined up on this show, let's take a quick look on how the markets are doing. Well, the Nifty 50 continues to stay under pressure. The counter is down almost 0.6% as we speak, trading almost at its day's low point. We've seen a significant amount of dip, almost a 500 basis points dip in the index today itself. The Nifty Bank also trading under pressure, down by about 1%, largely dragged by Axis Bank due to slippage in the provisions. There's Nifty Defense, which is seeing significant amount of profit booking, down by about 2%. The broader markets also under pressure. The mid cap 150 down by about 0.6%. The small cap 250 down by about 0.7%. Let's also try to pull up the Nifty 50 heat map and see what counters are pulling down the entire Nifty. Of course, Axis Bank, the top loser on the Nifty 50, down almost 5% as we speak. Shriram Finance down 2%. Bharat Electronics down 1.8%. There's Grasim, which is seeing significant amount of pressure, down by about 1.7%. HDFC Life, Bharti Airtel, Tech Mahindra, all counters under pressure. Wipro fairly doing well in trade today after meeting the estimates as per where Q1 earnings stand, up 2%, ONGC up 1%, Tata Steel up 1% as well. So there are around 11 odd advances versus that of 39 odd declines on the Nifty 50. Let's also try to pull up the sectoral heat map and see how sectors are doing in trade today. Well, it's only the Nifty Media in the green and Nifty Metal slightly in green. Otherwise, all sectors in red. Defense top loser on the sectoral indices today, down 2%, Nifty Bank 1%, Nifty Finance, PSU Bank, all under pressure, down by about 0.6 to 0.7%. Let's also take a look at the broader end of spectrum and see what counters are buzzing there. Let's try to pull up the BSE 500 and see what are those counters that are under pressure. There you go. Clean Sciences down almost 8%. Alok Industries down 6%. Vellore Estate. That's because of the hospitality demerger that we're seeing the price correction there. Newgen Software continues to see pressure second day in a row. Alok Industries down by about 6%. There's Route Mobile also down by about 4%. But something that's doing well, KRBL up 3.5%. Mahindra Life Sciences doing well, 3% up. There's also Whirlpool, Triveni Turbine, Jubilant Pharmova, all trading in the green, about that 2.5% mark. But the interesting conversation that I was talking about is Yatharth Hospital. The counter is in focus, Varsha, in fact, and this is because there's a lot of retail interest that is being seen in the counter. What are you picking up and what's up with the company?
Right. So, Mahima, if you see investors and analysts, they are actually bullish when it comes to healthcare and especially hospital space.
Correct.
And why? Because there's been a lot of capital expenditure done by hospitals, including Yatharth. Now, just to speak about the company, it's a multi-care hospitals which operates in Noida, Greater Noida and Uttar Pradesh. The bed capacity is at 2,300 plus beds and the occupancy stand at around 61%, and the ARPOB, that is average revenue per occupied bed, stand at around 30,829. Even they are expanding their footprint when it comes to New Delhi and Faridabad, and also they also have a new hospital when it comes to Jhansi and then Greater Faridabad as well. And good set of financial numbers in the last 3 to 4 years. If you see, company has seen a revenue CAGR of almost 30%. We need to know that will this sustain. But a lot of investors' interest is in Yatharth Hospital. But to speak about that and what's the outlook ahead, let me invite Mr. Yatharth Tyagi, who's the whole-time director at Yatharth Hospital and Trauma Care Services. Mr. Tyagi, welcome to the show, and always a pleasure to speak to you. I was just speaking about that there's been a lot of investors' interest when it comes to Yatharth Hospital. I just wanted to know what has changed in the last 3 months. What's the outlook?
Hi, good afternoon. No, the outlook has been positive on the company. As you mentioned, we have delivered around 30% CAGR growth in terms of revenue in last few years, and that's the trend that we are seeing for last few quarter. Quarter on quarter also, the company has shown growth. This is primarily due to the expansion both in our bed capacity as well as increase in our ARPOB and occupancy it's increasing. So the interest, has been, quite positive for us. We have seen that over the last a couple of years since the company has been listed, and that's what the company has been delivering. Quarter on quarter, we have delivered on our, projected roadmap ahead, and with the 2 new hospitals that are going to be live this financial year, the momentum should be seen carrying forward for the coming quarters as well.
Right. Mr. Tyagi, you just mentioned about there are 2 new hospitals that will be live in this financial year. Just wanted to have timelines when these hospitals will be operationalized, and also what will be the impact on the EBITDA because of these 2 hospitals?
So one of the hospitals that is in New Delhi, area called Model Town, that has been live this week itself. So the hospital got inaugurated. It's a 300-bedded facility, and it is a super specialty hospital having, cath lab, MRI, oncology treatment, transplant program, as well as the second hospital, that is the Faridabad hospital, which is a 400-bedded hospital, will be live early next month. So with the 700-bedded added capacity this year going live, it adds on to our thought process of expanding our footprints within the North India market, within the NCR market. These 2 hospitals both are inorganic acquisitions. So with these 2 hospitals going live, yes, there would be certain drag on the EBITDA margins of the new hospital. However, our existing older hospitals like the Noida Extension and Greater Noida, they're also ramping up in occupancy. So overall, at the group level, EBITDA margins to what we have seen in the last quarter of the last year should be sustainable for the coming years ahead also.
So you mean to say that 25% of EBITDA margin is what you are expecting? Because there was a time, Mr. Tyagi, when the margins were in the range of 26 to 28%. But now you are suggesting that the EBITDA margins will be 25% at least for the next 1 or 2 years. Am I right?
Roughly around that. So even if you look at the last year, the EBITDA margins, that you were mentioned, 26-27%, if we exclude the new unit that was operationalized last year in FY25, that is the Greater Faridabad Hospital, minus that, the EBITDA margins would have been still, upwards of 26-27%. So it is the new additions of the new hospitals which is dragging down the margins, but excluding those newer units for this year also, the EBITDA margin should be in the range that you just mentioned.
Okay, got that view. Also, Mr. Tyagi, just wanted to have your view on how should we see the ARPOB, that is average revenue per occupied bed, evolving, given that you're coming up with the new capacities, and similarly, because of these new capacities, where will your ARPOB be when it comes to FY26 and also for FY27 as well?
When it comes to ARPOB, if you look at last couple of years, we have grown around 10% yearly, and we still feel that trend should continue for next 2-3 years, because there's still a long way to improve our ARPOB. There are certain treatments that we were not doing earlier that we have started recently, which are huge boosters to ARPOB, just like oncology, just like transplant program. So as the volume of these new therapeutic areas that we've started recently increases, we do expect a good ARPOB growth. Also, going forward, the newer hospitals that we are starting, we would be relying less on the government business. And the government business, the ARPOB is lesser compared to the private insurance and the cash patient. So also, when in the overall group level, our government business portion comes down, ARPOB is tend to increase from that. And third lever for our ARPOB growth going forward is also the rise in international patients. The cities that we operate in, both Faridabad and Greater Noida, they are very close to the upcoming Asia's largest international airport, the Jewar Airport. So we do expect a good outflow of international patient in these regions, and also those new treatments that we have started, they also cater to international patients in general. So going forward, these 3 levers should be keeping the momentum of ARPOB growth as well.
Okay, and Mr. Tyagi, how much capex do you plan to invest over the next 2 to 3 years?
I think as far as our bed capacity is concerned, today with these 2 hospitals live, we are at 2,300 beds. We feel that at least in next 3 years, close to 1,000 beds or more should be added. This is from the inorganic expansion, and as well as organic expansion, that is 450 beds are supposed to be added in terms of the brownfield capacity that we're increasing in our 2 existing hospitals. So around 15 to 1600 beds we are going to add in next few years. and capex per bed should be around 70 to 80 lakhs per bed when it comes to brownfield expansion. And as far as the greenfield expansion is concerned, I think 1 CR per capex per bed would be the right estimation for these inorganic acquisitions to take forward.
Got that. Also, so the kind of capacity growth plan that you have laid down, you were also speaking about the specialty mix. I just wanted to know what is your preference in terms of specialty mix after these capacities come online?
We are known for our super specialty, multi-specialty services. We have traditionally not specifically focused on one specialty. We have been known for our treatments in the areas where we operate for leading super specialty services. However, we do focus more on super specialty compared to specialties. So when I mean by super specialty, departments like cardiology, oncology, neurosurgery, high-end urology work, these would comprise of super specialties, and our focus is more on these specialties compared to the general specialties. In general specialties, you would include the internal medicine, the basic gynae, orthopedics, and internal medicine. Some of our hospitals today, for example, the Noida Extension, the Great Noida hospitals, they're contributing around 70% of the business is purely super specialty business. Super specialty business, not just the RPOP is higher, but also, the hospital is known for much more in terms of life-saving and life-threatening surgeries. And we're able to perform higher complex surgeries in these super specialties. So that's what the focus will be also in the years ahead.
Also, Mr. Tyagi, considering your historical growth rates, that is, around 30%, by FY27, can we see Yatharth having a revenue of around 1500 crores?
As I mentioned, in the past, we have grown at a 30% CAGR. I think we quite positive outlook is that, this momentum should continue, and rightly because the occupancy levers is there, bed capacity is increasing, as well as RPOP is increasing. So what we have delivered over the last few years in terms of a CAGR revenue growth, that should be sustainable for next 3 years also.
Also, Mr. Tyagi, my last question to you would be, considering the capex that you are doing, how much, just wanted to have your mix on the capex, how much is it from greenfield, and how much is it from brownfield, if any ballpark percentage that you can give us?
75% of the capex would be on the greenfield expansion, and 25% capex will be on brownfield expansion in next 3 years. As I mentioned, 450 beds are going to be added roughly from the brownfield capacity, and then around 1,000 will be added in terms of greenfield, and the capex per bed in greenfield is also a bit higher when it comes to capex per bed compared to the brownfield expansion. So that's why we feel that around 75% capex would be a approximately right estimation for the greenfield expansion.
Right, got that view, Mr. Tyagi. Well, thank you so much, for joining this conversation, and all the best.
Thank you. Thank you.
Well, moving on, the next stock which is in focus is Clean Science and Technology. Let's pull up the chart and let's see what that company is doing. Is down almost 8%. Now, there are two to three key reasons why this counter is not working. Let's just focus first is how Q1 FY26 numbers were. So if you see, we have seen this soft quarter. There was a guidance cut. Promoters also announced stake sale. If you see Q1 FY26 results, missed estimates, and there was a visible softness when it comes to demand. But a few good things that happened is 25% of top line came from newer launches, and the market share gains has been seen by the company during this quarter. Just to speak about the four numbers, revenue was up 8.4%, EBITDA was up 5.5%, margins were at 41.1 versus 42.3% last year, and net profit was up 6.3%. But why the stock is under pressure as of today? If you see, one thing is management has lowered their full year EBITDA growth guidance. Now the expected growth is now 15 to 18%, which is down from 18 to 20%, and the more clarity is expected after Q2. The other reason why the stock is under pressure is because of the promoter possibility of selling minority stake, and the stake sale is to support the family estate planning, and that's the reason why we are seeing a Clean Science and Technology under pressure. So I would say not a good set. I mean, okay set of number, but the management guidance, the downward guidance is what letting this stock under pressure, and also the promoter possibility of selling, you know, a majority stake. But the other stock which is in focus is Heritage Foods, which posted a record Q1 FY26 with consolidated revenue up 10%, but profit took a hit. Mahima, what's the update there?
Right, so I think the stock is flying in trade today, and this is because you know, overall the company has managed to see a good revenue growth despite of this quarter being impacted by early monsoons. Overall, it's been a highest ever quarterly revenue for them. Value-added products did see a slight hit in terms of sales because of early rains, but steady growth in terms of milk sales and volume realizations as well. Revenue up 10%, EBITDA down 21%. Margins have taken a hit on the back of raw material prices going up. Net profit down 30%. Overall, in terms of operational metrics, milk procurement saw a rise of around 10% odd. Value-added product contribution slightly declined from 37% to 36%, but the management did come out and said that they want to still increase this by another 10 percentage points. Raw material prices increased by 4.7%, and procurement also grew in terms of volume. Lastly, in terms of product-wise growth, milk revenue saw a growth of 6%, value-added saw a growth of 6%. Fat products, interesting, of course, on the back of lower base, saw a growth of 73%, and ice cream business also grew by 8%. But another counter that's in focus is Reliance. The interesting story here is that Reliance Retail is set to acquire Calvinator, which is an interesting play of consumer durables. They'll be entering the space of ACs, washing machines, etc. It's a strategic brand play to scale white good presence for Reliance in India. This move basically aligns with their broader retail strategy, that is to expand product adjacencies in the entire retail space. Now they aim to expand the brand recall, mass accessibility, as well as in terms of the company. It basically is a legacy brand and targets the tier 2, tier 3 markets mainly. This basically means that it gives Reliance you know, a nameplate to enter the white goods space, plus the cost time, the lag it will not be much because they'll be able to expand quickly with their Reliance big retail stores. Lastly, analysts believe that acquisition is unlikely to move needle for Reliance Retail in the near term, but could put pressure on the peers in terms of pricing power as well, because competition increases in this space. So that's with regards to where Reliance Retail stands. But shifting focus and moving on to our next conversation, that is Shopper Stop. Interesting quarter for them as well. We're joined by Kavindra Mishra, who is the Managing Director and CEO of Shopper Stop, joining us now. Mr. Mishra, you know, like I said, it's been an interesting quarter for you. You know, there are losses that have narrowed, there's margin expansion that has happened, revenue growth has also been decent. Just give us a sense as to how the quarter has gone by as per what your expectations are, because Q1 generally is not the best quarter out of the 4 quarters that you have.
No, I think you are. First of all, thank you for inviting me for this conversation. No, you are bang on. Normally for us, Q3 and Q2 are the best quarters. I think what has happened is that we have really worked on a lot of the operational KPIs. We have worked on our strategy on premiumization, which actually is helping us to drive revenue, create a differentiated experience for our consumers, and that has led to ensure that our departmental store business, which is the mother ship here, has had a good quarter, I must say. Despite Eid date shifting or Operation Sindoor in the month of May, we have had a 5% like-for-like growth. And I think the most interesting part is the premiumization, which is the key pillar for us in terms of our strategy. That has those product categories have grown by 8% like-for-like. So I think it has been a strong quarter for us. It's something which we are quite happy with. If you look at the cost structure, that's as well, we have been able to be very cautious on the way and conservative on our cost management. I think this is something which we are happy with. And I think fundamentally, if I talk about our loyalty program as well, Q1 was our best ever in terms of recruiting our loyalty customers. Our first citizen contribution has gone up to as high as 85%. So I think a lot of operational KPIs getting ticked this quarter, and we believe that the goodness of this will carry on forward in the coming quarters as well.
Interesting. Mr. Mishra, you mentioned about premium brands. Correct me if I'm wrong here. I think now premium brands almost constitute 67% of your total revenues. Just want to understand your ambitions with regards to the premium segment. What are the kind of brands that you're planning to boost in this part of the segment? Because if I'm not wrong, premium segments will also lead to better margins, and overall a better product mix will also augur your bottom line.
See, first of all, it leads to a differentiated consumer experience, I think, which is very, very important for us, because it gives the customer a reason to come to Shoppers Stop. So I think getting those premium brands across categories, as all of you know, that beauty was one category where we did really well, and we started our premiumization journey there. But now you have an Armani exchange also in our stores. You have whether it's apparel or it's handbags, you have Da Milano, you have all very, very premium brands and exclusive brands coming into our departmental store, and this journey will keep on growing. And the best thing is that as the contribution of the premiumization or this journey continues and the contribution of premium brands grow, the GMROS also grows substantially. So typically, premium brand will have a 1.2x more productivity in our stores versus a non-premium brand. So I think that's something, as a strategy, we have decided that we have the best set of consumers. We want to give them a premium experience, premium product, and that's where our personal shoppers also come into play. 25% of our business is now being driven by our personal shoppers. I think that's something which is a very curated service, which only Shoppers Stop has in the country. So I think there are a lot of these elements which are coming together, along with operational efficiency and driving the top of the funnel by getting newer customers within our portfolio, which is helping driving this.
Right. Mr. Mishra, even the beauty revenues, including the distribution part, has seen a good growth this quarter, 17% if I'm not wrong. Just want to get a sense, because competition in this particular space is rising a lot. Your peers are also going ahead and giving targets of, store expansion, plus their e-commerce presence is also strengthening day by day. Give us a sense there. What's the competition like, and what is the kind of strategy that you're adopting?
So I think competition is intense, as you rightly said. So we have players who are very strong in online, or we have players who are just starting in the multi-brand space. For us, just like the way we have for the box, premiumization is the key. We are entering into exclusive partnership with brands where they are available with us. We want to build our beauty journey around experiences. So we do a lot of makeovers. We do close to 1 million makeovers every year. Those customers, typically 50% of those convert to transactions. So I think our journey around beauty is built on premiumization and experiences. of what's true for Shoppers Stop as a business is true for our beauty venture as well. And I think we are very happy with where we are, and we'll keep on driving this whole piece with us.
Okay. Also wanted to get a sense on what are the plans with respect to where store expansion stands, and all of these store expansions, how will they be funded?
So we are looking at close to 6 to 7 departmental stores in this year, and around between 30 to 40 Intune stores, which is our value format. We are looking at funding them from internal accruals mostly.
Mr. Mishra, your margins have also expanded this quarter, and I'm just trying to understand, because as compared to where they were earlier, around that 16 to 17% mark, they're coming back to those levels. When do you expect margins to go back to that 16 to 17% levels?
I think as we rework on our product strategy, as we rework on our private brand strategy, that's when we see this whole piece turning gross margins in the way we are expecting. So I think it's a WIP, work in progress right now, and we are quite hopeful for driving these changes as we go ahead.
Internal timelines that you've set for that target?
I think you will start seeing goodness in this whole thing in the coming quarters.
All right.
I can just share that with you.
Okay. One last question to you. March 2025 ended. So FY25, you ended with top line of around 4,600 odd crores and a bottom line at around 11 odd crores. What's the target that you've set for FY26? Where does that number go?
It should be a much stronger number, if I may say so.
Is there a percentage that you have in your mind? Can you define stronger growth for us?
I think let's meet every quarter. You will see the performance of the business.
All right.
Quite hopeful for the coming year. Yeah.
All right. Just one more last question. Just want to get your sense in terms of your breakup of your revenue in terms of online and offline sales right now.
So online typically is around 3 to 4% for us. The rest is offline.
And is that growing, that 3 to 4% quarter on quarter?
So as we speak, we are doing a transition. We are moving to a newer version of the app, and my sense is that you will see a lot of goodness there from next month onwards, because our transition happens then.
Okay.
Then we can actually start seeing the growth numbers there.
Interesting. Okay,
A
Mr.
lot of
Mishra.
investments are being done, and see, it's a stated goal to be India's #1 omni-channel premium retailer, and I think we are on the journey as we speak.
All right, and all the best for that, Mr. Mishra, and thank you so much for taking out the time and speaking with us at NDTV Profit. With that, we're completely out of time on this edition of Top Trades, but do stay tuned to NDTV Profit, India Market Clothes on the other side.
That's huge. That is a biggie. It's out of there.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
जनता के पास सवाल ही सवाल है, जवाब ढूंढने को वो देखती है न्यूज, और देखती है यहां तो सवालों का माया जाल है। ऊपर से ही अलग फाइट है, कोई पूरा लेफ्ट तो कोई पूरा राइट है, बीच में मुद्दे के साथ कौन है, जनता को जवाब चाहिए। इसीलिए सवालों की परेड नहीं, मैं लाऊंगा खबरों की कचहरी। मैं शुभांकर मिश्रा, मेरे साथ देखिए कचहरी रात 8 बजे सिर्फ एनडीटीवी इंडिया पर।
They promised guaranteed returns. They advertised illegal trading in broad daylight. But NDTV Profit picked up the trail.
2 साल हो गए मैडम। डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We called, we questioned, we exposed.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
Because your money deserves protection, not empty promises. Easy money, hard lesson. Stay alert. Verify before you invest.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
watching India market close, where it's a mayhem for the markets for sure today. Let's pull up the Nifty 50, trading around 0.6% lower, almost at day's low point. The Nifty Bank under pressure, down by about 1%. Sensex also trading 0.6% lower. Let's pull up the heat map and see what counters are putting that pressure. Axis Bank, of course, the top loser on the Nifty 50 today, down by about 4.6%. Shriram Finance down by about 2.3%. BEL down 2%. HDFC Life also down by about 1.5%. But some counters that are actually doing well in trade today includes Wipro, 2.5% up. Tata Steel up 1%. ONGC, Bajaj Finance and IndusInd, some names doing well. Let's try to pull up the advance decline ratio, because that's going to be an interesting one to watch out for. On the Nifty 50, there are 11 odd advances and 39 odd declines, but on the broader end of the spectrum, there's 1500 odd declines versus that of 700 odd advances. So that ratio is almost 1:2. Let's also pull up the sectoral heat map and see how sectors are doing in trade today. There you go. It's only the Nifty Media that is in the green, up by about 0.9 odd percent. Nifty Metals slightly in the green, 2 odd percent. Nifty IT largely flat, up by about 0.05%. Nifty Realty also flat, but it's the Nifty Defense that's seeing significant amount of profit booking, down by about 2%. The Nifty Private Bank down by about 1.4%. The Nifty Bank also seeing downtake of around 1%. Consumer Durable seeing downtake of around 0.8%. Nifty FMCG also under pressure, down by about 0.7%. That's with regards to where the sectors are concerned. Let's also try to pull up the broader markets and see how broader markets are doing in trade today. There you go. The mid cap 150 also under pressure, slightly recovered from its day's low point, but down by about 0.5%. The small cap 250 down by about 0.6%, slightly recovered from its day's low point. Let's also try to pull up the BSE 500 and see what these counters are doing, where there's PVR Inox that's seeing gain about 3.5%, KRBL up 3.5% as well. Triveni Turbine seeing gains of about 3%, Mahindra Life, Chemplast, Whirlpool, some counters in the green, but there's Clean Sciences seeing significant downtick in trade today, down by about 8%. Alok Industries down by about 5.8%. There's Axis Bank, of course, seeing significant amount of pressure. Route Mobile, Atul, SW Solar, some counters that are in the red, down by about 4%. But Harsh, that's with regards to where the markets stand. What else are you picking up? It's Axis Bank, which is definitely one of the top losers on the Nifty, and because of which the Nifty is under pressure.
It is, and it is our stock of the day as well. So we will discuss that. Thank you so much, Mahima, for getting us all of that. Very, very detailed market check. But let's take a step back. European markets have inched higher, so we're seeing the stock 600 up around 1/3%, the DAX 2 up around 4/10, the CAC is up 0.5% thereabouts. So some names within European markets as well, but defense continues its downtrend. Down over 7% in the month of July now is the Nifty India Defense Index, and that now reflecting on your screen, one of the top losers in trade today. So that's the other one. But US futures have climbed as well. So you're seeing globally things looking better. India, specifically for defense, looking lower. The India VIX has risen from its 15-month lows, at least today. When you're looking overall at some names as well, and let me just pull up some names for you. One, the BSE 500 chart, of course, Mahima's covered, but the hotels business demerger, Vellore Estate in focus on the back of that. Some losers today, a Clean Science, a Newgen Software, and you have a Sterling Wilson. We had numbers coming from Clean Science which weren't particularly bad, but it's the promoter exiting 24% of his stake. He will still be the majority owner in Clean Science, mind you, 51%, but the stock obviously not taking that, and the street not taking that too well, 8% lower on that one. Newgen Software, Sterling Wilson on the back of numbers. Sterling Wilson more on the back of that order book which has come off. The other one, a couple of them which have hit 52-week highs on a day like this are Kim's and HDFC AMC and Anand Rathi Wealth. What a run Anand Rathi has had, and we'll discuss some of those as well. In terms of volume-led losers, a GE Vernova, a Cochin Shipyard, a HAL are some which are featuring HAL and Cochin Shipyard, of course, within the defense pack, and the defense pack is one of the key losers in trade today. But yeah, so that's just kind of to sum it up. Let's bring in Ruchit Jain to get us better perspective on what he's seeing with regard to Indian markets. Ruchit, both the Nifty and the Nifty Bank, what's your call? Yesterday was an expiry day move, yes. Today also we are seeing sustained weakness despite global markets holding up. So give us that perspective.
Yeah, hi, very good afternoon, Harsh.
Good afternoon.
Well, what you've seen in last 3 weeks, our markets have been going through more of a consolidation phase, or what we also call a time-wise correction. When this entire correction just seems to be a sideways phase within an uptrend. Now we are trading around very crucial support levels right now, because this level of 25,000 to 24,900 is where the 40-day exponential moving average on Nifty plays around with the rising trendline support. So I think the follow-up move in the coming week and Monday or trading session, Tuesday's trading session will be very important to see whether we manage to form a base around this 40-day mark and resume the uptrend from here on, or we break this moving average support. So ideally, it's more of a time-wise correction within an uptrend. 24,900 should be the pivotal point, or what we can say the make or break level for the short-term trades. And in case only if 24,900 is breached, then we would expect some more corrections towards 24,550 to 600. Otherwise, these are the levels where maybe a markets could form a good support base. So today we are trading around that very crucial support. So the follow-up move from here on will be very important to watch.
Okay, and the Nifty Bank as well, Ruchit, give us your take on that one.
So we are going very selective on the Nifty Bank Index. As of now, there are no signs of a trended up move on the Nifty Bank Index. The major support for the index would come around 55,900, which is about more 300 to 400 points lower from current levels. So it's better to keep a wait and watch approach on the Nifty Bank Index as well.
Ruchit seems more negative than positive today. Ruchit, what are your top picks in this market and how would you trade them?
Well, very few picks, just recommending one of them in the show. So SBI is one stock that we like positionally. While we spoke about the Nifty Bank Index, where we can see the impact is more of the private sector banks, SBI is one of the heavyweight where the stock has recently seen a good consolidation over last 6 months. And even if you see the entire rally which we witnessed in the banking space from the month of April to June, SBI had not seen any kind of participation in that rally. So in terms of that, even now, if we witness profit booking in the overall market or the broader markets, and those stocks which have rallied significantly, they are witnessing some profit booking. But SBI is one stock which has not yet seen any kind of significant up move over past few months. So the risk reward ratio has become quite favorable from here on. So price volume action is also looking quite positive, where the recent price up moves have been supported by rising volumes. So the downside seems to be very limited from here on. For a positional basis, traders should go long on SBI over here with stop loss below 800. We expect targets around 855 to coming in SBI once we see a resumption of the broader uptrend.
Ruchit, actually just before we get to Ruchit, can we just show the defense index or any defense ETF and just show what's happened in the month of July. So if you pull up the 1 month data, you'll kind of get that sense, right? Because I think for the month of July as a whole, defense has had a fairly ugly performance, right? Down, as we can see, 7.5%, right? In the last 1 month. Now, Ruchit, typically bouncing back, fundamentally the order flows have only gone up. India's own capex for defense has inched higher. Is this correction showing any signs of being close to support levels, or do you expect more downside?
Neeraj, although the longer term trend for Nifty defense index is not negative, but the only thing is that the index had already rallied significantly in 3 months time frame from April to June. If you look at towards March, and when the Nifty India Defense Index bottomed around 5,000 levels, from 5,000 to just in the 3 months perspective, the index had rallied towards 9,000. So that kind of a move cannot be repeated over every 3 months time frame. So definitely, I think this is one of the corrective phase within an uptrend. I think the Nifty India Defense Index should go through some time-wise correction as well, along with this price-wise dip which we are witnessing before resuming any kind of broader uptrend. Now, on the levels front for the index, the major support for the index is coming around 7,100. We are now around 8,200 on the index. I think some more dips towards 7,900 support could be seen in the short term. And once we get a dip towards 7,900, I think that's where the risk reward ratio could become favorable again to take some contra longs on the Nifty Defense Index. But as I said, we expect that once the index stabilizes around that 7,900, it would go through some time-wise correction as well.
Okay, so that's on the Nifty India Defense. What's the take on IT, Ruchit, at this point? We've seen some pressure on the index over the last maybe week and a half, but today it's holding up.
So I think today it might be showing a relative outperformance compared to the broader markets, but on a trending basis, we are not witnessing any kind of trended up moves coming in the either of the large cap names, nor on the mid cap names, except bearing a few like Coforge. Now we have seen a pullback move in last couple of months in the Nifty IT index, but again at the higher level we can clearly see that all the heavyweights such as Infosys, TCS, HCL Tech, none of them have been able to surpass their 200-day moving average resistances as well. So I think looking from that perspective, we are not expecting any kind of positive momentum to coming immediately in the Nifty IT index. I think relatively on pullback moves, we would continue to witness some selling pressure as well.
Okay, Ruchit, stay with us. Time for a quick conversation. We have Ashutosh Mishra, Head of Research, Institutional Equity, Ashika Stockbroking, joining us in just a minute. But there you go. Good afternoon, Ashutosh. Let me first start off with your take on Axis's numbers. What is your assessment, and do you believe that the worst is now penciled in, or do you believe valuations are cheap, or do you believe that you would want to stay away from this one?
So we can say that worst is almost priced in. Like if you look at the commentary and intention of the management, it does not look that they have guided this in the fourth quarter that they are doing some review and the result is out in this. Normally, first quarter is also weak quarter for the banks in the terms of that they recognize the agri NPA, especially the larger bank who have a substantial higher agri portfolio. So there also we see some pressure comes into this segment. But in my view, probably second quarter onward, we are going to see a transmission impact, especially on the deposit front, to start getting reflected, and that's where the things will start playing out. And even CRR impact will be there in the third quarter part of it. So from the perspective, if you look, the worst is behind us for the Axis Bank, in my view. Whether things will improve very quickly, I have my own doubt on this part of it, because we have seen that last year also growth was lagging. If they are not able to catch up on the growth, then probably this year also will be washed out, and then we will look for FY27. But if they were to deliver the growth going forward from here, then things may be looking good for them.
Okay, all right. Ashutosh, what's your take with regard to this technical write-off they've taken? Would it worry you at a time like this, and especially at a time when we've seen what's happened to an IndusInd, and maybe I'm nowhere alluding that it's the same case, but would it at all worry you?
No, it's not a matter of worry, but only thing is that it need to be communicated much more clearly in advance, which was lacking in that terms. So there we can question management on that part of it. That if they were doing these type of deep internal audit or internal system change for certain segment of the loan, they should have communicated to the investor in advance in a much more clearer way, rather than just as a passing remark in the fourth quarter commentary.
Ashutosh, the other question that will be in the minds of the people might be that if I'm not saying they will show a similar one, but if there are some chinks in the armor of HDFC and ICICI as well, could that make people move in a sizable way from banks to NBFCs, even if they want to stay within the BFSI space, or alternatively reduce exposure to banks to some other sectors, if you will?
So our house call was ideally from the last 2 months about that, no, going more long on NBFC and reducing weight on the bank. Simple reason was that if you see the historical high of the bank's names in the last 2 years, it was happened because of the rate hike. When the rate reversal cycle has started, there will be impact on the banks, and we all know that will get reflected over the next 2 quarters, or 2 to 3 quarters going forward from here. So in that way, still NBFCs looks to me much better than the larger bank bet. Where we are more positive on the bank side is the smaller banks. Because there they have much higher term deposit contribution, and the term deposit rate has come down substantially. So they were the larger benefit of this whole rate cut cycle and liquidity flush in the system rather than the larger bank out. So my view is very clear that prefer smaller banks with non-MFI exposure type of thing, and then we can prefer NBFCs over the larger bank.
Okay. And so what? Can I ask you, and we'll talk about NBFCs, but can I ask you, what's your pecking order when it comes to the smaller banks? Because there are people who've bought into the small finance bank and others. I mean, is there a pecking order that you have there?
So we prefer the bank where have a less microfinance exposure. So if you see the business numbers of CSB, Karur South Indian Bank, these banks are doing quite well in that pack. So in my view, these banks can do quite well going forward from here.
Okay, the other two that will come out with numbers, and we discussed those, we just touched upon those with Ashutosh, was an HDFC. Well, flat on the net interest income is what HDFC is penciling in, or rather analysts on the street are penciling in with regard to an HDFC. Operating profit also expected to be largely flat, just about up 1% or thereabouts. Provisions will also hold in what is supposed to be a tough quarter, especially where agri is concerned. Some of those numbers are on your screen. Those are provisional numbers already disclosed by an HDFC bank. But profitability to hold up when you're looking at it sequentially. Ashutosh, do you a material inch up in margins not expected, of course, this quarter, but would you then say that there could be any inch down in margins? Because HDFC did see an inch up in margins in Q4. Do you think they'll give away that inch up, if at all?
Surely they will give away some of the margins which we have seen in the fourth quarter. And a peculiar case where the difference between HDFC and ICICI will be there, that HDFC has just changed or relinked their HDFC Limited loan books to the EBLR linked loan in the recent past. So they have, in my view, have taken much better linkage terms and conditions compared to many other banks with their EBLR linked portfolio. So HDFC and compared to ICICI, probably HDFC will see a relatively lower compression in the NIMs compared to ICICI Bank, in my view.
But Ashutosh, that's unfair because ICICI is also on a higher base. So how much of an inch down are you expecting on an ICICI? And if I can venture, what's the take on Kotak as well? Because those numbers will get benchmarked to Kotak's numbers.
So even these three, if I just compare the three banks which you named, I will say the Kotak will be giving one of the good result in thing, followed by the HDFC and then ICICI Bank.
Okay. I'm just.
But all three, I don't expect any negative surprise on asset quality or as such any of these three banks out there. Main focus will be on a growth and NIMS territory going forward from here.
Got it. I'm moving tracks a little bit, Ashutosh, because I'm coming to the top of the number 2 in your pecking order, which is NBFCs, and just trying to understand whether out here also, do you prefer the mid-size ones over the large-size ones, or because the cycle might just be starting after what the RBI has done, that people might prefer the larger ones, they might be the first ones off the block and gain more?
So I will prefer the mid-size one again here.
Why so?
Larger one is so larger one still has a valuation wise at much higher level. So it's more of a valuation call rather than the business call.
Okay, and what is it that you like in the mid-size NBFCs?
So if you look at we still like Poonawalla and we like Sriram, although in the commercial vehicle segment, we expect some asset quality pressure to come in. Probably from here to next quarter, we are going to see some more positive traction in coming in. But Poonawalla is the one which I can name from that we like at this point of time.
Okay, Ashutosh, we'll leave it at that. Thank you so much for taking the time out and being with us. Really appreciate your time.
Thank you.
All right, Ruchit, just very quickly, any thoughts here on any of the or trades on any of the banks or NBFCs? You briefly spoke about it, of course, but at this hour, if, for example, if you had to trade one of the NBFCs, do the charts show positivity on any of the large or the mid-sized NBFCs?
I think within the mid-sized NBFC, L&T Housing Finance have shown very good strength over the last 2.5 months. There has been a consistent outperformance compared to other NBFC names in this thing, and the price up moves have also been supported by good volumes. So technically, it seems that if one has to play for a bit short to mid-term, then this outperformance could continue going ahead. So very selective within the NBFC space, looking at the momentum. But L&T Housing Finance could stand out. L&T Finance could stand out within that.
Okay, we'll leave it at that. Ruchit, thank you so much for taking the time out and being with us. Really appreciate your time. And because we need to slip into a break, but we'll leave you with a slice of a very insightful conversation with Ravi Dharamshi, founder and CEO of ValueQuest Investment Advisors, on our special segment, Talking Point Unfiltered. You've always spoken about these mega trends all through the times that we've spoken. Back from 2015-16 when I first started talking to you, when I think we were in the midst of the chemical mega trend, if you will, and the pharma mega trend, you kind of try to identify some of these and then maybe invest early in them and then ride the whole wave till you can. Would that be a good summary of one basic investing style?
So let me try and explain a bit with a little bit more nuance and a little bit more in detail. See, in any particular industry, there are phases, right? You have a tough phase, struggle phase, then you hit that inflection point, you have the great growth phase, and then you reach a kind of a plateau, then again you have a growth phase. Idea for us is to identify which that growth phase is. Everybody can name a lot of mega trends today, but even within a mega trend, you make money only when you are invested in that particular growth phase. And for that, you need to be very clear in your mind what stage that particular mega trend is. And there are markers that we keep track of, whether it is the technology curve, the cost curve, behavioral shifts, regulatory shifts, capital flow, talent flow. All these things tell us which way the wind is blowing, how strong that wind is. Is the mass adoption reached that kind of an inflection phase? Are we going to see a J-curve kind of a growth phase? If yes, then that is the phase in which the maximum value creation tends to happen. And that is what we want to capitalize on. A mega trend can last 20 years, 30 years, 50 years, but the phase of making money might not last that long. That might be a 5, 7, 10 year phase. And that is what we want to capitalize on. I hope that's a small nuance that I had about investing in megatrends.
No, it is a good one, but just trying to probe that a bit. So this would be different for different industries, right? The growth phase, if you will, because I read a chart in your presentation that there is a start phase, a growth phase, and a scale phase, if I'm not wrong. So for every industry, its growth phase would be different.
Absolutely.
In terms of the timing.
Oh yeah, for sure. In terms of the timing, in terms of the duration, in terms of what kind of delta we can see, how much of that value can actually be captured by the participant, everything differs from one trend to another, one industry to another industry. And one trend can spawn many sectors also. It is not restricted to one sector. And for example, we have spoken a lot about energy transition, but it is actually a trend that encompasses 15-20 different sectors. It is not restricted only to solar. Solar might be the biggest, but there is power transmission, there is biofuels, there is nuclear, there is hydrogen. So many other sectors are also part of the energy transition, and not every sector hits that inflection point at the same time. Solar probably has hit that inflection point 3, 4, 5 years back. Nuclear is probably some time away in terms of hitting that inflection point. So you need to be able to identify that inflection point within a mega trend to be able to ride that extraordinary growth phase where the value creation tends to happen.
What are the markers for this growth phase? I mean, are there common markers which people can take kind of?
No, so let's go one by one. I already mentioned them, but let's say technology curve. So for example, lithium-ion battery technology has hit that inflection point 3-4 years back, and it is expanding it is getting adopted very, very quickly. However, there is a competing technology called sodium-ion technology. Now the problem with lithium is that lithium is short in supply, and we might not have it in our country. So then you might still end up being facing the same problems that you face with fossil fuels, that you are at the mercy of some other nations who will, whether they will supply or not, like it is happening in the case of rare earth elements right now. Now, sodium ion is freely available, but that technology has not reached that inflection point because the lithium ion by nature tends to be very dense. Sodium ion is not that dense. If it is not that dense, then you need more of the material to produce the same unit of power. And for that means maybe the size of the battery expands. So if that is the case, then the applications will be different. It might not be applicable in a transportation kind of a thing, but more stationary kind of application might be there for sodium ion. So where are we on the technology curve? Then where are we on the cost curve? It is not only about technology. Nuclear might be a mature technology, or solar, for example, is a 70-year-old technology, but it hit that cost inflection point few years back when China mass adopted it. And once China mass adopted it, the prices crashed. And when prices crashed, that's when the mass adoption everywhere else in the world has begun. So along with the technology, you need to hit that point in cost also. Then regulatory tailwinds need to be in favor. Governments need to be supporting that, no, we are going to adopt this particular technology and we are going to incentivize the user industry to deploy that. Then you need to see the money flowing in, that people deploying the money need to be able to see the IRRs, and if they can see IRR, that's when the money will flow into it, and that's how everybody will plan their capex and their capacities according to the opportunity. So a confluence of a lot of things need to happen for you to say that this particular technology has reached the takeoff stage and now money can be deployed. From a primarily a listed market investor's point of view, investing in something that is 10-20 years out is not a prerogative. We don't invest in something that is loss making or not reach that kind of an inflection point. So we have a very time limited view of these trends. In next 5 years, which are the technologies which will hit that inflection point where we can make good money, and that is how we narrow down our focus.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
They promised guaranteed returns. They advertised illegal trading in broad daylight. But NDTV Profit picked up the trail.
2 साल हो गए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We called, we questioned, we exposed.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
Because your money deserves protection, not empty promises. Easy money, hard lesson. Stay alert. Verify before you invest.
जनता के पास सवाल ही सवाल है, जवाब ढूंढने को वो देखती है न्यूज, और देखती है यहां तो सवालों का मायाजाल है। ऊपर से ये अलग फाइट है, कोई पूरा लेफ्ट तो कोई पूरा राइट है, बीच में मुद्दे के साथ कौन है, जनता को जवाब चाहिए। इसीलिए सवालों की परेड नहीं, मैं लाऊंगा खबरों की कचहरी। मैं शुभांकर मिश्रा, मेरे साथ देखिए कचहरी रात 8 बजे सिर्फ एनडीटीवी।
On to our next segment. It's 2:30, so that time of the show when we get you what's being heard on the street. And we are joined by Hiral Dadia to decode all the chatter from her dealing room sources. Hiral, good afternoon and thanks for joining in. What are you gathering from your sources?
Lots and lots of news because it's a day where you're seeing a lot of stock-specific action. But to start with, Edelweiss, that has been in focus over the last couple of trading sessions. Today, there is some bit of profit booking, but there is a chatter of buy flows that are coming in on large HNI desks for this one. If you see the stock, it's up nearly 5% in the last 5 trading sessions. And there is a buzz of a potential corporate announcement also that could be coming in on a Edelweiss. So watch out for this one in trade. Apart from that, L&T Finance will be reporting numbers. Now, if you see the stock performance, 40% upside in the last 6 months. Again, huge buy flows on the institutional desk in terms of L&T Finance as well. And the dealers are indicating that the first quarter could turn out to be strong in terms of the numbers. So watch out for L&T Finance as well. Two companies that are on the back of news where there is a chatter of an OFS that could be coming in there. Now again, buy flows coming in on the HNI desk at lower levels on both these counters. That is Amber and Coforge. Amber, we also know that there was a fundraise. In fact, there are conversations happening that there could be a IPO of one of its subsidiaries in terms of where Amber Enterprises is concerned, and a Coforge again only on the back of a OFS. So watch out for both these names. And lastly, a potential fundraise from a foreign investor is what Adani Green is eyeing. That stock is under pressure today, but overall, that, I mean, with the kind of interest that you're seeing in terms of renewable energy as well, Adani Green is on the cards of HNIs right now.
Okay, so all of those on the list, and
it's very interesting. I just have a follow-up to Hiral though, because I remember we speaking about Edelweiss 2 days ago as well, and it's a stock that's kind of stayed at these levels with volumes going up, of course. So what is this buying for? Any idea around that? I mean, is it because there is always this talk, right, that they have 4 or 5 subsidiaries, they're incubating more. So what is this news?
So the buzz is with a corporate announcement. So very much inclined towards what you're saying with the individual subsidiaries that they have, but no confirmation so far in terms of what are they planning to do in terms of the corporate announcement. It could be anything to do with the subsidiaries.
Okay, very interesting. So Edelweiss, let's pull that one up, and let's also have a look at L&T Finance, because you'll have numbers for L&T Finance also come through. So that one also will be in focus. 2% higher on an L&T Finance on a day like this. Buy flows seen, and Q1 could turn out to be strong is what dealers are indicating. Kunal Shah joining us at this hour, Mirae Asset Sher Khan to talk to us technicals. Kunal, let me start off with those two names within the NBFC pack, and Edelweiss and L&T Finance. What are you seeing? Are you positive on any of these?
Good afternoon to everyone. Definitely on Edelweiss, I think the structure looks quite positive. The long-term charts also indicates high top, high bottom on the technical chart, indicating this momentum is likely to continue towards the mark of 135, 140 on the higher end. So I'm bullish on Edelweiss, looks very strong on the chart. LTF again, result based. So overall, if you look at the long-term chart, it had already given us a double top breakout on the monthly chart around the mark of 190. So now that will act as a very strong support on the downside. So any dips, I think could be a good buying opportunity. 190 should be a stop loss on the downside.
Would you trade the index at all, Kunal, or leave the index out because it's anyways not doing much?
So I think for today's trading session, what we have seen that Nifty has given us a confirmation of the downtrend, and we expect Nifty to go towards 24,700. And if we are able to sustain below that, then the next level directly comes at 24,200 on the downside. So overall, our view has been negative on the Nifty. Bounces should be an opportunity to initiate shorts on the Nifty index. We have already seen IT is an index on the technical charts where the larger term pullback is over, and now we expect further correction into the IT index. So that is one thing that could play out on the negative side. Defense as a sector, we have already seen profit booking from higher levels. So any bounce in defense could be again an opportunity to increase, to see the selling pressure. So we are negative on defense as well. So I think that will push the markets on the lower end. Now we have three big results coming up: Reliance, HDFC, ICICI. So again, that is one point where the market could have a gap up, gap down opening on Monday's trading session. But overall, there is a clear-cut divergence in Nifty and Bank Nifty, where Nifty is showing us weakness, whereas Bank Nifty is more or less trading in a range. So I think probably from next week we'll have a directional move on the markets till the time Nifty doesn't surpass its 20 DMA, which is placed at 25,300. The view stands on the negative. Bounces should be an opportunity to initiate shorts. We are expecting short-term targets of 24,700 on the downside. As far as Bank Nifty is concerned, here I think there's a wait and watch is what I'll say. Avoid trading Bank Nifty. You have two banks coming out with results which have more than 30 to 40% weightage on the index. So I think there is no point taking a trade here. So avoid Bank Nifty index at the current levels, and Nifty is something where intraday bounce should be utilized as a sell opportunity.
What about your ideas, Kunal, for the afternoon?
Yeah, so I think I have two stocks where I'll be focusing on. One is on the long side, one is on the short side. First is Dalmia Bharat. I think that looks technically strong on the charts, where it has given us a fresh breakout, and we expect further upside into the stock. So that is a buy for me, keeping a stop loss of 2150 and looking for targets of 2400 on the upside. So Dalmia Bharat is one stock which is looking very strong on the technical chart. The second stock where I think sell side potential continues to increase in the entire space. We have already seen some profit booking and correction at the higher levels, but I think the capital market theme, this is where I think still some selling pressure is left, and I have a negative stance on BSC. So BSC has already seen a correction from the higher levels. Now there was a pullback, which we feel is over, and this pullback can again take the stock down and could make a new swing low as well. So that is where BSC is a sell for me from the current levels. Keeping a stop loss of the recent swing high what it had made. The high was 2585. 2585 should be a stop loss on the upside, and on the downside I'm expecting targets of 2360 to 2340 on the lower end.
Okay, so that is the take coming in from Kunal. But, you know, if anyone had any bets on what the stock of the day was, I wasn't betting a penny on this one. So Axis Bank is the stock of the day for us. In 5 out of the last 7 quarters, the stock has had a downward move on the day after results. And not just a downward move, it has moved down by 2.8% or more. And this 2.8% was, of course, 7 quarters ago. So of late, the volatility post the day of results has just gone up. 5% lower in trade today. There have been misses in terms of expectations. Let's pencil them out one by one. The first one is with regard to provisioning. And elevated provisioning is one thing. Due to technical write-offs, but that was only to the tune of 821 crore. The balance amount of provisioning was still 3100 crore plus, which was well above the 2200 crore which the average analyst on the street had penciled in. So provisioning clearly a shocker, both on the in terms of the technical write-off itself was a shocker, but even outside of that. Technical write-offs were taken largely out of prudence, is what the bank said in its commentary yesterday, and they called themselves the most prudent bank, both in terms of providing as well as in terms of reversing the provisions made. So both of those, they've called themselves out as the most prudent bank in the country at the moment. Even adjusted for technical write-offs, and I mentioned this, the provisioning was elevated. Let's talk about point number 4. Margins were a miss. It was expected to trend lower, but they've spoken about through cycle margin of 2.8%. Now we've arrived at a margin of 3.8% already. The through cycle margin, I beg your pardon, was 3.8% is what they've penciled in. So we've already arrived at that margin number, and only 25 bips of the rate cut has been priced in. So we will first see that 75 basis point rate cut getting priced in. starting likely next quarter and fully maybe next to next quarter is what the management indicated. Talking about one beat as part of the entire earnings, operating profit was a beat on the back of strong other income and lower OPEX, which was welcome, frankly, because they've spoken about that 2 to 2.1% OPEX on various conference calls over the last 8 to 10 quarters, but that's not been delivered. Maybe still not delivered, but at least a path towards lower OPEX has been delivered. So positive on that count. Let's talk what brokerages are saying. Let's pull up what Jefferies is saying. Asset quality disappoints, expects trends to stabilize. They've cut the target price to 1370. While some of those lines come on your screen, we'll keep flipping over. Slippages have surged due to new classification. Growth stays moderate with margin correction is what is being penciled in. Macquarie is saying the PAT miss is driven by higher credit costs, but Macquarie's last line, if we can pull that one up, that was with regard to the fact that the growth is actually onerous and there persists growth, there persists a risk on the return on assets estimate as well. So that's with regard to Macquarie. Let's talk about Citi, and Citi also very similar lines. They believe that there is a cut required with the way one views Axis. They maintain their neutral, they cut their target price. Let's go across to Kunal. Kunal, what's your take with regard to an Axis Bank in particular at this point?
I think definitely Axis, if you look at this bank, one of the banks which have been an underperformer, the kind of sell-off for what we have got in the stock, or you can say rejection on 27th of June, that again indicated that the stock is not likely to outperform. And it has already breached this support of 1150 on the upside. So I think that's a strong resistance. So any bounce would be an opportunity to initiate fresh shorts. You can expect this stock on the monthly chart at least to go towards the mark of 1000 to 950 on the lower end. So I think it is ready to get below that 4-figure mark. So I think 950, 960 is where I'm looking the stock heading on the monthly chart.
950, 960, but it's recouped. I mean, no, actually you can't call it a recoupment because it's still down about 5% per se. I think 1100 was touted to be this big support, and anyways, we heard the technical view from Kunal, so watch out for some downside here. Neeraj Devan is with us. Neeraj, good having you. Thanks so much for joining in. And I wonder, what do you make of Axis numbers, and do you believe that fundamentally there is downside here?
Yeah, good afternoon. Yeah, Axis, if you compare the large cap private sector bank, Axis Bank will always be at a discount. So there was always a case that it should narrow the discount, but the kind of numbers which has come this quarter also, I don't think that discount is going to get narrow anytime soon. So I think it may still underperform the basket of large private sector banks. So I think there are definitely better options available for an investor. I think let's wait and see the next quarter. There's no hurry to invest only in Axis Bank, and then see if there's any improvement happening there. Then we can think of investing in Axis. So for a new investor, to put in fresh money, I don't think there's any hurry to buy Axis because it's fallen by 5% today. There's definitely a reason why it has fallen by that much today.
Okay. Neeraj, we're just marking some of the sectors which have had a slightly iffy month of July, right? It was believed to be a good month. So far it's been okay. But somehow defense stands out as a sector which is cracked quite significantly, nearly 8% downtick after the proof of concept post Operation Sindoor. So what is this? An overvalued sector getting a bit of a reality check? Or is this a dip that you would use to buy because you believe in the long term?
Yeah, both the things. Like it is definitely because it was overvalued. It has run up in the short term, it has run up a lot. So there had to be some profit taking, some correction, because it's a long-term story. So I also believe in the long-term story. I think someone who wants to put it in for a long term, I think these are opportunities whether you can add position. And we were saying this earlier also when the stock had run up a lot, that you will get opportunities because market doesn't run up in a linear way. So you are getting the opportunities. Long-term story is still intact. So go for the strong companies, which have done well even on the operation front as far as the financials are concerned. So I think I think I will go with that. That there is opportunity and the profitable. The current downturn is only because of profit taking.
Okay. All right. Let's take a bit of a pause here. One of the bigger Nifty companies, or the biggest Nifty companies, all set to declare earnings today. Reliance Industries, revenue expected to fall by around 7.5%, with the biggest savior for the company being the telecom sector, is what analysts are penciling in. Swami joins us with all the details on what we can expect. Swami.
Well, a muted set of numbers are expected from Reliance Industries in the first quarter of FY26. Revenues are expected to be down by nearly 7.5%. EBITDA could increase by around 1.5%. Margins are expected to come in at 18.4%, while the net profit, that is expected to be high by around 2% on a sequential basis. Now, if you look at the segment-wise data, the retail segment, which contributes the most to its SOTP target price, that there the revenues are expected to be down by 4%, while the EBITDA is expected to be down by around 1%. However, on a YOY basis, the numbers are expected to grow on the back of the store additions and higher footfalls that Reliance Industries has seen in the first quarter of FY26. Now, if you look at the O2C segment EBITDA, that is expected to be higher by around 2% on a sequential basis. Now, largely the Singapore gross refining margin, that averaged around 77% higher, and this is the sole reason why the O2C business is expected to report a good set of numbers, because these positives are largely offset by a maintenance shutdown that happened in the first quarter, and also the petrochemical margins were weakish in the first quarter. So these two negative factors had largely offset the higher GRMs that we had seen in the first quarter of FY26. Now, if you look at the oil and gas exploration EBITDA, that is expected to be down by around 4% on a sequential basis, largely on the back of lower production number and lower volumes that we had seen in the first quarter. Now, if you look at Reliance Jio, that is a telecom arm of Reliance Industries, that is expected to report a solid growth. In fact, the highest growth compared to other segments of Reliance Industries in the first quarter of FY26. Revenues are expected to be higher by largely around 3%. EBITDA is expected to be higher by nearly 4%. Margins are expected to come in at 53.3%, while net profit is expected to be largely flat at close to 6,700 crore. The ARPU number, that is a key number for a telecom company, that is expected to be high by around 1% at close to 208 rupees, while the subscriber number is expected to come in at close to 49.75 crore. Now, the numbers are seeing a growth largely on the back of the tariff hike that company had done nearly 4 quarters back, and also because of subscriber addition that we have been seeing for Reliance Industries. In fact, this is the 4th consecutive quarter where we will see a growth in the company's ARPU on a sequential basis. Now, the key things to watch from Reliance Industries earning will be their management outlook when it comes to the refinery and the petrochemical business. What is the commentary coming in for the new energy business? What is the commentary coming in for ARPUs and tariff hike that is expected even going forward? And how has been the growth when it comes to Jio Fiber, and what is the capital expenditure plan will be important to track from Reliance Industries earnings.
Okay, thank you for that very, very detailed breakdown of what we can expect. But joining us now, Prabal Sen, Senior Research Analyst covering Indian oil and gas and part of ICICI Securities. Welcome, Prabal. Let me start off by asking you, what are the key numbers you're looking out for? Swami clearly seems to believe that telecom will be center stage when it comes to the Q1 FY26 numbers. Are you of the same view?
Yeah, I think Somit pretty much covered whatever I had to say, so I don't have much to add. I think he pretty much explained all the details that are there. But I think in the OTC segment, I think it's going to be interesting to look at how much the numbers actually improve on a QOQ or on a YOY level. I think someone did mention the fact that there was a shutdown, and a shutdown impacts not only the throughput but also the product yield for that quarter. Otherwise, you would have probably seen an even stronger number. If you just take a look at how GRMs have behaved and the fact that Petchem is broadly flattish, if not slightly better, this number would have been stronger if not for the shutdown. Telecom, you're absolutely right. Our telecom analyst, I think, had put out a note a few weeks earlier as well, highlighting that Reliance is gaining ground in BWA, enterprise, and fiber, ahead of their rivals, if my memory serves. And therefore, the improvement that we're seeing should actually gain a lot of momentum. If I look at his estimates, almost the entirety of EBITDA growth over FY27 and 28 is frankly being driven for Reliance from the telecom segment, built on an expectation of improving ARPUs, recapture of subs in mobility, as well as a growth in the enterprise and fiber space. So to that extent, I think telecom definitely will be one to watch. Retail is, I think, something that we would also watch with some interest. If you look at the trends, the last 2 quarters actually have seen a little bit of a recovery in retail momentum. Before that, we did have a couple of quarters where growth seemed to be slowing down. There was a lot more closures of physical stores where they were probably cleaning up some of their offline presence and basically optimizing their inventory. To that extent, I think the slowdown is something that had impacted numbers. That seems to be getting covered. And now again, even in retail, we are expecting that momentum should come back. So to that extent, I think this quarter should be a good indicator of what to look forward to for the next 12 to 18 months from both these high growth segments. OTC, as always, remains cyclical, and frankly, it's extremely uncertain at this point of time which way GRMs and Petchem will move. But this quarter definitely will be better from a YOY perspective.
Yes, you've also covered plenty, Probal, so tough to kind of question that. But give us a perspective. If there was one pocket which could surprise on the upside or which could prove to be a dampener, what would that be? What is it that you feel in your gut that could be a positive or a negative, on either side?
No, I think as has been the case over the last few years, retail and telecom are the sectors that people look at in terms of, and of course, the capex number as well as the cash flow number. I think that is something that should increasingly come under focus as we move to probably a situation where a lot of the capex on the telecom sector is now behind us, and it's basically new energy capex. That's the only high cap should actually start to see a little bit of a decline, ideally speaking, improving the FCF yields, improving the return ratios. So I think not just this quarter, but over the next few quarters, capex numbers, net debt numbers are something that at least I would definitely want to look at, because that has been our one concern or one slight, skepticism in terms of valuations, where we have not really seen FCF yield conversions and return ratio improvement to the extent that we would like. But earnings growth, I think, definitely led by retail and telecom. So I think metrics on those two segments will be the ones to watch out for.
Excellent. Thank you, Probal, for rounding that up. Cash flow is the other piece, absolutely spot on. And something that, of course, we'll have to keep our eye out on as the numbers come out later today evening. Thanks so much, Probal, for joining us this afternoon, giving us that perspective. But ahead of numbers, Kunal, your take on a Reliance, quickly on charts, how is it looking?
Yeah, on the chart perspective, if you look at Reliance, the long-term chart still remains intact. Yes, there could be some short-term volatility. What we can expect is that firstly, Reliance is trading below the 20 DMA. So there's a clear-cut hurdle around the mark of 1500. On the downside, the support for the stock is placed at 1420, 1410 zone. So that's a demand zone. So probably this is a 50-point range in which the stock is stuck, and you can expect the stock to consolidate in this range post results as well. So I'm not expecting significant move on either side. Only if on the downside 1430, 1420 is breached decisively, then you expect further correction into the stock, or we might continue to consolidate between 1400 and 1500 for Reliance.
Okay, all right. It's also time to slip into a very short break as we round up this segment. The last half hour, of course, ahead of us. And of course, we'll get you the top buy today, sell tomorrow recommendations. And we'll start talking a few more stocks which are buzzing in trade. So stay with us.
जनता के पास सवाल ही सवाल है, जवाब ढूंढने को वो देखती है न्यूज और देखती है यहाँ तो सवालों का माया जाल है। ऊपर से ये अलग फाइट है, कोई पूरा लेफ्ट तो कोई पूरा राइट है। बीच में मुद्दे के साथ कौन है, जनता को जवाब चाहिए। इसीलिए सवालों की परेड नहीं, मैं लाऊंगा खबरों की कचहरी। मैं शुभांकर मिश्रा, मेरे साथ देखिए कचहरी रात 8 बजे सिर्फ एनडीटीवी इंडिया पर।
They promised guaranteed returns. They advertised illegal trading in broad daylight. But NDTV Profit picked up the trail.
2 साल हो गए मैडम। डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We called, we questioned, we exposed.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
Because your money deserves protection, not empty promises. Easy money, hard lesson. Stay alert. Verify before you invest.
Welcome back. You're watching India Market Close. Well, markets, Harsh, are still under pressure, down by about 0.6 odd points. Slight recovery from its day's low point, but we're almost at where we started the show, on 0.6% down. The Nifty IT also under pressure. Banks under pressure for sure. Axis dragging the entire index down by about 0.9 odd percent. The broader markets also seeing pressure. Let's pull up the mid cap 150 and the small cap 250 and see what's happening there. Mid cap 150 down by about 0.5 odd percent, small cap 250 also down by about 0.5 odd percent. Nifty defense seeing significant amount of profit booking there. Let's in fact try to pull up the counters on the Nifty defense and see data patterns down by about 4 odd percent, Bharat Dynamics down 3.8 odd percent. Astra Micro also down by about 3 odd percent. The only counters in green in fact are Zentech, MTAR and Dynamatic Technologies, which is almost flat as we speak. But let's move on to our next segment, that is bull versus bear. And today we put spotlight on Wipro. The tech major posted its first quarter results, and in fact it's the counter that's the top gainer on the Nifty as well today. We have Puneet joining us with a bull versus bear case on what's happened with the earnings. Puneet, what are you picking up?
Well, thank you for that. It's definitely been a very strong quarter for the company in terms of, the deal wins amongst others, and we'll be putting the spotlight on that. But there are some key challenges that could prop up going forward, and we'll put that in the bear segment as well. But first, the strong deal win momentum in this quarter. 16 large deal wins was what the company had in Q1. Last quarter, they had 17 large deals. So the momentum of large deals has continued. They also had 2 mega deals in this particular quarter. They mentioned that this was essentially one of the mega deals was conversion with a client who had been with Wipro for almost a decade. So they have been able to maintain revenue growth share with its key clients, and that's one of the key positives that the market is taking today in terms of quarter one results. But a lot of the deals that the company won even last year as well, they had $5 billion in terms of large deals in FY25. Some of them were transformational projects, and that have now been put on hold, something that we're witnessing across the IT companies. So for Wipro, that will be one of the key ones to watch out for. If the deal wins are translating into financials and showing into revenue growth, that will be one of the key challenges going forward. But the market clearly taking the deal wins as a positive factor. When you look at the second bull and bear case, they have been saying that the company was one of the biggest beneficiaries of vendor consolidation, and this is a very key point because largely we see companies like TCS and Infosys being the beneficiary of vendor consolidation, while players like Wipro as well as someone like a Tech Mahindra loses out. But now the company is mentioning that they've been able to, be a big beneficiary in this space, and hence that is going to be important in terms of revenue growth going forward. So this could be one of the positive factors, but the deals may bring revenue growth at the cost of pressure, and that's something that we know that once these large deals come in the short term we see a margin impact, and we've seen the consolidated margins come to 16.03%. That's also led by the consulting aspect. So that will be one of the key things to watch out for going forward. In terms of brokerages, Macquarie as well as Morgan Stanley is maintaining a positive view. They have said, Macquarie is saying that this year target price of 290 rupees per share. And this is key because the analyst Ravi Menon has been tracking the space for the last 3 decades, and he's seeing Wipro as a turnaround story going forward. Morgan Stanley has also emanated a similar positive view. They've gone on to say that this has the potential to be a key re-rating trigger because Wipro has underperformed over the last few years compared to the large cap IT players. In terms of Jefferies, they mentioned that the improving outlook is positive, but the upside could be capped going forward with the differential that we've seen in pricing in terms of share price performance has inched up even before the results came. And finally, in terms of the valuations, at 19 times price to earnings for FY27, while it is positive and much slightly lower, at least I can say, with compared to TCS, who's at 23 times price to earnings. The valuation discount compared to the other large cap peers, which was visible 2 to 3 quarters ago, has now gone because the market is sensing positive deal wins as well as Wipro to be a vendor consolidation winner. That's the bull and bear case on Wipro. We are seeing multiple positive factors and we're seeing the stock react today on that as well. Going forward, margins will be in focus because of these large deals.
All right, Puneet, thank you so much for giving us all those details with regards to where Wipro stands. Neeraj, hi, good afternoon to you. Your reading on Wipro, how are you, placing it against its peers?
Well, good afternoon. Actually, last couple of quarters, Wipro has definitely surprised, compared to the peers. So I think that continued this quarter also with the kind of deal wins they've announced. And, the stock had taken a dip pre-results because of the other results which had not come in line with the market expectation. But generally, I'm not too positive on the large cap IT space for the time being. So that's why I have a negative bias towards the sector. Though Wipro definitely is doing better than the peers, but generally I'm not so positive because I want to see some further improvement happening across the sector. Because if Wipro is able to crack deals in this environment, definitely the margin will not be that great, and they will somewhere reflect down the line. So I want to see if those sectors doing well, deal wins are better, improving for the sector, then I can make a case for investment in the sector, which I am neutral right now.
Kunal, anything with regards to where GMDC stands? The stock is flying in trade right now. It's up 12% as we speak. Anything specific that you're observing on the charts?
I think on the technical charts today, the stock has given us a breakout above the 20 DMA, so that's positive. On the weekly chart, if I see, we have seen the 5-6 weeks consolidation high has been taken out with strong volumes. I think definitely a very strong candidate on the further upside. You can expect the stock to go towards the mark of 490, 500 in the very short term. So already the stock is quite up, so utilize dips to buy the stock. If you get it around the mark of say 410, that would be a good entry point for the stock.
Interesting. Okay. Another counter that's in focus on the back of its earnings is Polycab. It's been yet another good quarter, good growth in terms of cables and wires, as well as a good growth in terms of FMEG as well. There's profit growth that the company has seen second quarter in a row, and of course, all eyes on the counter after even Jefferies and UBS that has reiterated their buy rating and raised the target prices as well for the counter. Puneet joins us with key triggers behind this bullish outlook.
Well, thank you for that. So it's definitely been a very strong results for Polycab. They've been outpacing the industry growth, and now that's starting to reflect in the numbers as well. So we had a positive view from Jefferies, a target price of 8,180. They're mentioning 3 key points. It's the highest ever sales in quarter one, as well as profits in quarter one. So that's a key positive. They mentioned that the execution continues to be for the highest and the strongest for Polycab in the industry. and that is also leading to the cables and wires segment where the growth momentum is continuing. In terms of the fast-moving electronic goods segment, which includes fans amongst other key segments that Polycab is in, they've seen that the profitable growth has now started to come in and it's expanding further on their target as well. For Polycab, they view it as one of the key plays in the private capex as well as the housing and infrastructure space, and they're anticipating FY 26 to 28 in terms of EPS growth at 26% CAGR. So despite the valuation being elevated, the growth over the next 3 years is estimated to be very strong. We also had someone like a UBS come out with a positive view. They've actually increased their target price to 8,100 from 7,150 earlier, and they're also mentioning that Polycab is showing its growth prowess being the leader in this space. They've said that the FMEG growth is profitable for the second consecutive quarter, and the valuation remained constructive on the positive demand scenario as well as the EPS CAGR. And we also had a chance to speak to the management of the company. So CFO Gandharv Tongya actually highlighted one of the key projects, the Project Spring, and what it will do in terms of the growth versus the cable industry is expected to be 1.5x over the next 5 years. Listen in what he had to say.
We gave our guidance for the next 5 years in Jan this year. We call it Project Spring, wherein we are trying to transform the organization. This, in a way, is an extension to our previous transformational project, Project Leap. Within the Project Spring, we aspire to grow at a rate better than the industry's growth rate in cable and wire, perhaps around 1.5x of the industry growth rate. As far as FMEG is concerned, we would like to grow at 2x of the industry growth rate. On profitability, let's split in two parts. On cable and wire, historically, we have been guiding 11 to 13% of EBITDA margin. We believe we should be able to maintain it, and wherever possible, probably would be able to improve it. As far as FMEG is concerned, last 2 quarters, we have been able to report profitability in this segment, March as well as June this year. Between now and 2030, we would like to get to 10% of EBITDA margin in FMEG. So overall, at a company level, it's possible that we are able to improve on our profitability predominantly because of FMEG improvement.
Okay, so that's of course the management of Polycab, but Neeraj Diwan, positive with regard to Polycab, you had a slew of brokerages which came out hiking target price by as much as 1,000 rupees. On the back of what were, of course, a very, very strong set of numbers.
Yeah, definitely the kind of number they've shown this quarter as compared to June quarter last year have been tremendous. So if you see this kind of growth coming for the year, then definitely the stock deserves the re-rating from these levels. And I think the kind of targets which the street is expecting it to reach will be reached. And this sector also generally, I think, after some consolidation has again picked up. So I think order flow has also increased for them. So I agree with the view that this definitely can be a positive sector for the year.
Okay, interesting take there. Kunal, anything on Heritage Foods that you're seeing? The numbers did come out, but they were not as impressive as the kind of stock movement that we've seen in trade today. It's up 7%, but we saw margins shrinking. We saw net profit down almost 30-odd%. Is there a trade there?
See, overall, the trend for the stock has been positive. You have seen a lot of volatility into the stock. Yesterday it was down by 5-6%. Today it is up by 7%. So I think it's quite a volatile stock. Overall, the trend is intact. If you are holding long or want to initiate a long on it, one should keep a strict stop loss of 440 on the downside. If that is triggered, then exit. And if the momentum continues on the higher end, it can go toward 530, 540 on the upside.
And anything on Kalamandi that you've seen? I mean, this stock has been one of those stocks that's been seeing momentum, in the past few odd days of trade.
Sorry, I don't track this stock, so I have no view on it.
No worries. Anything on Orissa Minerals that you're seeing? The stock is up 10% as well.
Yeah, I think you are seeing the mineral stocks, whether it's an GMDC, NMDC, or an Orissa Minerals. They are buzzing in trade today, and they are backed by volumes. Definitely a good bounce what we have seen from the oversold zone. So this can extend towards 5750, 500 on the higher end.
Neeraj, this Clean Science and the possible promoter exit, at least partial exit of the promoter, is that a concern at all? Because the stock has reacted really adversely to that, 8% lower. and promoters continue to hold 51%. The company in its quarterly earnings, the numbers didn't look bad either. So just not sure if you track it, but do you have a take?
Yeah, basically, I had a chance to look at the numbers. So numbers were not bad. And even if you compare it to other companies in the sector, the kind of multiple they are trading at, Clean Science after the fall today on valuation looks attractive. So I'll have to see and look into the news about the promoter exit and reducing stake. That's something which may have concerned the street, but purely on numbers, I think this looks like an opportunity.
Now, another set of stocks that are in focus on the back of earnings includes Shoppers Stop, Route Mobile, as well as Sterling and Wilson Renewables. We have Jasmeet joining us with more details on what's happened with the earnings of all of these three companies. Jasmeet, what are you picking up?
Well, right, thank you for that, Mahima. Yes, there are the three earnings here, and let's break down each earning and understand what's happening with the market. Firstly, it's Shoppers Stop. Well, the stock is down 5% in trade today. The key highlights from this particular result will be the premiumization has led to sales growth, while the healthy growth across all the operational KPIs was seen in this particular quarter. While the First Citizen segment of the management contributes sales roughly 85%, and management also opened 4 Intune stores with a capex investment of 21 crore in this particular quarter. Now, quickly, let's look at the numbers, how the numbers have reacted for this quarter. When you look at the revenue, it's up 8.6%. While the EBITDA is up 20.2% for the management. The margins are at steady 14.8% versus 13.2% in the previous time. Well, the company has reduced the net loss. It's currently at 15 crores while compared to 22 crores in the previous year. While now when you look at the operational metrics for the company, the average transaction value per transaction has increased by 6%, while the average selling price has seen an uptick by 3%. While the next on my list is Route Mobile. While the stock is down 5% in trade today, let's quickly understand what are the key takeaways from this particular result. The decline in volume came from the communication platform aggregator, which impacted the performance in this quarter. Secondly, the low margin customer contracts were written off in this quarter. The management terminated those particular orders so that they can have better margins going forward. Thirdly, the company continues to see a softness when it comes to the SMS segment of the business, while the overseas business, which roughly contributes 95% of the overall revenue, saw an uptick, saw a downtick by 9%. When you look at the financials, the revenue is down 4.8%, while the EBITDA is down 24%. And the margins are at 8.9% versus 11.2% in the previous year same quarter, while the net profit is down 32%. The next one would be Starlane, Wilson and Renewable Energy. While the stock is down 4% in trade today, the key takeaways from this result would be the revenue uptick was by the higher execution in EPC project. The EPC is the biggest project, biggest segment of the management, which contributes roughly 95% to the overall revenue, while the EPC saw an increase of 98% on YOY basis, while the O&M segment, that's the operational and maintenance segment, also reverted to a steady state level as per management. The net debt has increased due to the higher payment to the vendors, while the company also signed an MOU with South African government for construction of 961 megawatt of project. While as per the financials, the revenue is up by 92.5% in this quarter compared to last year same quarter, while the EBITDA is at 85.5 crore. The margins are at 4.9%. It's again an uptick from 2.7% in the previous year same quarter, while the net profit stands at 31.9 crore. Well, so much positive for this company, but the stock is still down 4%, given that on QOQ basis they have seen a downfall of net profit at 42.5 crore compared to 55.38 crore in the previous quarter. So these are the stocks to watch out for.
Okay, thanks so much for that, Jasmeet. Along with all of those, let me also quickly mark out Hindustan Zinc, because that one's numbers, Q1 FY26 revenue has gone down by around 15% odd. Of course, you can see the volatility on that stock on the back of the numbers, but the numbers were largely in line. So while the stock tanked 1% and thereafter has recovered, that's the key positive. Margins have fallen 335 bips. The estimate was 49.5%. It's come in at 49.65%. So marginally better on the margin count. Profitability too has fallen by around 25%, but much anticipated. 2234 crore is the profit after tax number versus the 2107 crore which was estimated. So largely, in fact, above estimates, if at all I should call it that. Neeraj, some of these metal counters, including the likes of a JSW Steel, expected to declare numbers. Give us your take on something like a Hindustan Zinc. Are you liking that one? Is it on your radar? High dividend yield promoted by a Vedanta. What's the sense?
Yeah, actually, I'm positive on the non-ferrous side. So,
Okay.
I like non-ferrous metal space. Hindustan Zinc also purely on the business, zinc prices, silver prices, all, should do well going ahead also. The kind of demand which is there for zinc, silver, for industrial use, for various use. So but Hindustan Zinc had a problem in the sense that there was a sale by Vedanta. So that also weighed strongly on the company. You saw the stock price drifting down after that, and plus there's no clarity on the further stake sale. That is also market has been waiting for that. So even that is not coming. So I think that is the reason why the stock is trading at these kind of valuations, because the stock is definitely cheap, and with the high dividend yield, this should be an attractive bet for long-term investors. So I think at these prices, definitely one can accumulate this. Though in the short to medium term, there will be definitely we'll be looking forward to what is happening as far as the further disinvestment is concerned.
So that's on Hindustan Zinc, but the other one is JSW Steel. And let's quickly pull out what we can expect with regard to where JSW Steel is concerned. The India operations saw a 5% decline on a sequential basis. So volume has come off. But capacity utilization for India stood at 87% in Q1 FY26, which is decent. When you're looking at expansion, realizations are expected to expand. Spreads are also expected to expand. In fact, the EBITDA per ton is expected to go up by 23% on a sequential basis to 10,476 rupees per ton. EBITDA per ton is set to improve on the back of lower coking coal costs and better steel prices. This is as per JP Morgan, of course. Overall, the EBITDA number will rise 13.5% is the expectation. Margins to rise to nearly 17%, to 67 bip rise in margins on a sequential basis. Profits will rise 37% is what the street is indicating. Neeraj, within the metals, would JSW feature in one of the top 2-3 names that you would want to look at, both in terms of value as well as growth, both?
Yeah, there's definitely growth, but in the short to medium term, I'm a little concerned about the ferrous metal space. I think JSW Steel also is a company which has a high debt, and if there's some slowdown in the earnings can really impact a lot in the overall profitability. So I'm not too positive on the ferrous metal right now. One, because of global issues, because of what will happen with the tariff front is concerned, China slowdown. So all that will weigh on the metal space as a whole. So that's why I'm just positive on the non-ferrous space. But I think there the demand is more than what the supply is. So that is one space I'm still positive on.
Okay, Kunal, do you have a view with regard to a couple of these names which have either declared numbers, Hindustan Zinc or JSW Steel?
I think JSW Steel, it has been just consolidating since the last 1 month or so, and I don't expect any momentum to get built up over here. I think on the metal space, if somebody is looking out on the counter perspective, then I think SAIL, that should be on your radar. Here we have seen that the stock has given us a consolidation breakout on the technical charts with volumes, and this is where 135, 130 zone, which was the hurdle that has been taken out. And I expect this can go towards the mark of 148, 150 on the high.
Okay, Kunal, I don't think I took your view with regard to a clean science. Do you have one?
For clean science, I think overall the chart was on the negative side. The stock has given us a breakdown in today's trading session. And now we can expect further declines for the stock to fill the gap of 1230, 1240 on the downside. And I think that filling of the gap could be a good opportunity to go long into the stock. So short-term perspective, if you look at, there is some bit of correction still left. But I think 1230, 1240 should be a good level of entry on the long side.
Okay, so that's with regard to a clean science. A couple of other big buzzers, data patterns, Bharat Dynamics, both of those are down over 4%, and so is the Nifty India Defense. Kunal, your take on a couple of those names before I take your BTST call.
Yeah, I think on the defense space, in the last 2 weeks, we have been suggesting our clients to exit the defense space. It was overstretched. There was profit booking, which was clear cut visible on the chart as well. So there is sector rotation happening, and we have been negative on the stock. In fact, we had initiated sell on HAL, BEL. That worked out very well. So I think overall we feel that still there is downside left on the defense space. So I think again any technical bounce what you get into the defense space would be an opportunity to exit. Stocks like HAL, BL, Mazgaon Dock, GRSE, this could be the stocks which can continue the downward momentum. Specifically for HAL, if you look at it, it has given us a breakdown and can still come down further towards the mark of 4,500 to 4,400 in the very short term.
Okay, your BTST trade for today, Kunal?
My BTST trade over here will be Dalmia Bharat. I think strong breakout on the technical charts what we have got, and you can expect further upside into the stock. It can go towards the mark of 2280, 2300 on the upside in the BTST trade.
Okay. Neeraj, a lot of cement companies are buzzing in trade today, and this is because Nuvoco Vistas came with its earnings today. Good EBITDA growth there. What is the kind of reading that you're taking from that particular earning, and how do you think this quarter will fare for these cement companies?
I think because the raw material pressure was low in this quarter, and so the demand is yet to pick up, which we had expected earlier, and the prices also have not gone up as far as cement bags are concerned. So, but because of the cost being low, the profitability should have improved this quarter, and I think going ahead, you'll see pickup in demand also happening for the cement for the sector. So I am positive on the sector for the rest of the year also, with raw material prices being low and demand picking up. So that will give an opportunity for the companies to increase the price also somewhere down the year. So I think overall this should be a positive year for the cement sector.
Okay, so that's with regard to cement. Vari Renewable is the other one which is in focus today. Company reported a stellar Q1 with net profit surging 3x. We spoke with Manmohan Sharma, who's the CFO, and who expressed confidence in maintaining this momentum throughout the financial year. Listen in.
Last year, if you see, our top line was 1597 crores, and prior to that 876. So if you see that on a quarter-on-quarter basis, we are 2.5 to between 2.5 to 3x in any kind of parameter. So looking at the presently what we had did in March 25, we have already done 603. So I think this pace will continue over this financial year.
Okay, Vari SW Solar, what part of the power value chain, Neeraj, are you betting on at this point?
Yeah, I'm positive on renewable energy companies, but not these specific, like something like a Sterling Wilson, which is a purely, EPC company with, they have not been that kind of improvement that had come earlier as far as the order flow is concerned. So I'm positive on companies like maybe Tata Power, or companies like JSW Energy, which is expanding a lot into, they're coming out with a lot of capacity. Plus, they're also into storage, energy storage. So this is one sector where there is a lot of work to be done, and a lot of capacity will be created by JSW Energy also. So the Tata Power, JSW Energies, and GIPCL is another company which is going through a capex, which they're also coming out with a lot of capacity, and valuation-wise, it is quite attractive. So these are the kind of companies in the power space which I'm looking at.
Okay, that's with regards to where JSW Energy stands. Neeraj, your quick view on Newgen Software. It came out with its earnings, and the street for sure is not impressed with the way they posted their earnings. What is your reading there, and what's not working for the company?
Here's the name again, please.
Newgen Software.
Okay, no, I don't track Newgen Software. So generally, I'm not too positive on the software, the technology space right now. But Newgen Software, I don't have any specific.
Understood. Kunal, your quick view on the reading where charts are concerned for Newgen Software?
Yeah, I think for Newgen Software, again, there has been a breakdown into the stock and trading below the short-term moving averages. This can slide down further towards the mark of 800, 820 on the downside. So the short-term view continues to be on the negative side.
Okay. Okay, so that's with regards to where Newgen Software stands. Kunal, anything with regards to where JTL Industries stand? The stock is seeing pressure today also. Yesterday also, if I'm not wrong, it was under pressure. Anything on the charts that you're picking up?
Sorry, which stock you mentioned?
JTL Industries, yes.
Yeah, okay. So over here again, we have seen that the larger term trend has been on the downside where lower top, lower bottoms are there, and you can expect further decline into the stock. The next support for the stock on the downside is around the mark of 69. So it can come down towards 69 in the short term.
Okay. And anything on Sterling and Wilson that you're observing?
So on Sterling and Wilson, I think definitely the stock had given us a strong breakout on the technical charts. From the current levels, I won't recommend a fresh buy, but any dips would be an opportunity. There could be still most 5 to 6% left on the upside.
Neeraj, just wanted to get your sense on the hospitality space. You know, there's ITC Hotels that has come out with its earnings, IHCL, which also posted its earnings today. Anything that you're picking up from the early trends of these earnings, and any preferred pick in the entire hotels business space?
I think the earnings will pick up only going ahead. You know, this quarter also there was some concern with Operation Sindoor happening. So, you know, in spite of that, the numbers have been pretty good, even from ITC. ITC numbers are exceptionally good. Even Indian Hotel has come out with very good set of numbers. So there was slight pressure on the margin, but still the numbers were good. So I think going ahead also, and as we progress in the year, things will improve for the hospitality industry. So I like EIH Limited, which if you compare it on valuation front to other to peers, it is trading at a discount, and it has really good properties, and they're into the luxury chain of hotels where they own also some of the properties. So this is one which I'm positive on, purely if you compare it on valuation with the peer group.
Okay. Neeraj, thank you so much for giving us those insights, and thank you so much for taking out the time and speaking with us at NDTV Profit.
Thank you.
Kunal, your quick view on Shopper Stop. You know, when I was going through the earnings, it's not been a very bad quarter for the company as such. You know, the net losses have narrowed down. There's margins that's picked up, but something's not right, in terms of where technicals are concerned. Anything that you're seeing on the chart specifically?
Yeah, I think overall the stock has been facing resistance at 580, and we have seen rejection at those levels. So I think that is a crucial level which needs to be surpassed decisively on a closing basis. Once that is taken out, then you can expect the momentum to come back. The stock can go towards 700, 720 levels on the upside.
Okay, Kunal, just before we close for the day, what's your pick within the private banking pack? There's an HDFC, there's an ICICI coming out with numbers. We've still got 2.5 minutes. Would you pull a trade?
I think definitely not on the two big boys. No need to take out any trade. I think you might have a decent amount of gap up or a gap down opening. So over here, I'll be more bullish somewhere on Kotak Bank on declines. I think that is looking positive to me. The support for the stock is at 2100. So if you get around those levels, I think good opportunity to enter on the long side. And one can expect again a rally towards 2200, 2250 on the upside.
What about something like a Shriram's on the NBFCs, Kunal?
I think Shriram Finance again looks on the negative side. It has already given us a breakdown in today's trading session from a rising trend line, and it has also breached the 100 DMA, and you can expect further decline into the stock towards 600, 620 on the downside.
Yeah. All right. Thanks so much, Kunal. We'll let you go on that note. We're a minute and a half from close, and we have JSW Steel's numbers, which are out. They'll come on your screen in just a moment. We're down 0.5% on the Nifty, down 140 points this Friday. So that weakness from Thursday carrying forward to Friday. JSW Steel is a stock on our radar. But before I get there, the Nifty Bank is what's causing the severe weakness on the index itself. 1% lower on the index at close, and 1% lower on the Nifty Bank as well. So broadly, that's the take. Let's pull up, 0.5% lower on the Nifty 50 index, around 140 points, but 1% lower on the Nifty Bank index. Let me pull out the heat map on the Nifty, and that will give us a sense that the breadth was weak today. That's a second consecutive day where the breadth has been weak, Mahima. And Axis Bank was, of course, the key contributor, 5% lower contributing to the woes on the Nifty Private Banking Index, which is down 1.5%. So that's where a lot of the pressure has come from. Bajaj Finance, though, standing tall on a day like this, 2% higher. Some of the other names which have actually done okay in trade, and we'll pick those out, especially from the consumption and the metal basket. Tata Steel has done okay. Wipro is the other one on the back of numbers which has done okay. ICICI Bank within the private banking pack has also done okay. Some of the PSUs, something like an ONGC, has been okay. On a day like this, Reliance in focus because you'll have results coming through, so positive bias on that stock as well. Within the Nifty, that's the roundup. But let's look at sectors as well before I toss it to Mahima for broader markets. And within sectors, the metal index is perhaps the only one which is standing tall. Outperformance from IT, but absolutely flat. And some weakness still persisting on the technical charts is what we were told. But defense is where the weakness persists. 2.5% lower, now 8% lower for the month of July on the defense index. Private bank we did speak about, so I won't delve deeper. 1% lower on the finance index, and well, the other one, the consumption index, also down around 0.6% thereabouts. Those were the main ones, frankly. But can we have the advanced decline, and Mahima, the broader markets?
Right. So let's try to pull up the advanced decline ratio. You know, even in the start of the show, it was the same ratio. It's almost 1:2 there, and the gap has not narrowed since then. So that's with regards to where the broader end of the spectrum is concerned. But let's pull up the mid cap 150, probably trading at its day's low points now. There you go. Market in terms of the Nifty 50, we already tried to pull that out, down by about 0.6%. But the broader markets also being under pressure. The mid cap, the small cap 250 down almost 0.7%. And the mid cap 150 also down by about 0.6%. Let's try to pull up the weekly charts as well, you know, before we go towards the end of the show and see as to what's the factors to watch out for during the weekend. There you go. The weekly chart of the Nifty suggests that we'll be closing 1%, 1.2% down on the Nifty 50. Nifty Bank closing around 1.2% down, and most of it probably is because of the trade today. In terms of the Nifty Bank, there is 0.8% downtick. Mid cap 150 closing 1% higher. The small cap 250 closing 1.5% higher. So not a very interesting week of trade for sure. 4 days we saw a significant amount of consolidation. Today we're seeing the downtick in trade that we're seeing. But factors to watch out for during the week, or
let's quickly pull it up. Those are corporate actions for you, adjustments in terms of dividend which will happen Monday. Quickly looking at numbers, those are earnings today. The big boy Reliance along with IndiaMart, L&T Finance, all of those will come through. Bandhan Bank is the other lender which will come through. MRPL, Aarti Drugs, Hudson Agro. That's earnings today for you, ladies and gentlemen. The other one is earnings tomorrow, and this is the big one. HDFC, ICICI, AU Small. You'll also have an RBL and a Yes Bank. So it's a slew of banks coming out with numbers along with the Canfin Homes. All of those earnings happening tomorrow. Likely reactions Monday. The Nifty Bank is going to have a fun day on Monday. Trust me.
Not a fun weekend for you, for sure.
there's going to be just so much to dissect.
Yes.
And all of those numbers will come through. But Monday as well. And this is, of course, for your perspective, so that any trades that you make, you keep some of these names in mind, because these are all the earnings coming out on Monday for you. So those are some names for you. Completely out of time on this edition of India Market Close. JSW Steel earnings flashing at the bottom of your screen. Looks like an inline set, maybe a slight bit of a beat. On the other side, we'll dissect those numbers. Stay with us.
जनता के पास सवाल ही सवाल है, जवाब ढूंढने को वो देखती है न्यूज, और देखती है यहां तो सवालों का माया जाल है। ऊपर से ही अलग फाइट है, कोई पूरा लेफ्ट तो कोई पूरा राइट है, बीच में मुद्दे के साथ कौन है, जनता को जवाब चाहिए। इसीलिए सवालों की परेड नहीं, मैं लाऊंगा खबरों की कचहरी। मैं शुभांकर मिश्रा, मेरे साथ देखिए कचहरी रात 8 बजे सिर्फ NDTV इंडिया पर।
promised guaranteed returns. They advertised illegal trading in broad daylight. But NDTV Profit picked up the trade.
2 साल हो गए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We called, we questioned, we exposed.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है.
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
Because your money deserves protection, not empty promises. Easy money, hard lesson. Stay alert. Verify before you invest.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make in our categories that we have been supplying to our defense forces some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real plan? Welcome back. Thanks for being with us. You're watching Market Express. I'm Harsh Saida. Let's get straight into the show. Well, JSW Steel's numbers out, and we spoke about that. And let's pull those numbers out for you. In fact, the Q1 PAT has come in at 2,184 crore versus the sub 2,050 crore, which was the expectation. Seen PAT surge on the back of much better margin outlook. We have Vansh with us, standing by. Vansh, first give us a deep dive of the numbers itself. What's leading the beat?
Yeah, so the numbers are better than the estimates. The revenue has fallen by 3% at 43,400 odd crores versus the estimates of 42,800 odd crores, and the EBITDA has risen by 18% at 7,500 odd crores versus the estimates of 7,200 crores, and the margins have risen to 17.5% versus 14.23%. The estimates were of 17%, and the net profit has surged 46% at 2,200 odd crores versus 1,500 odd crores. If we talk about the EBITDA per ton, now the EBITDA per ton for the company stands at 10,375 rupees versus 10,475 rupees estimates. So these are the numbers, and the numbers look good on the front side.
Got it. Vansh, could you quickly repeat that EBITDA per ton number, because that's something I missed.
EBITDA per ton for the company stands at 10,435 rupees versus the estimates of 10,476 rupees.
Okay, so largely in line with estimates on that EBITDA per ton, but the top line leading the beat overall in terms of both EBITDA as well as profitability EBITDA standing at 7,576 crore versus the 7,200 crore estimate that we had, and margins at 17.6%. So 7,234 crore was the NDTV profit estimate. So a good set of numbers overall coming in from a JSW Steel, Nifty 50 company, something that we'll have to watch out for on Monday for a reaction. But let's pull up the stock price intraday. Can I just see it? Because these numbers came at the last few minutes of trade. And the stock obviously perked up 1%. What I'd want to know is, was it up all through the day or not? I'm just going to quickly look at that, and then maybe, well, the stock did see a sharp spike in the last few minutes of trade that you can see, and that's why it's closed 1% higher. Otherwise, we were trading around the 1,027 to 1,035 levels. So that was lower. That 1% spike that we saw was largely on the back of numbers. So some bit of it built into the numbers already. But of course, we'll have to wait and watch for Monday on the full reaction of the counter. And of course, you'll have the earnings call as well as brokerages and analysts commenting on this, which will obviously spark a reaction. But back to you, Himakshi.
Yeah, and so Harsh, I think we are joined by Parthiv Jonsa.
Okay.
Okay. So, let's go ahead with the bulletin now. So, I'd like to address how the markets have fared today. So, benchmarks closed in red for the day as Nifty ends below 25,000 mark, dragged by financials. Sensex also loses over 500 points. Most sectoral indices closed lower for the day. Nifty Media, Metal and IT only ones to close in the green. Now, if you look at how the markets, benchmarks closed lower, so they have been, they've closed lower for the third consecutive week and underperformed the mid and small cap indices as, okay, so I think there's some one more, news that we're getting in that 361 VAM has released its Q1 of FY26 results, showing a mixed bag of performance there. While overall revenue saw a decent 10% jump to 725 crore rupees and profits also climbed 15% to 374 crore rupees. Operating revenue growth was sluggish, increasing by only low single digits. The company's assets under management showed strong growth, rising 14% to 6.63 lakh crore rupees. LTI Mindtree starts the year on a strong note with margins in line at 14.3% and deal wins of $1.63 billion, slightly above the last quarter. So management expects that margin expansion to continue into Q2, supported by strong traction in the large deals. The consumer business shows healthy growth and the company remains confident in sustaining momentum despite macro challenges. CEAT reports solid top-line growth of over 10% with material cost staying stable. Margins dipped slightly, likely due to increased marketing activity. While net profit also falls, EBITDA shows a modest rise. The company also announced a 450 crore rupees capex for expanding its Chennai plant. Afcon's infrastructure emerges as the lowest bidder for two major highway projects in Croatia, valued at over 4,500 crore rupees. So the contracts part of the A1 motorway connecting key Croatian cities mark a significant milestone in the Afcon's international expansion. Both projects are also expected to be completed within 42 months. Now let's look at the brokerage notes. Now, as per the Jefferies, Indian pharma majors show mixed performance across the key generics. Cipla gains share in albuterol but loses ground in the hydrocortisone injectables. Sun Pharma maintains double-digit growth in the Illumya and Sequa, though Givance remains flat. So Dr. Reddy's gains in GCI products but loses in Guasepa. So Revlimid sees sharp market swings there as firms rush to use up allocations amid this rising competition. Despite a very disappointing quarter, Jefferies maintains a buy on Axis Bank but trims its target price to 1,370 rupees, citing weak Q1 results. Asset quality disappoints due to a spike in the slippages from new classifications. Though trends are expected to stabilize from Q2, Jefferies believes that although the growth remains moderate with margin pressure, the valuation discount continues to support the bullish stance. Wipro Q1 performance is mixed, with earnings under pressure and revenue growth faltering. However, strong deal wins help offset the weakness, signaling robust client demand. Jefferies remains positive on the stock despite trimming its target price, citing potential recovery in the second half as large deals begin to ramp up. Tata Communications posts a mixed quarter. Revenue remains flat sequentially, while EBITDA edges up slightly, improving the margins. However, net profit also plunges sharply due to exceptional items, including those profit before tax grows over 50%, indicating underlying business strength. The company also announces a 1,000 crore rupees fundraise via NCDs to support future growth. Now, if we look at Bajaj Auto Credit, which is a wholly owned subsidiary of Bajaj Auto. So they've approved a fresh issuance of non-convertible debentures worth 5,000 crore rupees. It also enhances its commercial paper limit to 3,000 crore rupees and sells 750 crore rupee cap for subordinated tier 2 debt. So these moves aim to strengthen its financial flexibility and support future growth. Godrej Properties acquires nearly 48 acres of land in Bengaluru, marking a strategic expansion in South India. So the land offers development potential of around 1.1 billion square feet for residential plotted projects. As per the exchange filing, this move aligns with the company's focus on premium housing and strengthens its presence in a high growth market. Heritage Foods reports its highest ever quarterly revenue in Q1, hitting 1,137 crore rupee, which is up 10% year on year. Despite the early rains impacting value-added product sales, the company shows steady growth in the milk sales volume and realization. So EBITDA also rises 21.2% to 73.8 crore rupees, though margins dip to 6.5% from 9.1%. Net profit also falls 30.7% to 40.5 crore rupees. Milk procurement grows nearly 10% to 17.8 lakh litres per day. So with raw milk prices up 4.7%, value-added products contribute 36.1% to the revenue, which is slightly down. So product-wise, milk revenue rises 6%, value-added products grow 6%, and fat products surge 73%, and ice cream business gains 8%. So this is reflecting strong broad-based growth despite the challenges. Now let's look at Reliance Retail. So Reliance Retail acquires iconic home appliance brand Kelvinator in a strategic move to boost its consumer durables business and accelerate growth in the India's premium home appliances market. So Kelvinator, a pioneer in the electric refrigeration with century-old legacy and famed in India since the 1960s for its durable, high-quality products, now joins Reliance's expanding portfolio. This acquisition aligns with Reliance's vision of democratizing aspirational living by combining Kelvinator's innovation with Reliance's unmatched scale, comprehensive service, and vast distribution network. So the company aims to deepen consumer engagement, expand its market leadership, and unlock substantial long-term opportunities in the rapidly growing consumer durable sector. Nuvoco Vistas report a strong Q1 with revenue rising nearly 9% year-on-year to 2,872 crore rupees, driven by 6% growth in the cement volumes to 5.1 million tons. So EBITDA surges over 50% to 518 crore rupees, with margins improving by 500 basis points to 18%. So net profit jumps sharply to 133 crore rupees from just 2.25 crore rupees last year, boosted by a 3.2 times increase in the other income to 14.8 crore rupees. So the company also completes the acquisition of Vadraj Cement with current capacity at 25 million tons per annum, poised to expand to 31 million by Q3 of FY27. So this marks the highest first quarter EBITDA in Nuvoco's history, signaling robust operational performance and growth momentum. Now, Infibeam Revenues approves allotment of 70 crore shares through a rights issue priced at 10 rupee per share, raising 700 crore rupees. So the issue is oversubscribed by 1.4 times, reflecting strong investor confidence despite the stock being down 40% over the past year, though up 18% in the last month. So the proceeds will support strategic investments including Phronetic AI expansion of Rediff Pay and other digital payment initiatives, aligning with the company's focus on AI-driven fintech solutions. This move strengthens Infibeam's position in the AI and digital payment space while enhancing its growth potential. Clean Science and Technology post a mixed Q1 with revenue rising 8.4% year-on-year to 243 crore rupees, but results miss estimates and softness in the demand is seen. EBITDA grows modestly by 5.5% to 99.8 crore rupees, nearly 100 crore rupees, with margins narrowing slightly to 41% from 42.3%. So net profit increases 6.3% to 70 crore rupees. Over 25% of revenue comes from newer product launches, and the company gains market share despite the challenging quarter. So management lowers full-year EBITDA growth guidance to 15 to 18% from 18 to 20%, citing demand softness and global headwinds, while expecting better clarity after Q2. Promoters indicate that plans to sell a minority stake to support family estate planning, creating additional pressure on the stock. Indian Hotels report strong Q1 results with revenue up 31.7% year-on-year to 2,041 crore rupees and EBITDA rising 28% to 576 crore rupees. Net profit also grows 19.3%, while margins hold steady around 28%. So the company sees double-digit growth in the key metrics with RevPAR up 11% and average room rates rising 12%. So despite a slight 90 basis point dip in the occupancy, the international portfolio shows solid improvement there, with 78% occupancy and RevPAR growth of 13%, led by strong performances in London and the US, especially San Francisco. Now, management reaffirms double-digit growth guidance for FY26, maintains a capex plan of 5,000 crore rupees over the 5 years. Now, plans to also invest 1,200 crore rupees this year in the asset upgrades and new projects, including opening over 30 new hotels. State GST departments across at least 6 to 7 states are cracking down on nearly 60,000 unregistered businesses. Now, these businesses, primarily in the B2C sector like salons and eateries, are now receiving notices to pay up back taxes, some running into lakhs. States like Karnataka, Gujarat, Tamil Nadu and Andhra Pradesh are actively scrutinizing these businesses for operating outside the tax net despite exceeding mandatory turnover thresholds. India's smartphone industry, represented by the India Cellular and Electronics Association, has appealed to the government for urgent intervention to counter informal Chinese sanctions threatening $32 billion in FY26 exports. Now, over the past 8 months, China has imposed restrictions on exporting high-precision tools and equipment essential for electronics and manufacturing, creating significant production hurdles. So, additionally, curbs on critical minerals have triggered input shortages, risking supply chain disruptions for manufacturers. Now, compounding these issues, travel restrictions and the recall of Chinese technical teams working in India have hampered technology transfer and production scaling. Japan's inflation eases in June, with the headline CPI falling to 3.3% from 3.5% and core inflation matching expectations at 3.3%. So the slowdown is driven by lower fuel prices, though food inflation is there, especially rice remains elevated. Despite the cooling, inflation stays above the Bank of Japan's target, keeping rate hike expectations alive amid trade tensions and economic fragility. US solar manufacturers are seeking new tariffs on solar imports from India, Indonesia and Laos. So the Alliance for American Solar Manufacturing and Trade claims largely Chinese-owned companies in these countries are flooding the market with unfairly cheap products. Now, this action triggers a US government investigation into whether these imports are unfairly priced or subsidized, and if they are harming the American solar industry. India's ONGC has teamed up with global energy major BP to drill a series of stratigraphic wells across the country. So the move aims to boost exploration, improve geological mapping, and identify untapped oil and gas reserves. ONGC says that the partnership will help unlock India's hydrocarbon potential and support the long-term energy security as well. Daikin Air Conditioning India has launched a new office in Chandigarh as it moves to expand aggressively across North India with a focus on Punjab, Haryana and Jammu. So the company has invested 2,800 crore rupees in India so far and plans to boost sales, service and technical support operations to meet the rising demand. So last year, Daikin sold over 2 million rooms AC units and now aims for 2.5 million units this year. Tech Mahindra plans to invest heavily in sales, marketing and learning infrastructure across key global markets over the next 2 to 3 years, as revealed by the chairman Anand Mahindra at the company's AGM. He said that the firm aims to strengthen its competitive position in the strategic verticals. So, including AI, manufacturing, BFSI and telecom. Prime Minister Narendra Modi launched development projects worth over 1,200 crore rupees across Bihar and West Bengal, with 7,200 crore dedicated to Bihar and over 5,000 crore to West Bengal. So in Motihari, Bihar, he inaugurated rail and road upgrades and incubation facilities, fisheries initiatives and flagged off 4 Amrit Bharat Express trains. In Durgapur, West Bengal, he kick-started projects in power, oil and gas, rail and road infrastructure. The US State Department has designated the Resistance Front, so a Lashkar-e-Taiba offshoot linked to the April 22nd Pahalgam terror attack, as a foreign terrorist organization and especially designated global terrorist. So India welcomed the move, with External Affairs Minister S. Shankar calling it a strong affirmation of India-US counter-terrorism cooperation. The move imposes legal and financial restrictions on TRF and comes amid international scrutiny of cross-border terror networks. Justice Yashwant Verma of the Allahabad High Court has petitioned the Supreme Court to challenge the findings of an in-house 3-judge panel that alleged that he had large amounts of cash stored at his official residence. So Verma claims the panel, appointed by former CJI Sanjeev Khanna, denied him a fair chance to respond and drew conclusions without full investigation. His plea comes as Parliament prepares to introduce a removal, which is the impeachment motion against him during the monsoon session. Well, with that, viewers, it's a wrap on Market Express, but please don't go anywhere as Sanjana Chauhan takes up with Profit 360 on the other side of the break.
They promised guaranteed returns. They advertised illegal trading in broad daylight. But NDTV Profit picked up the trail.
2 साल हो गए मैडम। डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We called, we questioned, we exposed.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
Because your money deserves protection, not empty promises. Easy money, hard lesson. Stay alert. Verify before you invest.
जनता के पास सवाल ही सवाल है, जवाब ढूंढने को वो देख
The market closes lower for the second consecutive day. The Nifty closes below 25,000 and Sensex loses 500 points. Nifty Defence is the top sectoral loser. As India and the US enter the fifth round of trade talks, sources say the ongoing negotiations are focused on securing preferential access for India, raising the question of whether India could land a better trade deal than its Asian peers. Indian smartphone manufacturers have written to Telecom Minister Ashwini Vaishnav highlighting how China's informal trade restrictions are disrupting their supply chains. They identified choke points that are slowing production, raising costs and threatening India's global export competitiveness. Starlink is set to appoint its India CEO as it builds a core team in Delhi ahead of a planned launch by the end of 25. India welcomes USA's move to designate the Resistance Front as a terrorist organization. External Affairs Minister S. Jaishankar calls it a strong affirmation of India-US counter-terrorism operation. The Prime Minister's office convenes a crucial meeting to address India's growing rare earth magnet supply crisis as manufacturers across the auto and electronics sector warn of severe production risks due to China's tightening export restriction. An Israeli strike kills over 90 in Gaza in one day, including aid seekers. Israel says it deeply regrets the strike on Gaza's only Catholic church. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Along the next half an hour, we're going to bring you the latest in markets as well as national and international news. So let's take a look at how the markets fared today. Benchmarks ended lower for the second consecutive day. Nifty closed below 25,000 as financials dragged it lower. Most indices ended in the red with Nifty Defence as the top sectoral loser. Let's go across to Harsh Saita for a wrap of the day's market action.
Well, the Nifty 50 was down 0.6% at close today, and frankly, the overall market mood was also not the best. The breadth on the Nifty was just about 2 advances or maybe less than 2 advances for 3 declines that we saw. So the breadth wasn't favorable. Very similar kind of a breadth even on the exchange. So if you pull up the advanced decline, broadly all through the day, that's the kind of breadth that we saw. Start of trade was okay, but we fell from the highs and we sustained at below the 25k levels. So now we've started to see maybe 24,900 start to emerge as possible levels we're looking at, and if that gets breached, you could well see levels of 24,500 or 600 as well. So those are the levels we're talking about probably next week. But what was the big drag? It was large private sector banks. The index was down 1.5%. Sectoral, largely led by Axis, but then you also saw HDFC, IndusInd, and Kotak, all three contributing to the losses on the large private sector banking index. You also saw ICICI though, but move in the other direction. And mind you, HDFC, ICICI both to declare numbers tomorrow, which is on Saturday. So you'll likely see a reaction on those counters in any case on Monday and on the index as well. Now let me talk about the other big boy, Reliance, also in focus just prior to results. Stock not really doing much, frankly, in trade today. So, but that was one counter in focus. Let me talk about sectors and stick with that. Metals was the one which was in the green today, and therefore you saw the likes of a Tata Steel or JSW Steel, both of them perked up in trade. JSW Steel's numbers also came out right at close, and the stock perked up 1% at close. What we also saw was IT as an index outperformed today on the back of Wipro and its numbers. In terms of the larger underperformers, well, you saw the Nifty India Defence Index down another near 2.5%. You saw the private banking index, I did speak about that. The Nifty Bank was also down 1%. The Nifty PSU Bank outperformed both of those indices, the private bank as well as the Nifty Banking Index. So the PSU banks were relatively better off. But outside of that, consumer durable stocks were also under pressure. That index was also down. But broadly, that was the theme. I did mention that both the mid cap and small cap index largely in line with the Nifty 50. So that's how it played out. Some names, of course, let's pull those out within the BSE 500, top gainers, top losers. Clean Sciences being one of them. But outside of that, plenty of movers on the index. Not too much on the positive side, more on the negative than the positive.
Meanwhile, we had a conversation with Ravi Dharamshi, founder and CIO of Value Quest Investment Advisors earlier today, and we explored the mega trends driving markets and how investors can spot pockets of value amidst the noise. Let's listen in.
You've always spoken about these mega trends all through the times that we've spoken. Back from 2015-16 when I first started talking to you, when I think we were in the midst of the chemical mega trend, if you will, and the pharma mega trend, you kind of try to identify some of these and then maybe invest early in them and then ride the whole wave till you can. Would that be a good summary of one basic investing style?
So let me try and explain a bit with a little bit more nuance and a little bit more in detail. See, in any particular industry, there are phases, right? You have a tough phase, struggle phase, then you hit that inflection point, you have the great growth phase, and then you reach a kind of a plateau, then again you have a growth phase. Idea for us is to identify which that growth phase is. Everybody can name a lot of mega trends today, but even within a mega trend, you make money only when you are invested in that particular growth phase. And for that, you need to be very clear in your mind what stage that particular mega trend is. And there are markers that we keep track of, whether it is the technology curve, the cost curve, behavioral shifts, regulatory shifts, capital flow, talent flow. All these things tell us which way the wind is blowing, how strong that wind is. Is the mass adoption reached that kind of an inflection phase? Are we going to see a J-curve kind of a growth phase? If yes, then that is the phase in which the maximum value creation tends to happen. And that is what we want to capitalize on. A mega trend can last 20 years, 30 years, 50 years, but the phase of making money might not last that long. That might be a 5, 7, 10-year phase. And that is what we want to capitalize on. I hope that's a small nuance that I had about investing in megatrends.
Now, India's strong growth story has global investors watching closely for a rebound. According to Taimur Beg, chief economist at DBS Bank, 2025 could mark a key turning point for the Indian economy despite recent slowdowns. He points to a dynamic shift in private capital flows during 24 to 25 and highlights that India's promising medium-term market potential even amid ongoing uncertainty over global tariff wars. Let's listen in.
We do look at the Indian markets on a cross-asset basis, and the equity market dynamic has been super interesting at a time in 2023 when global investors were selling equities around the world, including India. Indian domestic investors themselves propped up the Indian market in a massive manner. And at that time, I started questioning whether the FII flows are even relevant for India, given the amount of domestic liquidity and domestic excitement we have with respect to the Indian market. On the 2024-25 dynamic, I began to see tremendous amount of dynamism on the private flows side. You talk to lawyers in Bombay and what they're seeing in terms of deal flows, M&As and FDI, just, extraordinary. But 2025 now is a bit of a sobering moment. private or public side, we don't see that much excitement, whether it's domestic sentiment or deal flows coming from the outside. So the lawyers that I talk to on the corporate side are not as busy as they used to be. So overall, I think there is a bit of a stock taking momentum, loss of momentum type dynamic in place as far as India's financial markets are concerned. I would not attribute all of that to impatience about GDP growth. I think some of the deals that I'm talking about and some of the IPOs that I've been seeing, they basically talk about India over the next 10 years. It's not about what happened in last quarter or where inflation is going or what RBI would do. It is about the medium-term potential. And that, in my view, remains very attractive for global investors, independent of the uncertainties we have with the trade war right now.
Meanwhile, Puneet Chhatwal, Managing Director and CEO of IHCL, says the company's business has grown strongly and is set to surpass 1,500 crore rupees soon. He said that serving meals in the sky will be an important growth area going forward, and the company looks to diversify beyond aviation.
As a business has done well in the last 3 years. It has become more than 1,000 crore business, expected to get to 1,500 crores soon. And, we all know the news with the number of new planes coming into India. Serving meals in the skies will be a very important business going forward. And also TajSATS is diversifying into non-aviation business, using those kitchens and utilizing the capacity that we have for institutional catering contracts. So I think over time, we will see that the dependency on just airline catering will be reduced from 100 to 80%, and 20% of the contribution will come from non-aviation business for TajSATS. It is doing phenomenal margins for the business that it is in. It's at around 23%. 23% EBITDA margin in this kind of business is very healthy.
And now on to some news on the ongoing India-US trade talks. Official sources have said that this deal will be all about preferential access. Now, this is the 5th round of negotiations between India and the US, and the sources suggest that the deal will likely be announced next week. My colleague Rishabh joins in with what he's picked up from his sources.
What we're picking up from government sources is the fact that this trade deal, which has been imminent for a very, very long period of time, what we're hearing on that about now is that the main theme is going to be preferential access. That is something that Donald Trump has also pointed towards in terms of his deals with Vietnam, his deals with Indonesia. But this is something that we'll also see now with India. That's what we're hearing from the official government side. The Indian negotiating team, led by Special Secretary of the Commerce Department, Rajesh Agarwal, continues to be in the US. This will now be the 5th day of negotiations for them. And there is some sort of an outcome that is expected ahead of the August 1st deadline, roughly about 12 days left for that, and that is something that we're keeping our eyes peeled on so far as well. An update on the UK FTA signing as well. Remember, this FTA was finalized about a month or two back, and now the final formal signing of this deal will take place, post which the operationalization of this deal will take about an year or so. So that's what we're hearing, is that the Prime Minister, India's Prime Minister Narendra Modi, is likely to visit the UK for this signing sometime next week, perhaps July end, is what NDTV Profit also reported. But what we know so far is that there's no finalized date, but July end, India's Prime Minister might go for a formal co-signing of the UK FTA with UK Prime Minister Keir Starmer as well.
Rishabh, stay with us because there's a possible pattern of informal and targeted trade restrictions being imposed by China, which is being flagged by India's top smartphone and electronics manufacturers. Now, they claim that this pattern is putting India's booming electronics manufacturing ecosystem at risk. So tell us more about what you've picked up on that.
this was a letter that was sent by the ICEA. This is an industry association of electronics manufacturers and smartphone makers. They sent out a letter to Ashwini Vaishnav, India's IT minister, India's IT and electronics minister, on July 1st, asking for an urgent meeting. And also they flagged off 3 very interesting specific choke points that the Chinese have been informally administrating. So these are not curbs that the Chinese government is doing on paper. These are all off paper, informal stuff that is being done by the Chinese administration to stifle India's growth in terms of electronics and smartphones. Now, the 3 choke points that I have here with me, we reviewed a copy of this letter that was sent. The first choke point is, of course, the restrictions on exports of high-precision tools and machinery. So that is something that the Chinese government has been doing for a very long time now, and this is across sectors. But over the last 8 months or so, these choke points, these restrictions have now been extended to electronics manufacturing. Choke point 2 is the critical mineral risks that has been the talk of the town for a while now. We've seen with rare earth magnets, but this is going to impact electronics manufacturing as well, not just EVs. And 3 is the travel restrictions and recall of Chinese technical workers. This is something that we saw happen with Foxconn very recently. And now we're seeing this on a broader basis as well across manufacturers, across smartphone manufacturers, because this leads to some sort of stalling of technology transfer, as well as the new sort of product development that Indian companies want to do. So these are the sort of Chinese informal Chinese sanctions that have been affecting this electronics industry, and this body really wants to set up an urgent meeting and also find some solutions to mitigate these issues.
Thank you so much for that update, Rishabh. We'll continue tracking this update and bring you all of the details. Meanwhile, moving on, big updates coming in from the satellite broadband space as Elon Musk's Starlink is inching closer to its India debut. Sources exclusively tell NDTV Profit that Starlink is set to appoint an India CEO ahead of its anticipated commercial launch by the end of 2025. Let me quickly go over to my colleague Aishwarya, who's joining us with all of the details. Aishwarya, take us through what we know. This is as Starlink is eyeing the India CEO.
Well, that's correct. End of 2025 is what we've been hearing from our sources, that Starlink will make its India debut. Ahead of that, what they are aiming at is what our sources are telling us is that they will be setting up a core team and an India CEO hunt is ongoing as we speak before the commercial launch in 2025. So far, if you've seen, the one name in reports and in news is their global licensing head, which is Padmil, who has been in talks with the government and also going through all the paperwork to set up its India business, starting from their unified license and their in-space authorization as well, that he has been negotiating with key stakeholders, the DOT and TRAI as well. In fact, about 10 months back, the one hire they made was for their company secretary based out of New Delhi. In fact, the copy of the LOI that NDTV Profit had reviewed earlier showed that their initial office will be set up in New Delhi for, of course, public policy and talks with the government, the proximity to the ministry and the officials as well. So in most likelihood, they will be headquartered out of Delhi. And post all of this regulatory hurdle, which they have already cleared, the next step, of course, is applying for a test spectrum. A request will very, very soon go to the DOT for a test spectrum approval and setting up of their earth stations as well going forward. They've identified locations across India. So that's the update so far. We'll hopefully bring you the name of the first Starlink India CEO very, very soon here on NDTV Profit.
Right, Aishwarya, stay with us because now we also have some other news coming in, this time from the Prime Minister's office, where sources are telling us is actually convening a high-level meeting with key stakeholders, including the Mines Secretary, to address the escalating rare earth magnet shortage that is threatening critical industries, whether it's EVs, smartphones, and renewable energy technologies. So take us through that, Aishwarya, because this is an issue that has been constantly plaguing the Indian exporters and, of course, all of these industries as well.
That's correct. It has plagued a whole lot of industries. What we're hearing and picking up from our sources is that the Prime Minister's office is in fact holding a key stakeholders meeting, probably went through this afternoon on the rare earth restrictions from China's export of rare earth minerals and rare earth magnets having impacted a whole lot of business, especially the hearables business, what we heard from a couple of weeks back from industry sources also. What we've also been given to understand is that the Mine Secretary, Kanta Rao, is likely to be present in this particular meeting and may have been part of the consultations that have gone through this afternoon. If you remember, on the 11th of July, in fact, H.D. Kumaraswamy's ministry, the Ministry of Heavy Industries, had said that the government is taking steps to tackle this situation by setting up an over 1,300 crore scheme in order to bump up our rare earth magnets production. And there are two companies who will get subsidies and will be beneficiaries of that particular scheme. And hopefully we will be able to fix some bit of the shortage of rare earth minerals and rare earth magnets that have impacted sectors across the board. So that's the update so far, and we'll keep you posted on what were the outcomes of the meeting also going forward.
Right, Aishwarya, thank you so much for bringing us those updates and definitely looking forward to what the outcome of this extremely crucial meeting is. Moving on, with geopolitical turmoil and trade wars escalating, crude has seen its share of volatility, and OMCs such as Indian Oil have their contingency plans in place. In an exclusive NDTV Profit, spoke to A.S. Sani, chairman of IOCL, who tells us that their latest challenge close to reality was when the Strait of Hormuz was at stake. Listen in.
OPEC, in fact, has hinted that they will be boosting. So far, there was a trimming of production. They will be boosting supply going forward. How are you looking at that macro situation and crude impact on crude overall on the pricing as well?
Actually, it is basically not increasing, I will say. It is a partial restoration of what was cut down earlier. It was earlier cut down to a much larger extent. Now slowly every quarter or every few months they are bringing back those figures, and still they have not reached to where they were 3 years back or 4 years back. So it is basically restoration of whatever was earlier kept as capped. And that is what the hint that we got, or that is the sense that we got, that they are also trying to bring a stability to the whole oil market, which is in their favor also, because they also get a sense of what kind of revenues they are going to get in coming future or in the coming year for their budgeting. And it gives a good sense to us also, because we also understand where do we stand in terms of what amount of outgo will go in terms of billions of dollars that we will be going to spend as India or as Indian Oil in the coming year or coming.
Meanwhile, the Ola and Uber driver strike has entered its 4th day with no breakthrough yet. Drivers are staging a sit-in at Azad Maidan, sticking to their main demands: fairer fares and equal rates with metered taxis. My colleague Shubhana was on ground speaking directly to the protesters. Let's listen in.
Mumbai's lifeline, the app-based cab services have come to a halt. Now that's because Ola and Uber cab drivers are off the road and commuters are in pain. We are here surrounded by the cab drivers who are in a sit-in protest at Azad Maidan. This is the 4th day of the protest. Sir, I wanted to ask, this is the 4th day of the protest. What are your demands? What is the problem? If you could just explain it to us.
We have a very basic demands. I mean, actually the fun fact is that we have zero demands. All that we are asking is execution of the existing laws that we have in place but unfortunately the startups who boast about employment generation, and we in everyday newspaper we read about the fundings they are getting in millions and $billion. You can witness here they are misusing that funding and they are exploiting passengers and drivers, and that's why lakhs of drivers in all over Maharashtra, in Pune, Mumbai and Nagpur have stopped working, and we are protesting against the basic demands, the livelihood that we should get, that is the rate that has been fixed by RTO of the every district, by the RTA, that is Road Traffic Authority.
हमको जो गवर्नमेंट ने रेट दिया है वो अभी तक ओला उबेर रैपिडो इन्होंने उनके जो ऐप पे और लगाया नहीं, आया नहीं। जब तक वो ऐप में नहीं दिखेंगे तब तक हम यहाँ आंदोलन करने वाले।
कस्टमर से कंपनी कितना लेता है? 400-500 लिया तो हमारे हाथ में कितना आता है? 250-300 आता है। हाँ, उसमें CNG जाता है, उनको AC भी चाहिए तो AC से माइलेज घटता है बराबर। दूरी का 1 घंटा लगेगा, 1-1.5 घंटा 2 घंटा ट्रैफिक में चला गया, हमारे जेब में क्या बचता है?
Since July 15, thousands of drivers are off the road as they are staging in a protest at Azad Maidan. This is the 4th day of the protest and they're demanding a right fare per kilometer rate and relief from steep commission cuts. Well, they're not just asking, they're making demands. Now, a committee is set to meet the representatives of Ola and Uber today to negotiate on the same, but for stranded riders and frustrated drivers, the wait still goes on. This is Subhana Sheikh with camera person Prahlad from Mumbai.
Right, thanks for that, Shubhana. And moving on, in a major development, the US State Department has officially designated the Resistance Front, also known as TRF, as a foreign terrorist organization and a specially designated global terrorist organization. Now, TRF is widely recognized as a proxy of the Pakistan-based terror group Lashkar-e-Taiba. The move comes in response to the devastating April 22nd attack in Pahalgam, in which 26 civilians lost their lives. Reacting to this, External Affairs Minister S. Jaishankar called it a strong demonstration of growing India-US counter-terrorism cooperation. He also acknowledged the US State Department's action and emphasized on India's zero-tolerance approach to terrorism. And that's a wrap on Profit 360. Stay tuned to NDTV Profit for more news and updates.
जनता के पास सवाल ही सवाल है, जवाब ढूंढने को वो देखती है न्यूज और देखती है यहां तो सवालों का मायाजाल है। ऊपर से ये अलग फाइट है, कोई पूरा लेफ्ट तो कोई पूरा राइट है, बीच में मुद्दे के साथ कौन है, जनता को जवाब चाहिए। इसीलिए सवालों की परेड नहीं, मैं लाऊंगा खबरों की कचहरी। मैं शुभांकर मिश्रा, मेरे साथ देखिए कचहरी रात 8 बजे सिर्फ एनडीटीवी इंडिया पर।
They promised guaranteed returns. They advertised illegal trading in broad daylight. But NDTV Profit picked up the trail.
2 साल हो गए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We called, we questioned, we exposed.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात, खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
Because your money deserves protection, not empty promises. Easy money, hard lesson. Stay alert. Verify before you invest.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make in our categories that we have been supplying to our defense forces some of the best platforms in the world.
Hello and welcome. You are watching KYC. Today we have a unique company in the oil and gas space that we'll be covering. We're talking about Deep Industries today. Let me first start off with what I want to know with regard to where Deep Industries is concerned. They've guided for a 25% growth. They're seeing good growth tailwind, but for how long is really the question, because it's a small company, 3,000 crore in terms of market cap, and therefore the tailwind can be very strong. The question is, as the base starts to creep up, and it's done a decent growth clip over the last 3 years, and you'll see those numbers, as the number, absolute number in terms of top line goes up, for how long can they grow at 25%? Really, that's going to be my question. The second one is they've announced a 500 crore capex. I want to know everything about this. The funding, I also want to know what this does to capacity, and maybe not capacity per se, but in terms of top line capacity, how much bandwidth in terms of top line does this capacity expansion give to Deep Industries? And the third piece is with regard to ROEs, therefore, because it's such a large capex project, what the ROEs will be at the end of it, or maybe a year or two as this fully starts to kick through. Margins at 40% plus, they've guided that this is sustainable, but of course there's a possible downside risk from maybe a raw material price or otherwise. I'd want to explore that and understand that better. Now, Dolphin Kandla, this is the big piece, because there is a huge one-time knock which the company has taken in FY25. Likely that will not trickle through, but is there absolutely any additional risk with regard to Dolphin and Kandla, or is it fully provided, is what I would want to know. And what the possible upside to it is also something I'd want to know. So both set of risks, downside as well as upside. Then I'd want to know how much will Dolphin and Kandla contribute to margins, because this is more backward integration. So how much will this contribute to the margin number of Deep Industries, and how much otherwise can the margin number go up by in any case, is what I'd want to know. They've guided for maybe a 2% inch up in margins this year. 40 to 43% is the band they've given for margins. Last off, client concentration. Of course, very few players in the space, and therefore the clients are concentrated, but is there a thought process to diversify at all, and if so, how, is what I'd want to know. But let's start off with what the company is about. And we did say, and I did mention, that it's in the oil and gas exploration and drilling industry. It provides 70% of or rather covers 70% of the value chain in oil and gas post exploration, and that value chain is largely what drives the numbers for a Deep. So let's understand the products and services better. One is the natural gas compression. This boosts gas pipeline pressure, and it rather it calibrates the gas pipeline pressure, and that is one of the services that it provides. Second is gas dehydration, that removes water from the natural gas, making the pipeline safer. Third one that they do is workover and drilling rigs. Now this is of course for new rigs and maintenance of old rigs as well. So both of those is what this service covers. The fourth piece is integrated project management, end-to-end project execution when it comes to oil and gas. Charter hiring gas facilities is also what they cover. Full gas processing systems end-to-end is what they take care of. Production enhancement contracts, takeover and boosting oil fields already existing is also the other piece that they take care of. And then there is offshore marine services where they provide supply vessels, tugs, and accommodation barges as well. So all of those are provided by Adeep Industries. Then there's equipment manufacturing, and this is basically compressor boosters which they provide among other equipment that they manufacture as well and they provide as well. And then of course it's trading. Specialized equipment is what they trade via international arms that Deep Industries has. So all of this is what they do. In terms of business model, let's understand that as well. They manufacture some compressors, chemicals via subsidiaries based mainly out of Gujarat, but the core is renting services equipment to oil and gas firms, and a lot of them are Indian PSUs. So you have a decent recurring income which continues to come through as well. They also do selling, or rather they operate sites, they sell services, or rather they operate sites through in most Indian oil states. They also have forayed into global expansion, UAE, Africa, Mexico. How much of that diversification is actually playing out is what I'd also want to know. So that's going to be a key. Last one is with regard to raw materials, whether there's any risk of that. Well, in a nutshell, the risk is extremely low. Those are some key inputs for you in front of you. That's with regard to raw materials. Certain suppliers as well, let's pull those up. And those are fairly standard. And commoditization, yes, chemical spares, there is some bit of commoditization, but not too much. Price fluctuations are surely a possible downside. Timely availability of specialized machinery is the other big downside. So if you don't get machinery on time, you aren't able to execute all the contracts that you have. That's something you want to keep in mind as well. So that's broadly the understanding of Adeep Industries. Let's start off with the 8 metrics that we'll talk about today with regard to Adeep: income statement, balance sheet, cash flow, return ratios, shareholding, street cred. We'll look at guidance that the company has given and thereafter derive valuations and try and see where it is, where the 5-year average price to earnings is concerned versus what valuations currently sit at. All of that on KYC today. Let me start off with the income statement. Now, in terms of top line, it's done 21% on a 3-year CAGR basis on the top line. You see the way in which top line has moved. It's moved from around 322 crore to 576 crore in FY25. There's been a consistent growth. The guidance continues to be 25%. We'll come to that when we come to the guidance metric. EBITDA has gone up by 26%. In the same time period on a CAGR basis. From 116 crore, it's come to 231 crore now, so doubled. Margins have also inched up from 36% to 40%, and profitability has gone up from 71 crore to 134 crore, which is a 24% CAGR. But something to keep in mind is you have a one-time knock on that net profit number of 251 crore in FY25, which we have ignored for the purpose of this calculation. Why have we ignored it? Because it was due to an acquisition, or rather a couple of acquisitions that Deep Industries made of assets where the assets weren't fully, the receivables reflecting in the assets and the inventory wasn't correctly valued. So they've done an accounting adjustment, consolidated all the assets into Deep Industries itself to try and work out efficiencies, and that's why there was an exceptional loss. The point being, it's a one-time exceptional loss. That's something to keep in mind. That's the trajectory in terms of margins that you are seeing. Now let's look at the balance sheet, and in the balance sheet as well. First off, this is a 3,000 crore market cap company with a near 1,800 or 1,900, 1,850 crore book value. So that's for your reference with regard to the price to book. The borrowing number is also fairly low at just 205 crore. Very strong capex is what they've penciled in. And the cash and bank balance currently sits at around 51 crore. So fairly healthy in that sense. For a 3,000 crore market cap company, borrowing is not too high. This includes short and long-term borrowing. So 100 crore roughly each. So that's the whole picture with regard to the balance sheet. We've given this a thumbs up as well. No concerns. Let's talk about cash flow now. And when you're looking at cash flow, largely we've given this a neutral only from a perspective that cash flow, yes, very, very healthy. But the CFO to EBITDA in FY23 was slightly lower. So there's been some bit of choppiness with regard to CFO to EBITDA. That's something you want to be mindful about. But unwind has happened in FY24-25. So it doesn't look as bad at this point. Net cash flow, not exactly the metric you'd want to look at in a company which is investing quickly into capex. So that's something to look out for as well. They will continue to invest in capex, so net cash flow may not really come through, but again, not the appropriate metric. Operating cash flow is what we will look at, but we've given this a neutral out of abundant caution. Let's look at return ratios now, and you'll see the return ratios are on an upward trajectory, but they've not crossed 12%, and that's for me a bit of a concern. Can it cross 12? That's a question we'll pose to management as they continue to ramp up on capex. But 8, 10, 12, at least there is some bit of consistency to it. There isn't wild choppiness. We've given this a neutral, giving the management a little bit of benefit of doubt with regard to return on capital employed. But broadly, this is one metric which you really want to look out for, because if you're doing large capex, you want to see that the ROCE of the company is solid. So you want to keep your eye out on this one if you're looking at Adeep Industries. Let's look at shareholding now, and you'll see a decent shareholding sitting with the promoters. Very low interest from FIDIs, public hold the rest, and even in terms of number of shareholders, they've jumped substantially from FY22, where there were just 17,000 shareholders. You're currently sitting at 38,000 shareholders overall. So that's one metric you want to kind of consider if at all you are an investor. The number of shareholders has gone up, no FIDI participation, but a thumbs up nonetheless, because the promoters own a very solid 63.5% in the company. Let me now talk a little bit about street cred. And the street cred, 1 month the stock is up 9%, but you look at the 6-month trajectory, negative 21%. Year to date, negative 16%. 1 year, the stock is up 50%. And 5 years, it is up 22x. So what we've seen in a nutshell is that over the longer period of time, as the performance has really picked up with regard to this one, you've seen very strong returns. But in the near term, we've seen that there isn't as much return that investors have made. Is it time to be cautious or not? Well, we'll look at valuations, of course, and that will give us a better picture. But that's the street cred that we see at this point. Now let's look at the commentary that's come through. And this is an important one, because you want to see and you want to be sure that the commentary that's coming through is good. FY26 top line, 25 to 30% growth is what they've guided for. 40 to 43% margins is what they've guided for. They've also guided for PAT to grow faster than top line. We'll extrapolate some of these numbers when we look at valuations. Kandla and Dolphin's receivables are nearly fully provided is what they've said, but I want to know whether there's a downside or upside risk to that. Contracts with Indian PSUs are fixed, so there's visibility with regard to where growth is concerned. And you also want to therefore understand where do return ratios stack up at the back of all of this, if at all that is the case. But we've given this a neutral out of abundant caution. That is on the guidance. Now let's look at valuations. You've got FY25 to FY26. If top line were to go up by 25%, that's the top line number you'll see, which is 720 crore. EBITDA at 40%. We've been conservative here, lower end of the band, but likely this will be slightly higher. I will give you the number if it's slightly higher as well. So EBITDA margin at 40%, you got an EBITDA of 288 crore, very close to 300 crore. And this is only in a case where you are virtually doing a 40% margin. If you're doing a 43% margin, it's a little in excess of 300 crore. So maybe 310 crore is what the top line will be. And revenue also, I'm building in lower end of the band at 25%. If it's 30%, then the revenue number will stand at 750 crore and the EBITDA number will stand at 330 crore. So that's something you want to keep your eye out on as to where it stands, and maybe we'll get some color from management. Now, profit at 30% growth versus the current year, removing the one-offs, will be around 175 crore. That places the price to earnings multiple at around 17 times. If profit were to do, say for example, 35%, then the number will be 81 crore and the price to earnings will be around 16.5 times 1 year forward. That's just 1 year forward I'm extrapolating for, or rather 9 months forward. Now let's talk a little bit about the market cap to EBITDA as well. That stands at less than 10%. The 5-year average price to earnings on a Deep Industries is around 15 or just below 15. So it's trading roughly at the right price point when you're looking at the 5-year numbers versus the 1 year forward price to earnings. That's the way one should look at it. Maybe a 10% premium on the price to earnings number, but an upside surprise to earnings could well reverse that. And mind you, we're looking at just 9 months forward. So FY27, that's what most analysts currently are looking at. Then maybe this number changes a bit. So something again to look out for. But that's valuations. We've given that a neutral. Let's stack up now all of the metrics and give it the final KYC rating. Let's look at, okay, so those are the first 4 metrics. Income, balance sheet, that's how it's stacked up, and those are the last 4. One thing that stands out here is probably no thumbs down. And if at all, and it's 5.5 on 8, but if at all one were to just try and give a possible one big monitorable here, it's the return ratios, and we'll quiz the management with regard to that. Let me bring on board Rohan Shah, Director Finance and Group CFO Deep Industries. Rohan, we've spoken earlier. Thanks so much for joining. It's a pleasure having you here. Sir, give us the color. You've won a couple of contracts as well this quarter. And I don't want to talk about Q1 FY26, understandably on silent period. But what is the top line shaping up as? You've guided for 25 to 30. My question is, can it exceed 30? Is there a positive bias to that top line guidance that you've given?
Hi, good morning, Harsh.
Good morning.
Definitely, the way we have guided in past, the growth is appearing very promising. And we are gunning towards year-on-year growth of more than 30%. So this year also we are expecting growth somewhere above 30%.
So how long can you grow at this 25 to 30% kind of band? So FY26 will be a strong growth here, 30% plus. What does that do to FY27, 28? Give us a slightly zoomed out picture, 2 to 3 years.
So based on our current order book, whatever we are just giving a guidance is based on existing order book itself. And based on this existing order book, we expect that next 2 financial years, we would definitely grow above 30%. And for FY28, if we'll have to talk, whatever new projects we would be adding in our existing order book, that would help us in growing FY28. So there is a clear visibility of next 2 years, which should be more than 30% growth.
Got it. So you should be at 1,000 crore in terms of top line by FY27, if I'm getting this math right. Let me, sir, talk to you a little bit about EBITDA. You've acquired Dolphin Kandla. What does that do to your margin number? And you started off also on a lower margin base in terms of FY25. So how much will be the organic margin pickup as a result of this and the inorganic margin pickup from the acquisition of Dolphin and Kandla?
See, organically, our EBITDA margins have been in range of 40 to 42%. And with acquisition of these companies, we are anticipating to improve it further. So organically, 40 to 42% is growth we are anticipating going further. And with these acquisitions, this EBITDA margin can go as high as 45% as well.
Got it. So okay. So upward bias to margins. How quickly can it go to 45 in the next 2 years, sir?
We are expecting in next 2 years. Yes.
Got it. Understood. Okay. I'll pull out the numbers as well. So on the 500 crore capex that you're doing, what is the kind of funding that where are you going to get that funding from? You're sitting on around 50 to 60 crore rupees of cash, maybe a little bit more at the end of Q1. Where does the 500 crore come from? Are you planning a QIP? At what value will you plan a QIP?
See, the capex we have planned would be funded with mix of all different resources. One is, of course, as you rightly mentioned, the internal accruals. We will definitely take some amount of debt as well, because we are fairly, or I would say highly, very confident on taking debt, because our debt equity is very much in control. And we may think of raising equity as well. We have taken all approvals for raising equity through QIP, and we might go for QIP as well, depending on the market conditions.
Sir, give us some color. So if you were to do a QIP, you've suggested at the end of Q4 in your con call that you will do the QIP at the right price. What to you is the right market capitalization?
See, based on the growth which we are envisaging, based on our existing order book itself, year-on-year growth of more than 30% is something one cannot ignore. And with such improved margins, the valuation which currently we are getting, we believe it is quite on lower side. And we'll definitely look for some good PE multiple and some good valuation to come in by market recognizing our growth and the margin prospects.
Okay. Okay. I won't push you on that count, but would it be something in the range of 20 to 25 times 1 year forward? Is that something that you're more comfortable with? And if you get that valuation, will you do an equity raise?
Yes, we can look.
Oh, understood. What happens if the equity raise doesn't go through? You do a debt raise, and that is a large amount of debt to take on your book. You have around 200 crore of debt already. How much will be the debt raise? Because you plan to do this entire 500 crore capex in FY26 itself.
See, as I said, we are quite comfortable on taking debt because our existing debt is very minimalistic. Probably we are the only company in this industry who is having such low leverage on their balance sheet. And so taking debt of 300-400 crores is not an issue at all. So if in case we'll not be able to raise equity, we can definitely fund this capex through internal accruals and debt.
So, sir, what is your current cost of debt? Give us that picture.
Our current cost of debt is in range of 8.2 to 8.5% per annum.
Understood. And you'll probably add another 300 to 400 crore of debt if at all you don't get equity, or if you don't get the right valuation in equity. Is that what you're saying?
Yeah, we are pretty much comfortable in raising debt.
Understood. So another 400 crores of debt at around 8.5%. Even if I take that as 9%, that's around 40 crore of EBITDA shaved off in interest cost. That's broadly the take, right? That's how one should look at it. And therefore your profitability and so, okay, what does this 500 crore capex do to your top line? Give us that picture. For how long does this capex suffice, and what is the max top line you can do on the capex that you're undertaking?
See, in our business, the mobilization time for deploying any particular asset in a project is ranging from 4 to 8 months. And so whatever capex we do in a particular year would fairly start earning in next financial year. So the capex which we are planning in this financial year will definitely start earning probably in Q4 or in next financial year. And this capex will definitely add to a great amount contribution in our top line, and this would be additional to what we are envisaging as of now.
What would that top line be? Would it be 1500 crore? Can you give me a number?
See, in our business, generally 500 crores of capex would give you annual revenue of to the tune of 350 to 400 crore.
Understood.
And this particular assets have useful life of more than 20 years. So we can use these assets for 20 to 25 years.
Got it. And the 1,000 crore top line that you're guiding for in FY27, without this capex, can you do 1,000 crore, or what is the outlook with regard to that? Give us that color.
Yes, as I said before, this growth of FY26 and 27, we are envisaging on existing order book only. And for that, there is no need of any further capex. So 1,000 crore we can achieve without capex.
Understood. So if you do the capex, your top line can easily go from 1,000 to maybe 1,500, 14 to 1,500 crore, or 1,350 crore at the very least, 1,500 crore at the most. Am I right when I assume that?
Yeah, you can assume that.
Point taken. Okay. Sir, give us color on Kandla and Dolphin, the receivables as well as the inventory that you carried over there. You've provided a certain number. Any more provision which may be required, or any amount that you haven't provided for? That's my first part of my question. Second part of my question, is there any upside, which means will any of that money actually get realized or come back? Do you see that happening?
See, we have experience of acquiring now more than 3 companies from insolvency, and we have seen that we have been fairly able to recover their old receivables to the extent we can. And with regards to Kandla and Dolphin Shipping, we have already taken write-off of inventory which was not there in their books. So that has already been written off. With regards to receivables, we will give our best efforts to recover out of this old receivables of these targets. And we are quite hopeful that we can recover at least 25 to 30% of it in current financial year. Probably we'll give a try for next 2 years to recover, and then can take a decision.
Wow, that's amazing. So, sir, what was that receivables number? Give us that perspective. 250 crore is what you wrote off. But how much of that was inventory? How much was receivables?
So whatever we had written off was majority was inventory. Okay. We had written off almost 250 crore, of which 240 crores were inventory and 10 crores were receivables.
Got it. So, sir, on a 500 crore capex, if you're doing 350 crore at the very least in terms of top line at a 40% margin, right, that gives you a ROE of maybe 20%. How quickly do you get there? Because you're currently at 12.
See, in our return ratio, I would request you to evaluate in a way that there is one item of goodwill is lying in our balance sheet, which is a non-cash item of almost 400 crore. So while calculating any return ratio, one should exclude that part, because that is a non-cash goodwill, and we haven't paid anything to acquire that. And so to my mind, calculating correct return ratio, you should exclude that. So that will give you the correct picture of return ratio. And the existing return ratio which we are at would definitely tend to improve going forward, with an increase in top line as well as margins, because going further, we are expecting to improve on margin fronts as well.
Got your point, sir. Thank you so much. This is super insightful. You've been very, very candid with me. Thank you for that that conversation and that perspective that you've given to us and our viewers. But thank you, sir. But that's all the time we have, viewers. Thanks so much for tuning in to KYC. From myself and the whole team that puts the show together, thanks so much for watching.
They promised guaranteed returns. They advertised illegal trading in broad daylight. But NDTV Profit picked up the trail.
2 साल हो गए मैडम। डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We called, we questioned, we exposed.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
Because your money deserves protection, not empty promises. Easy money, hard lesson. Stay alert. Verify before you invest.
If you talk to anyone who lives in Bangalore, you talk about, hey, what is your biggest issue? Apart from their boyfriend, girlfriend, spouses, etc. They will say, oh, this is traffic. I hate this traffic.
You've had quite a journey through the whole startup maze, I would call it. You were in InMobi, you've worked on quite a few ideas, you've done the corporate bit with Citi, and then how did you land on the idea of Yulu?
During my journey with InMobi, I thought I would be retiring at the age of 40.
Retiring at the age of 40, okay.
And as I was approaching 40, I started thinking that what does it mean, and the idea was not going really well.
Sir, hota hai. When you have that hunger and that appetite, when it's no longer just about the money.
Yeah, it was actually never about the money. My journey when we started in InMobi office in that outer ring road area used to take close to 8 to 9 minutes from my home, and that started becoming 15 minutes, half an hour, sometimes 45 minutes. So I thought, maybe this is a problem I should be working with.
Give us the elevator pitch.
Sure.
What is Yulu and why is it important?
85% people in India do not have vehicle of their own. They don't have driving license. Other side of the business is now the gig worker. Today, from a revenue perspective, it is almost 90% plus.
जनता के पास सवाल ही सवाल है, जवाब ढूंढने को वो देखती है न्यूज और देखती है यहां तो सवालों का मायाजाल है। ऊपर से ये अलग फाइट है, कोई पूरा लेफ्ट तो कोई पूरा राइट है, बीच में मुद्दे के साथ कौन है, जनता को जवाब चाहिए। इसीलिए सवालों की परेड नहीं, मैं लाऊंगा खबरों की कचहरी। मैं शुभांकर मिश्रा, मेरे साथ देखिए कचहरी रात 8 बजे सिर्फ एनडीटीवी इंडिया पर।
Imports become the exception rather than the norm, and increasingly
A lot of responses said mind your own business, and a few even said ask for a referral.
He had certain circumstances which forced him to get into multiple contracts with different people.
Dual employment is fine in two circumstances.
You cannot justify something which is illegal.
During this period of time that you're working with me, you'll exclusively work with me.
You have to understand you're not the only one in this situation. If you cannot afford the premium, you most certainly cannot afford the
hospitalization, right?
The Soham Parekh story went viral for various reasons. But most importantly, it was the concept of moonlighting. Is it legal? And if it is legal, is it ethical? If you're a freelancer, there are a few important questions to ask. What is the right way to draw up a contract? One that is not unfair towards you, the professional, and the company. And if you are a professional, chances are that you're not receiving a regular income. How do you manage your financial goals and responsibilities? What are the right things to do financially in order of priority? This is MoneyWise on NDTV Profit, and I'm Alex Matthew. Joining me on this conversation is Ankita Ray, partner at Cyril Amarchand Mangaldas, and Harshvardhan Rungta, CFP Rungta Securities. Thank you so much to the both of you for joining in. I want to set the context for this conversation with the results of a poll that we did on social media, and I think that the results are quite interesting. We asked, do you think that moonlighting should be allowed? And very interestingly, the two responses that got the most votes are yes, always, and second, depends on the contract. The second question we asked was, have you ever had a secret hustle?
20% said yes, comma, thriving quietly. And the most responses, however, were thought about it. The third question we asked, if your team member had a side hustle, you would 1, support them, warn HR, mind your own business, and 3, ask for a referral. A lot of responses said mind your own business, and a few even said ask for a referral. So we got a few very interesting responses. It kind of gives you a sense of what people are thinking. But the most important question at the start of this conversation, and that's to you from a legal standpoint, is moonlighting legal?
So if you see, Indian law does not really define moonlighting, right? It's basically understood that in addition to your primary employment, if you have another job, or in the case of Soham Parekh, multiple jobs, right? Now the legal standpoint therefore has evolved by way of various case laws going up to the Supreme Court. And the position is pretty clear that moonlighting, or shall I say dual employment, because you know when you say moonlighting, there's always a connotation that it's without the knowledge of the employer. So the more legally acceptable term is dual employment, and dual employment is fine in 2 circumstances. 1, as long as your employment contract provides for it, and 2, if you have sought the prior approval of your employer. Right? Barring these 2 conditions, it is not supposed to be legal. Now, of course, we have to remember here that we are talking about an employer-employee relationship, right? Now, why is that important? We need to draw a distinction between the term employee and that of a consultant.
Or professional.
Or a professional, or
freelancer.
An independent contractor, freelancer, right? Now, when you talk about, say, an employee, you're on the rolls of a company. The company pays you a salary, makes your social security contributions. As opposed to that, if you're a freelancer or if you're a consultant, you are hired on a service contract, which means you're hired to do a particular service and you're given a fee in exchange of that. Right? Now, how that usually plays out is the contracts are quite different for both these categories of professionals. When we talk about, of course, moonlighting, you will see you're talking about an employment contract and someone having multiple employments, right? So that's the way we kind of approach it.
Okay, so we'll circle back to a couple of these things, and I've gotten my initial answer, is it legal or is it not? The answer I have gotten is that it depends. It depends on whether you're an employee and whether your employer knows.
Yeah.
1, and 2, if it's a contract. If it's a contract, if it's available as an option in your contract, then you can do that.
Yes, but even if you're not an employee, it depends on your contract.
Sure.
Right?
So we'll circle back to that type of contract. The question to you is, one of the things that Soham Parekh has said is that he was living hand to mouth. He had the need to go out and sign all of these multiple contracts. Now, I don't want to debate that. The point is that it draws to light the reason why a lot of people do this, which is that they have an urgent need for capital. They have an urgent need to generate more income. And that stems from the fact a lot of the times from not receiving money on an ongoing basis, Harsh. Is this the biggest challenge that a professional that is in this kind of scenario faces? The inability to have a regular income?
So, well, Alex, had 2 parts to this. The one is irrespective of what reasons you give. So, as in this case, where he said that he was hand to mouth, etc., he had certain circumstances which forced him to get into multiple contracts with different people. You cannot justify something which is illegal.
Yeah.
So there could be a situation, you cannot say that, look, I was in a financial problem, that is why I did this. Yeah. That does not exempt a person from doing something illegal.
Sure.
So that's the first part of it. Now come to what your second question was. Does being hand to mouth or not having sufficient cash flows instigate a person or motivate him to do something else? Well, if there is a survival, kind of a threat, then maybe that a person may look for any source that he can generate extra income. Now, Still, that does not justify, if I may say so. I mean, it's not fair if it's in your contract, as Ankita mentioned, if it's in your contract to be an exclusive engagement, if it's in your employee agreement for that matter. So then you cannot justify it by any means.
Sure.
Now, what do you do in such a case? So one, you have to understand you're not the only one in this situation who's trying to manage cash flows. So do not let these circumstances, hit onto your morale, where you're going to say that, or your moral for that matter, and to say that, okay, let me now do something which is illegal. Now, you have to very consciously, okay, it's easier said than done, but you have to very consciously, try and arrange your cash flows. You may approach your employer or that person whom you're working with for, say, advance payment for your services.
Sure.
Right, rather than do something which is illegal and that backfires upon you so badly.
Yeah. Okay. So that's the way to deal with a situation where you are hand to mouth. But beyond that, generally, and this is a general statement or a general question, would you agree that a lot of professionals face the problem of not having money when they need it? And so famine and fortune or famine and surplus is something that they're constantly dealing with, because there will be protracted periods of time when they're not earning, but then they get a bulk of their money. So cash flow is the biggest issue. Would you agree?
Absolutely, yes. So in fact, things have become better now. So in my own experience, we are dealing with our own clients. We have many freelancers and professionals who are now engaging with us. We constantly face this problem of sorting out their cash flows because they get money sometimes when they contract and when they execute a particular project, they get their funds immediately in their hand. And all the next payment cycle is almost a year or 6 months later. So for those 6 months, they're not going to have a salary kind of an inflow. So they have to manage their cash flows in that period with the lump sum that they already received. Now talk about merchant navy. Talk about all sailors who are in merchant navy. So they are by their employment contracts not working for 12 months.
Sure.
They work for like about 6, 7 months or 8 months, and they are on shore for the rest of the period, where they're not even engaged, where they're not even getting their salaries. So when you get money in that period of 6 to 8 months, now that money has to be surviving for 12 months at least. So these are very common circumstances. It's not something unusual for freelancers.
In your opinion then, from that perspective, before we dive deep into the way that contracts should be constructed, what in the order of priority, what are the steps that somebody in this situation needs to take? It's possible that a lot of people listening in are either starting down this path or contemplating it. So what are the things that you should strike off your list in order of priority?
So first and foremost, you have to be very clear and accept and acknowledge the fact that you will not have a steady cash flow. Many people whom we interact with, they're so positive in life, which you should be, but they're so positive in life saying that, okay, now I've got X amount of money in this quarter, say for example, let's go buy a fancy car. Next quarter, we'll look at it that time. We'll manage something. So this kind of a pushing your problems for the next quarter or the next year is not going to solve problems. So you need to be very conscious and aware that this is a payment that you received in this quarter and you may not have any cash flows for the next 2 to 3 quarters.
Yeah.
So you need to have enough provisions made for surviving during those periods where you don't have cash flows. So your basic expenses, so you first make an estimate of what are your basic expenses for your food, clothing, shelter. I mean, these things which you need to just pay off for sure. And that much amount you need to make sure that you've kept it aside. Now, anything over and above that you have, that you may think of, spending on discretionary items.
Sure.
Like you may want to upgrade a phone, whatever you want to do.
Or buy a car.
Or buy a car for that matter. So buying a car is again tricky because there's an EMI.
So I will circle back on insurance, for example, and sometimes in fact, if you have enough of an amount that you're receiving, the ability to pay yourself a salary, you can actually work that out. I'll circle back to that. But Ankita, I want to dive into the nature of these contracts. And here I'm specifically not talking about employee-employer relationship. I'm talking about consultants. So I'm talking about professionals that, as you pointed out, are on service contracts.
Right.
And there are various ways in which these are drawn up. I've heard of some novel ways in which these can be drawn up. When you're looking at such a contract, what are the things that are normally contained? And if you do want to stipulate that you want the freedom to take up additional sources of income, what should you look at as a professional in these contracts?
Right. So I understand we are approaching it more from the perspective of consultants.
Yes.
But I think the clause that we are looking at will remain the same whether it's an employee-employer contract or a consultancy, which is called the exclusivity contract. As the name suggests, it basically means that during this period of time that you're working with me, you'll exclusively work with me. Right? So the first thing that anybody who wants to do another job in addition to the one that is primary for them should look out for that exclusivity clause and what it says. Right? Now there are various ways in which it can be handled. Some clauses will say that okay, during your working hours you cannot work for anybody else, right? Some employers who want to be more sanguine about how this clause will play out, they will say that during the tenure of this agreement, right? So it's not working hours. It's as long as you're working for me, whatever the hours, you cannot work for anybody else.
Sure.
Now, these are very watertight clauses seen in employer-employee contracts. These are also now finding a mention in the consultancy agreements also. But this is where it helps when you speak to the service provider and have a dialogue with them. In cases, both parties can even negotiate to see the contours that they want to plan out. For example, it can be that, okay, you cannot work for certain of my competitors.
Sure.
Okay, but you can work for everybody else.
Right.
As we are increasingly seeing in some sectors, depending on the kind of talent or the lack thereof, if you want to hold on to people, some companies may actually be okay with you doing other jobs as long as you inform them, or in some cases take their prior approval. So these are the basic aspects that need to be looked at. I mean, recently we are also working with many employers, for that matter, in drawing up dual employment policy, because they also realize that, okay, we are fine with them having another source of income as long as our interests are not hampered in any manner.
So would you say, Ankita, from a legal standpoint, that it's becoming much easier for individuals to find work outside of the traditional sources, to say, for example, in the IT space, if you're coding for somebody, or in the content space, if you're writing for somebody, if you're ghostwriting for somebody, or if you're doing a voiceover, nobody's going to be able to point out and say, hey, or maybe voiceover if you're known well enough. But if you've written for somebody, nobody's going to be able to say, hey, you know what, I know you're writing, I know you wrote. So I guess employers from that perspective are becoming wiser to the fact that they need to get ahead of this problem, because people might just do this anyway. You saw the results of the poll, so you want to be a little more accommodative. Is that the perspective?
Yes and no. Depends on the sector largely, and again depends on whether that sector hires more of employees or more of independent contractors or consultants, right? Employers typically tend to be a bit more protective of their employees, and for obvious reasons, right? You are completely within the system of the company, you have access to their confidential information, etc. But you are right, they are thinking about it. We are seeing many employers actually thinking this idea that, as long as they tell me or take my approval and they are not with a competitor, I'm fine with them having a side hustle. That's fine.
And it can be social media as well, right? Because a lot of people are both social media influencers and professionals.
Correct. And in that kind of a situation, what also matters is the kind of information you're putting out there as a social media influencer.
Right.
Because nothing that you say should damage the reputation of my company, right? So that is also a valid reason that employers often have.
And people codify that?
Oh yes, they do. They do.
So give me an example. I mean, not with a company name, but how this would be drawn up.
That to say that if you're releasing any content, they have guidelines on the kind of content that you should not put out.
Sure.
For example, with the geopolitical times that we are living in, many employers are actually coming out with policies to say that please be careful about what you say about the geopolitical situation. Ideally, do not even go out there and make a statement
about it,
because you are our employee and that reflects
on the company,
on us. Right? So these are slight shifts that we are seeing. Now, of course, if we come to the space where a consultancy or a freelancer is the norm, then we see things to be slightly more relaxed.
A little looser, yeah.
But at the same time, companies are very careful about whether you're working with a competitor or not.
Sure.
And I'm sure there are valid interests, right, on both sides. Of the coin.
Yeah, it makes a lot of sense and very interesting conversation on the legal aspects of it. But Harsh, to circle back to that insurance, and you've said on conversations with me, even for the regular salary earning individual, you would put insurance in certain cases above even making an investment. It's the first thing that you suggest doing. And for somebody that's not earning a regular income, therefore it becomes much more important. So how do you go about this? Should all professionals have, for example, a term insurance if they have a dependent? Should they always have health insurance? How much cover do they have?
Yeah, so actually speaking, I mean, not only for people who have regular income, who have irregular income, every family should have adequate insurance in some form or the other. It could be life insurance. Health insurance is, of course, a must. But as you said, term insurance, is that mandatory? Well, it is mandatory for people who are earning members of the family and who have financial dependence on them. So if there is somebody in your family who's dependent financially upon you, it is your responsibility to ensure that if anything were to happen to you, there is an emotional loss to the family that cannot be replaced. But if there is a financial loss, there is a provision, there is a product that helps you replace yourself financially for your family. So it's a question you need to ask yourself. You love your family until you are alive, or you love your family until they are alive. Okay, so you may not be around, but your family still needs those requirements, financial requirements, which needs to be solved. So many of the times we believe that those people who in employment have a belief that because we are insured by our employers, we don't need to buy independent covers for ourselves.
Health insurance, right?
Yeah, so that's not true. So you just need to make sure that you are independently covered for yourself. It could be your term insurance, which is life cover. Now, health insurance is a very, very important, cover to buy, especially in case you have irregular income. So I'm saying it is a necessity for everybody, but
even more
so for people who have irregular income. Now, let me highlight this with an example. Now, if you are a person who's on contract and you make your money only in certain periods of the year, and if there was any kind of a health issue where you or any of your family members were to be hospitalized, and all that savings that you had or all that income that you generated goes into paying for that health treatment, then what happens? Right? So everything that you've done till now can completely be exhausted only with one hospitalization. Now, health insurance in that context becomes the most important cover to buy, and adequate health insurance, not just health insurance.
Okay,
so just make sure that, and many of some people come back to me and say, look, medical premiums have gone up exponentially. I cannot afford it. Should I not pay for it and not take a cover? The only statement that I would make in all such cases is, if you cannot afford the premium, you most certainly cannot afford the treatment.
Hospitalization, right?
Yeah, so non-affordability of premium is the smallest problem that you have. Imagine if there was a hospitalization, you would most certainly not be able to afford the treatment cost.
So, and the second part of what I wanted to ask you was, can you pay yourself a salary? And there are ways in which you put a lump sum in a particular product. And in the mutual fund space, for example, you can do a systematic withdrawal plan if you set something up like that. Is that a feasible approach to have?
Of course. So what we're talking about is ensuring a regular cash flow, because our expenses are going to come month on month, right? So if I have money in my bank account, and this is usually what we do, so I can narrate that and illustrate that as well. So if there is a freelancer who earns in, say, particular in the first quarter, say for example, and we know in visibility that next 2 quarters there is no regular income because they're working on certain projects, and once the completion of the project happens, then they will be paid. So if you earned in the first quarter, for example, you park that money out, get it out of your bank account, because if it lies in your bank account, then it's usually seen as a habit that you tend to spend it. But if you're taking one step, you create one leg of this transaction, which is you park that money in somewhere else. It could be mutual funds, it could be anywhere else. In some cases, we have another bank account in which it is transferred. So let's not get into the details of where it is transferred, but let's just put one wall in between you and you're spending that money.
Sure.
Now you know that whatever expenses that you're incurring in this month, you have money in your bank account. Now something that is going to happen next month, might as well come into your bank account in the next month. So that is where the SWP works. That you set up a systematic withdrawal plan and you say that I want the next tranche of redemption to be done only on the first of the next month. So it works like a salary for you.
Yes.
Though you're paying yourself, in the words that you used, you're paying yourself, just ensuring I get the money when I need it, rather than keep it in my bank account and restrict myself from accessing it.
I do want to ask about escalation of cost. Of course, from the perspective of the employer, but from the perspective of the professional, you're talking about being remunerated for the work that you're doing. In your opinion, are these getting more common, or should there be conversations once again between the company or the employer and the individual to work that into a contract, to say that you have regular escalations for the amount that you're being remunerated for example, being paid for the work that you do? I met an interesting individual who has a credit-based system, for example. He has his defined amount of work, and beyond that, anything that is done is, say I give you 10 credits for the year, each activity is 1 credit, and beyond those 10 credits, you pay me as per the credit basis. So you can have novel contracts as well.
Oh, absolutely. But, this is not common, or I would say even required that much in a employer-employee situation, right? Because you're getting a regular salary, you have your scope of work, there are year-on-year increments, your bonuses. This all forms part of your company policies, which is a part of your contract, right? But yes, it is relevant when we are looking at freelance contracts or consultancy contracts, like we discussed right up, that these are very project based or service based contracts, right? So to have a clear idea of which project it is, what are you required to do under it, and how much will you get paid for it, and what happens thereafter, or if there's any additional scope of work. Yes, we are seeing contracts being drawn out in a more expanded fashion, taking into account these contingencies as well.
Okay. And we're rounding out the conversation now. Oftentimes, and I've spoken to a few professionals, this is not really a widespread feedback that I've gotten, but anecdotal evidence, they don't really stop working, right? They continue working for as long as they can. They don't have a stop at 60, especially if they're doing a service. But how do you plan for when you stop working? That regular SIP becomes a problem. Is there a workaround?
So, well, Alex, the point is, ideally, every human should work until they are physically able to work. Because there's no point sitting at home at any point in time. I mean, it doesn't work well for your mind. It doesn't work well for yourself in any case. So how do you keep yourself engaged, whether professionally, whether productively, or whether it's social work? Okay, so you need to keep yourself occupied. The question is, how do you manage your cash flows? That is the very specific area that we're talking about. You need to be sure that post-retirement or post-working life, nobody's going to pay you anything.
Sure.
So you need to have adequate provisions and reserves made so that you can survive with dignity for the rest of your life. You don't want to go, asking for financial support from your children or from your relatives, because you've been supporting them all your life. Imagine a situation post-retirement, you have to be dependent on your children for funding yourself. I mean, if given a situation, let's not walk into that, right? So plan well in advance so that you have enough reserves where you can live your life with dignity until you're alive.
Fantastic.
Okay. Now, just one point on, if you'd be interested to know, what is that line that you draw in terms of ethics with work, right? Yeah. So I have a very interesting example that I just recalled, if you permit me.
Of course, please.
Okay, so I hired a cab once for the entire day. Okay, and the driver who was driving me around, the cab did not belong. He did not own that cab. He was only driving for the day. Now, every stop that I took, and when I came back, I saw him cleaning the car every time. The taxi, he was cleaning that every time. So out of curiosity, I just asked him, because you're only driving it for the day. In the evening, you're supposed to return it back to the owner. Then every time that you're dropping me somewhere, I come back, you're cleaning the car. It's like an OCD kind of a problem or something else? He made a very interesting statement to me. He said, this is the car because of which I earn a living. Though it does not belong to me, I don't own it. But I'm just out of respect making sure that the source of my income needs to be respected and taken care of. So now coming to whether moonlighting can be legally organized in contracts, otherwise, I think anybody working for anybody in fiduciary responsibility to anybody just needs to ensure, if this is the source of income for me, how morally right can I be to that organization or that person or that client, so that I don't violate my own moral ethics, not to do with what is there on contract. You can have everything written and still do things. You can have nothing written and still do it correctly.
On that beautiful note, thank you so much to the both of you for taking the time. It's been an insightful conversation. And that brings us to the end of this edition of MoneyWise. It's been an absolute pleasure bringing it to you. Let us know what you think about moonlighting and otherwise, and do stay tuned. Lots more coming up on NDTV Profit.
Brought to you by Canara Bank. Together we can.
Sir, try berry pulao. Too good. Good, no? Hey, why are you giving him such looks? Ignore tips and use your own mind before you order. Lots of people give unsolicited stock tips. They can be dangerous. Study the company and the risk associated. Invest only after analysis.
सोच कर, समझ कर, invest कर.
Fresh air. The roof, but different. The grill, but different. The alloys, but different. The seats, but different. Different is in the XUV 3XO Rev X series, starting at ₹8.94 lakh.
जानते हैं क्यों पूरा इंडिया सिर्फ एनडीटीवी देखता है?
क्योंकि सही खबरें और सही इरादों की मिसाल है एनडीटीवी।
ठीक ऐसे इरादों की कहानी है हमारी मूवी तन्वी द ग्रेट।
पापा used to call me
तन्वी द ग्रेट
रिलीज हो रही है 18 जुलाई को मूवी थिएटर्स में।
और फिल्म से जुड़ी हर अपडेट सिर्फ एनडीटीवी पर और वेबसाइट पर।
कैश कम है, विड्रॉ करना पड़ेगा।
ट्राई एसबीआई डोर स्टेप बैंकिंग, कन्वीनियंट है। बैंक आएगा, करेगा कैश डिलीवर, टिक। टीडीएस सर्टिफिकेट, टिक टिक। अकाउंट स्टेटमेंट, टिक टिक टिक। हैट्रिक। सबको पता है एसबीआई डोर स्टेप बैंकिंग कन्वीनियंट है, सबको पता है।
Well, hello and welcome back to NDTV Profit. We're now in conversation with the management of Wipro post their Q1 earnings. We're now joined by Mr. Srini Palia, who's the MD and CEO of the company, Mr. Aparna Iyer, the CFO, as well as Saurabh Gobil, who is the CHRO. Gentlemen and ladies, thanks so much for joining in today. Largely, one of the key aspects of the results and something that I came across was vendor consolidation that all of you spoke about, in the press conference as well yesterday. In this aspect, what has been one of the key aspects to have several large deals as well as look at vendor consolidation as a theme? And what do you think, according to you, has been Wipro's strength in this aspect when the macro environment is so uncertain to actually be a biggest beneficiary of vendor consolidation? Because traditionally there has been some kind of weakness in that for Wipro, but with you coming in over the last year, what has changed which has benefited you specifically in vendor consolidation to start with?
So, Puneet, if you look at it, we called out consulting-led AI-powered Wipro. I think that's a strategy that we have adopted last year. Having said that, if you look at the mega deal wins that we've won, 2 of them were in the banking financial services and 1 of them was in the technology and communication. So what mattered to us and what mattered to the client is our understanding of their landscape, our understanding of their business, our understanding of where they want to go with the technology trends that's happening, especially with AI. So we brought in the consulting aspect of it, we brought the domain aspect of it, and more importantly, the solution is based on how the client was looking at and how they wanted to implement going forward. So all these factors really helped. Of course, our long-term partnership with them and the way we have delivered as well.
Well, the other one was deal wins, because we've seen that as one of the strengths in this quarter as well. Last quarter you had the Phoenix deal win, a large one. This one again, 16 large deal wins in this particular quarter. But in the last year also you had $5 billion of deal wins, but that kind of translation into the financials, if has not happened, or maybe it's going to happen and we're going to see that in the next couple of quarters. What factors do either of you see as that of those deals which you won last year? Because these ones are going to, of course, take some time, 4 to 6 quarters to come into numbers. Of the last 2 years, your deal wins actually has been very strong. But so what could be one of the key reasons where you're seeing those deals also take some time to ramp up to reflect in these near-term numbers that we've seen?
I think your question has some of the answers that I was looking for, Puneet. So number one is you talked about the Phoenix deal, right? While we announced it in Q4, we'll start executing that in Q3 because there's a lot of planning phase that happens. Also, some of the deals that we won now, it may take a quarter for us to ramp up and get to execution mode. Having said that, there are certain changes that happened, which I talked about in the last quarter results, wherein some of the large transformation programs the client actually put on hold because of the situations that they went through tariffs, and that was specifically in certain industry segment, which was around consumer and energy and EMR sectors. I think once those come back, once a situation certainty comes back, hopefully those transformation programs will kick in. But having said that, most important for us now are the deals that we have won. How do we execute on day one, and how do we deliver the value for the clients that we are committed to them?
So you had some deal wins in this particular quarter also in the weaker segments, first to say the retail, the consumer. Has that largely been shifted to cost takeouts or some new features that the client wants specifically? Has that change now happened?
Yeah. So if you look at our deal wins, there are a combination of both cost optimization, vendor consolidation. There are also some of the new programs that they want to start. For example, Aparna talked about the B2C opportunity, right? They want to see change the customer experience, especially the digital customer experience. So that's a new project or a program that particular retailer is starting to take off. Second, there are certain areas of the back office that they want to actually bring in agentic AI and transform their business process so that they get in the velocity and productivity and experience for their end customers as well. So it's a combination of both, Puneet.
And the one aspect also was the capex of IT companies. You've had a new dividend policy earlier this year, 70% distribution over the next 3 years of profit. So how does that align with your capex which you have to do on new technology? Essentially, or the incremental capital which you say, and in finance we love to throw the term of sales to assets. Essentially, how will that? I'm sure that won't take a backseat, but how will that transform over the next few years, maybe 3 years, since you have the dividend policy for that aspect, in terms of going into new areas, and what is the strategy for that?
Maybe Aparna, if you could.
Yeah, so we do have, even as we started the fiscal year, we're about $6.2 billion of gross cash. That has only improved in the first 3 months already. We had been generating consistently about 120% and upwards north of that in terms of net income. So cash flow generation has been robust, and we expect it to be robust even going forward. And we starting off on a very, very solid base of cash on the balance sheet, and that gave us the confidence to increase our capital allocation. And even while we've increased it, we made sure we have enough of a war chest to pursue both organic and inorganic investments. We feel very, very confident that we will be able to support this increased capital allocation and meet the strategic needs of the business.
So how long could you, now if there's a timeline, but how long do you think your new investment today, $1 invested today in new technology, how long do you think that will take into conversions of either a deal win or in your financials? Has that gotten longer? Or
I think those cycles have actually got much shorter, especially from a technology standpoint. Technology cycles are getting extremely quick. We started with generative AI and then it became agentic AI, and now there's going to be, I'm sure, the next big one that will come through. So I do think that these investments that we make are very here and now and pay off here and now. And that's been the nature of how IT services has worked, and we just expect it to get faster and faster.
No, just taking a long-term view, and if you all three of you can comment on this, because during Y2K we did see coding as one of the key expertise for which IT companies wanted that kind of talent, and we saw a lot of regional hubs within India created across states where coding became such an important thing, and that kind of went into the 2010s itself. Last 20 years has been that. My question largely is that with AI you might not see that case anymore of coding, or it has transformed in that role. So what do you actually see right now in an ideal employee when you're hiring? Because Gen AI and everything is changing so quickly, so you won't find that employee who will know everything about that, because it might be old in 3 months. So what are you looking at in an ideal employee, and if what from each one of your perspectives?
Sure. Maybe I'll take the first business. Saurabh can add to that. If you look at the way the world is, the programming world is changing for the engineer, right? Earlier it was about pure play coding. Now we're talking about prompt engineering. But what is important when you get into prompt engineering is understanding the business context, right? And only then you can prompt the right one, right? So the way I see it is the new hires that we have, their understanding of the business landscape, understanding how the data works, and then how you implement the AI. I think that aspects become more important in addition to basic programming language. And please understand, when you're doing a coding, the tools can do so much in code generation, so much in testing, so much in deployment. The human involvement could be there, because when you're getting into production environment, you have to be extremely careful how that the application will happen, and how do you monitor that. So there are definitely certain tasks that can be automated, but there will be very important tasks in the context of the business, prompt engineering, and so on and so forth, that an individual must have.
And if I look at it, apart from the technical skills, today is anyone who wants to become part of us or anywhere, two aspects come out very clearly. One is learnability. Given the changes happening in the macro environment and in the technology landscape, how quickly people are able to learn. I think that's a very key aspect which we try to look at it. Communication. How do you? Srini spoke about understanding business. You have to work with the clients. You might be extremely good in your technical knowledge, but how are you able to communicate to the people? I think all these things come together, when you're looking at a person. And the last point I'm saying is that we are still not there. We still need people who understand basic language skills also, because there is coding happening right now. 100% is not AI driven. But we are evolving as we move forward. But these tenets would continue as we look at people.
Just final couple of questions on, the fresh hirings has been one of the key aspects you mentioned before, 10,000 new fresh hires you want to do it this year. But the net headcount addition number, when I see over the last 3 quarters and remove the quarterly aspect, it's not been that in terms of, addition. And now with Srini coming in over the last year, what is the strategy over the medium term, if not numbers? With fresh hires coming in, you will be looking at new verticals from the clients that you want to challenge, and you need that people. So what would be the net headcount addition be in the medium term?
So I think if you look at headcount, it's a function of the entire people supply chain. There is how much we hire, how many people are attriting, what is the bench. And I think if you put all these 3 things together is what we need to look at it when you look at headcount number. Today, if I look at, we have a good bench. Our utilizations, while for the quarter has gone up, for the year-on-year we are down, and we think we have had space to improve. We are looking at hiring attrition which is flattish to So if you keep all we will continue to hire depending on demand, depending on requirement. We have won some large deals. We need to make sure we execute on them. We deploy people. We have in fact, utilization has come down because we are keeping people ready for those big deals. So we will hire depending on the demand, both from campuses as well as experienced people. But it will keep changing as we move forward over the business scenario. That's how we look at it.
Well, one final question, in terms of margins, because we've seen some impact this quarter, but again, over the last 8 to 12 quarters, we've seen a strategic increase from 15 to 17%, and this quarter has been the first where we've seen some impact on that. Do you think that for this year, the margin, you will try to manage the margins in a difficult environment, while on the medium term, the 17% margin to 18% margin is the target for Wipro going forward?
We've, like you rightly said, over the last 8 quarters, we've shown a lot of strength in the fact that we can improve margins. Right now, we are very, very focused on converting some of the deals that we've booked. We're very excited about the bookings we've had. This will translate to a good potential in the quarters to come. And, converting those deals into revenues will need upfront investments. We've spoken about how some of these are vendor consolidation wins, which are, by nature of it is very, very strongly contested. And, clients do want a share of the savings, right? So in some sense, there are pressure on costs as well, as we start. But, we go back to what we have done in the last 8 quarters. We will continue to put those levers at play and offset some of these pressures. I'm not calling out a band at the moment. We're very, very excited about the deals that we've secured. We're focused on better growth.
Well, gentlemen, thanks so much for joining and giving us perspective on a whole host of topics apart from the recent quarter. We wish you the best and look forward to our next conversation.
Thank you, Puneet.
Thank you.
Thanks for tuning in to Talking Point Unfiltered. And my guest today is Ravi Dharamshi of ValueQuest. And the idea of doing the conversation with Ravi, as I told him as well, was to try and understand that how do large investors think of mega trends? And how do they chase these mega trends? How do they diversify their portfolio between 4 or 5 concurrent mega trends that they might be seeing at any given point of time? Ravi, such a pleasure having you here.
Thanks, Neeraj. It's my pleasure to be here.
So, you've always spoken about these mega trends all through the times that we've spoken. Back from 2015-16 when I first started talking to you, when I think we were in the midst of the chemical mega trend, if you will, and the pharma mega trend, you kind of try to identify some of these and then maybe invest early in them and then ride the whole wave till you can. Would that be a good summary of one basic investing style?
So let me try and explain a bit with a little bit more nuance and a little bit more in detail. See, in any particular industry, there are phases, right? You have a tough phase, struggle phase, then you hit that inflection point, you have the great growth phase, and then you reach a kind of a plateau, then again you have a growth phase. Idea for us is to identify which that growth phase is. Everybody can name a lot of mega trends today, but even within a mega trend, you make money only when you are invested in that particular growth phase. And for that, you need to be very clear in your mind what stage that particular mega trend is. And there are markers that we keep track of, whether it is the technology curve, the cost curve, behavioral shifts, regulatory shifts, capital flow, talent flow. All these things tell us which way the wind is blowing, how strong that wind is. Is the mass adoption reached that kind of an inflection phase? Are we going to see a J-curve kind of a growth phase? If yes, then that is the phase in which the maximum value creation tends to happen. And that is what we want to capitalize on. A mega trend can last 20 years, 30 years, 50 years, but the phase of making money might not last that long. That might be a 5, 7, 10-year phase. And that is what we want to capitalize on. I hope that's a small nuance that I had about investing in megatrends.
No, it is a good one, but just trying to probe that a bit. So this would be different for different industries, right? The growth phase, if you will, because I read a chart in your presentation that there is a start phase, a growth phase, and a scale phase, if I'm not wrong. So for every industry, its growth phase would be different.
Absolutely, absolutely.
In terms of the timing.
Oh yeah, for sure. In terms of the timing, in terms of the duration, in terms of what kind of delta we can see, how much of that value can actually be captured by the participant, everything differs from one trend to another, one industry to another industry. And one trend can spawn many sectors also. It is not restricted to one sector. And for example, we have spoken a lot about energy transition, but it is actually a trend that encompasses 15-20 different sectors. It is not restricted only to solar. Solar might be the biggest, but there is power transmission, there is biofuels, there is nuclear, there is hydrogen. So many other sectors are also part of the energy transition, and not every sector hits that inflection point at the same time. Solar probably has hit that inflection point 3, 4, 5 years back. Nuclear is probably some time away in terms of hitting that inflection point. So you need to be able to identify that inflection point within a mega trend to be able to write that extraordinary growth phase where the value creation tends to happen.
What are the markers for this growth phase? I mean, are there common markers which people can take kind of?
No, so let's go one by one. I already mentioned them, but let's say technology curve. So for example, lithium ion battery technology has hit that inflection point 3-4 years back, and it is expanding it is getting adopted very, very quickly. However, there is a competing technology called sodium ion technology. Now the problem with lithium is that lithium is short in supply, and we might not have it in our country. So then you might still end up being facing the same problems that you face with fossil fuels, that you are at the mercy of some other nations who will, whether they will supply or not, like it is happening in the case of rare earth elements right now. Now sodium ion is freely available, but that technology has not reached that inflection point because the lithium ion by nature tends to be very dense. Sodium ion is not that dense. If it is not that dense, then you need more of the material to produce the same unit of power. And for that means maybe the size of the battery expands. So if that is the case, then the applications will be different. It might not be applicable in a transportation kind of a thing, but more stationary kind of application might be there for sodium ion. So where are we on the technology curve? Then where are we on the cost curve? It is not only about technology. Nuclear might be a mature technology, or solar, for example, is a 70-year-old technology, but it hit that cost inflection point few years back when China mass adopted it. And once China mass adopted it, the prices crashed. And when prices crashed, that's when the mass adoption everywhere else in the world has begun. So along with the technology, you need to hit that point in cost also. Then regulatory tailwinds need to be in favor. Governments need to be supporting that, no, we are going to adopt this particular technology and we are going to incentivize the user industry to deploy that. Then you need to see the money flowing in, that people deploying the money need to be able to see the IRRs, and if they can see IRR, that's when the money will flow into it, and that's how everybody will plan their capex and their capacities according to the opportunity. So a confluence of a lot of things need to happen for you to say that this particular technology has reached the takeoff stage and now money can be deployed. From primarily a listed market investor's point of view, investing in something that is 10-20 years out is not a prerogative. We don't invest in something that is loss making or not reach that kind of an inflection point. So we have a very time limited view of these trends. In next 5 years, which are the technologies which will hit that inflection point where we can make good money, and that is how we narrow down our focus.
Got it. Okay. So So, okay, so by the way, viewers, we've done a very exhaustive conversation with Ravi and his colleagues on the energy transition piece. So I'm not going to spend so much time on this episode talking about energy transition as much as I thought we'll talk about 2 other themes and 2 other mega trends and try and take Ravi's understanding of those mega trends and want to understand whether the technology markers or other markers, if permissible in these industries, how do they suit or how do they fit in? So let's talk about financials and a particular subset of financials, Ravi. You've been selectively constructive in that bucket. 2025 has marked a new Reserve Bank of India, and people are very constructive on NBFCs. But I remember a conversation with you wherein you spoke about how the non-lending financials, and particularly the capital marketplace, is a mega trend that people should have caught ideally early, but maybe right now, is it too late to latch onto it, or is it still in the early cycles?
So definitely we are not at the beginning of it, but at the same time I don't think we are at the end of it also. I think this particular trend has a long way to run, and we will see a lot many more players emerging out of here. And case in point, my own firm, which is an AMC, right? We might see a lot of AMCs. We are witnessing one of the first private equity, pure play private equity player filing for DRHP, and they might get listed. Tomorrow there will be other alternate asset managers that will also get listed. And I think this is still the beginning of the trend. But let me dial back. What are the drivers of this trend? Number one, India is getting formalized. India used to have a huge informal economy. With the advent of GST, with the informal sources becoming less and less because we are going towards cashless, less cash economy, let me put it that way. So the avenues for the cash deployment are going down and down, and that means you have to go through the formal channels in terms of borrowing or lending or doing any kind of business transaction. So formalization is underway. Second trend is the financialization is underway. And when I say financialization, essentially India used to be a 35% savings economy. We have dropped to being at 25% savings. 25% of the GDP is what we save, but 25% is also a huge number when you put it in context with some of the developed nations. They barely save. So of that 25% bucket, large part of it used to go towards real estate, gold, nothing against that. But as you create more and more wealth, it's only so much real estate that you can handle, and it's only so much gold that you can have. All these, the billionaires and the wealth family offices that have come up in the last 5 years, they are not incrementally going to buy more and more real estate or more and more of gold. So they naturally are gravitating more towards financial assets. Now it might be so that some people might prefer alternate assets, some people might prefer mutual funds, some people might want to invest overseas, but that's fine. Incrementally the money is going more towards the financial assets. So one is the formalization, second is the financialization. So any financial product which is fee based will see a big tailwind over the course of the next 10-20 years. In some way, this is a moment you can compare with the 1980s in US, where in their what is it called, 401k. They were allowed to invest in equities, and that trend caught up, and it became bigger and bigger portion of the American public's portfolio. And I think it went from some less than 10% to more than 40-50% kind of a number in a 20-year time horizon. I think we are in year 4 or 5 of this. The way we have seen the money come into equities, and particularly in SIPs and mutual fund, is, I believe, a beginning of a trend. For a long period, since say 2008 till 2020, almost a 12-13 year period, we did not see that pie grow at all. Markets were more driven by foreign flows rather than by domestic flows. But because of allowing EPFO money, because of more money getting into the financial channels and into the market, now we have enough pools of capital domestically to be the main driver of this whole trend. And I think this is still the beginning. So any business that is in and around the capital markets, it could be bond markets for all you know, but in and around the capital markets should do well over a 10-20 year period. And of course, like any other industry, we will also have our cycles, and there will be consolidation also at some point of time. Right now it is all very fragmented because the numbers are large. More and more people. In fact, we are going to witness one of the largest top 3 players in the AMC industry getting listed. If this is the beginning of the trend and the player is still getting listed, I mean, I'm sure the trend is not over. But of course, it doesn't mean you will make money necessarily from the next 1-2 years perspective. You have to have a slightly larger perspective over there, is what I feel.
Fabulous show, Ravi. Thank you so much for this one today. Lovely conversation. And imagine, viewers, what a conversation the defense and the aerospace one promises to be. I look forward to doing that, and I'm sure you all look forward to tuning in for that. But thanks so much for tuning in today. And Ravi, once again, thank you so much.
Thank you so much for having me.
They promised guaranteed returns. They advertised illegal trading in broad daylight. But NDTV Profit picked up the trail.
2 साल हो गए मैडम। डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We called, we questioned, we exposed.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
Because your money deserves protection, not empty promises. Easy money, hard lesson. Stay alert. Verify before you invest.
If you talk to anyone who lives in Bangalore, you talk about, hey, what is your biggest issue? Apart from their boyfriend, girlfriend, spouses, etc., they will say, oh, this is traffic. I hate this traffic.
You've had quite a journey through the whole startup maze, I would call it. You were in InMobi, you've worked on quite a few ideas, you've done the corporate bit with Citi, and then how did you land on the idea of Yulu?
During my journey with InMobi, I thought I would be retiring at the age of 40.
Retiring at the age of 40, okay.
And as I was approaching 40, started thinking that what does it mean, and the idea was not going really well.
Sir, hota hai. When you have that hunger and that appetite, when it's no longer just about the money.
Yeah, it was actually never about the money. My journey when we started in InMobi office in that outer ring road area used to take close to 8 to 9 minutes from my home, and that if you talk to anyone who lives in Bangalore, you talk about, hey, what is your biggest issue? Apart from their boyfriend, girlfriend, spouses, etc., they will say, oh, this is traffic. I hate this traffic.
You've had quite a journey through the whole startup maze, I would call it. You were in InMobi, you've worked on quite a few ideas, you've done the corporate bit with Citi, and then how did you land on the idea of Yulu?
During my journey with InMobi, I thought I would be retiring at the age of 40.
Retiring at the age of 40, okay.
And as I was approaching 40, started thinking that what does it mean, and the idea was not going really well.
Sir, hota hai. When you have that hunger and that appetite, when it's no longer just about the money.
Yeah, it was actually never about the money. My journey when we started in InMobi office in that outer ring road area used to take close to 8 to 9 minutes from my home, and that started becoming 15 minutes, half an hour, sometimes 45 minutes. So I thought, maybe this is a problem I should be working with.
Give us the elevator pitch.
Sure.
What is Yulu and why is it important?
85% people in India do not have vehicle of their own. They don't have driving license. Other side of the business is now the gig worker. Today, from a revenue perspective, it is almost 90% plus.
Urban mobility. It seems like a no-brainer. When you have so many people in the larger cities in India struggling in traffic, pollution issues, the idea of a company that helps people travel in an eco-friendly way seems like an idea that was waiting to happen. Yet, nearly 8 years later, Yulu is one of the few companies, or perhaps the only one, that is actually in this space. So, why this idea and how will this be causing a disruption? To speak on this, I'm pleased to invite Amit Gupta to the episode today. Amit, thank you so much for being here with us.
Thank you, Tamanna. It's a pleasure to be with you in this show.
Okay, tell me about the idea of Yulu, because you've had quite a journey through the whole startup maze, I would call it. You were in InMobi, you've worked on quite a few